Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
News when you want it with Bloomberg News Now. I'm Doug Krisner. The White House is defending the Pentagon's handling of a September attack on an alleged drug-running boat. The administration is also denying that Defense Secretary Pete Hegseth had given the order to kill everyone on board. And at the same time, congressional lawmakers from both parties have launched reviews of these strikes. Here is Tim Burchett, Republican congressman from Tennessee.
I'm sure we'll have multiple hearings on this, but as usual, Congress under either party doesn't do a whole heck of a lot. We'll probably write somebody a strong letter, and we'll bring some people in, and both sides will pair up against each other. But the reality is Congress isn't going to do anything.
That is Tim Burchett, Republican congressman from Tennessee. In Hong Kong, authorities say they found the deadly fire at an apartment complex was accelerated by cheaper substandard netting used by workers to evade government testing. Police and the Independent Commission Against Corruption have so far arrested 13 people in connection with the fire. Hong Kong Chief Executive John Lee says an independent committee will be established to investigate the cause of the fire.
We will make sure that those who are responsible will have to bear the legal responsibility. I ask for a thorough investigation, and we should turn our anger and sorrow into power of reform. We have to hold those responsible accountable. We have to expose the truth. We have to do everyone justice. We have to make sure that the deceased can rest in peace and that we can give a peace of mind to those who survive.
That was John Lee, Hong Kong's chief executive. The death toll from this fire has risen to 151. U.S. Special Envoy Steve Witkoff, together with President Trump's son-in-law Jared Kushner, are set to be in Moscow this week to iron out a peace deal to end Russia's war in Ukraine. Now, yesterday, American and Ukrainian officials met in Florida. U.S. Secretary of State Marco Rubio said talks were productive, but he said more work needs to be done. We got some perspective from retired Lieutenant Colonel Alexander Vidman.
I've never seen anything quite so chaotic as this iterative process to attempt a peace negotiation. Sometimes it looks reminiscent of shuttle diplomacy. You got some statesmen going between Moscow and Kiev or other capitals. But what you don't have, and what's evident and present in this one, is you don't have folks that have no competence negotiating, folks that don't actually have a formal role in government like Jared Kushner.
That was retired Lieutenant Colonel Alexander Vidman. Netflix has made a mostly cash offer for Warner Brothers Discovery in a second round of bidding. We are told Netflix is working on a bridge loan that totals tens of billions of dollars. Here is Bloomberg's Chris Palmieri.
Yeah, we definitely are hearing that they're edging a little bit closer to that $30 number, depending on how you value things. Big surprise here that we reported was that the Netflix offer is mostly cash, because Netflix's stock has been doing terrific in recent years. A lot of people expected them to use that as the currency, and apparently they feel more confident paying cash.
That was Bloomberg's Chris Palmieri. Now, Paramount, Skydance, and Comcast are also making bids, and we are told their bankers worked on improved offers over the Thanksgiving weekend. Now, Netflix and Comcast are only interested in the Warner Brothers Studio and the HBO Max streaming service. By the way, these offers are binding, and that means the board of Warner Brothers is in a position to sign off on a deal quickly if its goals are met. Nvidia has invested $2 billion in the chip design software maker Synopsys. This is part of a broader engineering and design tie-up aimed at infusing Nvidia's AI computing technology into more industries. Now, the companies will be deploying AI agents. They will also work on joint marketing. Here is Nvidia CEO Jensen Huang.
I recognize that none of this is exclusive. Synopsys has a lot of chip partnerships they're going to continue to nurture and continue to advance. Nvidia has a lot of partnerships with Cadence and Siemens and Dassault that we're going to continue to nurture and advance.
That was Nvidia CEO Jensen Huang. Shares in Nvidia were up 1.6% in the regular session. The results of President Trump's MRI have been released. The White House says the president received a preventative MRI of his heart and abdomen, and the images showed normal organ functioning. Here is Press Secretary Caroline Leavitt.
President Trump's cardiovascular imaging was perfectly normal. No evidence of arterial narrowing impairing blood flow or abnormalities in the heart or major vessels. The heart chambers are normal in size, the vessel walls appear smooth and healthy, and there are no signs of inflammation or clotting. Overall, his cardiovascular system shows excellent health.
That was White House Press Secretary Caroline Leavitt. The UK will adopt a more pro-business approach to China. Even so, the British government is saying it will not trade its national security for deeper ties on trade. That's according to British Prime Minister Keir Starmer. In his annual speech on foreign policy, Starmer said his government will focus on the relationship with China.
I am clear that no transformation today carries greater consequence than the rise of China. It is a nation of immense scale, ambition and ingenuity, a defining force in technology, in trade and global governance. So our response will not be driven by fear, nor softened by illusion. It will be grounded in strength, clarity and sober realism.
That was British Prime Minister Keir Starmer. A significant winter storm is set to bring heavy snowfall to a large section of the U.S. Northeast. The heaviest is expected to hit upstate New York and parts of Massachusetts through Maine, where more than a foot of snow may fall overnight into Tuesday. The storm is expected to move quickly through the region and should be gone by Wednesday. And that is News When You Want It with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
This is Caroline Hyde.
And I'm Ed Ludlow, inviting you to join us for Bloomberg Tech, a daily podcast focusing exclusively on technology, innovation, and the future of business.
Every weekday, we bring you the top headlines from the world's biggest tech companies.
From finance to defense, AI to entertainment, and from startups to the Magnificent Seven.
We highlight the latest stories of the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets.
We do this all every weekday, then bring you the most important conversations and analysis in our podcast.
Search for Bloomberg Tech on YouTube, Apple, Spotify, or anywhere else you listen.
Join us every afternoon on your commute home and stay ahead of the tech news cycle.
That's the Bloomberg Tech Podcast. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Subscribe today, wherever you get your podcasts.
Hello, I'm Caroline Hepker, introducing you to the new Stock Movers report from Bloomberg. There are so many big names in equities to keep track of, and our Stock Movers report is the best way to find out which individual names are making the biggest moves every day. Stock Movers consists of short audio reports, they're 5 minutes or less, delivered right to your podcast feed throughout the day. We'll bring you conversations on the day's biggest winners and losers in equity markets and explain the news and the data that's driving those gains and losses. Listen a couple of times throughout the day to find out what's moving equities and why. Just search for Stock Movers on Spotify, Apple Podcasts, or anywhere you listen. Get the latest stock news and data backed by reporting from Bloomberg's 3,000 journalists and analysts across the globe. Subscribe to Stock Movers wherever you get your podcasts.
Everyone, good morning, good afternoon, good evening to all of you. Welcome once again to this live analysis. फिलहाल देखें कमोडिटी मार्केट को तो पॉज ही है. क्रूड ऑयल न्यूट्रल हो गया है, नेचुरल गैस भी न्यूट्रल हो गया है. कल अच्छा मोमेंटम आया था सेलिंग में भी. लास्ट ट्रेड जो क्रूड ऑयल का था उसके बाद रिकवर किया थोड़ा बहुत. क्या प्लान कर सकते हैं. निफ्टी थोड़ा सा बेरिश है. एचडीएफसी बैंक भी काफ़ी गिरा आज. लास्ट 3 मंथ से कंटिन्यूसली बाइंग में ही था निफ्टी, थोड़ी बहुत प्रॉफिट बुकिंग स्टार्ट हो गई है लग रहा है, बिल्कुल हाई से। कि 1:30 अभी लंदन सेशन की ओपनिंग रहेगी, देन 1:30 के बाद शाम को 6:30 न्यूयॉर्क सेशन ओपनिंग, 8 PM यूएस मार्केट ओपन, और कोई डेटा नहीं है आज। क्रूड को ऐसे देखोगे ना, हायर टाइम फ्रेम पे इट इज स्टिल इन अ रेजिस्टेंस जोन, काफी पुराना और काफी बड़ा रेजिस्टेंस जोन है, मल्टीपल टाइम टेस्ट कर गया, ऊपर से हायर लेवल भी टेस्ट हो गए इसके। लाइक ये ऑलरेडी एक बड़े रेजिस्टेंस जो उनके अंदर है तो उसको अब कंसीडर नहीं करते हैं। नेक्स्ट रेजिस्टेंस को मार्क कर लेते हैं, मेरे अकॉर्डिंग वो ज़्यादा सेफ रहेगा क्रूड ऑयल में, बिकॉज जिस लेवल पे अभी है वो लेवल काफ़ी बार टेस्ट हो गया ऑलरेडी। कोई नया रेजिस्टेंस ही क्रिएट कर दे तो दैट विल बी अ न्यू रेजिस्टेंस राइट नाउ। बहुत ही कंसोलिडेटेड रेंज में फंस गया। हायर टाइम फ्रेम पे देखोगे ना, वेरी हाई कंसोलिडेशन रेंज। थोड़ा ऊपर जाके आता तो सेलिंग और अच्छी बनती, कल के हाई के अराउंड अगर फिर से पहुंच जाता है तो। ये नीचे से सपोर्ट ही बन रहे हैं, ऊपर से छोटे छोटे रेजिस्टेंस भी बनाए जा रहा है कंटिन्यूअसली। रेजिस्टेंस बनाया था वो अभी भी इंटेक्ट ही है, याद होगा यहाँ पर एक रेजिस्टेंस बनाया था कल, यहाँ से सेलिंग आई थी, वो अभी भी इंटेक्ट ही है। रेजिस्टेंस तो क्रूड में यही दिख रहा है, इसमें ना बहुत ही कॉम्पैक्ट रेंज बना दी है। ड्रॉ करेंगे तो पूरा चार्ट ही भर जाएगा क्रूड ऑयल में। इसको हम कंसीडर करते हैं लाइक ये एक रेजिस्टेंस, ये एक सपोर्ट, तो ये एक इमीडिएट रेंज है जो अभी भी इंटैक्ट ही लग रही है। मेजर रेजिस्टेंस ये ऊपर 5420 से 440 के अप्रॉक्स, और नीचे मल्टीपल सपोर्ट जोन, ऊपर ही जो ब्लू कलर की लाइन ड्रॉ करी है दैट इज आल्सो रेजिस्टेंस। मॉर्निंग पे ओपन हुआ है, लोअर एंड के डिमांड एरिया से बाइंग आई है, ऊपर एरिया के जो रेजिस्टेंस जोन है वहां पर स्टक हो गया है। बाकी जिस तरह का लेवल है ये नीचे वाला इतना इजी तो नहीं है, मुझे लग रहा ब्रेक कर पाना। काफी बड़ा लेवल है, ऊपर का रेजिस्टेंस काफी स्मॉल है। पे नहीं आ रहा इसमें। अगर नीचे आके फिर बाइंग आए तो मेरे अकॉर्डिंग बेटर रहेगा एक बार ना ट्रेड करने के लिए। उस केस में यहाँ पर के जितने सेलर हैं वो भी निकल जाएंगे, या तो फिर ये ब्रेकआउट ही कर दे। नीचे अगर ये कुछ इस तरह से अगर जाता है इट विल बी बेटर rather देन यहीं से डायरेक्टली ऊपर जाता है। बट ये रेजिस्टेंस थोड़ा सा वीक ही लग रहा है, मतलब इतना स्ट्रांग भी नहीं है लेकिन ठीक है, तेजर रेजिस्टेंस इज देयर। बाकी नीचे सपोर्ट तो ठीक है, दो दो सपोर्ट बने वहां पर, एक्चुअली मैंने कंबाइन कर दिए दोनों। इस पर ध्यान रखना, कल दो तीन न्यूज आ रही थी कि यूएस के प्रेसिडेंट वाइट हाउस में वेनेजुएला की सिचुएशन के बारे में कुछ डिस्कस करने वाले हैं। ये भी रिपोर्ट आ रही थी न्यूयॉर्क टाइम्स की ओर से कि मड्रो से उनकी कॉल पे बात हो सकती है, जो वहाँ के प्रेसिडेंट हैं या प्राइम मिनिस्टर जो भी हैं वेनेजुएला के। बाकी यूएस ने ऑलरेडी वेनेजुएला पे अ, उनके लाइक जो उनका ऊपर का स्काई का एरिया है, स्पेस नॉट स्पेस बट कॉमर्शियल व्हीकल्स, कॉमर्शियल जो प्लेन है उनके लिए बंद करने के लिए बोला है कि वहां पर मत चलाएं। तो हो सकता है आने वाले टाइम में हमें देखने के लिए मिले कि एक स्मॉल स्केल वॉर हो सकती है। बाकी व्हाइट हाउस की ओर से ये कहा गया था कि मडुरो को, जो वेनेजुएला के प्रेसिडेंट हैं, कि आप स्टेप डाउन कर दो, गद्दी छोड़ दो, तो हम कुछ नहीं करेंगे। लेट्स सी क्या डेवलपमेंट होती है इस पे अब। क्रूड में वैसे तो मुझे लगता नहीं यहाँ पर अभी ट्राई करना चाहिए, रिस्क बहुत है सेलिंग में, बट एक थोड़ा सा अगर रिस्क ले सकते हैं तो ये एक ट्राई कर सकते हैं, ठीक है। बट अगेन ये रेजिस्टेंस थोड़ा सा वीक है रेजिस्टेंस, लेकिन वीक है, लेकिन इतना भी कह सकता हूँ। नीचे ये पूरा जोन ही सपोर्ट जोन है एक्चुअली में, तो मैं एक्सपेक्ट कर रहा हूँ कि अगर ये थोड़ा सा अगर नीचे आता है इस एरिया से और फिर यहाँ से इतनी लिक्विडिटी है सारी, यहाँ से प्राइस थोड़ा सा सेलिंग साइड पे लिक्विडिटी लेके नीचे आए और फिर यहाँ से जाए, rather देन डायरेक्टली यहाँ पर लिक्विडेट कर दे सारी पोजीशन, मुझे लगता है तो ज़्यादा बेटर रहेगा। तो थोड़ा सा यहाँ पर ना ये थोड़ा रिस्की समझो इस ट्रेड को, काइंड ऑफ अ रिस्की ट्रेड दिस इज इन क्रूड ऑयल। तो क्वांटिटी थोड़ी कम ही रखना, टारगेट मैंने बड़ा रखा है, थोड़ा नीचे आता है इस जोन से वापस बाइंग ही कर लेंगे, ठीक है। समझ में आ गया ना, थोड़ा सा क्वांटिटी कम ही रखना। एसएल भी जा सकता है इसमें, या फिर हो सकता है प्राइस एसएल हिट करे और फिर नीचे की ओर आए, इट माइट पॉसिबल। नेचुरल गैस में भी, नेचुरल गैस में ऊपर का कुछ पता नहीं चल रहा है, ऊपर 15 मिनट का कुछ लेवल ही सो नहीं है, नीचे सपोर्ट तो है इसमें, खैर ये दिस इज अ सपोर्ट नाउ। रेजिस्टेंस का थोड़ा सा कंफर्मेशन का वेट करना पड़ेगा मुझे लग रहा है। गैस में भी देखते हैं, ठीक है, इसमें थोड़ा सा रेजिस्टेंस क्लियर नहीं है 15 मिनट टाइम फ्रेम पे, हायर टाइम फ्रेम पे तो है रेजिस्टेंस, 15 मिनट में थोड़ा सा मुझे लग रहा है वेट करना पड़ेगा, ठीक है। बैंक निफ्टी रिकवर कर गया, एचडीएफसी बैंक तो सुबह पता नहीं क्यों गिर गया था, कुछ न्यूज़ थी, आई डोंट नो, कोई बताएगा कमेंट बॉक्स में। बड़ा गैप डाउन हुआ है एक्चुअली में, रिकवरी थोड़ी बहुत आ गई है बट स्टिल। The NSE on Monday, December 1st, released final guidelines to align with market regulator Securities and Exchange Board. SEBI has asked the NSE to reduce the concentration of weights in indices which have future contract, अच्छा, which include the Nifty Bank as well. HDFC Bank, ICICI Bank, which are the top two weighted stock on the Nifty Bank, will see a gradual weight reduction. अच्छा, restructure कर रहे हैं क्या ये? HDFC Bank weightage in the Nifty Bank index will decrease from 27.5 to 18.9% over four tranches, starting at the end of December 2025, resulting in a weight reduction of approximately $330 million. I guess देखो ओवरऑल है तो बुलिस। कल भी सेल ऑफ आया था थोड़ा बहुत, वो एक मैंने लिखा था वहां पर एक वीक रेजिस्टेंस जोन रिस्की ट्रेड था वो। दो बार वहां से सेलिंग जरूर आई बट प्राइस नीचे लो नहीं ब्रेक कर पाया, अभी भी कंटिन्यूएशन में ही मूव कर रहा है अपसाइड की ओर। क्लोजिंग आ जाती है ना इस लेवल के नीचे 430, इस एरिया के नीचे अगर क्लोजिंग आ जाती तो ये अच्छा खासा रेजिस्टेंस बन जाता ऊपर अपर लेवल पे, बट ऐसा हुआ नहीं। ट्रेड में ध्यान रखना गाइस, ये रिस्की ट्रेड है थोड़ा सा, इट इज अ काइंड ऑफ अ रिस्की ट्रेड। बस मैं हल्का सा पुल बैक ही एक्सपेक्ट कर रहा हूँ कि थोड़ा पुल बैक आ जाए तो एक री एंट्री का मौका मिल जाए डाउन साइड से, सिर्फ उसके लिए लगाया है ट्रेड। क्वांटिटी कम ही रखना, एसएल जा सकता है इसमें। नेचुरल गैस में ये अभी भी सपोर्ट है नीचे 425 टू 427 अप्रॉक्स। ऊपर रेजिस्टेंस का अभी एग्जैक्टली पता नहीं चल रहा है, 15 मिनट में तो है नहीं। एक काम करते हैं, किसी स्मॉलर टाइम फ्रेम पे ही देख लेते हैं। देखिए रेजिस्टेंस जोन है इसमें नेचुरल गैस में, बट ये बड़ा लग रहा होगा आप लोगों को, 4 आवर का है एक्चुअली में। दैट इज अ 4 आवर रेजिस्टेंस। 15 मिनट में कुछ बना ही नहीं है, तो 4 आवर में लगा सकते हैं। बेटर है कि थोड़ा वेट करें, अदरवाइज दिस इज अ 4 आवर रेजिस्टेंस जोन। ठीक है, बड़ा लग रहा है उतना ही हो। अब एग्जैक्टली इसमें कहाँ से रेजिस्टेंस लेगा भी कह नहीं सकते। 15 मिनट पे, 15 मिनट का होता तो स्मॉल होता, हो सकता है दो दो रेजिस्टेंस हो स्मॉल 15 मिनट के, बट 4 आवर टाइम फ्रेम के अकॉर्डिंग दैट इज द ओनली रेजिस्टेंस वी हैव। इसलिए मुझे लग रहा है शायद 450 के अराउंड होना चाहिए। एक राउंड नंबर का इसका बीच का उठा लें। ठीक है, कोई नया रेजिस्टेंस बनेगा 15 मिनट तो लगा देंगे। अभी के लिए ये 4 आवर का रेजिस्टेंस जोन है। नॉट, दिस इज नॉट अ 15 मिनट, बिकॉज उतना पीछे लेवल सो नहीं कर रहा है 15 मिनट टाइम फ्रेम पे। यहाँ से नेचुरल गैस में एक सेलिंग का ही ट्रेड बनाते हैं। तो अभी 15 मिनट के लेवल नहीं है, तो वी हैव टू यूज दिस 4 आवर टाइम फ्रेम जोन। ठीक है, उस जोन के अंदर अलग अलग लेवल हो सकते हैं, ध्यान रखना। कल का ट्रेड का ध्यान रखना, बार बार रिपीट कर रहा हूँ, रिस्की है थोड़ा सा, ठीक है। ऊपर का रेजिस्टेंस ये है जरूर, ये ब्लू कलर की जो लाइन ड्रॉ करी है, बट बहुत वीक है। मैं बस इसलिए एक्सपेक्ट कर रहा हूँ कि थोड़ा पुल बैक आ जाए तो वापस बाई कर ले। नहीं आता है पुल बैक, एसएल भी उड़ा सकता है, इसलिए एसएल छोटा ही रखना, क्वांटिटी कम ही रखना। नीचे सपोर्ट स्ट्रांग है, पहले ऊपर एसएल उड़ा दे और फिर नीचे आए, दैट इज ऑल्सो पॉसिबल। या फिर एक काम करते हैं, एक सेकेंड, इसका एसएल, इसके एसएल पर ही एंट्री रख दें क्या? ये कर सकते हैं। थोड़ा सा ना क्रूड ऑयल में काम करते हैं, ऐसी रिस्की ट्रेड है और रिस्क नहीं उठा सकते। इसके एसएल पर ही एंट्री पॉइंट लगा लो, वो बेटर है। इसके एसएल पर ही एंट्री पॉइंट लगाओ, ना कि एंट्री पॉइंट पे एक्चुअल एंट्री। ठीक है, इसका जितना एसएल है ना उतनी एंट्री वहीं पर रखो एंट्री, ना कि एग्जैक्टली एंट्री पॉइंट पे। रिस्क और मिनिमाइज कर देते हैं। ठीक है, वैसे होने को एक्चुअल एंट्री पॉइंट यही है, बट रिस्क लेते ही नहीं है, छोड़ दे। ठीक है, थोड़ा सा इस लेवल से ट्राई कर लेना, मिनिमाइज हो जाएगा बिल्कुल रिस्क। एसएल और छोटा। माइकल बरी शॉर्ट्स टेस्ला ऑन वैल्यूएशन एंड मस्ट पे प्लान। माइकल बरी आई होप आप लोग जानते होंगे, जिन्होंने 2008 का यूएस हाउस क्राइसिस प्रेडिक्ट किया था एंड अर्न गुड अमाउंट ऑफ मनी। ही शॉर्ट्स टेस्ला ऑन वैल्यूएशन must pay plan, fortune says.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
News when you want it with Bloomberg News Now. I'm Doug Krisner. The White House is defending the Pentagon's handling of a September attack on an alleged drug-running boat. The administration is also denying that Defense Secretary Pete Hegseth had given the order to kill everyone on board. And at the same time, congressional lawmakers from both parties have launched reviews of these strikes. Here is Tim Burchett, Republican congressman from Tennessee.
I'm sure we'll have multiple hearings on this, but as usual, Congress under either party doesn't do a whole heck of a lot. We'll probably write somebody a strong letter, and we'll bring some people in, and both sides will pair up against each other. But the reality is Congress isn't going to do anything.
That is Tim Burchett, Republican congressman from Tennessee. In Hong Kong, authorities say they found the deadly fire at an apartment complex was accelerated by cheaper substandard netting used by workers to evade government testing. Police and the Independent Commission Against Corruption have so far arrested 13 people in connection with the fire. Hong Kong Chief Executive John Lee says an independent committee will be established to investigate the cause of the fire.
We will make sure that those who are responsible will have to bear the legal responsibility. I ask for a thorough investigation, and we should turn our anger and sorrow into power of reform. We have to hold those responsible accountable. We have to expose the truth. We have to do everyone justice. We have to make sure that the deceased can rest in peace and that we can give a peace of mind to those who survive.
That was John Lee, Hong Kong's chief executive. The death toll from this fire has risen to 151. Netflix has made a mostly cash offer for Warner Brothers Discovery in a second round of bidding. We are told Netflix is working on a bridge loan that totals tens of billions of dollars. Here is Bloomberg's Chris Palmieri.
Yeah, we definitely are hearing that they're edging a little bit closer to that $30 number, depending on how you value things. Big surprise here that we reported was that the Netflix offer is mostly cash, because Netflix's stock has been doing terrific in recent years. A lot of people expected to use that as the currency, and apparently they feel more confident paying cash.
That was Bloomberg's Chris Palmieri. Now, Paramount, Skydance, and Comcast are also making bids, and we are told their bankers worked on improved offers over the Thanksgiving weekend. Now, Netflix and Comcast are only interested in the Warner Brothers Studio and the HBO Max streaming service. By the way, these offers are binding, and that means the board of Warner Brothers is in a position to sign off on a deal quickly if its goals are met. The head of Apple's artificial intelligence unit is stepping down. The company says John Giandrea is exiting his job as Senior VP of Machine Learning and AI Strategy. He will leave the company entirely in the spring after a period of transition. Nvidia is investing $2 billion in the chip design software maker Synopsys. This is part of a broader engineering and design tie-up aimed at infusing Nvidia's AI computing technology into more industries. Now, these companies will deploy AI agents and work on joint marketing. Here is Bloomberg's Ed Ludlow.
Synopsys makes the software by which chips are designed but also validated. So before you send a chip through the fab to be manufactured, you want to know that that design works. And that's a big part of what Synopsys does with all kinds of tech companies. And so part of the interpretation of why is Nvidia doing this is it's a sales channel, because Synopsys is basically saying, imagine how good our software would be if it was underpinned by Nvidia's GPUs and Nvidia's catalog of software.
Bloomberg's Ed Ludlow there. Shares in Nvidia were up today by 1.6%. U.S. Special Envoy Steve Witkoff, together with President Trump's son-in-law Jared Kushner, are set to be in Moscow this week to iron out a peace deal to end Russia's war in Ukraine. Now, yesterday, American and Ukrainian officials met in Florida. U.S. Secretary of State Marco Rubio said talks were productive, but he said more work needs to be done. We got some perspective from retired Lieutenant Colonel Alexander Vidman.
I've never seen anything quite so chaotic as this iterative process to attempt a peace negotiation. Sometimes it looks reminiscent of shuttle diplomacy. You got some statesmen going between Moscow and Kiev or other capitals. But what you don't have, and what's evident and present in this one, is you don't have folks that have no competence negotiating, folks that don't actually have a formal role in government like Jared Kushner.
That was retired Lieutenant Colonel Alexander Vidman. Also today, Ukrainian President Volodymyr Zelensky rallied European support in Paris as he met with French President Emmanuel Macron. Zelensky said there are improvements in the proposal, although there are still tough issues that have to be worked out with Washington. The Trump administration reportedly fired 8 immigration judges in New York City on Monday. These firings followed an earlier round of job cuts in New York immigration courts. The New York Times reports the firings are a part of a broader disruption across the country as the president seeks to accelerate deportations. Now, before Monday, about 90 immigration judges had been fired this year across the U.S., including 6 in New York City. And according to the Times, the judges who were fired earlier this year suggested the administration was targeting judges who were considered too lenient. And they also suggested the administration was trying to create a feeling of fear. And that is news when you want it. With Bloomberg News Now, I'm Doug Krisner, and this is Bloomberg.
This is Caroline Hyde.
And I'm Ed Ludlow, inviting you to join us for Bloomberg Tech, a daily podcast focusing exclusively on technology, innovation, and the future of business.
Every weekday, we bring you the top headlines from the world's biggest tech companies.
From finance to defense, AI to entertainment, and from startups to the Magnificent Seven.
We highlight the latest stories of the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets.
We do this all every weekday, then bring you the most important conversations and analysis in our podcast.
Search for Bloomberg Tech on YouTube, Apple, Spotify, or anywhere else you listen.
Join us every afternoon on your commute home and stay ahead of the tech news cycle.
That's the Bloomberg Tech Podcast. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Subscribe today, wherever you get your podcasts.
This is Scarlett Fu.
And I'm Paul Sweeney, inviting you to join us for the Bloomberg Intelligence Podcast.
Every day, we harness the power of Bloomberg Intelligence to bring you deep dives into the companies that are moving markets, from publicly traded companies like Apple to those that are privately owned but known by everyone on Earth, like OpenAI.
Now, I helped to build Bloomberg Intelligence to what it is today, Scarlett, and now our analysts are the best in the world, covering more than 2,000 global companies.
That is your legacy, Paul, and we speak to those in-house experts every day. They are Bloomberg's go-to authorities on sectors, companies, and legal processes.
And we do it all live each weekday then bring you the best conversations in our daily podcast.
So be sure to search for Bloomberg Intelligence on YouTube, Apple, Spotify, or anywhere else you listen.
Listen in the afternoons on your way home from work to catch up on the market news you missed during the business day.
That is the Bloomberg Intelligence Podcast. I'm Scarlett Fu.
And I'm Paul Sweeney. Subscribe today wherever you get your podcasts.
As well as other like-minded nations around the world for advice on how to handle this. And clearly, the Foreign Affairs Minister Lin telling me that they would like to see things, and it's in the interest of all parties, including Beijing, to diffuse the situation right at this point.
It's also not in Xi's interest, because the economic downturn. And also the high, the rising unemployment rate, and also the trade conflict with the United States. So I think it's not in everyone's interest to have the China-Japan disputes on the issues related to Taiwan to escalate.
So by not provoking Beijing, you feel, this is the way I'm reading it, you feel that this could die down sooner?
Yes, I think so.
How long?
Because I think Japan has already shown its willingness, because it's in the parliament. Yeah. It's in a QA session. Yeah. So that has some backgrounds. Yeah. So it's not just a different policy change from the Japanese side, but for Beijing side, maybe take maybe a year to stabilize the situation. But for saving Xi Jinping's face, he has to do something to show his domination in the disputes.
And again, the big question there, Tom, is what is going to be the impetus for those temperatures to come down short of an apology from Japan that China has demanded? And Japan, Tokyo, has given no indication that it is willing or is going to offer an apology. So again, the Minister Lin essentially saying it's going to need some time for a face-saving move, at least a year for Xi Jinping to have that face-saving time to show that he's being tough on Japan. Both sides, Japan and China, playing to their domestic audiences, while Taiwan here is sort of sitting back and hoping that temperatures cool down. But in the meantime, of course, they're also trying to solidify their support, not necessarily just because it only has 12 diplomatic allies around the world, but with what Lin calls like-minded nations. That's including the United States, Japan, South Korea, and others around the world, including India and European Union. Taiwan really making a concerted effort as well to get not diplomatic support, but also moral and economic support from the Europeans.
Okay, really interesting. Stephen Engel, our chief North Asia correspondent in Taipei, bringing us an exclusive interview. Steve, thank you. Some other news making the headlines this Tuesday morning. The White House defending the Pentagon's handling of a September attack on a suspected drug-running boat off South America is denying a report that Defense Secretary Pete Hegseth had given an order to kill everyone on the vessel. Spokeswoman Caroline Levitt confirmed 2 strikes on the ship, but says the order for the second attack came from a U.S. Navy admiral, not Hegseth. And the White House says Donald Trump received what it called a preventative MRI of his heart and abdomen as part of his annual physical in October. The president's physician says the scan showed normal organ functions with no acute or chronic concerns. It is unusual for most people to undergo MRIs during routine physical exams, and the White House had been under pressure to provide more details. Coming up, more turbulence for Airbus as it reveals hundreds of its best-selling A320 jets need to be inspected for potential quality flaws. We bring you the details next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience. proving to be a stronghold of stability in a world of change.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Why would you want to be chairman of the Fed? Are you sure you want that job?
If the president asks me to be Fed chair, then I'll do it. If I'm not Fed chair, don't be disappointed for me because I love the job that I have.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Bloomberg Daybreak Europe. Airbus shares fell the most since April after the plane maker revealed that inspections are needed for hundreds of its best-selling A320 jets over potential flaws in the aircraft's body. Let's bring in Bloomberg transport reporter Danny Lee. Danny, what do we know about this latest issue for Airbus? This seems to be a week where the focus is on challenges around Airbus and now the latest in terms of one of its suppliers.
Yeah, I mean, this is something about quality and production quality, which Airbus will be acutely sensitive to. And really, this revolves around some paneling on the fuselage, which could be a risk in terms of flight safety. Not an immediate risk by any means. It's more to do with the thickness of how some of these panels have been designed. But it's an issue that Airbus was made aware of. And it's something that kind of affects around several hundred aircraft, mostly newer aircraft, some aircraft that are in service, some are going through the final production line. And so therefore, it's something that Airbus wanted to swiftly take action on to try and resolve the issue. Although it's something, an issue that is not something that is necessarily an immediate cause for concern, such like the software glitch which caused or had global disruption over the weekend for airlines.
Yeah, so they had to work through that, didn't they, over the weekend with those updates across hundreds of their aircraft to the software, and now they're dealing with this issue. We focus then, and we do now, on the Airbus targets in terms of delivery by the end of the year. Some pretty ambitious targets. Does this derail that ambition?
I think it's a very good question, given what Airbus is doing to inspect the aircraft. Particularly, there are still many hundreds of these aircraft which are potentially at impact that are still on the production line. Whether they have to be reworked, and that could then slow down the output of aircraft that are needing to be delivered. And the key thing here is that Airbus has now delivered at least 70 aircraft in November. That leaves them with a record 165 aircraft it needs to push through in order to hit its annual targets. Now, its annual target is 820 deliveries to airlines, so it's under real pressure. And for quite some time now, management has said it's going to stick to those annual targets. So given these latest concerns around quality, or new concerns around quality, it remains to be seen what impact that will have on its outcome for the rest of the year.
Okay, we'll continue to monitor, of course, whether they can meet that target and how quickly they can get this issue sorted. Danny Lee, thank you very much indeed with that update on Airbus. That's a stock to continue to watch after the sell-off, of course, yesterday. We'll mark that one for you at the open this Tuesday. Let's get you up to speed on some other stories of the day then. Top market-making firms, Jane Street and Citadel Securities, are on track for record trading revenue gains as they challenge Wall Street's dominance. Jane Street's third quarter turnover jumped 18%. Putting it behind only top players JP Morgan and Goldman Sachs. Citadel's sales, meanwhile, rose 9%. Both have benefited from market volatility, often fueled by President Trump's shifting policies. And Bloomberg has learned that Warner Brothers Discovery has received a mostly cash offer from Netflix as it fields a second round of bids. Sources say the offers are binding, which means the board can sign off on a deal quickly if its goals are met. Warner Brothers, the parent company of HBO, CNN, and its namesake film studio, officially put itself up for sale in October after receiving multiple unsolicited offers for all or part of the company. And Cyber Monday spending grew more slowly in the US than Europe due to US President Trump's trade war and aggressive interest rate cuts by the ECB. Salesforce says global online spending, mostly from Europe, increased 5.3% compared to a year ago, while US spending rose by 2.6%. This is just an estimate, and the results could still change in the final hours of Cyber Monday. And price inflation here in British shops eased to the lowest level in 5 months as retailers rolled out Black Friday deals earlier than usual to entice shoppers. The British Retail Consortium says the rate of inflation slowed to 0.6% in November from a year earlier, compared with 1% the month before. Deals were particularly good across health and beauty, electricals and fashion. And Bloomberg's Markets Today team are hosting a live Q&A today at 1 p.m. London time. Digital subscribers and terminal clients have the exclusive opportunity to ask questions. Join them to discuss how UK markets have fared this year and what could happen next. Coming up, talking of the UK, the Office for Budget Responsibility chairman has quit after the early leak of Rachel Reeves's budget. We'll bring you more on that story. It's coming up. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Open Interest.
Well, if you're worried about inflation, maybe buy gold. If you're worried about tariffs, maybe buy gold. If you're worried that markets are too overvalued with the equity market and with credit spreads incredibly tight, buy gold.
What people are not talking about that they should be talking about is every major currency in the world is collapsing relative to gold. It's been going on for decades.
Don't miss Open Interest live weekdays.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks struggle for direction following a global sell-off that saw cryptocurrencies lead declines in risk assets. A closely watched auction of 10-year Japanese government bonds draws solid demand. Ukrainian President Volodymyr Zelensky says a new peace plan draft looks better as Vladimir Putin plans to meet with US envoy Steve Witkoff today. Plus, Airbus facing more turbulence as it reveals it needs to inspect hundreds of its best-selling A320 jets for potential quality flaws in the aircraft's body. Let's get to the markets then after a bit of a soggy day for European and US equities yesterday. The S&P 500 closing down by about 0.5%. The Nasdaq 100 in similar territory. Today, European futures also striving for direction after a little bit of softness yesterday. FTSE 100 futures pointing down by 19 points. S&P E-minis after the losses of yesterday pointing a little lower by 0.1%. And Nasdaq 100 futures looking to drop 47 points. Let's flip the board and have a look across asset. You do have stability in treasuries this morning after the sell-off across the curve yesterday with yields up 7 basis points on the 10-year. The 10-year currently yielding 4.08. We continue, of course, to get the data coming through of the US. Inflation data on Friday, the PCE gauge, of course. Euro-dollar at 116. Bitcoin stabilising around that 87,000 level after the sharp sell-off yesterday, currently up 0.6%. And Brent crude at $63 a barrel. Now to the UK, where the Office for Budget Responsibility Chairman Richard Hughes has quit after taking responsibility for the premature publication of the contents of Rachel Reeves's budget. You'll remember this, of course, last week. The early release of the document marked an unprecedented breach of procedure, with the OBR's inquiry calling it the worst failure in the organisation's history. Joining me now is Kit Reeves, co-editor of Bloomberg Markets Today blog. What's been the reaction to this, Kit? Good morning. To the OBR, in some respects, not a huge surprise that the head has stepped down, given the tumult and what the remarkable scenes that we saw last week with essentially the OBR coming out essentially an hour before the speech itself. So not a huge surprise on that front, but nonetheless significant.
Yes, definitely significant, and it plays into these worries over the credibility of these big institutions. So we've had issues with data quality at the ONS. There have been questions raised even over the Bank of England's messaging. So it plays into worries over trust and credibility, and there'll probably be greater calls for reform and questions raised over the power that the OBR, the budget watchdog, has over how it influences the public finances. In terms of the market, though, it's probably unlikely that there's going to be a big reaction. The market was very much focused on the budget, the contents of the policies, and it will probably continue to digest this, probably over the next month and maybe even into next year. But for the broader kind of sentiment, it is significant, and there'll be lots of questions raised over reforms and what it means going forward.
OK, and this at the time when the Prime Minister continues to defend that budget, indeed the Chancellor herself as well, defending Rachel Reeves, Prime Minister Keir Starmer, yesterday, amid accusations that the Chancellor misled the public about the state of the UK's finances ahead of that budget last week. Take a listen.
So we had, on the one hand, £16 billion less than we might otherwise have had. We had clear commitments that we'd made throughout the process as to what it was we were going to achieve. Therefore, against that backdrop, it was inevitable that we would always have to raise revenue. So there's no misleading there. During the overall process, the numbers improved.
So, Kit, Starmer then drawing and just reiterating his support for the Chancellor, Rachel Reeves. Does that then draw a line under this? But do we move on after this? Has he made the case convincingly?
I mean, that's probably what markets are hoping for, that, we can kind of move on forward and look at things like the Bank of England, interest rates, inflation data, all of that kind of stuff. So for the market, it was really focused on the budget, and it got what it wanted really from that. It got higher fiscal buffer. It got measures which were hopefully not going to be inflationary. So for the market, that's what it really cares about. In terms of where it goes with the politics at the moment, this is probably just noise for the market. But if there's any kind of spillover or escalation or questions over leadership, then that could start to play out. But we're not there yet, I would say.
No, not there yet. Well, I mean, we did see gilts selling off a little bit more than some of their European counterparts yesterday, and presumably some of that was down to politics. But the focus may be shifting now, so we continue to monitor gilts in the session today. We also have the Bank of England financial stability report out at 7 a.m. UK time. What are you and the team going to be watching for from that report?
So this is a twice-yearly publication, and it really takes a peek under the bonnet of the financial system and any kind of risks there and how and whether it can withstand shocks. So what we'll be watching for is any kind of commentary on issues such as private credit and how well the banks can, withstand any kind of shocks. We've had already reports out from the Fed, the ECB, the Riksbank, Germany's Bundesbank, which have flagged issues such as geopolitics, potential impact of trade tensions, high valuations in the market, given the AI trade has been pretty big this year. So we'll be watching for similar themes and also any comments on the bank's capitalization. So it'll just be an interesting look into how things stand and whether, there are any risks that we need to keep an eye on.
Yeah, given their earlier warnings earlier this year about valuations in the tech space from the BOE. It'll be interesting to see if they build on that in the report today. Keith Rees, thank you very much indeed. Co-editor of Bloomberg Markets Today and the blog, of course, that you can continue to monitor on the website and on the terminal. And Bloomberg's Markets Today team are hosting, meanwhile, a live Q&A today at 1 p.m. London time. Digital subscribers and terminal clients have the exclusive opportunity to ask questions. Join them to discuss how UK markets have fared this year and what could happen into 2026. Let's get you up to speed on some other news stories this Tuesday. Prime Minister Keir Starmer, meanwhile, says the UK will adopt a more pro-business approach in relationship to China, but not trade its national security for greater trade ties. Starmer sought to clarify his government's approach to Beijing last night in his annual speech on foreign policy. Starmer said the UK needs a policy that recognises China is a defining force in technology, trade and global governance, while also posing a national security threat. And talking of China, China's DeepSeek has unveiled 2 new versions of an experimental AI model, claiming the new service matches the performance of OpenAI's flagship GPT-5. DeepSeek says the new model performs well across multiple reasoning benchmarks, suggesting China's open source systems remain competitive with Silicon Valley's frontier proprietary models. And China's top-down AI strategy sets the country up to achieve a large-scale deployment that the US will struggle to replicate. The national rollout leverages low-cost open-source models and gives China a greater chance of improving economic productivity. But this model comes at a cost to private sector tech firms. These are the findings of a new deep dive on the Bloomberg terminal written by Robert Lee from Bloomberg Intelligence, who is with us now. A really significant report, and I know a huge amount of work has gone into this, Rob. It's a huge report, loads of detail in there. What are your main conclusions then, Rob?
I suppose you could use ChatGPT to summarise it, but yes, there's a lot of detail in there that I hope your viewers can find useful, and they can find that on the terminal via the mnemonic BI space deep. But the main conclusions are, I think it's China's economy, its productivity across the economy that stands to win out overall. I think that's the overriding conclusion. But ultimately, somebody has to bear that cost, don't they? And I think the government is playing some role in that with a heavy level of subsidies going into the national AI rollout, but it's actually the shareholders of the private tech platforms, the listed tech platforms, in other words, the shareholders of your Alibabas and Baidus, who are effectively subsidizing the national rollout to help democratize AI, so that under the government's overarching AI plus strategy, AI can be deployed rapidly across every single sector and every region of the nation. So the economy will win, but it's subsidized by the private companies.
So rapid deployment, rapid adoption, we're seeing that in China, and the innovation continues. We've had a reminder of that today with DeepSeek and its latest model. We've had QN recently, of course, from Alibaba, and the updates there. Rob, how is this all happening, given that China does not have access, or at least officially have access to Nvidia's most high-end AI accelerators?
That's true. I mean, it's a classic engineering challenge with the earlier export bans that were put in, somewhere close to 2 years ago. It's forced the Chinese developers to work a way around that, to tunnel under it, to work to find other ways. And effectively, they've moved to smaller, more computationally efficient models. DeepSeek being a prime example. When DeepSeek broke the headlines back in January this year, there were numbers that they disclosed highlighting the degree to which which they have really forged ahead on a global basis on the cost down front. So that's one of the main areas. And also, I think, as you've seen in recent headlines, the national suppliers of equivalent AI chips, the likes of Huawei and even Baidu, have ramped up capacity massively. So net, that's enabled to China to continue its developments relatively unhindered. I will still say the US maintains a performance lead, but even looking at third-party, in fact, US-based benchmarking services, the performance premium enjoyed by the likes of OpenAI and ChatGPT is only in the region of 10 to 11%. I think that would likely surprise a lot of people. So they are in the lead, but a very small margin.
Okay, so that performance premium of 10 to 11% for US large language models versus their Chinese competitors, and presumably that is starting to be squeezed. Given the deep dive you've done then, Rob, what is your best assessment of who currently has the best chance of winning this global AI race, if we frame it that way?
Within the China context, again, as I've said, it's clearly the economy. That China is looking to rebalance the economy away from prior years of being heavily reliant on the property sector and investment to drive these new productive forces of economic growth. It's clearly looking at the high-tech sector, AI being an element of that, along with the semiconductor sector. These are the future drivers of China's economic growth, and that ties in with what our colleagues at Bloomberg Intelligence have been writing extensively for the best part of 2 years or so. But on a global basis, again, I think China, rather than pursue technology for its own sake or pursue the frontiers, which is interesting, I think, China at its heart is a very pragmatic nation, and they're there ultimately to make money. So if you look at the capex spend from Chinese platforms, it's approximately 10% of what the US is spending. So they're really doing it on a budget, and there has been real true innovation from Chinese tech companies, with DeepSeek being the prime example. So as a result, with rising innovation in the sector, we're very intense focus on cost down and looking for near-term, short-term wins within the economy. I think, China is arguably emerging as the global leader in the low-cost, real-world application of AI. At the end of the day, all this investment is all very interesting on an intellectual level, but ultimately, you want to see a return on the investment and you want to be making money. So I think China's strategy, from where we stand at the moment, makes a lot of sense.
Okay, winning on ROI, at least for now. Robert Lee from Bloomberg Intelligence, and all that analysis, of course, can be found on the terminal, and some of it on Bloomberg.com as well. Rob, thank you for the detail. Coming up, we're going to stay with the tech space. We're going to be talking to one of Europe's most influential tech investors about why European AI funding is reaching new heights and whether it can continue into 2026 as well. Our conversation with Hussein Kanji, founder of Hoxton Ventures, is next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment. Soon it was past 1 gigawatt of capacity, helping anchor Indonesia's clean energy future. Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment.
And that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findstreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, funding in European AI is reaching record highs, with valuations in the median price tag for AI startups in Europe more than 20% higher than in 2024. To dig deeper into this and also what's happening in the AI space and how Europe can compete, let's bring in Hussein Kanji, founder of Hoxton Ventures, invests in early-stage technology companies and appeared on the Forbes Midas list in Europe in 2023. Some big exits for you historically with Darktrace, Deliveroo, and of course a number of exciting portfolio company members that we can look at as well. Hussein, thanks so much for your time. So the momentum was there in 2025 for European tech and the flows for VCs into some of these startups, everything from AI to deep tech to what's happening in the healthcare space. Just give us an overview of what happened as we get towards the end of this year and how that sets us up for 2026.
So more and more momentum in the European market for technology and for AI in particular. People forget that one of the leading AI labs in the world was DeepMind, which is now part of Google, born and raised right here in London, in terms of like right down the road at King's Cross. That alumni base and all the things that are affiliated with everything DeepMind have kind of created a whole wave of companies out here in the European continent, both in the UK as well as continental Europe, and that's just compounding. We're now starting to see examples of companies out here in the European market that are competing head-to-head with the American companies, and in some cases are the market leaders. So I'll give you a few examples. Yeah. So in voice AI, which is basically turning me and you talking into text and turning that into a really natural-sounding voice, the pioneering company right now is 11 Labs, homegrown here in London and in Poland. For video generation, a little character on the screen, you tell it what to say, kind of it pretends to be me or you. Kind of, we would call it a deep fake, 10 years ago, but these days, you call it an AI company, leading company in the world, Synthesia, born and raised right here in the UK, came out of UCL. We're starting to see many more examples of this. Lovable is a similar type of thing, coding development. You have an idea for a website or for an app. You want to, have the AI basically write that. You go to a website, you do it. There are a couple of US companies. There's a company homegrown here in Sweden. So we're starting to see more of these examples. My suspicion is over the next 5 years, we're going to see more and more breakthroughs kind of coming out of the European sphere. More and more of these companies turning out to be like category leaders and world leaders.
When do we get to a point where European startup, or where Europe is regularly minting $100 billion plus tech companies, which the US is doing on kind of an annual basis?
It's a really good question. The biggest thing that holds us back here is money. So we definitely have the technology capability. We definitely have the research labs. We definitely have the AI kind of frontier models. Everything's in our backyard. Weirdly enough, funding in the venture community is down in Europe. The flows are not as good.
Hello and welcome. This is the Michelle Hussein Show. I'm Michelle Hussein. I speak with people like Elon Musk.
I think I've done enough.
And Shonda Rhimes. That's so cute. This will be a place where every weekend you can count on one essential conversation to help make sense of the world. So please join me, listen and subscribe to the Michelle Hussein Show from Bloomberg Weekend, wherever you get your podcasts.
You certainly ask interesting questions.
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Caroline Hepker.
Almost $1 billion of leveraged crypto positions were liquidated during another sharp drop in prices yesterday. Bitcoin slid by as much as 8%, bringing its decline since early October to almost 30% before recovering in early trading today. The volatile moves have hit retail traders particularly hard as dip buyers have failed to materialise. Jalak Jobanputra, managing partner at Future Perfect Ventures, says the market is tracking a broader risk-off mood.
The October sell-off in the crypto sector was due to the tariff uncertainty around China. We also saw people taking profits when Bitcoin went up to 126,000. So in the span of 3 months or less than 3 months, we've seen over a 30% drop. That being said, I don't see a downward spiral because there are going to be people who want to get access to the asset.
Jalak Jobaputra speaking there as traders are now watching $80,000 as the next key support level for Bitcoin. Today, Bitcoin is trading up 0.6%, just shy of $87,000.
US envoy Steve Witkoff is travelling to Moscow today for talks over Russia's war in Ukraine. This as the EU's top diplomat has expressed concern that American attempts to push Ukraine into a lopsided peace plan would only encourage Russia's aggression. Europe is on edge after an initial 28-point plan proposed by the US suggested numerous Russia-friendly concessions from Kyiv. Ukrainian President Volodymyr Zelensky said updated language in the latest draft deal looks better, but territory remains the most difficult topic. Speaking after a meeting of EU defence ministers in Brussels, Kaja Kallas said putting pressure on the weaker side is not in anyone's interests.
Not in the interest of Ukraine, not in the interest of European Union, also not in the interest of the global overall security, because it's the United Nations Charter that says that you can't change borders by force. If this pays off, we will see this elsewhere. All around the world, then we see that whoever has the power gets to take what they want, which is not good for the majority of the countries in the world.
The EU representative for Foreign Affairs, Kaja Kallas, there. She went on to say that the outcome of today's US-Russia talks will be, quote, pivotal.
European defence firms are scrambling for a vital component in high-tech weapons, rare earth minerals. But nimble US rivals are scooping them up more quickly. Some estimates suggest European supplies could run dry in the coming months. Bloomberg's Freddie Fulston has more.
Sources told Bloomberg that US firms are much better at securing rare earths than their European counterparts. They have a sense of urgency and financial might, and they're more creative in how they navigate Beijing's restrictions on supplies. The EU is planning to commit at least $3.5 billion over the next year to help sever its dependence on China's raw materials. The funding would be critical to securing the military equipment Europe so urgently needs. In London, Freddie Fulston, Bloomberg Radio.
Taiwan's foreign minister says the dispute between China and Japan could drag on for a year. That's after Japanese Prime Minister Sanae Takaichi commented on the possible involvement of her country's troops if China were to invade Taiwan. Beijing saw those comments as crossing a red line. Speaking to Bloomberg, Taiwan's Lin Chia-lung said his country hopes the two sides can resolve their differences.
Japan has already shown its willingness because it's in the parliament, the QA session. Yeah. So that has some backgrounds for Beijing side. Maybe take maybe a year to stabilize the situation.
Taiwan's Foreign Minister Lin Chia-lung speaking there. Meanwhile, Taiwanese President Lai Ching-te has urged Beijing to act like a responsible major power. The Foreign Ministry in Beijing didn't immediately respond to a request for comment.
The UK is set to adopt a more pro-business approach to China. In his annual foreign policy speech, the Prime Minister Keir Starmer said the country's dealings with China will have more consequences for the public than any other global shift. He added that increased collaboration would not come at the cost of safety.
Our response will not be driven by fear, nor softened by illusion. It will be grounded in strength, clarity and sober realism, in line with our wider international approach and guided by our conviction that strong, purposeful engagement on the world stage is the best way, the only way in these times, to deliver growth and security for the British people.
Prime Minister Keir Starmer seeking to draw a line under a turbulent period for UK-China relations. His remarks come ahead of a decision about a controversial new Chinese embassy in London and a potential visit to the country next year. According to Starmer, professional and financial services, as well as creative and pharmaceutical industries, will be key beneficiaries of Chinese opportunities, adding the UK investment minister is currently visiting the country.
The chairman of the Office for Budget Responsibility has resigned following the premature publication of analysis of the latest UK budget. Richard Hughes took responsibility for the error after an investigation found the report was leaked due to people entering a predictable internet address. Former director of the Institute for Fiscal Studies, Paul Johnson, says Hughes will be missed.
It is a shame. He was a public servant of real integrity and one who had the courage as well to stand up to both this government and the last one when they've were less than clear about their communication, shall we say.
Paul Johnson speaking there. The document's early release marked an unprecedented breach of procedure. Chancellor Rachel Reeves called the mistake deeply disappointing. In a resignation letter published on Monday, Hughes said that he was certain the OBR, the UK's fiscal watchdog, could regain trust quickly despite the failure.
And those are your top stories. On the markets, the MSCI Asia Pacific Index 0.2 higher this morning. The Nikkei in Tokyo is flat. The Japanese yen 0.2 weaker against the US dollar at 155.71 after a keenly watched auction of government bonds there drew firm demand. European stock futures 0.1 higher for Euro Stoxx 50. Wall Street futures down by 0.1% this morning.
That's news when you want it with Bloomberg News Now. I'm Caroline Hepker.
I'm Stephen Carroll and this is Bloomberg.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
The forces shaping markets and the economy are often hiding behind a blur of numbers.
So that's why we created The Big Take from Bloomberg Podcasts, to give you the context you need to make sense of it all.
Every day, in just 15 minutes, we dive into one global business story that matters.
You'll hear from Bloomberg journalists like Matt Levine.
A lot of this meme stock stuff is, I think, embarrassing to the SEC.
Amanda Mull, who writes our Business Week buying power column.
Very few companies who go viral are totally prepared for what that means.
And Zoe Tillman, senior legal reporter.
Courts are not supposed to decide elections. Courts are not really supposed to play a big role in choosing our elected leaders. It's for the voters to decide.
Follow the Big Take podcast on the iHeartRadio app, Apple Podcasts, or wherever you listen.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Caroline Hepker.
Almost $1 billion of leveraged crypto positions were liquidated during another sharp drop in prices yesterday. Bitcoin slid by as much as 8%, bringing its decline since early October to almost 30% before recovering in early trading today. The volatile moves have hit retail traders particularly hard as dip buyers have failed to materialise. Jalak Jobanputra, managing partner at Future Perfect Ventures, says the market is tracking a broader risk-off mood.
The October sell-off in the crypto sector was due to the tariff uncertainty around China. We also saw people taking profits when Bitcoin went up to 126,000. So in the span of 3 months or less than 3 months, we've seen over a 30% drop. That being said, I don't see a downward spiral because there are going to be people who want to get access to the asset.
Jalak Jobanputra speaking there as traders are now watching $80,000 as the next key support level for Bitcoin. Today, Bitcoin is trading up 0.6%, just shy of $87,000.
US envoy Steve Witkoff is travelling to Moscow today for talks over Russia's war in Ukraine. This as the EU's top diplomat has expressed concern that American attempts to push Ukraine into a lopsided peace plan would only encourage Russia's aggression. Europe is on edge after an initial 28-point plan proposed by the US suggested numerous Russia-friendly concessions from Kyiv. Ukrainian President Volodymyr Zelensky said updated language in the latest draft deal looks better, but territory remains the most difficult topic. Speaking after a meeting of EU defence ministers in Brussels, Kaja Kallas said putting pressure on the weaker side is not in anyone's interests.
Not in the interest of Ukraine, not in the interest of European Union, also not in the interest of the global overall security, because it's the United Nations Charter that says that you can't change borders by force. If this pays off, we will see this elsewhere, all around the world. Then we see that whoever has the power gets to take what they want, which is not good for the majority of the countries in the world.
The EU representative for Foreign Affairs, Kaja Kallas, there. She went on to say that the outcome of today's US-Russia talks will be, quote, pivotal.
European defence firms are scrambling for a vital component in high-tech weapons, rare earth minerals. But nimble US rivals are scooping them up more quickly. Some estimates suggest European supplies could run dry in the coming months. Bloomberg's Freddie Fulston has more.
Sources told Bloomberg that US firms are much better at securing rare earths than their European counterparts. They have a sense of urgency and financial might, and they're more creative in how they navigate Beijing's restrictions on supplies. The EU is planning to commit at least $3.5 billion over the next year to help sever its dependence on China's raw materials. The funding would be critical to securing the military equipment Europe so urgently needs. In London, Freddie Fulston, Bloomberg Radio.
Taiwan's foreign minister says the dispute between China and Japan could drag on for a year. That's after Japanese Prime Minister Sanae Takaichi commented on the possible involvement of her country's troops if China were to invade Taiwan. Beijing saw those comments as crossing a red line. Speaking to Bloomberg, Taiwan's Lin Chia-lung said his country hopes the two sides can resolve their differences.
Japan has already shown its willingness because it's in the parliament, the QA session. Yeah. So that has some backgrounds for Beijing side. Maybe take maybe a year to stabilize the situation.
Taiwan's Foreign Minister Lin Chia-lung speaking there. Meanwhile, Taiwanese President Lai Ching-te has urged Beijing to act like a responsible major power. The Foreign Ministry in Beijing didn't immediately respond to a request for comment.
The UK is set to adopt a more pro-business approach to China. In his annual foreign policy speech, the Prime Minister Keir Starmer said the country's dealings with China will have more consequences for the public than any other global shift. He added that increased collaboration would not come at the cost of safety.
Our response will not be driven by fear, nor softened by illusion. It will be grounded in strength, clarity and sober realism, in line with our wider international approach and guided by our conviction that strong, purposeful engagement on the world stage is the best way, the only way in these times, to deliver growth and security for the British people.
Prime Minister Keir Starmer seeking to draw a line under a turbulent period for UK-China relations. His remarks come ahead of a decision about a controversial new Chinese embassy in London and a potential visit to the country next year. According to Starmer, professional and financial services, as well as creative and pharmaceutical industries, will be key beneficiaries of Chinese opportunities, adding the UK Investment Minister is currently visiting the country.
The chairman of the Office for Budget Responsibility has resigned following the premature publication of analysis of the latest UK budget. Richard Hughes took responsibility for the error after an investigation found the report was leaked due to people entering a predictable internet address. Former director of the Institute for Fiscal Studies, Paul Johnson, says Hughes will be missed.
It is a shame. He was a public servant of real integrity and one who had the courage as well to stand up to both this government and the last one when they've were less than clear about their communication, shall we say.
Paul Johnson speaking there. The document's early release marked an unprecedented breach of procedure. Chancellor Rachel Reeves called the mistake deeply disappointing. In a resignation letter published on Monday, Hughes said that he was certain the OBR, the UK's fiscal watchdog, could regain trust quickly despite the failure.
And those are your top stories. On the markets, the MSCI Asia Pacific Index 0.2 higher this morning. The Nikkei in Tokyo is flat. The Japanese yen 0.2 weaker against the US dollar at 155.71 after a keenly watched auction of government bonds there drew firm demand. European stock futures 0.1 higher for Euro Stoxx 50. Wall Street futures down by 0.1% this morning.
That's news when you want it with Bloomberg News Now. I'm Caroline Hepker.
I'm Stephen Carroll and this is Bloomberg.
Hello and welcome. This is the Michelle Hussein Show. I'm Michelle Hussein. I speak with people like Elon Musk.
I think I've done enough.
And Shonda Rhimes.
That's so cute.
This will be a place where every weekend you can count on one essential conversation to help make sense of the world. So please join me, listen and subscribe to the Michelle Hussein Show from Bloomberg Weekend, wherever you get your podcasts.
You certainly ask interesting questions.
Are you looking for a new podcast about stuff related to money?
Well, today's your lucky day.
I'm Matt Levine.
And I'm Katie Greifeld.
And we are the hosts of Money Stuff, the podcast. Every Friday, we dive into the top stories about Wall Street, finance, and other stuff.
We have fun, we get weird, and we want you to join us.
You can listen to Money Stuff, the podcast on Apple Podcasts, Spotify, or wherever you get your podcasts.
We have in Singapore the state-of-the-art technology, and then we export that technology into our metal plant in Georgia.
The Smart Factory brings...
Good Monday morning, 30 minutes until the first trading day of December. I'm Matt Miller. Danny Berger is off today. Bloomberg Open Interest starts right now. About that with Bloomberg Tech co-host Caroline Hyde. She joins us here on set to kick off the week. And Caroline, another deal here from Nvidia investing this time in a chip designing software maker.
And a public one at this. And it's done it before. Remember, invested in Intel. But largely we've seen it go into companies that help fuel the purchase of its GPUs, whether it's a neocloud like CoreWeave, whether it's OpenAI that needs the chips for designing its large language model. But we understand that this is all about the design the Crude are offering. Remember, Nvidia is so dominant because it's sort of a full stack. You get the hardware, you get the chips, you also get the software with which to be training your large language models. CUDA, CUDA as it's known. This is chip design and software company Synopsys that publicly trades, has not done well on the public markets. And now we see Nvidia coming in and snapping up $2 billion worth. But they say this is a partnership. This is about expanding time to ultimately the offering, but also speed to market. So it's meant to be a win-win on both sides. Thus far, it's a win for Synopsys shares, maybe not so much for Nvidia.
Not so much for Nvidia, although sentiment is obviously down today because in part of the drop in Bitcoin, which is, I was thinking this morning, if someone had told us 10 years ago that moves in Bitcoin could lead the entire market, we wouldn't have believed it. But that looks like what's happening.
It does, and whether or not it's a macro issue, what's happening with Japan, what's happening with ultimately the cost of government debt in Japan and what that means for the carry trade, that's a macro headwind. But there's a lot of specifics that are going on in the crypto world that's got us anxious. Largely, one of the biggest buyers of Bitcoin, MicroStrategy, or Strategy, the artist formerly known as MicroStrategy, has actually seen its CEO go on a podcast. Because remember, Michael Saylor is the chair. The CEO is saying, we could sell Bitcoin. What happened to the hodl mentality? So people are worrying that they're going to, basically because of the net asset value, the overall enterprise value of MicroStrategy falling below the actual amount that its Bitcoin is worth, could that force it to sell because it's got to pay off dividends? Then you've got to look at what's happening with Tether, stable coins. It's interesting, S&P give ratings to stablecoin issuers. They are worried about Tether. Tether's fighting back, saying you just don't understand our complexity, and of course it's because we're sort of a new world of financial instrument. But more broadly, they're saying you don't have enough buffers, safe buffers, to be able to pay back a Tether one for one. Remember, they've gone more into the world of Bitcoin ownership and into other corporate loans and the like, not just treasuries, not just cash. That's the key worry. And then you just got China as well worrying a little bit about stablecoins and crypto.
Yeah, so Noor Ali at the MLive blog points out that the Bitcoin fear and greed indicator has fallen faster than the price itself. And hearing these things from people like, what's his name, Fong Li at
CEO
at Strategy. I know they changed their name to Strategy, simply Strategy, which is like so generic that it can't really be the name for a company. But okay. If they sell off, like that just seems like it would snowball into a bigger sell-off in crypto.
And Matt, you're so right. I think the issue here is who is the buyer? Why are we not seeing people piling back into the ETFs at the moment? They have been a key buyer. Where's the institutional buyer? Where is the dip buyer? I think that's what many people are wondering at this moment. $80,000 is kind of the level everyone's now looking at. Remember, we've been here when we're looking at the $86,000 level, but a few weeks ago. I feel it's sentiment, right? We need a sentiment shift. And many are wondering about how they're booking their losses going into the end of the year.
I remember being at $86. So this is
it's still somewhere in your,
a long way
on some hardware that you can access.
From there, yeah. Caroline Hyde, thanks so much for joining us, reminding me of my lost Bitcoin. Turning our attention now to Big Pharma. Eli Lilly announcing it will cut the prices for introductory doses of Zepbound if you pay cash. This is just the latest move in the price war with Novo Nordisk that's getting more and more confusing in terms of pricing for these weight loss drugs. Joining us now to talk about it is someone who understands everything, at least in regards to this industry, Bloomberg Health reporter Madison Muller. So what do we know about Zepbound? Now it's what, the 5 milligram doses, the starter doses are going to be even cheaper.
Exactly. So the beginning doses, the starter doses, which, like you said, people sort of stay on for a month, maybe 2 months. This is, you know, because these drugs cause nausea and some GI side effects, people have to step up. So they can't start at the highest dose. They have to start lower and go up. So what Lilly and Novo are doing is offering some discounts on those starting doses. So Lilly's discounting the price of the first starter dose by $50 and shaving even more off of that second starter dose. And they're keeping the same prices for the higher doses. And this is sort of what we're seeing for Novo as well, which is discounting the first 2 months of treatment even further. A couple of weeks ago, they did that. But for patients, once they get to those actual therapeutic doses that you're supposed to stay on, those prices aren't really changing much.
Right, that's the key word, right? Therapeutic doses. That's the dose at which these things are proven in trials medically functioning, and not the starter dose of 5 milligrams, the transitioning dose of 7.5 milligrams for Zepbound, for Wegovy and Ozempic. It's different, 0.25 and 0.5. But what they're trying to do, I guess, is get you in, give you a taste of the weight loss, and get you kind of stuck in it before you have to pay full dollar for the therapeutic doses.
Right. And it's really hard for patients because I think even though these discounts are good for patients at the end of the day, there's a lot of confusion. I mean, I'm talking to people who are still paying the $500 for Wegovy and Ozempic when they should be paying a lot less at this point. And so hopefully the price will start to come down across the board and these discounts will be more uniform. I mean, Lilly and Novo both also struck deals with the Trump administration last month to bring down the price of these drugs starting next year. And so hopefully some of these discounts will start to be a little bit more universal. But the hard thing is that insurance coverage is still pretty patchy. And so there are a lot of insurers that don't cover these medications at the moment. And that's why Lilly and Novo are having to discount the drugs the way that they are.
Also, do they want to get rid of some of the stock before someone comes out with a pill that's more popular or a shot that you only take once every 3 months instead of once a week?
Right. I mean, that's the other thing is that pills are coming and that's going to put additional pricing pressure on this whole category. I mean, we're expecting pills probably next year. Lilly and Novo are both working on their own versions and the starting doses of those are expected to be even lower, around $150 a month. And that's part of the Trump administration deal as well. But that's, another expectation is that those will be really widely available to patients. It'll be interesting, though, because obviously the demand for these shots is really, really high. So whether or not people will switch over to the pills or whether that will open sort of a whole new market of patients sort of remains to be seen.
Madison, thanks so much for joining us on this. Really one of the two big themes of these markets over the last 3 years, AI and these weight loss drugs. Now let's get to, it is, of course, Cyber Monday. So despite all the concern around higher prices, a weaker job market, falling consumer confidence, Black Friday sales actually rose from a year ago. Sales increased 4% as Americans flexed their spending power. Bloomberg Markets correspondent Nora Melinda joins us now to tell us what drove the gains and what kind of deals were out there.
Well, there were clearly a lot of deals, and everyone's really been looking for a deal in this environment. I mean, Walmart called it the fact that a lot of consumers were actually going for Vizio TVs and Oura Rings, and everyone's really looking for some way to save money, and they're really trying to get out there right now. As they're looking ahead to the holiday season, you're seeing people really just trying to find any way to save money. A lot of the conversation heading into this Black Friday season has been analysts really looking to see how much of the consumer is spending on buy now, pay later, because, of course, we know that credit card debt is at record high levels right now, especially given the economy that we're dealing with. We've been talking about this K-shaped economy, which, of course, is the bifurcation of the upper class still being able to spend while the lower income consumer is still struggling during this economic recovery. So it'll be interesting to parse through and see what we get in terms of the metrics from the buy now, pay later spending. But clearly people were coming out and they were willing to spend. The National Retail Federation saying that they expected 187 million consumers for a record year. So we'll have to see. Today's Cyber Monday, of course.
I'll tell you that we just got headlines from Klarna, one of the big buy now, pay later companies, saying that it had, I guess, volume up 45% year over year for November 1st through Black Friday, November 28th. So at least in terms of that metric, and it's relatively new, so that kind of growth isn't surprising, but more and more people are using this stuff. What earnings are we going to get this week? It feels like earnings season is over, but we still get retail earnings coming out, right?
Yes, we still have more retail earnings to come. Of course, what we've been parsing really through right now is what TJ Maxx we got Walmart. There's a few others that are coming, but what we're really looking at right now is a very mixed landscape here. If you just parse through the earnings that we've been seeing thus far, we're really seeing a split. We're seeing Home Depot calling out the fact that they're struggling. People are not spending on big ticket items, but then you've got the likes of TJ Maxx doing well. So we're really looking at the discount names in this environment, seeing really outperformance there from their competitors.
All right, it'll be interesting to see what the dollar stores show us this week. Nora, thanks very much. Nora Melinda covers stocks for us here on Bloomberg Television. Next hour, we're going to talk retail spending with Mark Rosen of Catalyst Brands. That company owns JCPenney as well as Brooks Brothers. Check here on futures as we head into the first cash session of December. You can see that we are down 0.6% on S&P futures. NASDAQ futures down about 0.8%. The small caps moving even lower. I will say typically, while over the last 30 years, December is a good month, up about 1%, a little less than that. But if you look over the last decade, it's not a good month, off about 0.1%. We were down 2.5%. December last year. Let's get a look at some of the individual stories that we're following this morning. Canadian miner Barrick is climbing as it weighs an IPO of its North American gold assets. You can see the 3.8% gain in the pre-market there. Airbus is dealing with two new problems on its top-selling A320, the most flown jet in the world. The company found quality issues on some fuselage panels that need inspection just days after revealing a software glitch that affects 6,000 aircraft. These are the ADRs in the pre-market. And Moderna is down after William Blair flagged an FDA memo linking COVID vaccines in younger people to deaths associated with myocarditis, something that we already know way too much about from the pandemic. Coming up, President Trump claims he's picked his next Fed chair, but won't spill the name as buzz builds around Kevin Hassett and the promise of sweeping rate cuts. This is Bloomberg Open Interest.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Let's get to high interest. Look at what's making headlines around the world. U.S. and Ukrainian negotiators called their Florida meeting, quote, productive. Despite the lack of a breakthrough, U.S. envoy Steve Witkoff now travels to Moscow with a 19-point ceasefire plan. Kiev insists any deal must protect its sovereignty, while President Trump says there's a good chance an agreement can be reached. Goldman Sachs is buying Innovator Capital for $2 billion. The deal instantly expands Goldman's footprint in the booming buffer ETF market. Innovator runs $28 billion in defined outcome funds designed to limit losses. The deal lifts Goldman's ETF assets to about $79 billion, and that deal is expected to close next year. Meanwhile, in Washington, D.C., President Trump says he's chosen his next Federal Reserve chair, but he won't name his pick.
Chair, are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell me, Kevin Hassett.
I'm not telling you.
Advisors say Kevin Hassett is the leading contender as Trump pushes for aggressive rate cuts. Hassett calls the rumors premature, but signals he'd support cheaper borrowing costs. An announcement is expected before Christmas. And joining us now with more insight from Washington is Bloomberg's Fed and economy reporter Enda Curran. So, Enda, all signs, I guess, point to Kevin Hassett. Certainly in the betting markets, the odds of Kevin Hassett winning the Fed chair have risen dramatically and others have fallen. What does this mean for the bond market?
Well, clearly the president has said, Matt, that he has a choice made. He hasn't announced who it is, but he's clearly decided that. And it suggests that the process is more or less completed, even though we're told some of those interviews carried on last week and a shortlist was expected to go to the president. Nonetheless, we do expect an announcement this side of Christmas. That's what the guidance from Treasury Secretary Besson has been. Whoever does come out of it, and as we say, our colleagues have reported that Mr. Hassett is leading the pack, is obviously expected to be a dove, Matt. Like you say, I mean, President Trump wants lower borrowing costs. He wants lower interest rates. He's been explicitly critical of the Fed since he came back to office in January about where policy is, very critical of his institution, very critical of Chair Powell. So whoever comes in will probably have to be delivering on at least some of President Trump's political agenda. But they'll have to do that while, of course, maintaining confidence of the market, of confidence of investors, that the Fed does remain independent, that it is pulling the levers in the interest of the economy, not of the political cycle, and that they will remain independent of ultimately not at the beck and call of the White House, so to speak. So clearly, it's going to be a very tricky balancing act if it's Mr. Hassett or anyone else when they do come in as Fed chair next May.
What has to happen for Kevin Hassett to take this job, if indeed he gets picked? Does he need to go in front of the Senate for confirmation, for example?
Yeah, there are some mechanics involved in all of this. Number one, whoever gets picked, Mr. Hassett or otherwise, will need confirmation from Congress. They will have to go through that process. That could be quite a long and bruising process, depending who the candidate is. The Democrats, of course, will have question marks around Fed independence and whether or not this new person will just be an extension of the White House. Of course, the Republican side will have to see how they weigh up and scrutinise their own concerns when it comes to the Fed. And then once you get beyond that, Matt, there's a technicality of making sure that there's a vacancy on the board for this Fed chair. And if it was Mr. Hassett, for example, in that case, existing or current Governor Myron would probably have to step off the board when his current term wraps up at some point early in the new year to allow Mr. Hassett a space if existing Chair Powell decides he's going to stay on. So there's some mechanics there and chess pieces in terms of the composition of the board itself. But ultimately, whoever the president picks will be expected to sail through that process.
We have the next Fed meeting on or decision released on December 10th, right? And we get the change in non-farm payrolls that was delayed on December 16th. Is there any chance that they'll move their meeting until after they get that information in order to make a more informed decision?
There hasn't been any public commentary or signaling on that point from the Fed, Matt. Clearly, it's a very unusual situation coming out of a government lockdown. We're not going to have official inflation data or official jobs data before the meeting next week, like you say. That said, though, you could also argue that plenty of Fed officials have said they've had all the data that they need from private sector sources and from state level. And it seems like the policy committees is at a point now where you're either more worried about inflation or you're more worried about the labour market. And we certainly had plenty of dovish comments towards the end of as we headed into the Thanksgiving break and as we headed into the current quiet period for the Fed, indicating that the doves perhaps were winning out in terms of that debate. So I think there's a view among Fed officials. They've made up their mind. It's not clear whether or not the official data between now and next week would really change that for them.
Yeah, it looks like futures pricing in right now a 96% chance of a cut. Enda, thanks so much for joining us. Bloomberg's Enda Curran covers the Fed and the economy for us out of Washington, D.C. Coming up, Citi's Stuart Kaiser sees a tug of war between negative short-term momentum and positive seasonality for stocks. He joins us next here on Set. This is Bloomberg Open Interest.
This year, more than 1 in 4 cars sold worldwide will be electric. By 2030, that number will climb up to 40%. ASEAN has everything that the global EV industry needs. Bangkok Bank isn't just a lender. We are a connector. We are building a seamless EV supply chain, from raw materials to final assembly. สามัคคีคือพลัง Together, we are strong.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
RBC strategists see the S&P 500 rising more than 10% for a fourth straight year. The team led by Lori Calvasina sees the benchmark hitting 77.50 by this time next year. They say earnings growth and Fed rate cuts will offset doubts around inflation. Joining us now is Citi's head of U.S. equity trading, Stuart Kaiser, here on Set. So I guess it's not a tough call to make if you figure whoever is the next Fed chair is going to cut rates pretty drastically.
Yeah, I mean, I think the question, though, there is why are they cutting rates, right? If you look at market pricing, you're pricing less than about a 33% chance of cuts in all the meetings until June, right? You know, to get the odds of those cuts up, what has to happen? And I think that's the big question. Is simply naming a new Fed chair enough? Or are we going to have to see weakness in the labor market and the growth side of the economy? And if that's the case, you know, then that becomes a little bit of headwind for equity markets. So I do think we're getting to the point now where the Fed is basically data dependent. And now you have to sort of, you know, game theory your way through of what data am I getting to justify those cuts, and what does that mean for equity markets?
I mean, Masayoshi Son, the head of SoftBank, said whoever thinks there's an AI bubble is not smart enough. And he points out that, you know, if AI just becomes 10% of GDP, it will be huge returns. But that's a giant leap from here, right? Does that continue to drive the market next year?
I mean, I think it almost has to continue to drive the market next year to some degree. Look, I think if you're being bullish on the market outside of AI, I think you have to be of the view that you have some stimulus hitting the economy early next year from the new tax and spending policy, and then that's going to sort of stimulate consumer spending and support stuff. If you don't get that sort of stimulus into the economy, ex-AI, then yeah, I think you're kind of reliant on the AI trade here, especially with the Fed kind of now fully priced, right? The tighter credit spreads and lower rates have really helped small cap, kind of rally, underneath the surface. If you take away those rate cuts, you either need a broadening of U.S. economic growth, or again, yeah, you're sort of tethered to that AI trade.
Do you see, just 30 seconds till we have to take a break, but do you see a broadening of gains in this stock market? Because I noted the S&P equal weight index has moved up for 5 days in a row, so they're starting to come back a little bit.
Yeah, I do think clients are of the belief that the big, beautiful bill is going to stimulate the economy early next year, and that should support broadening. Whether that happens, I don't know. Whether investors will try to trade it, I think that is the case, and I think you're seeing early signs of that as we get late into the calendar year.
All right, Stuart, you're going to stick with us through the opening bell. You'll be with us for the first opening bell of December. It's an historic moment with Stuart Kaiser. In terms of the futures here, we do see losses across the board, and we're going to get into the seasonality. I may pull up the SEAG chart on the S&P 500, because if you look over the last 29 years, December is a good month, up 0.9%, but last year was a bad December. And if you look over the last decade, we're actually showing just slight losses for the month. So what happens now after 7 months in a row of gains for the S&P 500? Can we continue to climb? We'll find out. This is Bloomberg. Moments away from the start of trading on this first day of December. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at kind of a dour start to the month, with futures down 0.7% on the S&P. NASDAQ futures down a little bit more, about 0.9%. But to lift your spirits, we have the Partnership for New York City ringing the opening bell at the New York Stock Exchange. Catherine Wild, who leads that think tank, I believe she is stepping down after decades of leadership. They're ringing the opening bell. Down at the NASDAQ, you've got a bank holding corporation, Banner, ringing the opening bell, celebrating its 30 years, 3 decades of listings. And if I look at that stock over the last 5 years, it's up about 75%, so doing fairly well, not as good as the S&P. In terms of stocks right now, we have Nvidia kind of weighing on sentiment, weighing on the indexes. It's obviously very heavily weighted, the biggest company in the entire world, and it's down 1.4% in the cash trade. It's made a $2 billion investment in Synopsys, buying those publicly traded shares. That's boosted Synopsys 5.33% this morning. And then MicroStrategy right now down more than 6% because Bitcoin continues to fall. It's, I think, below 86,000. At one point this morning was below 85,000. And the CEO of Strategy saying if their MNAV falls below 1, that they would sell Bitcoin. That's a little bit technical, but essentially the value of their company compared to their almost $60 billion in Bitcoin holdings. Let's head back over to Citi's head of U.S. equity trading strategy, Stuart Kaiser, at the desk. And, I was saying earlier, Stuart, it's so strange to read the Bloomberg Stocks story and see that Bitcoin is seen as leading this market. I mean, is this asset really big enough to be the tail that wags the dog?
I mean, I don't know if the asset's big enough. I think the sentiment around it is viewed as important. You've also seen a significant pullback in retail trading activity within the equity markets. So I think equity investors are seeing Bitcoin lower. They're seeing retail participating a little less in equity markets, and are maybe a little bit concerned that that sentiment's been dented on that side of thing, and maybe that sort of bid below the market is not as sort of evident as it has been for most of the year. So I think Bitcoin's being viewed more as a sentiment indicator than specifically kind of a pass-through from an asset perspective.
Why would sentiment be bad, since, we have these companies investing trillions of dollars in CapEx. We have double-digit earnings growth that's expected to continue at least in the low single digits, or in the high single digits, I should say, next year. We just talked about RBC raising their outlook, and they're not alone, right? Isn't everything looking pretty rosy as the Fed is going to cut rates? We're getting stimulus from the big, beautiful bill. We may get $2,000 checks in the mail.
Yeah, I think if you pointed to two things, one would be consumer earnings this earnings seasons were a little bit messy, and management certainly talked very cautiously about sort of sentiment and the health of the consumer spending. And the second would be on the AI side of things. The reaction function has definitely softened, right? You had Nvidia traded down on earnings, Palantir traded down on earnings, Meta traded down on earnings. We've all seen what's happened to Oracle's share price. So, I think the sentiment and the valuation on the AI side is getting kind of an audit, so to speak, from the investment community, and more importantly to me would be that retail side of things. Seeing retail participation pull back at the same time that consumer earnings are showing some weakness. I think those are the two things, if you're getting a little bit more cautious, you'd probably point to.
I wonder what you think about Nvidia. I mean, if you get chips from Google or maybe chips from AMD that start to be as good as Blackwell, or at least better at other things, if you get a shift in that leadership, is that bad for the market, or is it good that we have more players?
It's tough. I mean, it's definitely a headwind for Nvidia and some of the leading semiconductor stocks. Same as we saw from DeepSeek back earlier in the year. And you could argue, yeah, that's bad for the semiconductor stock, but cheaper, faster, and more access to AI is actually better for everybody else.
Yeah.
The problem is, as you mentioned, Nvidia is the largest weighting in the S&P 500, so it can negatively impact the index. At the same time, that big picture, it's probably a healthy thing, for the global economy. And I think people are looking at it just that way. It's tactically, it's a risk. But structurally, it's probably a net benefit if it plays out that way.
Wow, Nvidia, by the way, currently at $4.25 trillion. So it's actually lost $750 billion in market cap over the past couple of weeks.
It's all rounding error.
Is the retail sentiment, I mean, is it that important right now? Are retail investors really big enough to drive this whole market?
I don't know if they're big enough. I think it's a little bit the same as Bitcoin. It's really a sentiment issue. And even your institutional investors are aware of retail participation. They're aware of the stocks they hold. And when they see a change in behavior, that kind of implies a change in the supply demand of the market. And I just think it makes people a little bit more cautious until they're confident that things have settled down. I mean, we estimate retail was about 15% of the market from a volumes perspective late in October. That's down to 10. It's a significant pullback. So again, it's the flows is part of it, but it's also the knock-on impact it has on sentiment and risk management on the institutional side, I think.
If you have a big client, if you have a whale calling the Citi trading desk and says, I have new money to put to work, what do you do with it?
I wait till year end. No, look, I think into year end, we do expect the markets to rally, and we think what's worked in the first 11 months of the year.
By the way, wait till year end is a fine answer. I mean, that's okay. It's only 1 month away. So
unfortunately, people will push back if I give them that answer. Look, so into year end, we think seasonality will take hold. We think your year to date winners are going to lead you. As you get into early next year, there's a lot of interesting, you mentioned S&P equal weight. There's a lot of interesting rotation, I think, opportunities. Healthcare has caught a bid recently, whereas we're seeing supply of financials, for instance. Financials have been an overweight, healthcare have been an underweight. So I think as you get into early next year, you do want to look at some of these rotations and leader laggards trades. But from now until year end, I think you want to play straight down the middle, be long equities and be long the winners, because we think that's what's going to drive you into year end.
We finally have $1 trillion healthcare company, right? Eli Lilly eclipsing $1 trillion in market cap with its weight loss drugs, Zepbound and Mounjaro. This isn't a theme that it seems like investors are playing as much as, it affects the consumer economy. What do you think about these healthcare companies and these weight loss drugs?
Look, I think healthcare has faced two pretty big headwinds the last couple of years. Number one was you had a regulatory environment that did not allow M&A. Right? So that took the valuation premium away from smaller biotech companies, et cetera. And secondly, that meant your large cap companies, other than the obesity drugs, were kind of starving for growth because they would normally buy the growth from those smaller companies. So I think what you're seeing now is the valuation has gotten pretty low. People are viewing it as a more positive regulatory environment. Lower interest rates have helped. And all of that has gotten people saying, you know what, maybe this has underperformed too much and maybe we want to step into it. We've been pretty bullish on healthcare for, I would say, the last 4 to 6 weeks around the obesity week. week, we kind of thought that would be a little bit of a catalyst, and it has been. But look, big picture, the question
this week is obesity week?
Well, obesity week was a couple weeks ago. They did it before Thanksgiving.
I see, because it feels like it was obesity weekend.
It does feel that
to
way.
me. But, I mean, Lilly's up 47% in the last 3 months. I mean, it's really, the slope has changed.
Yeah, no, it has. And I do think, the M&A story, the laggardship of the market, lower interest rates, and people really getting behind the idea that the government may be willing to sponsor purchases of those drugs in a more substantial way has been really positive for the space.
Oh, you know what? Joe in the control room prepared the seasonality chart. We might as well look at it since he put it together. We have this great function on the Bloomberg terminal, SEAG. You can use it with any index, maybe individual stocks as well. And here is a look at the last 10 years. It's a little bit confusing, but the top line is the average, right? So even though December is traditionally a good month over decades, over this decade, it's turned down. You're still confident in a Santa Claus rally?
Yeah, we're still pretty confident. I mean, December 2018 was obviously a pretty tough one, but big picture, if you go back 30 years, 40 years, 100 years, December's always been pretty positive, and we ultimately think that'll happen.
Yep.
I think last week was a good test case. We didn't have much news. It was a very quiet week, and we kind of started to drift higher. So that kind of shows you that no news is good news in this case. The Fed's now kind of fully priced. So I think that December 16th date, where we get the dual payrolls prints, is probably the most important day for the rest of the year. But yeah, we do expect seasonality to kind of kick in again.
All right, Stuart, great having you here. Thanks so much for joining us. Stuart Kaiser there from Citi is the head of equity trading strategy at the bank. Let's get a check on the stock market right now. On a broader sense, you see the S&P 500 is down just about 32 points, so a drop of about 0.5%. This is the move screen, so you not only see the breadth here, 116 stocks up, 385 down, but you can see a breakdown of who's helping and who's hurting. So on the upside, Amazon is adding 2.5 points. Then you've got Lilly adding almost 1 point, 0.6 of a point here. Synopsys also notably adding about a third of a point, and a much smaller company, of course. On the downside of the ledger, you've got these AI plays, right? Broadcom dragging the index down by about 7 points, 6.5. Microsoft by 4.5 points. Nvidia dragging the index down by 2.5 points. And then you've got Facebook, Apple, and Google, as well as Palantir and Oracle. So the AI trade is really what's hurting us. Let's take a look at the GRR. This is group ranked returns on the SPX L1 index. And energy, as the spike in oil continues this morning, in that trading, you can see that pushing up energy producers and consumer discretionary, as well as consumer staple stocks. So consumer doing well on this Black Monday, or sorry, not Black Monday, Cyber Monday. Black Monday would be far worse than a 0.5% drop. The utilities index is the biggest loser here, but you can see IT is also a loser, down 1%, and communication services, which these are the hyperscalers right now, just off about 0.75%. Coming up, stocks and crypto start December on the back foot. A closer look at tech sentiment with Mandeep Singh of Bloomberg Intelligence next. This is Open Interest.
Our ultimate goal was to turn the fridge from a storage box to a smart kitchen manager that helps the users.
That comes down to finding the optimal location for our camera.
I am most proud of our image matching algorithm. The entire user experience has to be fast and seamless. When it worked like we expected, it was really a breakthrough.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
It's time now for Top Call, some of the analysts' action and focus this morning. First up, UBS initiates Carvana with a buy rating, saying its online platform is attracting more used car shoppers. The firm's highlights, the firm highlights, I should say, UBS highlights Carvana's strong customer experience and technology advantage, saying that this edge should help it capture share in a fragmented market. Next up, JP Morgan names ASML as its top semiconductor pick, saying the company is best positioned as chip makers prepare for a new long stretch of investment sparked by improving memory prices. I believe ASML actually designs the chips, doesn't really actually make them. And finally, Guggenheim is boosting its outlook on Alphabet, arguing that Wall Street is still underestimating how much revenue Google Cloud can deliver over the next few years. The firm points to strong backlog growth as evidence of a plausible bull case that could generate $40 billion more in revenue than the consensus expects. That's interesting, and let's talk about that. Get the general tech outlook with Bloomberg Intelligence Global Head of Tech Research. Mandeep Singh joins us here on set. ASML makes the lithography machines, right? Mm-hmm. So they don't make the chips or really design them. They make the gear that makes them.
Yeah.
Just wanted to get that straight.
Yeah.
All right. What do you think about this Google call? I mean, it does look like they could generate significantly more revenue than the street expects, especially now that we know about the TPUs.
Yeah, and look, I think everyone is thinking about the total data center capacity that'll get added in 26, 27. And so from that perspective, what has changed is previously OpenAI told us they're going to be adding 26 gigawatts, 20 gigawatts on their own, 6 with AMD. Now I think everyone is realizing, one, they may not have the ability to pay for those 26 gigawatts. Second, because Google is so much more efficient with their CapEx, they may have an advantage in terms of adding more capacity that gets translated into cloud revenue. So really, everyone is still excited about GenAI build-out. It's just who builds what. And Google certainly has an advantage with the vertical stack they have.
I also wonder, the wealthiest consumers in the world probably overwhelmingly use an iPhone. And when you buy the phone, it comes with some software, some apps already on it. I figured it would come with ChatGPT preloaded in the coming years, but it may come with Gemini 3 preloaded, or 5 or 8 or whatever generation we're on. Do you know anything about what's coming on that?
I mean, especially with Apple, it wouldn't surprise anyone if Gemini is preloaded, because Apple has been using Google, for the past 10 years for a lot of the defaults, which is why Google pays those $20 to $25 billion to Apple. And look, a thing like large language model, which we know Apple hasn't invested in building their own large language model, it makes sense for them to rely on an existing partner like Gemini, where they don't have to pay as much to a default LLM as they may have to pay for OpenAI. So from that perspective also, there is a very high chance that Apple ends up using a Gemini. I don't know if it's going to be preloaded, but it will be one of the default apps that'll be running on your phone.
What's the expectation for an Apple? Because it has underperformed, for example, Google significantly, and obviously Nvidia, and others in the AI space as well. But you note that investors are starting to reward companies that are efficient with CapEx. Yeah. So not getting involved in this dogfight is pretty efficient to begin with, isn't it?
And look, right now, 3 or 4 companies are trying to train the same most powerful LLM. So think about what the Gemini 3 did, was to release a set of features that OpenAI will try to replicate. Is it really very efficient for investors to pay these companies to invest in training their LLMs when the functionality converges to a point where all 4 LLMs will have similar features? And that's where the market will be more discerning in terms of figuring out who they want to spend versus who they don't want to spend. And I think we may be close to reaching that moment in 2026, because you just want to, these companies are talking about billion-dollar training runs where you're spending $1 billion in training a model, and guess what? The output will be similar to an existing model.
Right.
It's just not very efficient.
By the way, to be fair to Apple, it hasn't underperformed everybody. I always look at a 5-year snapshot because the comp function defaults to that. Amazon is a huge loser compared to the rest of the Mag 7. And they have such an incredible cloud business, right? They must have a capable LLM in training. Are they not going to cash in on that?
Actually, they don't. So even though they have their own Nova LLM, it is still way behind the frontier LLMs, and they have a partnership with Anthropic. So from that perspective, you know, being that incumbent public cloud market share leader with over 50% share, when I look at all the other cloud providers like Microsoft and Google, AI is almost adding 20 percentage points to the growth. So Microsoft grew 40% this quarter. 20 percentage points came from AI workloads. That's not the case with Amazon. Amazon grew 20%. AI contribution could be maybe 2-3%, maybe 5% at best. So from that perspective, Google and Microsoft are getting a much bigger contribution of AI infrastructure workloads than Amazon is, and that probably explains why they haven't benefited as much.
Yet. Because Nova is a star that increases in brightness at a sudden and rapid pace, up to 14 magnitudes. So maybe. Mandeep, thanks so much for joining us. Mandeep Singh there runs our tech coverage for us at Bloomberg Intelligence. Coming up, Barrick shares rise on news of a potential IPO of its North American assets. We'll take a deep dive into the gold miner next. This is Bloomberg Open Interest.
Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing to kick off the week and the month. S&P 500 down 0.4%. So looking a little bit better than futures, looking a little bit better than it did the very first few minutes of the cash trade. And I'm over my shoulder here, out of the corner of my eye, you can see that Nvidia is rising. So that could change things. I do want to look at not the big indexes, but Nvidia up right now 0.4%. So a turnaround there that could help to lift things. Alphabet shares, Google down 1.3%. This was the story of last week, right? The rivalry here in terms of GPUs and TPUs. Disney had, I guess, a good weekend because Zootopia 2 came out, and it was okay. I don't think it was as good as Zootopia 1, but my 5-year-old daughter loved it. Warner Brothers, the deadline for the new bids that they're seeking is today, so there's a little movement there, but not much. Gold, even less movement, but we're showing you that because we're going to talk about Barrick right now. Maybe on its way to an IPO for its North American assets. It's mulling that. It's considering. It's probing the possibility there. For more on this story, we're joined by Bloomberg senior markets reporter Bailey Lipschultz. Bailey, I'm going to walk off set here and over into yours.
I'll wait and see you. Over here.
So what do we know about the Barrick story? As you know, this underlying asset doing nothing today, but over the past year has just rallied so far so fast.
Yeah, rallied very strongly, just given kind of overall sentiment. The big news is that the board approved management to consider IPOing their North America assets primarily. It's going to be partnered potentially with a larger mine in the Dominican Republic. But the big news from that is when you look at this Nevada mine, it's really been undervalued, according to analysts. Bloomberg Intelligence saying that the North American assets could be worth nearly $62 billion by themselves. Why does that matter? Overall, right now, the stock, at least on the U.S. trading, valued at $72 billion. So when you look at this potential unlocking a lot of opportunities, the big pitch from analysts and kind of the management team is that this can kind of narrow the gap relative to rivals, which has been something that has been weighing on the company.
Right. And the reason that we invite you on the show to talk about this story is not because you know so much about gold or Barrick, but because you know so much about IPOs because you cover that part of the market. How are the animal spirits? How are IPOs looking in 2025?
So far this year, it's been relatively mixed. The pullback that we've seen in the last month really did dent some of that appetite. We saw mid-November before that pullback, the average stock was up 22%. That at one point was essentially flat. Now we are still seeing a rebound. We do see investors wanting to put money to work. Mining companies and things in the gold and more defensive space are going to be interesting just because a lot of investors do want these growthy assets. They want to chase the crypto names. But when you really look at the companies that end up being some of the biggest winners, they are in the defensive space. We're looking at potentially seeing a Medline filing, which will be a huge healthcare company in the next few weeks, trying to get out before the year-end holidays. So when you look at overall appetite, we are up year over year for the third consecutive year, not quite back to the pre-pandemic norms, but we do see pretty good demand so far in 25 and a lot of excitement for next year.
I will say I had forgotten we have a function IPO Go. And you can click on the time series tab in IPO Go and you can see, the value, which has shot up, the deal count, which has dropped significantly. And it's just a fun function to play around with on the Bloomberg terminal. I'm not advertising it any further than that. I'm just telling you.
It is a good tool, but it does take a little bit of effort to know what you're looking for.
Here's the value picture of the time series. Check it out. Play with it on your own terminal. Bailey, thanks so much for joining us. Bailey Lipschultz there. Coming up in the next hour, Liz Ann Saunders joins us as we kick off December.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
You look over the past, say, 30 years, December usually gains 1%. Do you expect a Santa Claus rally into the end of the year?
Possibly. It wouldn't surprise me, though, between now and then where we get a bit more choppiness and weakness. I think some of the position unwinds are maybe not sort of fully baked in, but then to see a bit of a rally, particularly after the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
Does it puzzle you to see that futures are now pricing in a 96% chance of a cut? Are we all on board that a December cut is definitely happening?
Well, the Fed doesn't tend to buck market odds when they're as lofty as they are right now, but it wouldn't surprise me if we got what is often termed a hawkish cut. You could argue that if the Fed is thinking maybe there's a moment where a pause might make some sense, maybe it's better to provide that cut now, given market expectations, but then essentially telegraph a pause as opposed to having cut at the recent meetings, then say we're pausing in December and then telegraphing another cut given the absence of data. So in my mind, that's the most likely scenario, is the Fed cuts, and in the statement and reinforced during the press conference, it's a little bit more of what we heard last time, which is let's not assume we're on this continued path of additional cuts to come, at least in the near term.
If you zoom out, though, Lizanne, I guess it doesn't really matter so much what happens in December. If, President Trump picks a dovish chair, Kevin Hassett or any of the other candidates, and we do get a terminal rate at 3% or even lower in 26, 27, is that great for markets?
Well, first of all, the C in FOMC does not stand for chair; it stands for committee. So this is these are decisions that are made by committee via a voting process. And I think what's maybe interesting as we head into what everyone is assuming, and I know you guys are reporting, it's going to be Cassett, that the greater willingness for dissent, for voicing opinions and perspectives about the path for monetary policy against some, sort of standard chair-driven view, like under the days of Alan Greenspan. I think it's an interesting time, and I would expect that there will be bigger differences in terms of the voices as we hear Fed speakers out on the road. But I also think on a going forward basis, like we have seen in the recent couple of meetings, greater number of dissents, possibly in both directions, which may be a way to reinforce the independence of the Fed and the ability and willingness to buck any one particular voice.
All right, so that's the macro look at what's going to happen with the Fed. If you step into this market of stocks, Lizanne, and look at the valuations, we saw in a John Author's piece this morning that valuations for the cap-weighted S&P 500 that we all know and love are up around 25, whereas the equal weight is still at 20. Because these, Mag 7 stocks, and Nvidia in particular, are pulling us so much higher, does the concentration risk concern you?
Well, here's the thing about the Mag 7, and I think we're going to start to see maybe less of a focus on that particular cohort of 7 stocks, because none of the 7 rank in the top 10 from a price performance perspective. And in fact, none of them are the number one contributor to year-to-date S&P returns. So I think that's a really important point, because I think many investors conflate contribution and price performance. Nvidia is still the second largest contributor to S&P gains, but it's ranked worse than, I think, 60th in terms of ranking within the S&P 500. Broadcom is now the number one contributor to S&P returns. It's among the better performers. It doesn't happen to be in the Mag 7. So I think next year might be the year where there's a little bit less of sort of this unifocus on that particular cohort of names.
Well, we have seen the equal weighted index. By the way, I'm showing the chart where you can see the valuations, the earnings multiples have separated. And the reason we note from 3 years ago is because today, I think, or Friday was the 3-year birthday of ChatGPT. So that's a huge driver there. We did see the S&P equal weighted index rallying the last 5 sessions in a row. Are you starting to see that broadening out? And do you think the all-important retail investor is dipping her or his toe into that as well?
Yeah, I think investors across the spectrum, inclusive of institutional investors, are looking to take advantage of some of these rotations that are happening. And I don't think it's just purely a rebalancing that tends to kick in when you get to the last month of the year, either rebalancing strategies on the part of individuals or the more formulaic rebalancing strategies on the part of many institutions. I think there really is a thirst and a desire to find opportunities outside the mega cap leadership or prior leadership areas. And I think that is likely to persist. Now, I think equal weight is pretty interesting here right now. That said, I think it may be still at this point a stretch to say that's going to be linear and that we're going to see persistent outperformance by equal weight. But I think we're going to see fits and starts of it. I think there is a lot of money looking for opportunities, whether it's because of valuation concerns, frothy sentiment concerns, leverage to any sort of additional easing on the part of the Federal Reserve. There's lots of sort of fundamental rationales why that would exist. And I do think that that is going to continue, but importantly, not in a linear fashion in fits and starts.
All right, well, we'll continue to watch for it and really appreciate your time this morning. Liz Ann, thanks so much for joining us. She is the Chief Investment Strategist over at Charles Schwab. Now, the broadening may be something worth paying attention to, but we're going to focus in on Nvidia right now because it did flip into the green earlier after disclosing a $2 billion share purchase of Synopsys stock. Bloomberg Tech co-host Ed Ludlow joins us now to talk about what this means and why. So, Ed, I gather Synopsys designs or makes software that helps to design chips, right?
Yeah, it's the tool by which a chip is designed, but also validated. So before you send a chip through the fab to be manufactured, you test that actually the design is going to work. And it's really interesting because Synopsys is a supplier to Nvidia. They use that software platform. The stock's up 5%. Nvidia bought these shares at $414.79. It's now up near $440 a cent, taking between 2 and 3% of the company, replicating a playbook that you and I have discussed with Nvidia a couple of times this year. They took a stake in Intel in what was an engineering partnership. They took a stake in Nokia, which was also an engineering partnership in the telecoms domain. So there is some questions about, well, what does Nvidia get out of this? Synopsys is used by basically anyone that has their own chip designs, right? And so there's an argument that this gives Nvidia a sales channel. Synopsys will say, our software platform is so much better when it's run on Nvidia GPUs. So if you want to use our software to design your chips, you should also use it with Nvidia GPU to power that compute.
It seems like Nvidia, it's almost like an investment business as well as a chip maker. They have stakes in so many other companies.
Yeah.
It's got to be a huge portfolio. Is this part of the strategy?
I mean, we've had the opportunity to discuss this with Jensen Huang several times this year. Every time I've asked him what's the rationale behind taking 2 to 3% of a company, he basically will say, I thought it was going to be a good investment. And particularly in October when we were in DC and they made the Nokia investment, that day Nokia stock jumped 20% and he almost joked with me, well, I was pretty genius move, wasn't it? His words, not mine. But, it's kind of separate from the circular financing debate in that, they take equity positions where their bet is that the technology partnership moves the field forward in some way, and they get a return on the stock different to, say, lending money that's discussed in Ian King's Tech Daily today, the circular financing versus backing up loans debate. For Jensen, it's a very simple calculus. Is this or is this not a good investment? And they've got some cash to spare right now.
The debate or the story really of last week was Google TPUs and how efficiently they power Gemini and also Gemini versus ChatGPT. John Authors has a great column today wishing ChatGPT a happy 3rd birthday. How does this all seem to be shaking out? Because it seems that that SoftBank's CEO Sun was so sad that he almost cried when he had to sell his Nvidia stake, but he needed the money to invest in OpenAI. Like, what if they're not the ultimate winner?
Yeah, I followed this story from the beach last week because, as you know, I took a break, but it was kind of interesting to take a step back. The very simple argument for those that are still bullish on Nvidia and discount the threat of a Google TPU is that Nvidia is still supply constrained. They will sell every single GPU that TSMC can manufacture for them. And their margins are high, so there's no price pressure. There's no suggestion that Nvidia is having to discount to ward off some of that threat from TPU. TPU is also not that new a thing. I think this is what's so interesting. It's come up in the news flow because Google has started to do deals with third parties. The latest reported one that spooked the markets was Meta, right? But they had previously tried to make the TPU available to third parties with less success. And right now, from a volume perspective, Nvidia still holds 90% of the market, which when I grew up in the Bloomberg newsroom studying from you, that's a technical monopoly, right? And that's an enviable position to be in.
Well, now the teacher learns from the student. Ed, great to have you on the program. Look forward to Bloomberg Tech kicking off in just about 48 minutes. Ed Ludlow talking to us about Nvidia, which has turned around this morning and may drive a change in markets as well. Though they're still down 0.4% on the S&P. As you can see, the NASDAQ off about 0.5%. Coming up, private credit bulls are on a mission to stomp out rising hysteria over the so-called cockroach risks. Danielle Pauly, Oaktree Capital Management Assistant Portfolio Manager, joins us to talk about this next after Paul Davies wrote an interesting column on it, and Mark Rowan had a lot to say about it last week. Everybody's weighing in. We'll talk about it with Danielle next. This is Open Interest.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Let's get to high interest now. Look what's making headlines around the world. Ukraine launched a record wave of drone strikes on Russian oil infrastructure last month, hitting refineries at least 14 times and damaging Black Sea export terminals. The escalation comes as the U.S. pushes for new peace talks, and both Russia and Ukraine intensify attacks on each other's energy systems ahead of the winter season. Strategy set aside $1.4 billion cash reserve to cover nearly 2 years of dividend and interest payments. The move aims to ease fears it may have to sell Bitcoin as prices slide. The company also cut its 2025 earnings outlook as it assumes lower Bitcoin prices. And New York City will likely have a slick commute tomorrow, while the rest of the Northeast gets a dollop of snow from a storm rising up from the U.S. Gulf Coast. The storm will likely spark travel delays across the region and put more pressure on the U.S. air traffic control system, with planes needing to be de-iced and runways kept clear as high winds sweep across the region. So be prepared for your travel time to be much longer. Turning to the growing fears in the private credit markets. In his latest column out this morning, Bloomberg opinion columnist Paul Davies writes, quote, defaults among junk-rated private borrowers have climbed steadily since U.S. interest rates began rising in late 2022. The trailing 12-month default rate hit 1.3% of all loans this summer, which doesn't sound like much at all, but it's up from less than 0.5% in August and September of 2022, according to S&P Global. Joining us now is Danielle Pauly, Oaktree Capital Management Assistant Portfolio Manager for Global Credit Strategy. And Danielle, this just adds to the concerns we've had from a spate of bankruptcies that may well be idiosyncratic issues, but nonetheless, investors are worried. What do you say?
Termites are not eroding the foundation of private credit. I think that's the key. And so while we have seen defaults increasing, we should dissect that a bit because the entire market shouldn't be painted with a broad brush. I'll start with the best. The high yield bond market, defaults are actually low. They're below historical averages, and that makes sense. This is a high quality market, over 50% double B in this market right now. Defaults are increasing. They're elevated in the leveraged loan market, as has been pointed out, a little bit above historical average, which makes sense because a lot of the issuance of the low rate period got done, and those borrowers now have higher rates and are defaulting at a higher clip. But really, where the maybe mass defaults are lying is in private credit. And I think that that's where investors get concerned. But you need to focus on non-accruals, PIK interest. Not all PIK interest is created the same. So maybe bad PIK, you're getting around 5-6%. That's an elevated default, but not so high that as a credit picker at Oaktree, we can't find good loans to give to our clients to offer them an attractive income.
All right, I'm not as well versed in this stuff as my colleague Danny Berger, so it's a horrible time for her to be off. But I know that PIK stands for payment in kind, and this is, what is it? Not at all a default, but a reworking of the credit covenant where they'll add interest to a loan if they're having the borrower is having a tough time?
That's exactly right. So instead of paying that interest in cash, it'll be paid in additional, effectively, shares of a company, or just increasing your outstanding loan amount in the case of credit. And what it does is allows some flexibility for that borrower to get things in order instead of going into a traditional default and handling it in court through a bankruptcy.
So is that market getting bigger? Because that seems troublesome, I guess, from some people's point of view. Also, from others, maybe an opportunity, right?
Right. You know, I think if done appropriately, it can be an effective tool. So for us, we will look at PIK, but we often like to have 50% of it in cash, so a bit of protection. What's really important is in the private credit market, you have bilateral agreements with your borrowers. You're able to spot things early. You're able to partner with them to help provide these types of solutions to maybe get to a better rate environment. It looks like we might get this cut in December, and it looks like the trajectory of rates is going to be down, which generally should be good for borrowers.
So how does the market look right now? You know, I'm always scared of everything, so I don't have the courage. Okay, good.
Yes.
But whenever I talk to, sometimes I talk to Howard Marks, you know, your boss, and he'll say, like, I'm not scared, and there's not enough opportunity. Like, he wants more, right?
Yes.
Do we have that opportunity right now, or is it still looking pretty sparse?
Well, the kindling of the fire, I guess, is there, right, with the lax lending standards and some of the complacency issues we've seen, especially funding AI. I mean, there's just been a lot of deals that are getting done that we're scratching our heads about. We're remaining very disciplined because we do think that we're late in the cycle, and there could be opportunities for us at Oaktree to do more rescue lending, opportunistic distressed investing that we're known for as the cycle changes. But today, there's a lot to do in the core of the market. There are the tails, but if you avoid them, you can put together a high-quality performing credit portfolio that's giving you a yield of around 7.5%, 8%, all liquid. And then beyond that, when you start incorporating private credit, which still gives a yield high single digits, in some case double digits.
So what I'm hearing from you is a lot like what I'm hearing from Mark Rowan or Mark Lipschultz when we talked to him at Blue Owl, which is, at least in part, that what really matters is the team that you choose to run this credit for you, right?
Yeah, that's
it's a
absolutely
differentiator.
Right. You know, we're a bottom-up investor at Oaktree. Risk control is the primary tenet of our investment philosophy. We like to say, if you avoid the losers, let the winners take care of themselves. Income is so high, so if you can avoid those cockroaches, you will be great and you will get a really good return. I mean, credit today not only gives you a good income, but it's a place to hide out from the volatility in equities. Equity valuations are pretty high right now, and I think susceptible going into year end to some additional volatility.
All right, Danielle, great having you on set. Thanks so much for joining us on Open Interest. Danielle Pauly there of Oaktree Capital Management. We had her on our Friday interest rate show, and I said we have to bring her back to the main event. Still ahead, Black Friday shoppers came ready to spend, pushing sales up more than 4% over what they were last year, despite the softer economy, or at least the view of a softer economy that you get when you look at consumer confidence. We'll get the boots on the ground view from retailers with Mark Rosen. He is the CEO of Catalyst Brands. They own JCPenney, they own Brooks Brothers, and Greg Hewitt joins us of DHL Express US to talk about shipping, the all-important indicator there. This is Bloomberg Open Interest.
A lot of our inspirations for new features comes from experiences in our own daily life.
The other day, I needed to double check an important meeting schedule by finding a specific call recording. Thankfully, with call summarization feature on my Galaxy, I could quickly find it.
Our users ask complex questions, and our model has to be able to speak multiple languages. What seems impossible now can quickly become possible.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Bally's shares up after the casino operator and Steve Cohen bid for a casino in Queens, New York, won approval by the board. So we see that Steve Cohen, famed hedge fund operator, and Bally's are getting picked to run New York City casinos. And as a result, Bally's shares are up more than 10%. You can see from that action there. We're going to bring you more on this legal gambling in New York City, casino in New York City. Specifically, it looks like in Queens. And Steve Cohen, also owner of the New York Mets. And Joe will tell me in a moment how the Mets have done under his ownership, gets picked to run this casino. We'll talk more about that as this market continues to fall this morning to kick off December on a weak note, down 0.5% on the S&P 500. Coming up, Black Friday sales coming in strong as retailers are ready for Cyber Monday. We'll talk to Mark Rosen of Catalyst Brands next. This is Bloomberg. The U.S. consumer remains resilient. Data from MasterCard showing retail sales rose 4.1% on Black Friday. That surpasses last year's 3.4% growth. So better than last year and better growth as well. For a boots on the ground look at the consumer, we welcome Mark Rosen, Catalyst Brands CEO. Catalyst is the parent company of retailers like JCPenney, Brooks Brothers, Eddie Bauer, Aeropostale, Lucky Brand, Nautica. You know all the names. Mark, welcome to the program. Thanks for joining us here in studio. How was Black Friday and how is Cyber Monday shaping up?
Yeah, thank you for having me. So Black Friday was, as it always is, I think just a super exciting day for all of us in the retail business. I was out in stores that morning, and we had lines around the store at our JCPenney stores that morning of customers coming in for our 5 a.m. deals. They were waiting to get a snow globe, which is one of our historic nostalgic giveaways, but also a coupon book. I think consumers were really focused on value and deals this holiday. I will say the other big thing that we noted on Black Friday was Gen Z was fully in on Black Friday this year, and it was really exciting to see Gen Z shoppers out in the malls. Our Aeropostale brand did really, really well with strong sales and a really strong presence of Gen Z coming out.
It does feel like there's like a 90s comeback somehow.
That's right.
I don't know when Aeropostale really hit the first time, but there's definitely a second wave for these kind of brands. That's and right. You own a lot of them. How is that shaping up and what's driving it?
It's across the portfolio, right? I think the thing that brings our brands together is we have historic brands that the consumer knows and loves, and the thing that brings them together is it's also incredible fashion at a really affordable price. I think so. If you look at Aeropostale for the teen customer, all the trends, Y2K is actually the trend right now, right? It's the wide leg, the baggy, the low-rise denim, and that's doing really well. And so we're seeing consumers really come in for that. Brooks Brothers, which I know you're a shopper
It's near and
of.
dear to my heart.
Exactly,
yeah.
Right? So Brooks Brothers also had a great Black Friday, and we're moving into Cyber Monday, but there it was all about sweaters. So merino wool sweaters, cashmere sweaters, and the quarter zip is actually we have a quilted quarter zip that was our #1 selling item on Black Friday as consumers are coming in for that.
What are the common themes among the brands? You've had significant growth over the past few years, and you developed a great portfolio of brands. What are the common threads behind all of these businesses that you've put together?
I think the common theme, if you put it all together, is really accessible fashion for the American consumer with brands that they know and love. And that's really the thing is we've been able, as we put the whole portfolio together, if you think across JCPenney, if you think about Lucky Brand, and if you think about Aeropostale just as the primary brands for denim, and you think about the amount of denim that we source and buy for consumers across all of those brands, what the combination, which was just formed in January, has allowed us to do is put together all of that sourcing and really make sure that we're bringing the best value for the consumer by finding the best prices on denim and really giving that to the consumer on days like Black Friday. And, in this time where the consumer is really value focused, that is what's making the difference right now.
So how have you navigated what's been a volatile year in terms of policy, right? Tariffs, I imagine, must have a huge effect on the amount you pay for textiles. How do you how do you equal the hit of that in margins?
We work closely with our suppliers. Again, I think the combination this year was probably really well timed with tariffs to give us the combined volume of things like denim, like fleece, and looking at that combined buy across the total portfolio, and then working with our suppliers to get the lowest possible cost for consumers. And we've been committed to that throughout the year. At back to school season, we talked about it, but again at Black Friday, if you look at JCPenney, for example, well over half of the items that we offered at Black Friday deals matched the pricing of last year, because that's really the job of our merchants, is to make sure that they can deliver that pricing for the consumer. At Aeropostale, we delivered the same promotion that we had last year, which was buy one, get one free denim. And again, that's our merchant teams working with our suppliers to make sure that we can bring that to them. And at Brooks Brothers, it was the cashmere and the merino wool sweaters, the same pricing as last year.
So, I mean, good deals for Black Friday and for Cyber Monday is great for the consumer, but you must have to take price somewhere, right? So what's it look like over the totality of 25 and going into 26?
As we look across the total portfolio, again, it is the job of our merchants to make sure that they are working to get the best costing from our suppliers and deliver that in value to the consumers, and we mix that out across the total portfolio. And so we are really focused on making sure that the key items that our customers are looking for at the big moments like Black Friday and throughout the year like back to school, that we are delivering like item at like value.
In terms of 26, what do you expect for next year? Because the consumer has been resilient. The U.S. consumer is always resilient, right? Don't count out the U.S. consumer. But consumer confidence numbers were low. There's real worry about the labor market. And I was surprised to see such growth in this season. So what do you expect for next year?
I think the interesting thing about the consumer is we definitely see that the consumer has stretched wallets right now. But we also know that the consumer is going to make sure that those moments that matter for their families and the ones that they care about, that they are going to make the most for those moments. And so the consumer is going to have holiday and Christmas this year. What they're searching for is really more for value, and that's where we really win. At JCPenney, for example, this was the 4th year that Wallet Hub named us as the best place to find Black Friday deals. So we're making sure that we have the deals, that we're showing the value, and that is what's really important to the consumer, because although the wallet's stretched, they're also committed to taking care of their families.
All right, Mark, great having you here in studio. Thanks so much for joining us on this Cyber Monday. Mark Rosen there of Catalyst Brands. Let's get a check of what's going on in the stock market right now. We are still seeing drops, actually 0.6% on the S&P 500 to kick off this December. Traditionally, December is a strong month for stocks. We've, over the last 30 years, have gains of about 0.9%. Right now, we're not looking like that. Coming up, the U.S. consumer remains resilient. As we've said, Black Friday sales rising. As we said, we're going to get another check on this economy. Greg Hewitt joins us, DHL Express U.S. Chief Executive Officer, on Cyber Monday, and the read on retail from a shipper's lens. This is Bloomberg Open Interest. Holiday shoppers are spending big. November sales jumped more than 7% year over year, according to Adobe. Now all eyes are on Cyber Monday. For a behind-the-scenes look at the logistics powering it all, we're joined by DHL Express U.S. CEO Greg Hewitt. And Greg, this is where we get a great read on the industry, on retail, because if you buy something, especially on Cyber Monday, it has to be shipped. What are you seeing?
Well, so far, so good. Thanks for having me, Matt and Danny. It's good to be on. So far, things look good. The routes are out on the road, getting deliveries from Black Friday done. We're expecting a lift of about 33% during this peak season. That's U.S. Thanksgiving to Chinese New Year versus our Q3 run rate. That's a little bit below what I would say our biggest peak seasons, but a good modest peak, coming off a bit of a downturn this year with volumes down 30% overall. It'll be nice to see a lift during peak season.
What were the record years, Greg? What were the biggest peak seasons?
The biggest peak seasons would have been during the COVID years, where you not only saw everybody at home shopping online, you had things like personal protective equipment, you also had the vaccines moving around. Those produced our biggest volumes. But I guess with some of the changes in the regulatory environment this year, there was a lot of uneasiness, a lot of concern around what would volumes look like. It was great. We talked to 400 small and mid-sized businesses recently, and over 40% of them said that they were expecting larger orders this year versus last year. So that's good, some good optimism.
Yeah, I mean, we don't need to, we can go to stores and buy stuff. We don't need to ship everything. And of course, you have the tariffs, which I imagine would have been a headwind as well. But have you felt those tariffs? Has it been a problem?
Well, I'll say that it has created some volume declines, 30% year over year. It's also created a new challenge for me, which was staffing up to handle the complexity. We've added more than 600 people to the team in things like clearance and brokerage operations, finance and duty billing, and customer service to help get goods cleared accurately, compliantly, and delivered on time, and to have the back end support in collecting those tariffs from customers where applicable.
Yeah, I actually had a package. My German mother sent me a birthday package that was rejected by customs and went back to Stuttgart. I still haven't gotten it. Are you having more and more of these problems where because of new customs rules, because of new tariffs, because of the complexity, a lot of shipments just can't get through?
I wouldn't say we've had a lot of problems with goods not getting through. I think there are two things. One up front, really important as a consumer to, when you're buying something online or you're having a family member ship it to you, make sure the paperwork is accurate, contains all of the harmonized tax code information, that we've got a good email address or cell phone number that we can reach you when we need to ask a question for some clarity or we need to collect those duties and taxes. I think if we get those things right, me adding the team, the staff that can actually do the clearance work and connect with you can mean that there's no disruption at all. Overall, volumes are good. The clearance times are normal, and we're getting them delivered. I'm sorry that you had that issue with the package coming in from Stuttgart.
Wait, yeah, German customs are just the worst. Hey, I wonder if you have to add just people or if you can also add AI to help with this kind of work. How much more is DHL using artificial intelligence?
Well, I think that's probably a little bit more into the future. For these immediate changes, because they happen so quickly, we've employed people and done the upgrades on our existing systems to make sure that we were compliant and connecting with CBP and that we had the people to physically do the entries here in the U.S. I do think as we look to the future, we want to see if AI can get even better information on customs paperwork that we're collecting and bringing in. But I think that's a little bit more into the future. Maybe this time next year, I'll have a bigger update on the AI front.
Are robots part of the future as well for DHL, Greg, or do you already have a lot of automated work in your warehouses and your shipping points?
I would say we're still heavily reliant on people and labor to move the packages, to deliver the packages. We opened a facility that's probably our most automated outside of Chicago this year. It does a little bit more automation around our small letter sort. But this is still, logistics is still a lot about people moving packages and delivering them. Leveraging technology behind the scenes in customer service, maybe in the future in clearance, to help things go smoother for our customers.
What about the last mile? I've noticed more and more electrified vehicles, trucks, dropping packages. How deep is DHL into that technology?
Still a very important part of our strategy. We've got a pretty aggressive zero emission target by 2050 with some solid science-based interim targets for 2030. So most of my fleet purchase year in and year out is replacing traditional vehicles with electrified vehicles. It's still a challenge to make sure we've got a 250-mile vehicle with a good battery life and a good payload. And the infrastructure is still catching up across the U.S. We've had some success. The building I'm in here in Miami Gardens is almost all electric vehicles, so pretty proud of that.
So, Greg, what about the rates picture right now? I mean, things are looking better than you may have thought at the beginning of the year, or certainly the beginning of April. There's competition, of course, abounding, but you have individual idiosyncratic issues for some, the MD-11 groundings, for example. What do rates look like right now?
I would say from an overall standpoint in terms of rates, we've got a pretty stable environment after a few years coming out of COVID where we saw some pretty aggressive growth in cost of living or inflation. I think we're pretty normal now. I think the cost that most people are feeling is more associated with the tariffs, those additional costs, and they're trying to figure out how they weave that into their supply chain. That's not a cost really from DHL, it's from the government's assessment, but people need to figure that out in terms of where are they ordering from, and they're starting to look for alternatives. As you know, the heaviest burden tariff country is China, still a major source of manufacturing for U.S. companies. So they're starting to diversify. We see solid growth in markets like India, Vietnam, and Malaysia as people look for different ways to reduce unit cost in this new environment.
But if we look at, shipping rates for 25 and expected for 2026, what kind of increases are we going to see for those 2 years?
Well, we've called out our GPI at 5.9%. That's a fairly normal amount for us that reflects kind of some of the changes in dynamics, some of the changes in capacity, and some of the additional costs. I spoke to the more than 600 people I've had to add in order to manage clearance. So I think it's a normalized year overall.
All right, great to get some time with you, Greg. Thanks so much for joining us on this busy day. Greg Hewitt there of DHL Express talking about the shipping business, adding more than 600 people to deal with customs and tariff clearance. Let's get a check on what's going on in these markets. You can see that we still have red arrows. The S&P 500 about an hour and a half into the session, down 0.5% right now. The NASDAQ 100 down a little bit more. And the turnaround that we've seen for Nvidia shares not helping drive a turnaround for the broader market. Nvidia shares currently up 1.33%. Coming up, the race for New York's next casinos is tightening as Steve Cohen scores approval for an $8 billion project at Citi Field, trying to beef up that baseball empire with gambling, soccer, and more. We'll have the latest next. This is Bloomberg. No casinos yet. All right, Mets owner Steve Cohen just cleared a massive hurdle in New York's casino sweepstakes, winning approval to build an $8 billion complex for gambling right next to Citi Field. Bloomberg's Greater New York reporter Naha Katan joins us now with more details on, this is amazing in terms of the empire building story that Steve Cohen has out in Queens. He's got the Mets, right? Citi Field, obviously. He's got a soccer stadium now, and he's going to build a big gambling complex out there, right?
That's right. And, the job creation is incredible. 17,000 construction jobs, 6,000 permanent jobs, and it's going to make, tons of money when it opens, slated for 2030, $3.9 billion in tax revenue, generating $850 million in taxes.
So that all sounds great. Of course, there will be victims because it's gambling, but I guess they would be doing it somewhere else if they weren't doing it here. Do people think it's better that we have it, legal gambling in a casino rather than, I guess, in the basement of some shop downtown?
Well, Steve Cohen faced some opposition from a local council member who tried to prevent it, but in the end, the community came together, the borough president, and people really wanted this casino.
Isn't the idea, I have a guy on the inside, Joe, who knows everything about sports adjacent stories, and he says Steve Cohen has cleaned up the whole area around Citi Field. Like, there were a lot of chop shops there. It was really a dirtier or maybe a trashier neighborhood that he has now kind of leveled and is going to, I guess, gentrify, right? Isn't that good for Queens?
This is what the people are saying, right? Through their local politicians. He also wants to have a ferry come to Citi Field. This is something still in the works. We wrote that story a few months ago, but that could happen as well, so that people can come straight to Citi Field to gamble on the ferry.
So I guess I was going to ask what's next. And I guess the ferry is part of that answer, right? Traveling to and from this huge complex is currently a little bit difficult, and that would make it a lot easier.
Yes, definitely.
So what has to happen now? Because I'm imagining there will still be a lot of pushback against building this giant casino.
So actually, this is just the board recommending that they get one of 3 sites. All 3 were actually picked. So Genting has theirs and Bally's has theirs. All 3 of them will now have to just get a gaming commission license approved by December 31st. There's not going to be any problem with that. And I don't think there's going to be as much pushback as we might have thought. There were some protests, actually, just 10 people who got up and were upset about the decision. But apart from some Bally's pushback, perhaps, we're not seeing, a major force coming out against these casinos.
All right, well, it's a fascinating story, and I look forward to your reporting, Naha. Thanks so much for joining us. Naha Katan covers Greater New York for us. This is Bloomberg Open Interest. Let's take a look at what's going on right now in terms of the stock market. An hour and a half into the session, we do see the S&P 500 clawing back some of the losses here, now down just 0.3%. The NASDAQ also now down just 0.3%. And I told you just before the break that Nvidia had turned around and started showing some serious or substantial gains. We do see Nvidia close to 1.5% to the upside. It's interesting to see Google to the downside. And when I showed the breakdown on the move screen, you saw that it was almost all the AI play that was down. We had Broadcom as a loser. We had Google as a loser. We had Meta as a loser. But right now, Nvidia helping to keep this market from deeper losses. Disney doing well, up 1.25%. I've heard now a couple of good reviews for Zootopia 2, and Disney has a whole slew of sequels coming out. I did actually go see Zootopia 2. I didn't think it was that good compared to the original, but my daughter liked it. Warner Brothers right now, not moving a lot, but awaiting final bids that they had asked for. Gold down, but at $4,230 now. It's come so far, so fast that Barrick is considering IPOing its North American assets. So Barrick rising about 3% on that news. Coming up tomorrow, Morgan Stanley's Mike Wilson shares his outlook for stocks. Plus, Nancy Tangler joins us, as well as Meredith Whitney on this program. We hope you join us for it as well. This is Bloomberg Open Interest.
Every year, China imports about 66,000 metric tons of these. That's the weight of about 6.5 Parisian landmarks, or if you like, 440 blue whales. And most of these avocados come all the way from Peru. This journey used to take over a month. Now it's a straight shot, cutting it by 10 days. Why? One word, megaport. And it's paid for by China.
Well, Chinese President Xi Jinping begins a week-long South America tour, opening a China-funded megaport in Peru.
This is a huge investment, not only for Peru, but in Latin America, and it is expected to triple agricultural exports of Peru.
Over the last 20 years, China has built up a network of about 100 ports on every continent except Antarctica, clustered around key maritime choke points which are crucial to global trade.
This gives China a strategic advantage as global trade tensions rise. But it's also sparking concerns.
Even though these ports by and large are commercial ports, some of them do actually have the capacity to host naval vessels.
So why did China build a global ports empire? And should Washington be worried about it? Without ports, the global economy pretty much grinds to a halt.
Roughly about 80% of global trade is conducted via ships, and ports are crucial to that.
6 of the 10 busiest ports in the world are located in China, and 95% of the nation's trade is done by sea.
China has made itself rich by being able to find markets overseas for its manufactured goods and being able to ship raw materials to China to be processed. So making sure that it has access to a network of global ports is a key part of that.
And it's not only ports. China is also the world's biggest maker of container ships. Making these generational investments to dominate global trade infrastructure is a central pillar of the Belt and Road Initiative.
Over the years, it has become President Xi Jinping's signature global initiative with the goal to strengthen or improve global connectivity through building up infrastructure projects.
This has meant modernizing the ancient Silk Road with highways and rail while securing maritime pathways in and out of China.
Since the launch of the Belt and Road Initiative, Chinese entities' investment in overseas ports have accelerated, both in terms of scale and numbers.
This map shows Chinese entities have invested in 129 port projects, totaling over $60 billion from Tanzania and Australia to Nigeria and Cambodia. This dwarfs investments made by any other country.
There is no U.S. government initiative that tries to finance or build port projects overseas.
China has an entire ecosystem of companies, from cement firms, iron steel firms that specialize in building out ports. Those are not industries where the US has been focused in recent years.
But the level of Chinese ownership over its ports varies.
China's global port network is made up of a series of different forms of ownership by Chinese state-run companies and also Chinese private companies.
In most cases, they team up with multinational or local companies to build and run the ports, even though the land is still owned by local governments. 17 of the ports China has invested in have majority Chinese ownership, which could offer Beijing more leverage at those sites,
such as prioritizing container ships from a certain country or denying the docking of ships from other countries.
But China has little reason to disrupt global trade, which takes us back to the first megaport we mentioned, at Chancay in Peru. 60% is owned by China's state-run shipping company COSCO, and 40% by an entity controlled by an Argentine investor.
Chancay is located around 40 miles north of Lima, and in its final phase, the main area of the port is expected to be around 700 acres, which is about 80% the size of Central Park. So the port itself is huge. This port is part of China's large infrastructure push in Latin America. Currently, 3 out of 4 of the biggest economies of South America trade more with China than the US.
In fact, a third of all the containers exported by Peru are sent to China, carrying not only these favorites, but other agricultural products and minerals as well. So this makes Peru a crucial gateway into China for Brazil, Chile, and other countries.
The initial investment was of $1.3 billion, but if there's more demand, COSCO has said that it could invest $3.5 billion total for an expansion of the port.
Shanghai is a deep water port, which means that shipments could take place directly from Shanghai to major Chinese ports. So that would enable journeys to be cut down, costs to be reduced, trade to be increased between South America and China.
U.S. officials have criticized this port, telling Peruvian authorities that they should not have allowed a Chinese firm to create such a big investment in the region. But Peruvian officials have countered, saying that the U.S. hasn't been willing to make such a big investment in Peru.
As we know by now, this is not just a story about overseas investment. It's also about national security.
A number of Trump officials have even suggested that the port could be dual use, meaning that at some stage it could be used not just for economic activity but for military activity too. That's something that Peruvian officials strongly deny and that China denies too.
But these concerns are not unfounded.
Well, U.S. intelligence says China's first overseas military base in the tiny African country of Djibouti is likely to be followed by several more.
In Djibouti, what began as a commercial port eventually turned into China's first full-fledged overseas military base.
Remember this map? Of the 17 ports with Chinese majority ownership, 14 have potential for both commercial and military use.
Meaning it can service commercial ships, LNG tankers, oil tankers, and it might also have the physical capacity to host fueling ships, logistic ships for military purposes, or a military battleship.
China only has one overseas naval base so far, as compared to the several that the US has dotted around the world.
In fact, the U.S. also has a naval base in Djibouti, along with at least 127 other overseas military bases. Chinese officials strongly deny that the ports are for military use, but still,
many countries around the world are concerned that these Chinese port operators could in turn become listening posts to what the economies that are surrounding these ports are doing.
But the more immediate concern is that China could leverage these ports in a trade war.
China is operating the Panama Canal, and we didn't give it to China. We gave it to Panama, and we're taking it back.
For the US, the Panama Canal is really a crucial economic lifeline. Something like 5% of global trade travels through the canal, and 40% of US container traffic flows through it. Without that ability to easily pass between the Atlantic and the Pacific Ocean through that corridor, US trade would be very much impacted.
2 of the ports on either side of the canal are owned by Hong Kong-based conglomerate CK Hutchison.
To all intents and purposes, Beijing doesn't have direct control over Hutchison. But the very fact that the key executives at these companies may have direct relationship with the Chinese Communist Party, that really makes a lot of Western governments uncomfortable.
A foreign power today possesses, through their companies, which we know are not independent, the ability to turn the canal into a choke point, and that is a direct threat to the national interest and security of the United States.
China has said that it has always respected Panama's sovereignty over the canal and that it firmly opposes economic coercion and bullying practices. Yet, it has also pushed back against a deal that would give control of CK Hutchison's Panama ports to American asset manager BlackRock, calling the deal a betrayal of national interests.
The European Union has introduced investment screening regulations which make it much more difficult for China to buy up critical infrastructure, including ports, across the continent.
A tit-for-tat over docking fees has also been rippling through the shipping industry. Washington has also suggested that all this Chinese money comes with heavy strings attached.
But if you talk to officials in Nigeria, Peru, beyond, there's a feeling that, look, we need this infrastructure, it's important for our economic modernization plans, and China's the only game in town offering it.
Ultimately, we're going to see a reshaping of global trade flows because maritime trade has become more and more political.
joins us now after a refreshing Thanksgiving break that all of us cannot relate to. But I am curious, from your perspective going forward, how come you think that AI is going to resurrect that kind of lead higher, given some of the concerns that we've seen recently?
Well, I think if you look at the performance of the market this year, it's been driven by the AI infrastructure and, the AI enablers story. Going into next year, I think the big narrative for markets is how companies are going to adopt AI, and that's going to drive earnings. And so there's loads of data showing this. Some of the ones that we like to look is the Ramp AI Index shows 45% of companies are adopting AI. One of the things that we've been doing a lot on is, well, what is the actual tangible cost savings from this? And so far, we think that there can be basically 1% of cost cuts going into next year. That's $130 billion. We think that can basically be saved going into 2026. And there's this amazing narrative going on right now in the market where revenue's increasing. You've got 9% growth. Actually, at the same time, companies are cutting back on labor. And so if you look at the WARN data from the S&P 500 companies, it's been shooting higher. But this is nothing, absolutely nothing to do with them warning about the economy. Actually, their corporate guidance, earnings revisions are, close to all-time highs. So this almost, for me, feels like a Goldilocks scenario going with the AI narrative going into next year. And my final thing, if you have a little bit of labor weakness as a result of AI, then going back to your conversation about the Fed, might that not keep the Fed a little bit more dovish? And that, I think, again, can help support the equity market rally going into next year.
Goldilocks for the equity market, maybe not the economy, which is a sort of key distinction here. I do wonder, so this is an argument for AI being dominant, but that means the rest of the 493 outperforming, playing catch-up with the Magnificent Seven. Is that correct?
Correct. And again, one of the biggest things that we've seen over the last couple of years is that actually the performance of the Mag 7 has not been driven by valuations. It's all been by earnings growth. And now what we're seeing is earnings growth going from roughly 30 to 40% year on year into next year, probably being in high teens, and the rest of the market actually catching up with that. And so this will be one of the first years, really since 2021, where earnings growth between the Mag 7 and the 493 are going to be somewhat equal. And so I do see much more scope for, outperformance for the rest of the market.
What for you will be the telltale sign that actually adoption is underway significantly in some of these industries?
Well, to be honest, I already think that we see that. If you look at the data from some of the consumer stocks that are basically saying that we're using AI and becoming much more productive in terms of, targeted ad sales and whatever else, a number of companies on their earnings calls are discussing about how they're adopting AI and actually, again, replacing that, labor or freezing labor as a result of the higher productivity. To me, we're already seeing it from companies in the earnings calls. Now, you have to talk about the equity market and the economy. What's very interesting is that for the broad economy, I don't think we are seeing much productivity increase. It's really the large cap stocks. And so again, where does this AI productivity come from? It comes from companies with huge amount of employees that need to reduce it. If you're a small company and you have 10 employees, you're not going to really replace that with AI. But if you've got hundreds of thousands of employees, actually that's where the cost benefit comes from.
You mentioned that this means maybe the Fed then has to be dovish, but how could a Fed interest rate cut cycle solve the problem of AI?
In terms of, it doesn't really solve the problem of AI at all.
AI labor layoffs.
Yeah, exactly. It doesn't solve this really, but it does reduce some of the pressure on the labor market in the near term, right? In terms of reducing, credit costs, reducing interest rates, reducing some of that burden on the low-income consumer. And of course, it is the low-income consumer in particular which has been hardest hit by higher interest rates, given that they have more of their debt in sort of floating rate debt products like, auto loans, credit card loans, rather than mortgages.
At this point, it sounds like everyone's banking on stimulus coming from the fiscal side with potentially $2,000 checks or whatever else comes from the tax refunds that we get in January. We're expecting monetary stimulus when it comes to Fed rate cuts, possible use of the balance sheet. I just wonder if this makes the U.S. a less attractive place on a sort of currency-adjusted basis for equities based on some of what we're expecting to see on the fiscal side.
Totally. I totally agree with that. And actually, one of the things that I think the market is missing a little bit is it's not just stimulus that's coming out from the US. Actually, China's just done a $1.4 trillion debt swap. Germany is coming in with $150 billion stimulus next year. Japan is teeing up $110 billion stimulus next year. So actually what you could see is that you get a huge global wave of stimulus. As you mentioned, actually the dollar starts to weaken and the rest of the world starts to look very attractive, particularly because valuations are at a 30-40% discount. Even on the AI plays. You go to Asia, you got an AI discount there. In Europe, less so. But you've still got places like Germany, which are seeing 14-15% earnings growth and at a valuation of 14 to 15 times earnings. To me, that seems quite attractive at this point.
So what equity markets do you like? Germany and Asia plus the United States?
So we are overweight emerging markets. That includes Asia, LATAM. I mean, that's all due to, huge decreases in cost of equity and interest rate cuts. But yeah, Europe, Germany also stand out as our key overweights. And the US we're neutral on. And a part of that really is because if I was going to get my AI kind of tech play, I'd actually rather do it with emerging markets rather than the US at this point. Again, just from that valuation perspective.
Lisa mentioned what's coming out of Washington in terms of the fiscal stimulus. How are you thinking about the potential tariff impact, whether it's the United States or globally, because we're still waiting on the Supreme Court decision on the president's signature tariff?
Yeah, I mean, I think that is one of the aspects that worries me the most going into next year. So, I mean, the three risks, obviously AI bubble and, the Fed being more hawkish, and we kind of discussed that. The tariff one, I just don't think we've discussed it enough. I think everyone thinks that we've moved past tariffs and that's never going to come to bite. I do think there's been a lot of stocking up on inventory. And I do think we're starting to see incremental signs of inflation actually come through. We haven't had a lot of inflation data. And I suspect actually when we get it, what we're going to find is that actually, particularly on the good side, there's been a lot of pushing up there. And so I do wonder whether that starts to eat a little bit into margins. But this is where I could say AI comes to save the day. Because on the one hand, if you're a company and you're facing higher costs, actually, I think the big incentive as a company right now is, okay, why don't we adopt AI and try and reduce cost savings that way? And so much like COVID was like one of the biggest forces of innovation and adoption for companies, I actually wonder whether tariffs is one of the biggest forces of adoption of AI this year and next year because it forces people to become more productive.
Does it make you nervous that nobody else is bearish?
I mean, I talk to people that are bearish. I think you can speak to...
Are they enacting their bearish beliefs, or they just sort of feel negative?
I think there's two things. I think the sell side, including myself, is quite bullish. I think when I speak to investors, they're clearly a little bit worried about this. I think there's definitely, every room that I walk into, it is, are we in an AI bubble? That is the number one concern. And then, again, actually this conversation about the impact on labor and, will the consumer roll over more aggressively next year is probably the second biggest concern for for investors at this point. So, do I think everyone's bullish? No. I think there's actually a huge amount of money on the sidelines. And one of the things that I think is, again, really important here is that there's $3.5 trillion of cash sitting in time deposits. Just retail investors, cash, $3.5 trillion. And as the Fed cuts interest rates, that's going to unlock a lot of that cash, which can go into the equity market still. So I still think there's a lot more buying opportunities and money to go into the equity markets here.
Alistair Pinder, thank you so much for being with us. That's Alistair Pinder of HSBC. We had been tracking Airbus earlier this morning on news over the weekend that a majority of its A320 jets received modification. Reuters currently saying that Airbus faces new quality problems on dozens of A320 jets. And you are seeing, Anne-Marie, a real shift lower in Airbus futures, down 7.3% as people wonder, what else are we missing?
Well, yeah, exactly. We had earlier this morning that the vast majority of these jets were impacted by a software glitch. Now, Reuters is saying there's a new quality problem on dozens of them. This is going to weigh on the stock like we saw with Boeing. This takes a lot of time to unpack exactly what's going on, and potentially, as we've learned from the past, potentially more damaging news is going to drop as we understand what's happening with these jets.
Yeah, we'll follow this throughout the morning for you. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. Thank you. President Donald Trump is downplaying his social media post that called on airlines to consider Venezuelan airspace closed. U.S. forces have been massing in the region as Trump weighs military action that would go beyond strikes on suspected drug boats. Venezuela's government called Trump's remarks hostile and demanded, quote, unrestricted respect for its airspace. President Donald Trump says he has decided on his pick for the next Federal Reserve chair, and he's made it clear he expects his nominee to cut interest rates. Sources telling us here at Bloomberg, Trump's chief economic advisor, Kevin Hassett, is seen as the likely choice to succeed current Fed chief Jerome Powell. This all, of course, according to people familiar with the matter. U.S. consumers staying strong. MasterCard says Black Friday sales rose compared to a year ago. Sales, excluding autos, increased more than 4% on the day after Thanksgiving. Online sales dropped compared to last year, with many shoppers saying deals were more muted compared with last year. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, escalating tensions with Venezuela.
We consider Venezuela to be not a very friendly country. They sent millions of people, really, and probably a number in excess of that.
Does your warning mean that an airstrike is imminent, or should we not read it that way?
Don't read anything into it.
Robert Königsberger of Gramercy Funds Management joining us next to make the sense of this from an investor's standpoint. This is Bloomberg Surveillance. Good morning.
A lot of our inspirations for new features comes from experiences in our own daily life.
The other day, I needed to double check an important meeting schedule by finding a specific call recording. Thankfully, with call summarization feature on my Galaxy, I could quickly find it.
Our users ask complex questions, and our model has to be able to speak multiple languages. What seems impossible now can quickly become possible.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Kicking off the official start to the year with a little bit of softness, although we did grind higher for a seventh straight month in the S&P 500, right now dipping about 0.6% on the S&P. NASDAQ underperforming yet again after seeing a break in a 7-month rising streak, last month falling just by a bit. The Mag 7 still leading the declines, down by 0.7%. The Russell 2000 also lower. Key to watch some of the anecdotal data coming out this week, given the fact that we do not get non-farm payrolls on Friday. A big bet, though, going on in the bond space of a Fed put, some sort of reprieve. The idea of a Fed rate cut in December has gone up to almost 85% from some 25% just a few weeks ago. And right now you are seeing a little bit of a lift, but still contained yields pretty much across the board. 30-year yields, though, inflecting higher by about 4 basis points, 4.7% rounded up. And the euro dollar, interesting. A question of whether we are seeing the reignition of dollar weakness, euro strength on the expectation for an easy policy from monetary side as well as fiscal side. Under surveillance this morning, geopolitics very much in focus, escalating tensions with Venezuela.
We consider Venezuela to be not a very friendly country. They sent millions of people, really, and probably a number in excess of that. And a lot of those people shouldn't be in our country, from jails, from gangs, from drug dealers, from all of the people that came into our country shouldn't have been in our country, causing a lot of problems.
Does your warning
and drugs.
Does your warning mean that an airstrike is imminent, or should we not read it that way?
Don't read anything into it.
Here's the latest. President Trump confirming he held a call with Venezuelan President Nicolas Maduro as questions mount over recent U.S. airstrikes in the Caribbean. Joining us now is Bloomberg's Mika Solner for more. Mika, I just want to start with what we understand about what's going on and where we stand with respect to potential action from the U.S. against Venezuela.
Absolutely. The Trump administration has been extremely aggressive in its posturing towards Venezuela, blaming it on targeting their narcotics operation. As we just saw, the president has been very vague on exactly what his plans are in that region. But there's been a lot of questions raised by members of Capitol Hill, Republican members as well, in terms of the legal actions that the administration has taken and what the next steps could prompt.
I do wonder, Mika, do we have a sense of what that strike was over on offshore of Venezuela? It was in the Caribbean. Big questions now swirling in Congress about the legality of it. What's the latest on that front?
Yeah, there are a number of top Republicans on Capitol Hill, from the top Republican on the Senate Armed Services Committee, Roger Wicker, to many prominent House Republicans that have, asked about the legality of the most recent strikes. But this has been ongoing, and these are questions, and the administration has been very tight-lipped on this, even in their discussions with lawmakers and those in their allies, and have kept it, very secretive in terms of what exactly their plans are.
Mika Solner of Bloomberg, thank you so much for that. Robert Konigsberger, founder of Gramercy Funds Management, a global leader in emerging markets, writing, "It is so hard to imagine that the art of the deal leads to something short of Maduro ceding power. The path to de-escalation has become quite narrow." Robert joins us now. Robert, thank you so much for being with us. How are you understanding this from an investment standpoint about what U.S. involvement with Venezuela looks like now and what it will look like, say, 6 months from now?
Sure. Good morning. I think you need to break it down into a couple pieces, which is one, is there going to be regime change? What's the motivation of regime change? Then if there is regime change, what does that look like? And then ultimately, what does, what's the environment look like in Venezuela post? So from where we stand today, I mean, I believe, we at Gramercy believe the motivation is less about democracy and the stolen election from 2024 and more about narco-terrorism and quite frankly, taking back the Americas. There was the Monroe Doctrine, then there was the Roosevelt corollary, and now we've got the Trump corollary. So this is bigger than just a stolen election last year. And I think the way that this narrative has played out will play well with MAGA. And I think that was always a concern. I don't think MAGA cares about democracy in Venezuela. They do care about 8 million Venezuelans who've immigrated, a great deal that have come to the U.S., security, what have you. So then, we believe this is more than just regime change. We believe that Trump and Rubio have, bigger aspirations in mind. This isn't just about, a show of force in the Caribbean and then move on. But then to your question of regime change, and, we at Gramercy spend a lot of time thinking about what might regime change look like. There's capital R regime change, which I think many would like to see, which is, the Maduro regime leave, the Chavistas leave, and Machado and her people come in, capital R regime change. That may be difficult. We may see something more like smaller regime change, where it's some sort of government transition where the Chavistas and the opposition still collaborate towards new elections.
What do you think the timeline for all of this is?
I mean, it's so difficult to say, but, as you saw in Eastern Europe when the wall fell, so to speak, regime change takes longer than you think it's going to take, and then it happens faster than you thought it would happen. So, there's a lot of metal in the Caribbean right now. Would be surprised if we're in the same position at the end of the first quarter. Be surprised to see this status quo at Easter. But it's really hard to tell.
You talked about narco-terrorism. You talk about immigration. For the Trump administration, is this also about China and its encroaching on U.S., what the U.S. would probably view as its sphere of influence in South America writ large?
Absolutely. I mean, I think, the evolution of globalization is back towards regionalization and, as you say, spheres of influence. And, I referred to the Monroe Doctrine, and that was about, the Americas for America, if you will. And then the Roosevelt corollary went further and said, we will intervene militarily in Latin America to protect ourselves. So I think what the Trump administration is focused on is just what you said, which is getting the Chinese and their influence out of the Americas, getting the Russians and their influence out of the Americas, and going back to a world of spheres of influence where, maybe we'll be less focused on their region and more focused on our region. And who knows what the deal was in Alaska between Putin and President Trump as it related to Ukraine versus the Americas. But, Russia's been pretty darn quiet. China's been pretty darn quiet.
Robert, does this make you want to invest more in Latin America or less?
In Latin America? I mean, I think there's a lot of different opportunities in Latin America. I mean, for us, we've been more focused on private credit rather than public credit. But I think, as many have started to realize, emerging markets isn't necessarily more risky than developed markets. And we're seeing plenty of opportunities within Latin America. I mean, Venezuela's, there's very few ways to express interest in Venezuela. I mean, most of it's through the external debt at the moment, which is, I think, up 3 times since the bottom.
You said something there that I think a lot of people are going to find interesting, which is that you think that emerging markets might not be more risky than developed ones right now. It's something people have been flirting with. Are there dynamics in the developing world that you're seeing take hold in places like the United States or Europe that you find concerning and that you think that emerging markets in some ways is almost a reprieve from?
Sure. I mean, I grew up when we had 2 worlds. We had developing markets and we had emerging markets. I think today we have developing markets, emerging markets, and submerging markets. And it's the developing markets that are moving right to the submerging markets. And the things that we saw in the 80s and 90s that concerned the world about emerging markets, we're seeing about developed markets. Quite frankly, large debts, large deficits, and what have you. The emerging markets never had the flexibility to not adjust, to when COVID happened and what have you. And their fiscal houses are generally in order. Now, of course, emerging markets is a really big label. It's not a homogeneous asset class, nor is developed markets. But we're quite constructive on EM.
Gramercy Funds Management founder Robert Koenigsberger, thank you so much for being with us as we do parse through what's happening. I do wonder, Anne-Marie, from your perspective, how much some of the latest developing news around Venezuela, around that strike on the boat offshore of that nation, seems to be potentially having ramifications in Washington, D.C.
Well, I think a lot of senators want to get to the bottom of is actually what was ordered by the defense secretary after this really scathing report from the Washington Post about the strike and the subsequent secondary strike that existed when it seemed like two individuals were still alive and then they had a secondary strike. When it comes to Venezuela, I recently caught up with Mike Wirth. He talked about being there for the long term and rebuilding that economy. When you hear from Robert, it does seem like that's where they are as well, and that this administration certainly wants to see a huge change in that country.
Yeah, rebuilding potentially some of the Latin American potential allies, as well as rebuilding the infrastructure around energy, potentially for artificial intelligence. Coming up, Ian Harnett of Absolute Strategy Research on the controversies facing investors in 2026. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
After the seventh straight monthly gain for the S&P 500 this morning, taking a little heat off that, we did see a monthly loss for the NASDAQ for the first time going back to March, 1.4% decline. We are seeing that decline extended, which really is notable given the fact that people are wondering whether this is a rotation or whether this is a bubble that is starting to burst. And the Russell 2000 futures down almost 1%. But the real question on the consumer, yes, they're spending, but is it enough? And is it enough for the bond space, 2s, 10s, and 30s? Is there a question of how far the Fed can cut, about how aggressive they will be as President Trump talks about choosing a new Fed pick? We now have more than an 85% chance of a Fed rate cut come this month. Right now, 3.5% on the 2-year, just up about 4 basis points on the 30-year to 4.7%. Can you believe that in the currency space, what you get is a weaker dollar as people expect an easier Fed and potentially deteriorating economic data. Euro at least rising. Maybe it's just a reprieve after a lot of negativity around Europe. 116 right now. 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. As you mentioned, we're seeing a real risk-off mood to the market this morning as we start the week, and it's showing up in Bitcoin, falling as much as 6% earlier to below $86,000, though we have recovered some of that since then, and most of that having to do with the risk aversion we're seeing in markets, but also China's central bank saying it plans to clamp down on cryptocurrencies, and that is hitting stocks like Coinbase, MicroStrategy down 4%, and BitMine down 6%. Meanwhile, over in Europe, we are seeing Airbus shares falling more than 8% now in the pre-market on a Reuters report that the plane maker has run into quality issues with fuselage panels on dozens of A320 jets. Remember, those are the same jets that suffered a software glitch last week that affected 6,000 planes, though that has now been fixed. But this is all coming as Airbus races to meet tough delivery targets it's set for this year. And we end on Canadian solar. Those shares are moving to the upside by 11% in the pre-market after it said it's moving control of its Chinese factories to Canada in an effort to avoid U.S. tariffs and also keep it on the good side of U.S. regulators as it wants to continue selling into the U.S. market at a time when we know Washington is clamping down on clean energy imports from China, an area that, of course, China dominates. Lisa.
Thank you so much, Yahaira. On our radar this morning, U.S. and Ukrainian negotiators saying they had a productive discussion about a framework for a peace deal this weekend down in Mar-a-Lago. Secretary of State Marco Rubio saying there's more work to be done. A special envoy, Steve Witkoff, heads to Russia today. Meanwhile, U.S. consumers demonstrating their resilience as the holiday shopping season kicks off. Black Friday sales increasing over 4% from a year ago, despite economic concerns. Today is Cyber Monday. Tomorrow is, I don't know.
They're all blending together.
Ticket Tuesday.
So many people are buying their Black Friday sales online. So I feel like Black Friday, Cyber Monday is all merging together, which is why I find it almost shocking that consumers spent a record $11.8 billion online on Black Friday online, when basically you're going to have the same deals potentially on Monday. I just want all the emails to stop. I feel like it is just spam overload from the retailers. I understand it's percentage off, but okay.
I think they're all personalized. Or Anne-Marie, please come in. We know what you like. Here's all of the list of things.
And then it's, guess what? We're giving you another 24 hours. We see that in your cart. Okay, I left the cart as it was. I'm not buying it.
Well, but this to me actually does highlight, is this a sign of strength or is this a sign of weakness? We're talking about this as a resilient consumer. At the same time, who's buying? What are they buying? How much are they waiting to buy for the deals, not necessarily buying earlier? And how much is this on an inflation-adjusted basis, not nearly as good as it looks? And I know that it sounds like Debbie Downer, but this is kind of the tea leaves that people are looking for in the absence of that holistic data that we normally get out of the Bureau of Labor Statistics.
Absolutely. I think you nailed it. This isn't inflation-adjusted. So it almost feels like maybe it's flat from where we were last year. And if you look at what the Fed Beige Book talked about, it's the lower end consumer that is really struggling. How much of this 11.8 that's being spent is actually just from the higher end cohorts we're going to go out and spend anyway?
This has really been the underpinning a lot of the change in tone that we've been hearing around the U.S. consumer and the U.S. economy, which is the reason why there is such a focus on the Federal Reserve. President Donald Trump finalizing his choice, supposedly, for the next Fed chair. All signs pointing to his chief economic advisor, Kevin Hassett, as a likely candidate to succeed Jerome Powell, which definitely has been fueling the upside in markets. Optimism around AI showing signs of slowing as concerns linger over valuations and spending plans. Global stocks falling in November for the first time in 8 months. Ian Harnett of Absolute Strategy Research writing, America is in a race to dominate AI. We see this as part of a broader objective to boost productivity, keeping the U.S. as one of the world's richest economies. Ian joins us now, and I think that the most controversial question to you is, will it work? Is the U.S. still a bastion of returns and safety?
Well, I think, what we're looking at is an environment where President Trump is determined to win the midterms. They're going to work whatever they can do to avoid recession. I think, our chief rates economist, Ebra Harbi, wrote a great piece about Kevin Hassett. Looking at his voting profile, that potentially would lead to Fed rates being 75 basis points lower than they might have been otherwise.
This is the reason.
And so, that's one of the things that we're starting from. Definitely recovery rather than recession, I think, Lisa.
This is the reason why a lot of people are expecting an easier monetary policy. The reason why you're seeing that baked into Fed funds futures, as well as the sort of optimistic tone for the forgotten 493. Do you think that is the right way of looking at this? That either one way or another, the rest of the universe, the equal-weighted universe, is going to outperform?
Yeah, we're certainly expecting that broadening out. We're seeing that in some of the data. But the real question that investors have to answer for 2026 is, this is a really unusual balance. Really strong earnings growth and expectations of rate cuts. That isn't going to survive probably the whole of the year. So is it going to be the growth in the earnings coming down, or is it going to be those rate expectations starting to get raised, even with a more dovish Fed chair, should we say?
Well, you think the AI CapEx endgame is coming, and you think there are signs of a bubble burst?
Yeah, absolutely. AI is a bubble, and so let's in terms of AI stocks, and that is going to be the problem. But why does it stop? And I think the thing that we see is that the end of bubbles typically comes because cash flows start to get strained. And that can be the cash flows of the producers themselves. And we're starting to see that cash flow headroom coming down. Our quant team have done some great work. But where we're going to see that is that it won't be CapEx that gets cut first. It'll actually be buybacks. So watch out for those. But historically, when bubbles burst, it tends to be that the people buying the goods, the services, they run out of cash. And that's going to be the thing. So, yeah, AI can be a structural story, but are those banks really cyclical rather than structural?
Has it all been exacerbated by the fact that we see a lot of circular financing in this space?
This is a very classic bubble experience. So we're seeing all the classic signs. We're getting exponential share prices. The companies are using those share prices to buy each other. They're buying each other's goods. They're doing it on vendor financing. That circularity that you're talking about. And then this CapEx blowout as the cost of capital comes down for these AI companies. As everybody tries to crowd into that space. That accelerates the build-out. But the trouble is the CapEx goes on like that. And if your sales just start to tail off, then the margins get hit. That's when the challenge is going to come for this market, and that's when we get more of a shock.
And this is coming at a moment where ChatGPT is turning 3. This is a reason why a lot of people are wondering, is on its birthday, happy birthday, good luck trying to survive for the next 3 years. There's this question of how much debt's been built out with data centers tied to ChatGPT, to OpenAI, incurring $100 billion of debt in that period. At what point can you see the overall market and U.S. economy continue to grind higher if you do have a busting of the AI bubble in a significant way?
I think at that point you'll be looking for those interest rates to coming down. But historically, when interest rates come down because things go wrong, that's bad news for equities. And that's the point where you could start to see the change. And that's probably going to be later in the year rather than earlier in the year. Actually, the biggest risk that we see for AI is that energy component. America has decided to use fossil fuel, hydrocarbon energy, and that's going to be expensive. Much more expensive than renewables that China is using. And it's also, there's something called the food, water, energy nexus. If you want to have more energy for AI, that's going to cost you something in terms of water, which is going to cost you something in food. Do you want a faster search engine, or do you want to still get your food on your plate? Those are the kind of decisions that we're going to see starting to come to the fore as we see more of these issues raised, I think, Lisa.
I think it's a great question. At this point, I think some people, after spending all the time on the phone, might choose their phones. I am curious, though, from your perspective, going forward, if this is the landscape, do you think that the chance of a negative return on the S&P 500 or the NASDAQ next year and a more negative economic outlook in the United States looks more likely? Because that seems to be what you're describing.
I think when we go into 2027, then it gets much more cloudy. You have to take that decision about higher rates or lower earnings. The big thing that we can see is that short term, these markets are being driven by momentum, they're being driven by liquidity, they're being driven by algorithmic trading. Longer term, what we know is that valuations matter. And so we just published a report recently about the lost decade for investors. If you are really investing for the long run, your long-run earning equity returns are probably about 3% over the next decade. That means you're going to get most of your returns from income, not from growth here. And that is going to be the biggest challenge for investors. So recognize this is a trading market, a momentum market, and AI is a big part of that. Investing for the long run, that's a difficult game. Let's go back to 2000. It was the digital age. We're living that digital age today. The big players today are the big players that they were there. Microsoft, Oracle, Apple. All of those companies lost between 65 and 97% of their value, their peak value, and took between 5 and 13 years to regain that value. Digital was the structural story. AI is a structural story, but there's the right price to pay for everything in the equity market.
Can we put two of your thoughts together, that the Trump administration is not going to want to see a recession before the midterm elections, and this idea that you think the AI story is starting to fade?
Yeah.
How does the Trump administration make sure that the AI story does not fade before the midterm elections, given how much of the equity market is propped up by it?
So I think you've got two levers that you can, or a couple of levers that they can operate through. First of all, Secretary Bessent made it very clear that he's very, very keen to keep rates as low as they possibly can. So whether that's the new Fed chair, whether it's using stablecoin to try and inflate demand for bills or redistribute the demand for bills, then that will be one mechanism. What they have to do is to reinflate assets across the economy. The household sector needs to take on leverage. The corporate sector needs to be encouraged to take on leverage. That's the way you get the debt back under control. So what does that mean? They're going to be pumping the housing market. They're going to be trying to unlock. There's $36 trillion of positive equity in housing that can't be accessed at the current time. Assumable mortgages, something like that. Some kind of innovation, privatization of Fannie and Freddie. Those are the kind of things I think we'll see up. open up. The other thing is crypto. They will continue this willingness to lend against crypto, to keep the economy going, and however they manage that, then we'll see. Almost a slip of the tongue there.
Ian Harnett of Absolute Strategy Research, thank you so much. Really wonderful to hear about what you expect next year. It is crystal ball season, and we've been getting a lot of them. And there's a lot of positivity because one way or another, there will be a fiscal bazooka or there will be a monetary bazooka or potentially even both.
And potentially even more so if we have a Kevin Hassett as Fed chair. What's interesting, though, of course, you have to remember it is a deliberative body. And because many people view him as tethered to this administration and the president, they might be more willing to come out against him because they are concerned that he is just purely politically motivated.
Does it make the other potential members more hawkish? Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Now, the latest on the investigation into the National Guard shooting in Washington, D.C. Homeland Security Secretary Kristi Noem says authorities believe the 29-year-old suspect was radicalized in this country. He's facing a first-degree murder charge in the death of the 20-year-old West Virginia Guard member Sarah Beckstrom. The data center that supports the CME Group derivatives exchange says it has bolstered its backup cooling capacity after overheating sparked a 10-hour outage on Friday that roiled world markets. CyrusOne owns the facility about 50 miles from Chicago. It says stable and secure operations have been restored, with additional redundancy now added to the cooling systems. A rally in the metals market to start the month. Silver is trading at a record as traders place speculative bets on the precious metal given ongoing supply tightness and rising expectations for a U.S. interest rate cut. And copper touching a record high on the LME on fears the global market is heading for a supply crunch. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, President Trump making his pick.
Are you picking a new Fed chair, or are you any closer on that right now?
I know who I'm going to pick. Yeah.
Who tell us? Kevin Hassett.
I'm not telling you. We'll be announcing it. Thank you very much, everybody.
So now the question is, when? When are they going to be announcing it? Sonia Martin of DZ Bank joins next. Maybe to answer that question, probably not. This is Bloomberg Surveillance. There was a question, will the S&P 500 manage to eke out a seventh straight gain? It did. On the last day, it was down 0.4%, and it climbed above it for that seventh consecutive gain, going back for the first time since 2021. We're losing some of that steam, down 0.6%, although the underperformance continues to be in the NASDAQ. Right now, you are seeing a bit of euro strength, dollar weakness, a real question about potential data that isn't coming out just yet from the United States. It's supposed to be Jobs Friday. It is not, but we do get ISM manufacturing and services and ADP payrolls, which people are going to be parsing through. And you do see yields just marginally higher, up 3 basis points on the front end to the mid end and back end. 10-year yields 4.04%. Under surveillance this morning, President Trump making his pick.
Are you picking a new Fed chair, or are you any closer on that right now?
I know who I'm going to pick. Yeah.
Who tell us? Kevin Hassett.
I'm not telling you. We'll be announcing it. Thank you very much, everybody.
Here's the latest. We're getting closer to finding out who will replace Fed Chair Jay Powell, maybe. Sources telling us here at Bloomberg that National Economic Council Director Kevin Hassett is the front runner. Joining us now is Sonia Martin of DZ Bank. Sonia, thank you so much for being with us. I'd love your reaction to both the price action in response to Kevin Hassett as a potential Fed chair, as well as just more broadly, this understanding in U.S. markets of Fed rate cuts that seem imminent.
Yes, I mean, we've seen quite a lot of volatility in rate expectations with the view to the Fed. I mean, the market had initially priced in a lot of rate cuts throughout the coming year. Then there was a lot of pricing out. When during the shutdown, I think people got somewhat overly optimistic, I think, on the prospects for the U.S. And now they're back in the game with more rate cuts. And that's partially, I think, because of some of the weaker data we've had, but also speculation mounting that it's going to be Kevin Hassett who will become the next Fed chair. Trump hasn't said when he will announce. Suspicions are or speculation is he'll announce before Christmas. He'll probably use a politically opportune time to do so. But Kevin Hassett is, of course, considered to be very close to Trump and therefore a monetary policy dove. and that is exacerbating rate cut speculation, and that's what is putting some pressure on the dollar right now.
Sonia, I wonder how much you expect that to continue into 2026. The first half of 2025 was marked by this belief that there would be overstimulation, a suppression of yields, a potential loss of Fed independence, and this would lead to a depreciation of the dollar. You saw the gold trade really pick up. Second half, completely different, flipped on its head. Do you expect 2026 to mirror what we've seen so far in 2025?
Well, maybe not as extreme. I think we've sort of gotten used to Trump a bit more, and we're not as surprised maybe at the way that he conducts policy as we were earlier this year. So I think the amplitudes of market move might be a little bit smaller. But generally speaking, I do expect the dollar to have some downside next year. For one, I think the U.S. economy is not as strong as people have recently come to believe. And there is the Fed issue. And for me, I cannot emphasize enough how important it is to me what happens with Lisa Cook. The Supreme Court will make a decision on that early next year. And I think it's really crucial to see what happens there, because if Lisa Cook does get removed from the Fed board for, a potential crime that she may or may not have committed 20 years ago, I think that sets a dangerous precedent. And I think the whole issue of Fed independence is definitely going to come back on the table next year. Yes.
Sonia, the market, though, is not acting like there is an issue of Fed independence. So do you think that actually, whether or not it's Lisa Cook leaving the board or not, do you think that is actually going to be such an issue? Because the market seems to shrug this off and moved right along.
Well, maybe especially because the market is sort of shrugging it off, I think it may be more of an issue. I mean, we know what happens in these situations. People kind of, gloss over these things, but then they can make a major comeback depending on the news flow. And I do think that issue will come back and resurface. I mean, I'm not saying that we are predicting that the Fed independence is going to become seriously endangered, but I think the whole issue will be a source of volatility next year, and therefore will time and again put pressure on the dollar. And I think maybe the market right now is focusing on other things and maybe not paying quite as much attention to this particular issue as it should.
Well, if the Trump administration decides to put Kevin Hassett as the chair of the Federal Reserve, will it embolden other members to be more hawkish?
Yeah, I heard you mention this earlier. It's an interesting take. I think that, the general market view is often that if the Fed is led by a very dovish president, then that's going to result in a generally dovish council, which I think we can all hope that you're right. And that's not going to happen. That in fact, in a way, we have seen this recently. We have seen that Fed members have been, I think, quite honest in their views on the U.S. and there's not been as dovish maybe as generally feared. So I think there is ideally that scenario where Fed members will feel emboldened to distance themselves from Kevin Hassett if he does become chair. But it will be a tricky time. There's a few new people on this board, so it's going to be a bit of a big shuffle, and there'll be a new dynamic.
It's really fun to play the parlor game of the Fed. We'll keep playing it. But, Sonia, there's a larger story here, which is more broadly around the world, developed markets are incurring more debt. They're seeing higher yields. There's a real question of how much that can really reverse next year based on just the overall demographic of an aging population and the debt load at play. Do you see a broader depreciation, devaluation of developed market currencies more broadly? And maybe not only with respect to gold outperforming, but potentially emerging market currencies as well, also doing better than they have traditionally just because of a dynamic that seems to be flipped a bit on its head?
Well, we're actually, when you look at the emerging market currencies, we're actually somewhat negative for the next year. A lot of these countries have serious issues to contend with. And obviously there is, the debt levels, as you mentioned, but also economic issues. Some of these countries have been very hard hit by the whole tariff situation. So I think in general, we're not that optimistic. Also, I think because the high level of uncertainty in the market in general that we are going to carry over into 2026, that is also going to be a factor weighing on these currencies. So I don't think there's going to be a huge upside, broadly speaking. There'll be exceptions, of course, but I think broadly speaking, we're looking at more downside for these currencies.
So is this basically a loss of some credibility in fiat currency right now that you're seeing expressed through gold, that you will see continue to be expressed through gold in 2026?
Yes, absolutely. And we're looking at our gold forecast is still quite optimistic. We're looking for gold to continue to rally into next year as demand from central banks, but also from retail investors remains strong in this area of uncertainty. And as you said, that also reflects negatively on the riskier currencies in general. So I think, that's a risk-off situation that's going to linger throughout next year. And to be honest, probably the next few years, given that Donald Trump is going to remain in office for a while longer.
Sonia Martin of DZ Bank, thank you so much. And we are seeing gold getting a lift. Bloomberg Commodity Index in general has been absolutely flying so far this year. It's right now at the highest level going back to January of 2023. You have a lot of commodities. We were talking about copper earlier, seeing its real boom. Gold has certainly been leading, and a real question here about potential algos that are getting involved. But it seems like the physical world is getting its comeuppance and has been getting its comeuppance, frankly, since the pandemic.
And silver as well. We're seeing silver and copper, which actually are more interesting sometimes than gold because they have real life use cases, not just a store of asset the way you see central banks come out and buy gold, especially if they're concerned about maybe U.S. sanctions or secondary sanctions from the United States when it relates to Russia or China. So, yeah, commodities on a tear. And when you think about the AI story, as we just had this hour, all that energy use is going to be needed, and commodities are going to be needed from when it comes to the AI data center rollout.
Yeah, and how does this really play into inflation? We will be getting core PCE talking about inflation on Friday. Unfortunately, it will be from September, so I'm not sure how forward-looking it is going to be. Coming up next, we're going to be speaking with Republican Senator Bill Cassidy about cost of living concerns as you do see the prices of commodities pick up. Mark Lehman of Citizens Commercial Bank on AI concerns. Claudio Irigoyen of Bank of America. And Amanda Lynham of BlackRock. You're watching Bloomberg Surveillance. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
There's more reasons to be cautious than bullish right now.
The consumer remains the bus driver.
The market's really telling you that December we're not likely to see a cut.
Ultimately, the market's going to tell the Fed what to do.
The odds of that rate cut have increased.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. To start off the month of December, the 12th month of the year, futures lower with traders coming off 7 straight months of gains on the S&P 500. Tech continuing its streak of underperformance this morning after actually having a loss last month for the first time going back to earlier this March. Right now, all eyes still squarely on the consumer as Black Friday morphs into Cyber Monday with early signs suggesting that Americans are still spending despite waning sentiment. And President Trump has made his decision regarding his pick to be the next Fed chair, and he'll fill us in at some point. Anne-Marie, hasn't he been talking about this for a while?
He's been talking about this for months. They have been talking about it for months. Remember, I spoke to the Treasury Secretary months ago, and he said we'll have a decision by the fall, an announcement. Now it's potential we'll have a decision, an announcement before Christmas at the very end of the year. You see the president's face light up, though, every single time he is asked about this. He loves to talk about monetary policy, and he loves to have this Game of Thrones type atmosphere when it comes to picking who is going to be the next Fed chair. Right now, our reporting is that in the pole position is Kevin Hassett, who right now is the president's chief economist. So lots of questions about actually how much of a political puppet this individual might be, or actually can he at some point put some distance between him and the White House?
At the core of the Fed discussion really is the consumer and spending power and cost of living concerns that have permeated every single poll and every single sentiment survey that we have seen heading out there. This week's going to be interesting because we do not get the non-farm payrolls report as we normally would get on Friday. We do, however, get ISM manufacturing later today. We get ISM services on Wednesday. We do, of course, also get some earnings coming out. We get ADP payrolls numbers as well as core PCE data on Friday and income and spending, although that is from September. So a real question here heading out of what this will really reveal. Right now in markets, you are seeing a bit of a dip in the S&P and the NASDAQ as people look ahead to potential disappointments in the AI space and a real question of what else can ignite some sort of risk on rally. You are seeing yields marginally higher, yield curve steepening. A question there of how much this is pricing in some sort of easy monetary policy in the short term, 4.04% on the 10-year. And crude up about 1.3% as OPEC Plus pauses potentially some of its output increases. Coming up this hour, we really do want to get right to this. Louisiana Senator Bill Cassidy, as consumers hit a record spend despite economic uncertainty. Mark Lehman of Citizens Commercial Bank with stocks sliding into the final trading month of the year. And Claudio Irigoyen of Bank of America Securities as President Trump teases his Fed chair pick. We begin this hour with strong start to the unofficial holiday shopping season, even as affordability concerns grow.
Online sales were up almost 10%. In-store sales were up 4%. It was really a blockbuster weekend after Thanksgiving. And so I think that the folks who were saying, wow, maybe people are going to be anxious about, going back and getting presents for the kids and so on, they've been disproven this weekend. And I think the reason is that incomes are up this year.
Shoppers spent billions on Black Friday and could break Cyber Monday records today. Louisiana Senator Bill Cassidy joins us now for more. Senator Cassidy, thank you so much for being here. Can you square this idea of incredible spending and the ongoing American consumer continuing to uphold the underlying economy and this real feeling that cost of living is becoming unsustainable?
Well, there's obviously segments within our society, and there's a group of people who are still managing to do well. There's another group of people who are really hurting. Now, they may have the money to go out and buy their children a gift for Christmas. On the other hand, there is an increasing cost of insurance, whether it's health, property and casualty, or flood insurance, as well as the increasing cost of groceries. They have extra money, but up here, but there's a lot of folks down here who are hurting.
This is the reason why a lot of people are expecting, even though we are seeing profits at companies continue to increase, they're expecting the Fed to cut rates to respond to that K-shaped economy or the mass of people who really aren't feeling the gains. And I'm just wondering how much you're prepared to step in, that you think that it's government's job on the fiscal side to really support that lower tier of consumers that are really feeling the pain.
I would argue that in the tax cut for working families, or the one big beautiful bill, we attempted to do that. We did it both by no tax on overtime, no tax on tips, for seniors eliminating the tax that most would pay on their Social Security, but also putting in some pro-business efforts that would encourage business to reshore, to build out their manufacturing. Lastly, I will say, there's a lot of money taking place on infrastructure right now, and that infrastructure creates jobs. AI cannot swing a hammer. And so AI is not swinging a hammer. Those folks are being employed. I would say that there is a business strategy to help those folks who are in the kind of struggling area of the economy.
Senator, there's one area when it comes to affordability that actually might become a lot more expensive next year if Congress does not act, and that's the enhanced premiums when it comes to the Affordable Care Act. You have a hearing this week regarding this. Do you think we can get to a decision before the deadline?
Yeah, I think we can. I have a plan, but it's one that other Republicans have proposed some form of. And we take that enhanced premium tax credit, and instead of giving it to insurance companies, where they take 20% for profit and overhead, we give 100% to the patient in the form of a deposit within a health savings account. This allows her not to buy the more expensive silver plan, but to also get a cheaper plan called the bronze plan. Now, did I say it's cheaper? It's cheaper. And so we're helping her on her affordability. By the way, the money in her health savings account also gives her first dollar coverage for her child's trip to the ER. I practiced for 20 years as a doctor caring for the uninsured and the poorly insured. I learned that if you give power to the patient, you can lower health care costs. So we're giving power to the patient, not profit to the insurance company.
Well, Democrats come on board with this plan. It doesn't seem like they're interested in this. They want, at minimum, an extension for a year or two of the extended premiums.
So think about it. We would actually be, if you will, in one sense, extending the enhanced premium tax credit. But instead of giving 100% to insurance companies, they take 20% for profit and overhead. We're giving 100% to the patient. So you're getting an extension.
But the pool shrinks, that money. So
no,
those that are on the higher
end... Why would it
end,
shrink? It does not shrink.
Well, for the insurers, are they going to have to pay more? Are you going to have to say you're on, say, the premium plan? Or is your plan going to be even more expensive because it's not being subsidized by those on the lower end?
No. Again, going back to this, if you got this amount of money, and currently under the current plan, you give 100% to insurance companies, and they take 20% for overhead and profit. Instead, you give 100% to patients in terms of deposits within a health savings account. First, you're lowering their deductible, and because you have lowered their deductible, they can take a cheaper bronze plan. Now, normally you don't because your deductible is higher. We just lowered their deductible. They're getting a cheaper bronze plan. By the way, when you give power to the patient, she gets the health care she chooses to have that she knows she needs, as opposed to the health care the insurance company permits her to have. A lot of wins in here for the patient. Who would not be for that, whether you're a Republican or a Democrat?
Do you think that this is enough to prevent the government from shutting down again in January when this comes back up?
Absolutely. Why? Because we've actually addressed affordability on the exchanges. I would argue we also begin to address the overall increase in healthcare cost. When you give that woman, and women make all the decisions in healthcare, when you give her the power of the purse and you say, listen, if you go here, you save money. If you go there, you don't. Everybody begins to lower their cost to where they can attract her business.
You know, you said something earlier that I think is really important. You said that businesses have a role in creating jobs and creating a better landscape for the lower quartiles and deciles of the U.S. economy and the U.S. earners. I just wonder what policies you think need to be implemented to do that, because right now it doesn't seem to be working.
Are you talking about in terms of overall business
Overall
development?
business, yes.
Yeah, so I think that the tax policy that we've put in, and frankly with President Trump's tariffs, there's an incentive for people to begin to reshore, certainly nearshore. And so when you reshore, you're going to create jobs. Now, that doesn't happen like that. Think how long you need to put together your financing stack. But that's going to happen. And so as it happens, we'll see that kind of upswing in jobs for construction, for service, all those jobs that are related to that reshoring of manufacturing activity. And that'll cause a general boom. So that is a sustainable strategy to create prosperity for folks.
A lot of people are saying that the reason why companies haven't created more jobs is because they're using artificial intelligence for efficiencies. And you're seeing that in terms of Amazon coming out and saying they're laying people off because of some of the efficiencies they're getting from algorithmic learning. I'm just wondering, from a legislation standpoint, what you think that the government's role is in trying to make sure that people aren't left behind in this transition, given that a lot of these new programs can take on roles previously done by humans.
I'm a technical optimist. If you've got something that's going to increase the productivity of our nation, we'll increase tax revenue not by increasing rates, but by increasing the overall growth of the economy. When you increase that overall growth of the economy and you have more money, we've got like trillions of dollars of backlog in infrastructure. Let's just focus once more there. If you begin to invest that money in infrastructure, AI does not swing a hammer. You're going to create a lot of jobs for folks who right now are struggling to get better jobs. By the way, we're also building out our oil and gas industry, our energy industry. That creates a heck of a lot of jobs. And so everybody looks at the negative, oh, we're going to downside. We need to look at the positive. That will just shift investment to a more productive area of the economy. As we grow at the expense of other nations, or maybe we all grow together, we'll create that employment.
Lisa started out this conversation talking about affordability. Americans are still struggling. You're also looking at trying to address health care affordability by actually having this health savings account proposal. The president talked about $2,000 tariff checks. You're on the finance committee. You lead the health committee. Do you think that that is a good way to address affordability right now, putting money directly into consumers' pockets?
So I'd like to see what the president's going to propose. We do know that the debt and deficit eventually takes money out of our pockets. And so we absolutely know that. So the question is it better to pay down our nation's debt? And as you pay down our nation's debt, then it makes it easier to lower interest rates, for the Fed to lower interest rates, which then lowers a mortgage payment, which then maybe lower other forms of credit. As you do that, you make life more affordable that way. The other thing you have to worry about is if you give everybody a $2,000 check, does that bump up inflation, and therefore the Fed is inhibited on lowering their rates? So it can't be taken in kind of isolation. It has to be taken in context of everything we can do to benefit that person sitting at home struggling a little bit.
It sounds like you would be a no then on the $2,000 checks.
No, it sounds like I'm going to investigate so that I know.
Okay, while you investigate, there's also potentially going to be another big Senate, first a hearing and then a vote when it comes to the president's Fed pick. Right now, the front runner is his Council on Economic Advisors chair, Kevin Hassett. Do you think you would say yes to him being the Fed chair?
I've been impressed with Kevin. This is his second time around serving in Trump's administration. I think he's done a good job. Of course, I reserve judgment until we actually begin to look at him as Fed chair. We are having this problem of inflation, which just is a little bit sticky, and yet we want to decrease rates. How are you going to navigate that? But I'm certainly predisposed to support him.
Are you worried about Fed independence?
Fed independence is critical. You just have to have it. But I also think that Kevin would step up and be as aware of the importance of Fed independence as anybody.
Louisiana Senator, thank you so much for being with us. Louisiana Senator Bill Cassidy here in the New York studio. Very much cost of living on the docket, especially given how much health care has dominated the conversation and potentially, Anne-Marie, could be the reason why the government could shut down yet again.
Right. There's this going to be the debate. It's happening all of December. The senator is going to be leading a hearing on it. What do you do in the sense that you have these enhanced Obamacare credits that are going to be ending? And for Democrats, this is really important for them to have this fight because this is what the entire shutdown, longest shutdown in history, was based around.
Yeah, right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Goldman Sachs is buying Innovator Capital Management for $2 billion. The deal will combine the bank with an issuer of a relatively new type of ETF known as defined outcome funds that seek to limit downside risk. Stay tuned to Bloomberg TV for an exclusive interview with GSAM's co-head of third-party wealth, Byron Lake. That's at 3 p.m. Eastern. The man suspected of killing United Healthcare CEO Brian Thompson will be back in court today for a pre-trial hearing. Luigi Mangione's attorneys argue key evidence should be tossed because it was obtained illegally. Mangione has pleaded not guilty to 9 state counts and 4 federal charges. Crypto is seeing a sharp risk-off start to December. Bitcoin plunging more than 6% this morning, while Ethereum dropped more than 7%. The deep sell-off puts the entire crypto market on shaky ground, with traders bracing for more moves lower. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, AI keeping markets on edge.
We are expecting earnings to increase double digits, around 11%. The fulcrum of this market has been big tech. You do need tech to deliver.
Mark Lehman of Citizens Commercial Bank joining us next. This is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
A softer start to the last month of the year. We are seeing both the S&P and NASDAQ and Russell 2000 all falling across the board, deepening losses as the session grows older. Futures down 0.7% on the S&P. Yields just marginally higher with yield curve steepening at the 10-year denomination, 4.04%, up about 3 basis points. And crude higher with OPEC Plus potentially pausing some of their output increases after a vote over the weekend. Under surveillance this morning, AI keeping markets on edge.
We are expecting earnings to increase double digits, around 11%. The fulcrum of this market has been big tech. When we dig into it deeper and recognize that the AI trade is far beyond the hyperscalers, and hyperscalers are in actually pretty good shape, what we think is the earnings risk is limited, but the valuation risk is higher. So in a scenario in which the AI narrative shifts away, then we can see a 10 to 15% correction in the equity market. You do need tech to deliver.
Here's the latest. Equities under pressure following the longest string of monthly gains on the S&P going back to 2021. Still, concerns about the AI narrative are weighing on the indices and have kept the NASDAQ 100 underperforming. Mark Lehman of Citizens Commercial Bank remaining optimistic, writing, quote, AI investment will be a powerful economic driver and deflationary force for the foreseeable future. We expect a strong start to the new year, and the market should continue to broaden. Mark joins us now. Mark, thank you so much for being with us, and happy post-Thanksgiving. It seems like the divide between San Francisco and New York is one of vibes, where San Francisco feels really good and positive about AI. New York is feeling less so increasingly as the weeks grind on. Can you just explain this division in sentiment when it comes to what we're seeing in Silicon Valley versus on Wall Street?
Well, it's pretty early out here in San Francisco, but I would agree with your sentiment. It's true that
the AI story is largely playing out around San Francisco. 40% of the investment dollars are here, and it's part of the resurrection of the economy and resurrection of the city. All you got to do is drive from SFO into the city and see what the billboards say, and every single one of them is AI. You could be a cynic and say, boy, that reminds me a lot of 1999, and you'd be right. But also 1999 portended the next 25 years of innovation and growth of the NASDAQ and growth of technology. And I see a remarkable parallel between the two. It will be bumpy. Market cap's going to move around a lot during those periods, but it is going to be the story of the next decade and beyond.
Which is the reason why people are celebrating ChatGPT's third birthday, which I believe occurred yesterday. Happy birthday, ChatGPT. And it's raised this question of, are we already seeing the dominance of some of the initial first movers really wane, and whether you're seeing the likes of Gemini take over? I mean, how much you already seeing some of these cycles, the winners and the losers, shaking out in a way that could potentially be pretty disruptive, even if AI is the elixir that so many people think it is?
Lisa, that's exactly the right point. And we've seen it in the last month. If you saw what happened with Google and other stocks in the last month, how rapidly the ascent of market cap and some of the losers, if you will, in even small periods of time. And those moves are so substantial and so historic that's the story going forward. And you're going to have to be really careful. But I think the theme is the same theme going into the internet boom. If you're not exposed, you're really going to miss out. And this is the revolution. I keep calling it the second coming. I've said it on your show. It's going to happen, and it is happening. The real question is, how do you play it as an investor? And also, what is it? The ramifications for society and for our employment and for our economy. And that's the second story. And I think you talked about a little of that with the senator, and you hit a lot of the right points, because it is going to be a massive disruption. And we saw it in the have-nots technologically going into the internet, with education, with job training, with economic. This is going to be the same ramifications. And again, we've seen these microbursts in stock both ways.
When you look at the ramifications on society, we had Ian Hartnett on the last hour as well, talking about he thinks the CapEx endgame is approaching when it comes to AI. But when it comes to society, is it about the inflationary impulse, what that means for energy prices, or actually is it about concern that AI might just take away jobs in the labor market?
I think it's both. I mean, you're seeing the president really focused on the price of oil, right? It's breaking $60 a barrel, et cetera. And then you're seeing some of the home heating bills and some of the home electric bills skyrocket for some parts of the country. If you see it for the job training, if you see it for other parts of employment, it's going to have huge ramifications. I like the senator, am an optimist. And I said it 25 years ago when you had the dawning of spreadsheets and everything. We didn't not need accountants anymore. Jobs changed. Jobs are going to change. And the information economy is obviously going to change a lot of what those jobs are. We talked 5-6 years ago about running out of workers because everybody's going to demographically shift out and we're not seeing enough young workers. So these changes happen so rapidly and the tonal changes are so big. But I do think there's going to be government I wouldn't say intervention, but they have to play a part in what this means for education and what this means for the future and the cost of education. And all these things are so large, but technology doesn't slow down. Healthcare innovation with AI is going to drive cost lower. And the kind of drug discovery we've seen will start to accelerate. You're seeing it with some of the buyouts that you're seeing big biotech happen with big pharma. Those ramifications are happening real time. Healthcare deflation is going to happen as well. AI is deflationary. What it does to the rest of the economy is much more massive than that because, again, technology is the biggest deflator we have.
You are so bullish on AI. Is there anything about what is going on that gives you pause? Circular financing, vendor financing, any of this concern you?
I think, listen, I'm optimistic because of the ramifications for it and what it's going to mean for society. Do I think every part of this is not perfect? Of course I don't. I think there are bubbles being created everywhere. There's investment dollars being thrown at AI because the people who are late are throwing dollars at it. The market obviously is very optimistic about it, just like I was 25 years ago. Did that mean that the market was going to go straight up? Absolutely not. And I can't predict what's going to happen in the market. But I think the technology revolution is here. You have to be invested in it. You have to be consistent. You have to pay a lot of attention. But sitting around worrying about what will go wrong, I think, is important, but I think it should not change your investment horizon and should change your investment patterns.
But it might change how you invest. I'm looking right now at a chart that Deutsche Bank put out showing the 300% gain in the Magnificent Seven going back to the launch of ChatGPT 3 years ago. We have seen this incredible outperformance of a select few number of names. We've seen debt start to come into the picture. If this is a deflationary kind of phenomenon, at what point does the debt become, I don't want to say toxic, but a depreciating asset in a very real sense, especially at a time of rapidly shifting technology?
Lisa, it is such the right point. And I think what we see as a bank is where we're putting our own investment dollars, where we're putting our own capital, what kind of companies we want to take public. It's a story that plays out in every sector over time, which is where do you want to spend your dollars? Who are the right technology leaders? Who are the right companies? Who are the right leaders for those companies? And where do you get a little worried? And there large gains in those kind of stocks get a lot of people worried. But we've sat on this program a year ago, 3 years ago, 5 years ago, and looked at that list and said, boy, are these stocks overvalued? In a lot of respects, that would have been a big mistake. But again, look what happened over the last 6-8 weeks. Look at the moves in Nvidia and Google, and look at the amount of market cap that gets created and destroyed in a very short time. If you're not paying attention, that's a problem. And if you're not invested, that's also a problem.
Well, we're paying attention, Mark. Thank you so much for being with us, and thank you for waking up so early in San Francisco. Mark Lehman of Citizens Commercial Bank. Always wonderful to get your insights, and I'm sure we will again. It really has been this incredible divide between Silicon Valley that sees the potential and Wall Street that's getting increasingly worried, not about the potential of AI, but about the valuations.
But as Mark said, he's not looking at it as an investor. He's looking at the societal impacts and what AI is going to mean technologically for our future. I loved what he said about he thinks the Trump administration is going to be interventionist. Thinks they already are. Look at Intel, look at MP Materials, Lithium Americas, everything has to do with the supply chain for AI, they want to stake in.
Yeah, how are you interventionist? Is it in the physical world, or is it in some of the job trading or the potential other societal ramifications? Coming up, we're going to be talking about the ramifications for the Federal Reserve with Claudio Irigoyen of Bank of America Securities. He has a revised Fed rate cut call. Plus, Yahira Anand with their morning movers, Moderna shares falling after a legal setback. This is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Well, it's a slow start to the last month of the year, but we will maybe get a Santa Claus rally just yet. We did get one heading into the end of November, at least for the S&P 500, leading to the 7th straight monthly gain for the first time going back to 2021. This morning, you're seeing losses continue to mount in pre-session trading, down 0.7% on the S&P futures. NASDAQ underperforming yet again, down 0.9%. And the Russell 2000 doing poorly, down 1%, even though, A, we don't get non-farm payrolls, and B, there is more than a 100% chance of a Fed rate cut this month, now priced into Fed funds futures. What you could see priced into the bond space is it isn't necessarily an all clear. You are seeing yields inflecting higher, pretty much flat on the 2-year, but that yield curve steepening has been mounting throughout the morning. 30-year yields up 4 basis points. And a real question here about how much near-term rate cuts will prevent longer-term rate cuts over the 2026 and 2027 periods. We'll get into that discussion in just a moment. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start over in Europe with Airbus. Shares are falling 8.6% in the pre-market on a Reuters report that the playmaker has run into quality issues with fuselage panels on several dozen of its A320 jets. This is coming as the company races to meet ambitious delivery targets by the end of this year. And the sell-off deepened after its A320 jets suffered a software glitch just days ago that affected about 6,000 A320 jets. And though that problem has now mostly been fixed. Meanwhile, moving on to crypto, we are seeing crypto-linked stocks falling this morning. Amid this risk-off tone that we're seeing in markets just moments ago, I checked Bitcoin was down more than 5%, trading just above $86,000. And most of that has to do with the risk aversion we're seeing in markets, but also China's central bank saying that it plans to clamp down on crypto. And we end on Moderna. Those shares are also falling 4.2% in the pre-market on a major legal blow by a judge who rejected most of its attempt to avoid a patent lawsuit filed by Northwestern University. The company now faces claims that it misused the school's technology in order to develop its blockbuster COVID-19 vaccine. This is coming as the pharmaceutical company continues to struggle amid the decline of its COVID business. Lisa?
Thank you so much, Yahira. On our radar this morning, President Trump downplaying concerns over escalations with Venezuela, saying people shouldn't read much into a post where he said the country's airspace should be considered closed. U.S. forces continuing to amass in the region. Can you explain what happened over the weekend, Anne-Marie?
There's a widening campaign, of course, in this administration when it comes to Venezuela, when it comes to the Caribbean. The president of the weekend had this Truth Social telling everyone to avoid the airspace. People felt like there was going to be a strike, something happened imminently in the country. Then the president on Sunday said, don't read too much into that post. So he's moving forward and then taking a step back, which is why everyone is in this precarious position on where the administration stands right now and what they want in terms of, is it regime change when it comes to Venezuela? The president said he did speak to Maduro, but we have no readout or understanding what the two leaders actually discussed.
How much is this an issue of trying to secure U.S. influence in Latin America? How much is this an issue of immigration? How much is this an issue of drugs? How can we understand this in the broader discussion, as we were having earlier this morning, of the U.S. seeking to plant its influence more significantly in Latin America?
Well, this is the conversation we had the last hour when it comes to narco-terrorism, when it comes to immigration to the United States, but also when it comes from influence from the likes of Russia and China in Latin America, and the United States really trying to claw that back into what they would assume is their own sphere of influence. We haven't just seen it in Venezuela. We've seen it in other countries as well, particularly in Argentina.
Yeah, and this raises questions about rare earth minerals and others, which we will continue to parse through. Meanwhile, Airbus facing new quality control issues. Reuters reporting the plane maker discovered problems with fuselage panels on several dozen A320 jets. This after the company was already repairing thousands of aircraft following flight control software issues. And President Trump saying he has decided on his pick to replace Fed Chair Jay Powell, and he's expecting his nominee to cut rates.
Are you Fed Chair? Are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell us. Kevin Hassett.
I'm not telling you.
Trump's chief economic advisor, Kevin Hassett, is seen as the front runner. I love the, ooh, tell me, in the background.
And then is it Kevin Hassett? He just smiled, and then he said, okay, that's enough for now, because he didn't want to get drawn into maybe adding more of what he thinks. Whether or not he actually knows who it is or not, he clearly has a front runner's mind and is likely Kevin Hassett, who said, I think the market reaction to the rumors of him was quite positive. So didn't actually endorse that he should be the next Fed chair, but sort of did in a backwards way.
So we'll get drawn in by the Fed discussion. Bank of America Securities revising its Fed call and now expecting another 25 basis point cut at next week's meeting. Claudio Irigoyen of Bank of America Securities joining us now for more. Claudio, wonderful to have you. Thank you so much. What solidified it for you, the idea that next month really was going to be a lock, or this month, I suppose I should say, for the Fed rate cut?
I think there is a lot of focus on December or not. Now the market priced more than 100% probability of December. But to me, the underlying question is what the market expects the Fed to do versus what the Fed should do. And this is important coming into next year because we're going to have a new chairman, probably with a mandate to cut interest rates. And when you take a look at the economy, financial conditions are not tight. The economy is doing well. We actually revised our forecast for next year to 2.4% growth. And by the way, the call that we have for December comes with another 2 cuts in June and July. So we're still sticking to 3 to 3.25 as a terminal rate, which we already think it's quite accommodative in nature, really. So to me, the question is, okay, if they cut 2, 3, 4 times between now and mid next year, what's going to happen to the economy? What's going to happen to inflation expectations? Because, to be honest, there is zero chance that we're going to have inflation, core PCE coming close to the target before the end of next year. In fact, with the exception of China and Europe, most of the central banks in the world will have inflation above their targets. So most of the central banks are coming to the end of the easing cycle.
Why then are we seeing inflation expectations so contained in market probabilities? Maybe not necessarily in the University of Michigan sentiment survey, but certainly in terms of market pricing. Why have we not seen markets sort of clamor to revive their bond vigilante spirits?
I think there are a combination of things, probably some technical issues also playing in the market. Markets focus a lot on long-term inflation expectations. Companies cannot care less about 10-year inflation expectations. They don't make decisions based on that. They focus more on 1-2 years inflation expectations. And those numbers, as you said, as you mentioned, they are not 2%, not nearly close to that. So I think there is still an underlying issue. Let's see what happens with tariffs. Let's see what happens with the Supreme Court ruling on IPA. That can change things in the short term. But there is an underlying issue with inflation that has nothing to do with tariffs that indicates that inflation will be persistently high and above the target.
So if the Fed cuts in December, which, as you said, it's more than 100% chance, what happens for 2026? How do they continuously cut interest rates if you think inflation is going to be this underlying problem?
Well, it's the debate between what they are going to do and what they should do. Let's not forget that between the December meeting and the January meeting, you're going to have 3 employment numbers, 2 CPI numbers, 2 unemployment rate numbers. You're going to have a lot of information. It wouldn't be a bad idea to say, listen, we remain on hold in December. There is a lot of data that we need to revise. And if conditions are guaranteed, we're going to cut again, because the last 2 cuts were insurance cuts, which means that the Fed didn't have sufficient information to say this is the right thing to do. This is just in case we are wrong. Another insurance cut, 3 insurance cuts, probably too much.
You think financial conditions aren't tight right now?
They are not.
But aren't they tight for the lower-end consumer?
Not necessarily. With consumption, there is a tricky thing. This is what we call K-shaped consumption. And we have very good credit card data at Bank of America, and you can see that consumption is driven by middle and higher income brackets. Lower income brackets is no more than 15-20% of aggregate consumption, so it's not that important. That's where you're seeing some delinquencies, some issues, but aggregate consumption is fine. There is the linking between the labor market and aggregate consumption, and the question is 6 months from now, are we going to see much weaker consumption or much stronger labor market because companies will revise their hiring plans because much lower uncertainty about tariffs, etc. And probably it's going to be the second, the labor market recovering to continue supporting consumption. So if that is the case, you're going to see 6 months from now a very strong economy that might make you think that these cuts were probably too much. So 3 months from now, not even 6, 3 months from now, it's going to be interesting before the new chairman of the Fed. Probably want to know who's going to be by then, but before the new chairman of the Fed takes over the Fed, where the economy is. Because the first half of the year, you're going to have a significant fiscal impulse. It's an electoral year. Probably Trump will de-escalate on trade tensions and focus more on deregulation. So absent a spike in inflation that tighten financial conditions or a correction in the stock market because of AI-driven story, the economy will look strong.
The picture that you're painting is really interesting, especially given that you're head of global economics for Bank of America, because this isn't just a U.S. story. This really is a global story with respect to huge debt loads in a lot of developed markets, persistently high inflation above that 2% target, and a feeling that politically people cannot pull the strings and actually cut those deficits. So how much are you looking at maybe a good global growth backdrop next year, but potentially a really bad backdrop for debt going into a potential year where every economy has an incentive to run their society hot?
Yeah, 2025 was about 5 themes. Trump policies and the associated uncertainty, AI boom, the idea that productivity will boom in the future, China overcapacity, important because China is exporting deflation and goes to the rest of the world, fiscal deficits, and excess global liquidity. So what's going to change into 2026? Probably Trump is going to focus more on the regulation and less on trade escalation. But the rest of the things will be relevant. And excess global liquidity, I think it's key because people focus on the labor market making, the stock market making new high here, but stock markets are making new highs everywhere, in Japan, in China, in Latin America, you name it. And emerging markets are rallying, the spreads are making new tights every day, and gold is also rallying, and private credit is also rallying. So when everything is rallying across all asset classes, across all the regions, has to be something else, has to be a common factor, and I think that common factor is excess global liquidity. So and those imbalances are important because any shock that hits those imbalances and tighten global financial conditions, for instance, higher inflation in the U.S. that forced the Fed to review their policies, can contaminate the global backdrop very quickly.
Do you think the U.S. is still going to be the brightest shirt in a dirty laundry bin or whatever cliche you want to use?
Well, I mean, fiscal problems are not the U.S. problem only, right? You have fiscal problems in Japan, you have fiscal problems in the UK. Actually, there is a convergence between developed and emerging markets for the wrong reasons, right? In the sense that some of the problems in developed are similar to the historical emerging market problems in terms of the dynamics. But if you take a look at growth projections, we expect 1% growth for Europe and 2.5% growth for the US. And less than 1% growth for Japan. So within developed economies, the U.S. story seems to be the brightest story still there.
Claudio Irigoyen, thank you so much for being with us. Claudio Irigoyen, head of global economics for Bank of America Securities. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg.
सिल्वर को देख लेते हैं 1 आवर और 4 आवर में MCX या फिर Forex एक बार कंफर्म कर देना प्रसाद जी. Forex पूछ रहे हो आप या फिर MCX?
About private credit and obviously what's going to happen with the Fed at their December meeting. We actually see going into 2026 a very optimistic scenario playing out.
Amanda Lydham of BlackRock joins us next. This is Bloomberg Surveillance. A bit of softer tone to start the last month of the year after a 7th straight monthly gain for the S&P 500, down 0.7% now on the S&P futures. You are seeing that decline continue to grind further at session lows right now. Your 10-year yield's just up less than 3 basis points as people game out Fed strategy. Under surveillance this morning, credit skepticism.
That skepticism is predicated on concerns about AI, about private credit, and obviously what's going to happen with the Fed at their December meeting. So those three things are kind of weighing on investors' minds, but we actually see going into 2026 a very optimistic scenario playing out.
Here's the latest. Private credit concerns continuing to weigh on investors, even as losses from defaults are staying low. Amanda Lydham of BlackRock writing this: we believe the peak in defaults in the public credit market is behind us. Amanda joins us now. Amanda, thank you so much for being with us.
Thank you for having me.
This is the big question, right? How much are people pricing to perfection credit at a time when potentially defaults are going to inflect upward? There's been a lot of debt issuance in the tech space, and there's a feeling that private credit has gotten a little bit heady.
Okay, so I think there are a couple things to note. One is we often get asked in the corporate default market or corporate credit market when the peak in defaults is actually going to arrive. And what we point investors to is the data that actually shows in the leveraged loan market, for example, defaults peaked in November of 2024 at 7.7%, which is actually a fairly high number. That's using Moody's data, issuer-weighted trailing 12 months. But the point is that we think the peak in trade policy uncertainty is likely behind us. We think the peak in growth concerns is behind us. And we think the peak in debt service cost headwinds from higher interest rates is behind us. So when you put those three things together, coupled with a good enough growth backdrop in 2026, it's hard for us to envision a new peak in corporate credit defaults. And again, keeping in mind that we've already had kind of this flush in 2024 because of the high borrowing cost. I think coupled with that, our view for corporate credit, both liquid and private, is one of dispersion but not widespread market disruption. And I think that's really the key point to keep in mind.
So a positive outlook, a constructive outlook, as long as you're careful and you don't get some of the bad stuff. A real question, though, about just the spreads are pretty tight.
Yes.
But you have had a pretty loose market.
Right.
And there is a feeling that maybe the appetite is waning for some of the tech-related debt in a sense that maybe things have gone a little bit too far too fast.
It's a great point. Our view on credit is that if you're owning credit, you should be owning credit for income and yield, not necessarily because there's room for spreads to move materially tighter, and actually not because we think intermediate or long end rates are going lower. So that's really the view. That's a different way of thinking about credit versus past regimes when you had kind of a total return boost from tighter spreads and lower rates. It's really that income component. I would say to your second part of your question, we're not really seeing on the ground that appetite is waning to a large degree in credit. In fact, a lot of these episodes of widening, and by the way, we think episodic volatility is a feature, not a bug of this market, but those periods of episodic widening, they're getting bought. And so high yield spreads are actually back below 275 using your Bloomberg Index. So it's really to us, I think, pretty evident that there is a fair amount of capital on the sidelines. It's income and yield based. There is demand. And I think while spreads are tight, our view is that the bar for a sustained sell-off in credit spreads is also quite high. To get that, you would really need a severe deterioration in the growth backdrop, and we're really not seeing that, which goes back to this point of there's a lot of dispersion. There will be winners and losers. Not every part of the credit market is keeping pace with this tightening, but we don't see an environment of widespread market disruption.
When you look at the uncertainty, though, you named policy like tariffs uncertainty being one of them that you feel like you are past. Does it bother you that we still don't have a decision from the Supreme Court on IEEPA?
I think our view is that if the Supreme Court does strike down the IEEPA tariffs, that the administration has been pretty clear that they have other tools in their toolkit, such as sector-specific tariffs. So our view is basically that tariffs in this regime are likely to remain in place in some form. The key question is, are corporates adapting to that? And actually what we see in the margin perspective is that actually margins are holding in relatively well, and corporates have been forced to find other ways to protect their bottom line, whether that's through operational efficiencies that were originally supposed to take place over a couple of years. Maybe they're front-loaded, changing product mix, eliminating some SKUs. So it's really a bet on the management teams to figure this out, just like during the pandemic. The trend of corporate resilience was actually much more pronounced than I think many market participants feared.
There's a fiscal side of this and the administration side of this, and there's the monetary side of this. And we've been talking about the expected rate cuts coming this month as well as potentially next year. And you said that you do think that some of the peak rates and peak uncertainty around that has faded. At what point is that sort of a necessary ingredient for your constructive outlook on credit next year?
Sure. So I think our view on the monetary policy path from here is that there's probably one or two more rate cuts in the pipeline. But as we get closer to neutral, and Chair Powell has said we're probably already at the high end of some estimates of neutral, that will become a more delicate balance between their dual mandate. And so really what we've been emphasizing is the depth and the drivers of this rate cutting cycle are far more important than the timing of this. And if the drivers of the rate cutting cycle are driven by a significant deterioration in the labor market, that's not a great outcome for credit. By contrast, if the drivers of the rate cutting cycle are ongoing improvement in inflation, then that's a more benign outcome for credit. That said, it's hard for us to see rates going below neutral. We're expecting a normalization of monetary policy, not a sharp easing. So I think that income play on credit remains intact to a certain degree. It's moderated, of course, from the peak as rates have come down. But again, that's a double-edged sword. The yield backdrop for investors has moderated, but so too there's been some relief in debt servicing costs for corporate borrowers, which is important.
You were talking about being selective, and I do wonder, happy birthday, ChatGPT, third birthday. We should just touch on how much debt has been issued from the tech giants. We have seen $100 billion of debt tied to OpenAI and data centers that do provide services to them over the past number of months. I just wonder, does that make you nervous? Does that make you want to stay away from that debt as a potential pothole in an otherwise pretty bright backdrop?
So I think we view this as a bit of a regime shift in terms of the leadership of issuance at the sector level. As you noted, technology issuance actually months ago outpaced all other full years on record in the U.S. IG market. So it's been kind of a real paradigm shift in the way that the market is absorbing tech issuance. We think there's a lot more room for this to play out. Actually, if you just look at a very modest estimate of increasing gross leverage by half a turn for the Mag 7 ex Tesla, so excluding autos, there's hundreds of billions of debt capacity that could be added. So that's a large amount of debt, actually upwards of $400 billion. And again, a modest tweak in leverage. We don't expect all of that to be used immediately. We think more likely it will be gradual over time. But I think the market is adapting to a realization that tech will be a larger contributor to issuance. But again, the demand for this has been very robust. And I think just like in sectors like biotech, where there are drug discoveries that happen years after bonds mature, it's almost a similar bet on the management teams.
So you'd be patient. You'd be buying.
I think from our perspective, we think that this is actually a regime shift that has been met with a significant amount of investor demand.
Amanda, awesome to see you. Thank you so much for being here. Amanda Lynham of BlackRock here with us in New York. We are talking about the debt backdrop because that has been what's gotten people nervous over the past couple of weeks and months. This idea that this is a new segment of this story, which is it is including a little bit more leverage.
Right. And to Amanda's point, though, the appetite has been insatiable. And you mentioned it, $100 billion these tech companies are tapping the debt markets for. And people are just buying it up consistently. The appetite has been robust and healthy. At the same time, a lot of people are saying, where are we actually going to see the shovels in the ground, the data centers being built? Remains to be seen. Maybe 2026 story.
Well, 2026 will be a story of a question around the debt, but also a question around the evolution of AI. Coming up, we'll talk about that with Seema Shah of Principal Asset Management, Leo Feller of Numerator, Abigail Watt of UBS, and Oksana Aronov of JP Morgan Asset Management. You're watching Bloomberg Surveillance. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
The fulcrum of this market has been big tech.
We are still in the early stage of this AI investment or AI arms race.
We actually see going into 2026 a very optimistic scenario playing out.
The air is coming out of the bubble rather than the bubble bursting.
To call this a bubble, it's wrong.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Questions swirling about the resilience of big tech on ChatGPT's third birthday, with the forgotten 493 continuing a streak of outperformance. All eyes on who President Trump has picked to be the next Fed chair, with growing bets of a December rate cut bolstering last month's risk-on flavor, and a focus on the little bits of data we get this week to determine whether the economy is speeding up or slowing down. It was supposed to be non-farm payrolls on Friday. It is not. It is now ISM Manufacturing Monday. Anne-Marie.
It doesn't feel like the first week of a new month. And by the way, the last month of the year, where has this year gone? Without the jobs report on Friday. But even we're going to get it. All this data we're getting, at least a lot of it, is going to be really stale, like the PCE on Friday. So I'm looking at actually what happened in terms of real money being spent when it comes to Black Friday. Potentially we'll get a readout end of evening when it comes to Cyber Monday. And even though you made a really good point about hasn't been adjusted for inflation, the consumer is still holding up. We're talking about billions and billions of dollars. The American consumers decided to go out or online and spend on Friday, and that's continuing into the weekend, potentially into this week as well.
This is the reason why people are kind of at a crossroads. You're seeing a more than 100% chance of a Fed rate cut being priced into Fed funds futures right now for the meeting that happens next week from the Federal Reserve. You have this idea that going forward, they will have space to continue cutting rates going forward. At the same time that you've got a resilient consumer, and you have Claudio Irigoyen of Bank of America saying he thinks that inflation is going to remain persistently higher and really test the hands of a lot of central bankers. It kind of raises this question: how data dependent is this Federal Reserve within the absence of data and at a time of changing personnel?
Right. But the current Fed chair, Jay Powell, has made it clear you can pretty much look through the inflation prints because we're not going to see the potential pass on from tariffs all at once. You can look through all the hot inflation prints at the same time. They have been concerned with what's going on in the labor market. All of this is happening while we get a changing of the guard. And the president said yesterday on Air Force One, flying back to Washington, D.C., that in his mind, he knows who he's going to pick. And it comes on the heels of our colleagues reporting at Bloomberg that in the prime position is his chief economist, Kevin Hassett.
So will he cut rates? Will it be Kevin Hassett? Will ISM Manufacturing show something? Here's what we've got coming up for the day ahead. At 10 a.m. Eastern, we do get that ISM Manufacturing. Watch out for new orders, employment, and prices paid. The components are all going to have a greater degree of importance. President Trump will be signing bills. Jerome Powell will be speaking tonight at 8 p.m. Eastern at an event in Stanford. It is, of course, the quiet period for the Federal Reserve, but it is a memorial event, and we're going to be watching it as well. And then, of course, we do have Steve Witkoff heading to Russia, the whole question, the backdrop of Russia-U.S.-Ukraine discussions. Right now, we are seeing bonds and stocks continuing just to sell off a touch to start the new month, down 0.7% in S&P futures, yields higher by about 2 basis points on the 10-year. Coming up this hour, Seema Shah of Principal Asset Management with stocks edging lower. Leo Feeler of Numerator providing a consumer check-in as the holiday shopping season rolls on, and Abigail Watt of UBS previewing a crucial week, potentially, of economic data light. We begin this hour with stocks sliding to the kickoff, the final trading month of 2025. Seema Shah of Principal Asset Management writing, AI will remain the dominant force in the year ahead, although mounting concerns over a potential bubble may limit its ability to propel equity markets and household wealth. Seema joins us now. Seema, thank you so much for being here. Great to see you.
Great to be here.
So start with this conundrum. On one hand, you can believe that AI is a transformative technology that will have a huge impact on the world as we know it. But there still are questions about valuations. How are you sort of parsing that conundrum, or as you call it, paradox in 2026?
Yeah, I think what we're seeing, at least this has really taken off over the last 2 or 3 months, is that narrative has shifted. So there's still optimism about what AI can potentially deliver in the long term. But there are concerns that we don't really know. And how can we continue to invest in such a huge amount in something that we don't know exactly when it's going to start to deliver their return on interest on investment? So we think it's still going to drive markets. We think it's still going to be really key. But in terms of how much it really propels equity markets, how important it is for household wealth, that starts to diminish. Now, that doesn't need to be a really negative story, but it does mean that we need to start thinking about where else we're going to be getting this growth from.
Yeah, especially given the fact that a big question is the state of the consumer and the state of the rest of the economy. A lot of people have been coming on the show looking into their crystal ball saying 2026 is going to be the year of the rest of the 493, that's going to be the adoption. That's going to be a real question of a broadening out in a trade in equities. Do you agree with that?
I think there is definitely room for the other 493 to do fairly well. I mean, we've seen signs of that already this year. And when we're looking forward to 2026, we have a fairly constructive macro outlook. It's not accelerating growth. It's not incredibly strong growth, but it's fairly mundane, benign. And in that kind of backdrop, you can see other sectors performing fairly well. We still like financials. We think consumer discretionary can actually do pretty well in the first quarter of the year. So there are areas, but I do think at the same time, it is very difficult to completely separate AI from any of the narratives out there, particularly within the macro space. I mean, when we talk to clients and we talk about inflation, unemployment rates, growth, wherever you talk now, AI is a really key component of it all.
Going into the end of the year, what are clients most nervous about?
They're still very worried about the AI bubble. I mean, that's their key concern. They want to make sure...
Even more than the Fed?
Even more than the Fed, actually. And it's been an interesting shift in the last couple of weeks where there was real concern about what the Fed was going to do. Now there's the almost full pricing of a rate cut in December. And this belief that the Fed will continue to deliver as necessary.
So this feeling that policymakers are still going to be there to prop up the economy, prop up the market if necessary. And I think that's a real reassurance.
You talked about the forces that define 2025, inflationary pressures, the policy uncertainty out of Washington. Some of that has been quite acute. And you said it's going to shape the contours of 2026. When you look at policy, what exactly do you think is going to shape from 2025 into 2026?
So I think, these are real anchors for the economy. They always have been. This year, everything has been a little bit more heightened with the change in administration, the tariffs, etc. Now, for 2026, we think that tariffs is still a story. It's just that companies know a little bit more about the way that the administration is behaving. I think companies have decided are able to adapt. So that's key. Inflation is also still there, lingering in the background, still worries about how companies are going to pass it on to consumers, what happens to their margins. But it's less of a concern. So a lot of these things are still there. They're shaping the contours. But we have found that companies and consumers are able to think beyond that, so that increasingly there are other narratives that we need to be thinking of.
So you have a very global investor base that you talk to, a very global client base. And I would love to understand if the story of AI optimism with the backdrop potentially of worries evaluation, is that a U.S. story or is that an international story that kind of weighs the same way in, say, Asia and, say, Europe?
So it's a theme that all investors, wherever we're talking to, are still thinking about, but thinking about it in slightly different ways. So if you're in Europe, the fact that there are concerns about AI valuations does mean that Europe is a little bit more attractive. Nobody's expecting it to be a complete outperformer, but its stability and the fact that it has less exposure to technology within the main indices is a key winning point. So that is a kind of a focus of, we want to diversify. Europe may be a point of stability. And within Asia, a lot of people, of course, believe in the AI narrative still, but they're looking at the valuations which are a little bit more attractive than what you're getting in the US. So actually for 2026, people believe in AI still. There are concerns, but what it means is that they are trying to shift their global exposure to focusing a little bit more on Europe, focusing a little bit more in Asia. You still have some exposure to the US, of course, but it's more of a global diversification story than I think it was at the beginning of 2025.
How much does this play out both in bond markets and currencies? Because people have been looking for an excuse, or they were at least earlier this year, to diversify away from the United States. How much are they going to take this opportunity to do so on a non-currency hedged basis, meaning that there will be that sort of dollar depreciation that a lot of people were expecting to continue into the second half of this year?
It's funny, that doesn't seem to come up that much in conversations at the moment. I mean, when we're talking about the dollar as well, the growing belief is that, look, the dollar has essentially stabilized from here. We're not going to expect to see very significant movements. So that is a slightly different, tone to the talks that we were having about 6 months ago. So the focus, again, on Europe, on Asia, on parts of emerging markets, still very, very key without necessarily having to worry about the currency aspect.
We were talking to Claudia Irigoyen of Bank of America. It really stuck with me, this idea that you could see inflation pick up around the world and accommodative policies from developed markets around the world, because there isn't the political will to push back against this, which means that inflation is going to remain high. And it just sounds like a really bad backdrop for bonds. I mean, at this point, why not just invest in real assets, in stocks, and avoid the bond market altogether, particularly from the developed market, unless you're really just looking to lock in and sort of immunize any kind of schedule of payments that you have?
Yeah, I think we are expecting inflation to be somewhat elevated, right? So still above central bank targets, but it's not very volatile. We're not expecting inflation to be creeping higher, or at least to moving significantly higher over the coming months. So that's still a constructive backdrop for bonds. Having said that, though, we do think that there are other opportunities beyond the bond space. You mentioned private markets, real estate, infrastructure. Those are all really interesting stories in this backdrop where you have persistent inflation, but it doesn't necessarily detract very, very significantly from bonds.
What else do you like? Are you still interested in gold? It was a story of 2025. Think it persists in 2026?
I think that gold has had a lot of its heyday. That doesn't mean that it's going to come dropping back down again. But so much of the reason that people were excited about gold this year was about political instability. And I think going into 2026, that concern is fading a little bit. In terms of, from a long-term structural perspective, worries about what happens over the long-term credibility of your institutions, I don't think that's disappearing entirely. But having faded a little bit from the general narrative, it means that the shine on gold is fading a little bit. And so we start to think about whether other opportunities are.
You're visiting us from London. I'd love to get your perspective on what's going on in Europe right now, because they seem to be caught in the middle between what is going on with China and the United States.
Yeah, they are. And I think, whereas once it was a lot about which part of the world we're going to lean into, I think increasingly the biggest concern is that as China navigates this tariff environment with the US, they try to double down on where can they export to. Europe is really sitting in the crosshairs of that. So, in the last few years, we've seen all these concerns from the US saying that China's industrial policy has really hurt the US. It could be that the narrative starts to shift, where for Europe, it does become a real concern. And so for Europe, it becomes increasingly important that governments really do invest in the infrastructure. What are the other industries that can really do well to take over the baton from the manufacturing sector? So I think that is key, especially from the deflationary side. What is the ECB and how they're going to be responding to some of these risks?
Seema Shah, thank you so much for being with us, and great to see you in person. Seema Shah of Principal Asset Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. President Donald Trump is downplaying his social media post that called on airlines to consider Venezuelan airspace closed. U.S. forces have been massing in the region as Trump weighs military action that would go beyond strikes on suspected drug boats. Venezuela's government called Trump's remarks hostile and demanded unrestricted respect for its airspace. Eli Lilly is once again cutting the prices of introductory doses for its popular weight loss drug, Zepbound. Starting today, the lowest dose vial for cash-paying customers drops to $299 a month. It's the latest move in a price war with Novo Nordisk, which is making it significantly less expensive for people to start on the medicines. In sports, the Buffalo Bills dominated the Pittsburgh Steelers 26-7, while the Seattle Seahawks pitched a shutout, blanking the Vikings 26-0. Elsewhere, the Texans held on, beating the Colts as the Jaguars took down the Titans to jump into first place of the AFC South. Finally, the Denver Broncos narrowly escaped in overtime against the Commanders, winning a Sunday night thriller 27-26. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. I never thought I would see Anne-Marie get excited about
Everyone
football.
knows. I'm not
You actually said, you're like, don't ask me to talk about this.
No, usually. But my dad was so excited yesterday, and so was Mohamed El-Arian, because the Jets finally won. They never win, and they won yesterday, 27-24 against the Atlanta Falcons. And it wasn't in our brief.
Okay, well, you just did.
I bet,
so thank you.
I bet that's a Giants fan.
Oh, yeah, writing
that
that brief is a conspiracy theory. We'll dig into that. Up next, the morning calls, plus Leo Feller of Numerator with a consumer check-in as the holiday shopping season rolls on. That's coming up next. This is Bloomberg Surveillance.
It's better to pay down our nation's debt, and as you pay down our nation's debt, then it makes it easier to lower interest rates, for the Fed to lower interest rates, which then lowers a mortgage payment, which then maybe lower other forms of credit. As you do that, you make life more affordable that way. The other thing you have to worry about is if you give everybody a $2,000 check, does that bump up inflation, and therefore the Fed is inhibited on lowering their rates?
That was Louisiana Senator Bill Cassidy taking on the issue of affordability, which has so dominated Washington, D.C., very much front and focus as we get a smattering of data, not the official stuff this week in terms of non-farm payrolls, but still we do get ISM manufacturing later today, ISM services on Wednesday, and of course jobless claims on Thursday. Right now we are seeing those declines, but the outperformance has been from the equal weight. The S&P futures down less than everything else, which is really interesting given the continued underperformance of big tech, down 0.7% in the S&P futures. NASDAQ futures down almost a full percentage point, building on losses from last month, even though we did see some potential optimism springing, at least from the guests that we have here. Also, the Russell 2000 down 1%. Time now for the morning calls. First up, Bernstein cutting Zscaler to market perform with a $264 price target, saying recent results have, quote, added narrative issues, feeding into worries about increased competition. Those shares down 0.8%. Next up, Stifel cutting its price target on Home Depot to $350, citing third quarter results that point to a weaker underlying category not captured by expectations, down about 0.5%. And finally, JP Morgan raising its price target on Ulta Beauty to $606. The firm believing Ulta optimized promotions during the third quarter. It expects upward estimate revisions after its earnings print. Do they really have good promotions, Emery? Do you shop at Ulta? You don't shop at Ulta?
No, I do. I shop
Okay.
at Ulta. Yeah,
All
why
right.
not?
All right.
I do a mix of Sephora and Ulta Beauty, but Ulta Beauty has been on an absolute tear with the younger generation that does all these skincare regimes for their social media, and you have to go out and replenish. So I might go check out Ulta Beauty today for Cyber Monday.
Right, there you go. All right, there's your pitch.
The emails are coming in hot.
Yeah, well, now they're not going to stop after that. Sticking with retail, U.S. shoppers demonstrating their resilience, including Anne-Marie, to kick off the holiday season as Black Friday sales increased to over 4%. Leo Feller is the chief economist at Numerator, which tracks consumer and economic data. He writes, "We keep seeing retail spending increasing, even for lower-income consumers. So consumers saying they'll cut back doesn't necessarily mean they'll cut back. Watch what they do, not what they say." Leo joins us now. Leo, can you start there and talk about what you're seeing so far in this shopping season?
Yeah, thanks so much for having me. So it's definitely the case that consumers say that they are very pessimistic about current economic conditions. And yet this entire year, we've really seen consumers from lower end to higher income consumers increasing the amount that they are spending. And this just suggests that consumers are being very resilient. Although we are seeing them being very selective. And so they're saying they're going to try to take advantage more of promotions, more of Black Friday sales. And this might mean that we saw some of this increase that you saw right now in Black Friday sales is consumers pulling forward some of their holiday spending to take advantage of sales and promotions.
Leo, Lisa mentioned it earlier on the program. It's a record amount of spending, $11.8 billion online on Friday alone, 9.1% jump from last year, according to Adobe Analytics. But when you start to include inflation in that number, is it basically flat where we were in 2024?
Yeah, that's the right way to think about it. I mean, even in inflation-adjusted terms, the amount that people are buying has gone up, but the spend has gone up a lot more simply because we're seeing higher consumer prices. So with some work that I did at colleagues at the Federal Reserve, we saw that for products coming in from China, they are about 10% more expensive now than they were a year ago. So things like apparel, toys, home goods are all going to be more expensive this year than last year. And that means that consumers are, spending more, but not necessarily getting that much more.
When you see the consumer go out and spend in this K-shaped economy, where's the higher end spending and where's the lower end spending?
This is a great question. So we've seen kind of this bifurcation where club stores like Costco are doing extremely well with higher income consumers. And then you have your TJ Maxx's, your dollar stores, your Aldi's doing a lot better with lower income consumers. And so people really are trying to find better value, but that might mean buying in larger quantities, buying in bulk at a Costco, or just getting lower prices, more private label items at stores like Aldi.
What's your sense, Leo, of whether people are being more choiceful? I know that John, who is off this month, has talked about his dislike of that word, but this idea that people are being more deliberate about going out and shopping during times of promotion and looking for those deals. And that indicates really some discretion on the part of consumers, not necessarily, no holds barred, this idea of going out and spend the bank.
Oh, absolutely. This is very different than 2022 when consumers were flush with cash. Coming out of the pandemic, they had, record levels of savings. They were spending down that savings. We had gotten stimulus checks. That was a consumer that was not being choiceful, right? People were upgrading towards brand name items, willing to splurge. This time around, we really are seeing consumers being more selective, both in terms of the retailers where they are shopping, in terms of taking advantage of sales and promotions. And this is why when we look at Black Friday sales, we have to be careful about what signal that gives about how the economy is doing overall, because if people are purposely trying to take advantage of sales and promotions, that might mean that they're going to be spending less at other parts of this holiday season and overall not really increasing their spending all that much, right? This is the kind of selectivity that we have to be watchful for, because consumers that are watching a buck are the ones that are going to be trying to make sure that they're taking the best advantage possible of all these, Black Friday, Cyber Monday type sales.
Which really goes to the conundrum right now, not only for the Federal Reserve, but for markets. And you said this at the beginning, or the comments that you said, that, essentially watch what they do, not what they say. They're saying they feel bad, but they keep spending. Is it possible for both to be true, for people to feel bad and for them to be cutting back, but continuing to spend anyway, at least in overall numbers? What's the read-through for the Federal Reserve, for the forward look of the economy?
Well, overall, this suggests that the economy is still doing okay. The labor market at 4.4% unemployment, that's a historically, not a bad level. And so, the Fed Reserve is in this conundrum where, the labor market is weakening, but it's still doing okay. Inflation has been stuck at around 3%. And we're actually seeing inflation ticking up in core consumer goods. These are products that are normally deflationary or disinflationary. And so this just means that the Fed is really stuck in its difficult position where they are trying to perhaps stimulate the labor market a little bit more, but in a situation where inflation remains high. So I expect a lot of dissent at this upcoming Federal Reserve meeting, given this very difficult situation they're in.
The market has the Fed cutting interest rates. They are more than 100%. They believe that they're going to cut. And you think there's going to be dissents. Do you think that maybe this next week's meeting is a pause from the Federal Reserve?
I think there was so much Fed speak coming into this Fed Reserve meeting where roughly half the members on the FOMC were saying, look, maybe we just wait for more data. We haven't gotten a lot of good data given the government shutdown to be able to make a firm decision at this point in time. And at the same time, we do have this labor market weakness. I really do think this should be a mixed decision right now. And they might err on the side of cutting. But, we have another meeting coming up in January. So it wouldn't be, that inconceivable that they might just skip a cut this meeting, wait for more data, and then make a decision in January about how to proceed.
Leo Feller of Numerator, thank you so much. Maybe the good news is that we don't have any more Fed speak, at least not official Fed speak, although Jay Powell is speaking later today at an memorial event over in Stanford.
You brought up a good point, though, and we talked about this before the show. There will be Q&A. Likely someone is going to ask a question about the meeting next week. And yes, they are in a blackout period, but maybe there's a wink, wink, nod, a sway.
Oh, yeah, body language. We're going to be analyzing the body language in the absence of other Fed speak. Yeah, we're going to be looking at actually the data that does come out, albeit not maybe the gold standard. Still, some information coming out from the consumer. Coming up, we'll parse through that with Abigail Watt of UBS, looking ahead to some of those trickles from what the consumer is feeling and doing. Plus, Yahira Anand with your morning movers. Mag 7 futures lower to kick off the final trading month of 2025, led lower by the Magnificent Seven. From New York, this is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment. Soon it was past 1 gigawatt of capacity, helping anchor Indonesia's clean energy future.
We are starting the beginning of the last month of the year with a little bit of a softer tone, pretty much across the board. A feeling that maybe this can't last, although there are people hoping for that Santa Claus rally. Down about 0.7 on S&P, looking at 10-year yields that actually are up almost 4 basis points now, 4.05%. What you are seeing on the euro is a bit of strength, dollar weakness, 116, the euro climbing by about 0.4%, and crude higher. Watch this space given the fact that OPEC Plus is putting a pause on some of the output increases that they had been engaging with to end the year. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It is the tech sector dragging us lower with the Mag 7 all in the red this morning as investors continue to question the investments surrounding AI and whether they will get a return. It's a concern that Deutsche Bank flagged in a note this morning remains prominent, with the Mag 7 losing ground in November for the first time since March. Nvidia, I will also note, just announced it invested $2 billion in Synopsys stock. This is a company part of the chip supply chain, so just raising questions over the circular nature of these investments. Meanwhile, we are seeing Barrick mining shares rising 3.8% on news that it is exploring an IPO of its North American gold assets. A lot has been happening with this company because amid record-breaking gold prices, it was not able to capitalize due to cost overruns and operational issues. So Elliott Management stepped in back in November, and it has a new CEO also shaking things up. And we end on Airbus, shares still in the red, though paring its losses down 5.3% over in Europe after it confirmed an earlier report that it found a quality issue on some fuselage panels on its A320 jets. This just compounds issues over its most popular aircraft, since just days ago it flagged a software glitch on about 6,000 of those jets. And this is all coming as Airbus rushes to meet ambitious targets for this year. Lisa?
Thank you so much, Yahaira. Turning to the economy, we're not getting non-farm payrolls Friday. We would be getting a whole slew of data that we're not getting because of the backlog from the government shutdown. We are, however, getting ISM manufacturing, ISM services, ADP employment, and, of course, that core PCE data from September on Friday. Bloomberg's Enda Curran joins us now. And what are we looking for, and why is this week particularly important, even though we don't get that sort of gold standard non-farm payrolls report?
As you say, mostly second-tier data. But, Lisa, today we do get ISM manufacturing numbers at least. It's expected to tip upwards to around 49, which is a slight improvement. But if that's the case, it's still in contractionary territory and will mean that it's a ninth month of contractionary territory for that reading on the manufacturing sector. We know there's been a lot of pressure there from the uncertainty around tariffs and on trade policy, but also there will be a lot of focus on what those numbers today tell us about labour demand and broader demand for the manufacturing sector. So several clues that may come out of that. I think the bigger piece for this week, though, as you say, will be the core PCE reading on Friday. This is the Fed's preferred gauge of inflation. It's expected to tick up 0.2% on month, which would mean it's around 3% for the year. That would suggest that inflation is at least stable, even though, of course, it remains sticky and above the Fed's inflation target. But if you get a higher reading than that, of course, it might complicate further the already complicated Fed debate for next week. It's quite dated data. Of course, it's from September, but it's good as we have for it's all we have for now, I should say.
Well, that's what I was going to say, Enda. Does it matter at all? Because ultimately it's so dated, and there's a real question around the integrity, the relevance, given the fact that we're in December right now, that will it really factor in at all to the potential Fed rate cut next week?
All very valid questions. They are so dated, these numbers at this stage, Lisa. We know the economy continues to evolve in real time, but it is literally all we have, because we're not going to get either any more jobs or employment data from the BLS before the Fed meeting, or, of course, the CPI data before the Fed meeting next week. So I think we're probably at a space now with the Fed officials whereby they've probably made up their mind on where they're at. You either are more worried about the labour market and what's happening there and what potentially might be happening in the months ahead, or you remain more worried about inflation. It's hard to think those views will change dramatically over the coming week. It's clearly going to be a close decision by the Fed. All we can go on were those most recent comments before blackout, which were leaning towards something of a dovish outcome, but by all accounts, it's clearly going to be a very live meeting.
And Curran, thank you so much for being with us. Right now, there is a 99% chance of a Fed rate cut next week. It has gone down from 102% earlier this morning based on Fed funds futures, but up from some 25% based on just a couple of weeks ago. So clearly, very much the base case.
And Enda is talking about the fact that, though, it's going to be a live meeting. And Leo was talking about earlier in the hour that there's going to be those individuals that dissent at this meeting. So maybe the market is getting ahead of its skis on what we think the Federal Reserve is going to do.
Well, let's get the view from UBS. Abigail Watt of UBS writing this. We still expect a cut in December. We expect there is very vocal disagreement to the point that we were just making, but we also expect a large majority of the committee will support the decision. Abigail joins us now. Abigail, I love that we've gone from a data-dependent Fed to a data non-existent Fed, the idea that we don't even have the inputs. What are you watching to really gauge the vocal disagreement and the outcome of next week's meeting?
Yeah, so look, I mean, it's totally fair to say we don't have the official statistics from the BLS. We should have got that non-farm payrolls report this Friday. We won't be getting that. And the data that we think, would be important for that decision will actually be released week after, right? December 16th, we should get the October-November data from the BLS. Now, we do have other data, though. The committee can see that you've seen initial claims running around a similar rate to before the kind of government shutdown. You can see that when we look across a range of other indicators, you're seeing a labour market that doesn't necessarily look like it's significantly improved since they had those kind of official numbers. And I think for the committee, there is a case of risk management here. If you don't have those official statistics, it feels like the risk is skewed towards removing that excess restrictiveness now in the case of the likelihood that you potentially do see weaker numbers the week after, right? So I think that's the decision in front of the committee as they go into the meeting.
Abigail, then it basically begs the question, how much harder is 2026 if they do end up cutting next week?
So I think 2026 will continue to see this tension for the FOMC. I think you're going to continue to see this issue of inflation pushing away from their target, but simultaneously a relatively soft labour market. And I think that ultimately means that you see the FOMC potentially leaning on that kind of risk management. How do we remove excess restrictiveness? So, I mean, in our expectations, we think they will cut at the meeting next week. And our sense is that they could cut again in January. But then I think that tension potentially becomes a little bit more challenging for them. Our sense would be that you could see a little bit of an improvement in the labour market as you go into the second quarter of next year. And alongside that, we think you should be seeing more tariff-related price pass-through. And that combination, we think, leaves them on hold for a little while through 2026.
Even with a Chair Hassett at the helm?
I think it's an important point to note. Obviously, there's potential for personnel change next year, a new Fed chair. Our sense is that you could see potentially another cut in September. If I think about our kind of meeting-by-meeting profile, we think that by that September meeting, you'll have a new Fed chair in, a bit of a shift in the committee. And alongside that, we think that you potentially see them removing a little bit more restrictiveness from that policy rate. But ultimately, we think that they get down to 3.25 by the end of 2026. We're not necessarily expecting that they deliver a significant easing in policy at this junction. But I do think that, some of the kind of changes in personnel and the sense that you'll be getting past the peak inflation impulse from tariffs, I think that potentially leads to leaning towards a kind of lower federal funds rate in terms of the distribution.
Let's say I'm not getting any of the gold standard data. And I'm saying, you know what, I'm going to look for my own. Not only are we going to get ADP, which I know we've got very excited about, and ISM manufacturing and services, but I can go to the shopping mall parking lots and see how many people are there. I can see the numbers from Adobe that came out in a positive way versus last year in terms of the total increase and say, actually, the consumer's doing pretty well. How valid is it to sort of look at anecdotes based on the corporate world and spending habits during peak promotional seasons and sort of extrapolate out a trend about the overall U.S. economy?
Yeah, so I think you're right to think about the period you're in and whether that's, I guess, a typical period for kind of the level of spending that you would see in the economy, right? I think we are in a period where you tend to see kind of that seasonal shopping coming out and you potentially see support from discounting, right? So I think when we think about the kind of consumer and the look forward from the patterns we see around holiday spending season, I think it does tell us something about the willingness of consumers to spend, but it doesn't necessarily mean that we would expect that is a trend that can be persist and kind of pull forward. I think, when we think about the end of the year and into early next year, when we get past this holiday spending season, our sense would be that you see more of a kind of inflation hit for consumers. And I think when you start to see that, we could see a little bit more retrenchment, we think, from the consumer through this period.
I just think about how every time I go upstate and I see the car lots being full in terms of car dealerships, I think, uh-oh, bad economy, bad economic season. Or if I see fewer of them, I think, wow, okay, they're flying off the shelves. Anne-Marie was talking about how she puts in her shopping cart a number of things, doesn't buy them, and then she gets the promotional email saying, why not continue to shop for these items? I wonder if things like that are actually signals about what the different retailers are doing in order to juice sales, right? I mean, is this a signal or is that noise?
I mean, I think it's a sign that the consumer is becoming more kind of selective and careful in terms of where they're choosing to spend. I think that's something that we've been seeing kind of actually through most of the year. I think you've seen a consumer that is kind of choosing very carefully when they choose to come out and spend. This is something that our analysts have talked about at UBS. The kind of retail analysts have referenced this idea of coming out for holidays, but not necessarily maintaining that pace of spending. And I think that's the kind of key point here is I think when we look at the consumer consumer, I think you can see that there is a group of consumers who are still flush with cash and kind of sitting on relatively healthy balance sheets. But I think, there is an increasing portion of the consumer that looks like they're under pressure. And that pressure, we think, could potentially increase, as we go through the end of the year and into next year. So I do think we're in this period potentially of adjustment for the consumer. But when we get into next year, that big, beautiful Bill Act fiscal stimulus, we think could potentially help around tax season. So we're not outright pessimistic here. I do think there is some optimism to come as we go into next year, though.
Abigail Watt, thank you so much for being with us. Abigail Watt of UBS. I do wonder, Anne-Marie, this idea of that shopping cart. And I know that was just one anecdote, but we're all seeing that, right?
I've done that this morning already.
I mean, how much? But also they'll track your moves. And I wonder, is this AI at work, right? Are these sort of like little algorithmic spies out there that are looking for you? And
true. It's something that can be done now when you online shop that you just can't track if you are brick and mortar waiting for individuals to come in. You're not going to follow them around the store and see them pick something up and put it down. But you can track them all day long and potentially remind them you only have 24 hours, 12 hours, 6 hours. And you're like, yeah, I do kind of need that. Maybe I do buy it now.
Although there are those people that do follow you around at the stores. Are you sure you don't need any help? And then you sort of wonder, well, I can't ignore them the same way I can ignore an email. You have to sort of engage. Anyway, I'm digressing. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. U.S. Special Envoy Steve Witkoff is heading to Moscow as U.S. and Ukrainian negotiators say they had productive discussions about a framework for a peace deal. The two sides discussed potential parameters for a ceasefire as they pored over a 19-point proposal that emerged in Geneva last weekend. Airbus facing new issues affecting fuselage panels of several dozen A320 family aircraft. The suspected production flaw is delaying some deliveries. This after the company was close to completing repairs on thousands of the same jets following flight control software issues linked to solar flares. Disney's Zootopia 2 won the holiday weekend box office. The movie brought in $156 million at the US and Canadian box office over the Thanksgiving weekend. The film achieved the highest global opening for any animated picture in Disney's history, with a haul of $556 million worldwide. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, setting you up for the day ahead, plus Oksana Aronoff of JP Morgan Asset Management, as President Donald Trump says he has made his decision on the next Fed chair. This is Bloomberg Surveillance.
To me, the underlying question is what the market expects the Fed to do versus what the Fed should do. And this is important coming into next year. What's going to happen to the economy? What's going to happen to inflation expectations? Because, to be honest, there is zero chance that we're going to have inflation, core PCE coming close to the target before the end of next year.
That was Claudio Irigoyen of Bank of America talking about, yes, the Fed may cut rates next week, but don't look for them to aggressively cut in the following year. And inflation is not going to hit those targets. This morning, you're seeing equities futures just a bit softer to start the last week, the last month of the year. What we are seeing is the NASDAQ underperforming, down 0.9% following the loss last month. What we are seeing in the bond space is, yes, maybe the Fed will cut rates next week, and maybe next year there will be an additional couple of rate cuts. Nonetheless, that yield curve steepening has reasserted itself. So 2-year yields up 2 basis points, 3.5% on the long end. 30-year yields up now 6 basis points, 4.72%, raising a question about just what this means going forward about inflation expectations as well as the Fed path forward. Counting down to the opening bell, here's a trading diary for the week ahead. At 10 a.m. Eastern, we get ISM manufacturing data. At 4 p.m., President Trump signing congressional bills. And at 8 p.m., it is the blackout period, but Fed Chair Jay Powell is speaking at a memorial event. Tuesday, earnings from CrowdStrike. Wednesday, ISM services. And on Friday, core PCE, which sounds great, but it's for September, so don't get too excited. Turning back to the Federal Reserve, President Donald Trump saying he's decided on his pick to replace Chair Jay Powell. Sources telling us here at Bloomberg that Trump's chief economic advisor, Kevin Hassett, is the frontrunner. Oksana Aronov of JP Morgan Asset Management joins us now. Oksana, wonderful to see you. Thank you so much for being here.
Great being here, as always.
So I'd love to start there. This idea that the Fed is likely to cut next week, that is currently what's being fully priced into markets. And there's a sense that the economy is unclear, that there could be actually a reacceleration earlier next year. How much do you think that those inflation expectations are underpriced right now, akin to what we heard earlier from Claudio?
Can I just make a parallel between the Fed and that overly eager store associate following you around the department store?
Please, go for it.
Incessantly offering help, even though their actions are just like confusing you. And I think that's what the Fed has done. They're trying to be overly transparent. There's a lot of dissent within the Fed is what we're seeing. And we also know the Fed has had a history of just frankly not being agile enough, right? Staying low too long. Now they don't have the data. So frankly, their actions, as the kids say these days, are sus. And when we look at the lack of data and the data that we have had over the past, couple of weeks here and there, it has been, on balance, at least okay, right? Initial jobless claims came in lowest this year. The consumer is spending, even though consumer confidence seems to be declining, consumer spending seems to be okay. So what problem are we really trying to solve with this Fed cut? Because if the problem we're trying to solve is the one that's most talked about, which is affordability, that certainly hasn't happened since the Fed began this cutting cycle, because both long rates and mortgage rates are actually higher today than they were when the Fed began this cutting cycle in September of 2024. So I don't really see any reason for them to not stand pat here and just kind of see how the data develops. But, of course, they are going to cut because of all of this turmoil that they're in. They're under a lot of pressure, politically and otherwise. And I think this cut is going to happen, and we'll see whether it's the right one. I think the data will prove them wrong as we head into 2026.
If they were to just stand pat and wait for the data to come in and then make a decision, basically a pause, with where the market is lining up for a decision, what is it, 99% now? Lisa's been tracking it all morning.
So widely as well.
Right, but right now, with the market basically saying that they are definitely going to cut, what kind of reaction would we see if they decided we were going to pause?
The market would not like it. Equities wouldn't like it. Bonds wouldn't like it in the short term. But in the long term, perhaps it would give the Fed some more credibility, which I think it is sorely lacking, frankly. And it would provide a real kind of a North Star that, look, the Fed is data-driven. And we don't have really decisive data. And so based on that and the data that they do have, the little bit that they do have, they're choosing to kind of abstain here.
When you say the Fed is lacking credibility, is it because basically they said they were going to get inflation down and they accepted 3%?
Well, yes. That's part of it, certainly. They are essentially trying to now create some sort of a dampener for their fiscal dominance that, we are living through the age of fiscal dominance. And so Fed's not just credibility, but their really meaningfulness, impactfulness is just less. And again, we're seeing that in the fact that no matter what they do at the front end, the long end, which determines everything, right, in terms of costs, is just not budging. And so I think it's really the fiscal side of the house that has to get its game in order. And on that side, of course, everyone knows what they have to do. They just don't know how to get elected after they do it. So, and that's a story as old as time. So the Fed is in a really tough place here. And I think the new incoming chair has not only, the policy, the dual mandate, but also the necessity to kind of rethink perhaps even Fed modeling and how do they think about making these decisions so that there really is transparency and not just, this Fed member said this, and so the market odds sway this way, and then someone else says something else, and the market odds go the other way.
So somebody could take a look at all this and say, well, I'd rather just invest in Apple, or I'd rather just invest in Microsoft, or maybe just OpenAI, right? So there's this question of how much we're looking at the credit space as a haven from some of these discussions. You describe credit as still standing in the kitchen with the lights off. Can you please explain what that means?
Not my quote, but I do like it because I think that the spattering of headlines that we've seen related to, defaults or write-downs. I think that's just the tip of the iceberg. I think there's a lot of news that are going to continue to break, which is not to say there's not a lot of fantastic private credit deals that are out there that probably were originated earlier on, but particularly the deals from 21, 22, perhaps not the most robust vintage. And also you've now had this trend of, private wealth space adopting a lot of these. And so the question becomes how much investment tourism, as I like to call it, is there? How well is the due diligence that's being done on these? And so I think there's going to be a lot more news when you look at defaults on the public side, to the extent that we have any visibility into the private side. They are rising, but also distressed activity is picking up every year. So far this year, you've had $50 billion worth of distressed activity, and it's higher every year for the past several years. What does that mean? That means that this entire private credit ecosystem has created a way for companies that cannot refinance themselves to be taken out via private credit loan. Pay-in-kind activity is rising as well. So when you add all those up, you actually have a credit backdrop that's not nearly as robust as your sort of official default rate suggests. And one last point I'll make on that, BDCs, which are the daily valued vehicles consisting of private loans, which are perhaps one of the few ways for us to gauge what's happening on the private loan side, which is so opaque, they've completely disconnected from the high yield and the leveraged loan markets, which are, presumably the building blocks in terms of credit quality, and are off, double digits versus high yield markets that have done well so far this year.
So the whole idea of still standing in the kitchen with the lights off, you don't know what kind of creepy crawlies are going around until you turn the lights on. It's sort of the akin to Warren Buffett with the tide rolling out, and you can see who's swimming naked. And I just wonder, how do you range your portfolio with this? If you see potential downside risk for treasuries, you see potential downside risk for credit, and we're heading into a year where people are feeling uncertain about the AI story. I mean, what are you overweight?
So we very much like protection on credit here, not because we see sort of any kind of imminent risk, but we do know that it's not a question of if, it's a question of when, right? I always say that everyone is obsessed with identifying the top of the equity market, which is pretty much impossible to do because equities move on sentiment and bonds move on math. And when you look at investment grade spreads and see that they have been wider 95% of the time in history, or 97% of the time in history. When you look at high yield spreads, and they've been wider 95% time throughout their 50, 45-year history, this is the top, and it's just a question of when, not if. So we do like credit protection here, something that is incredibly inexpensive because most people are not thinking about it. Most people are thinking about how do I maximize yield here? How do I, get a little bit more yield into my portfolio, which, several years ago, getting what we're getting at the front end of the curve, which is still more than what you're getting at the long end of the curve, was fantastic. So we are staying defensive, not because we're not constructive on the economy, because we are. And we do think the economy will prove to be more resilient than is currently being priced in. But we realize that that's probably not a great thing for duration or interest rate risk. And also, credit has some real issues underneath, and we want to be protected to take advantage of that.
Oksana, wonderful to see you. Thank you so much for being here. Oksana Aronov of JP Morgan Asset Management. Coming up tomorrow, Cameron Dawson of New Edge Wealth, Apollo Global Management President Jim Zelter, Katie Kaminsky of Alpha Simplex, and Lindsay Piegza of Stifel. This was Bloomberg Surveillance, the first day of the last month of the year. Good morning.
Hello and welcome This is the Michelle Hussein Show. I'm Michelle Hussein. I speak with people like Elon Musk.
I think I've done enough.
And Shonda Rhimes.
Oh, that's so cute.
This will be a place where every weekend you can count on one essential conversation to help make sense of the world. So please join me, listen and subscribe to the Michelle Hussein Show from Bloomberg Weekend, wherever you get your podcasts.
You certainly ask interesting questions.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we begin with the push to end the war in Ukraine. White House Special Envoy Steve Witkoff is in Moscow today. He is set to meet with Russian President Vladimir Putin to discuss the latest proposal to end the fighting. This follows weekend negotiations with Ukrainian officials in Florida. This morning, the Kremlin says President Trump's son-in-law Jared Kushner will attend today's talks as well. We get more from Bloomberg's Balazs Pens.
It's been a period of very intense diplomacy, with some very, very high-level, high-stakes meetings ever since the publication of President Trump's 28-point plan to bring a halt to this war. And as we have heard from President Zelensky, it does seem like the U.S. and Ukraine are now at least in broad agreement over the outlines of the plan, and the two sides were able to get something that's closer to what they want to see.
It's Bloomberg's Balazs Pens. And ahead of today's talks, Putin claimed that Russian troops have taken over the city of Pokrovsk in Ukraine's eastern Donbas region. Ukraine's military denies it, says fighting is still ongoing in the city. Bloomberg News has been unable to verify either claim, but a takeover would be Russia's most significant battlefield advance in nearly 2 years.
Well, Nathan, a military strike on this side of the world is continuing to draw scrutiny. Now the White House is defending Defense Secretary Pete Hegseth following a Washington Post report that he ordered everyone killed on a suspected drug-running boat in the Caribbean. White House Press Secretary Caroline Leavitt is confirming there was a second strike on the vessel.
The strike conducted on September 2nd was conducted in self-defense to protect Americans in vital United States interests. The strike was conducted in international waters and in accordance with the law of armed conflict.
And White House spokeswoman Caroline Leavitt says the strike was ordered by Navy Admiral Frank Bradley, not Hegseth. Lawmakers are pressing for hearings on the second strike. Adam Smith is the top Democrat on the House Armed Services Committee.
Admiral Bradley's coming in this week to talk to us. That's, I think, where we're going to first get the information. And then I think we should go higher up the chain of command.
Democratic Congressman Adam Smith spoke to ABC News, and reports of the second strike have led to accusations of war crimes in the Trump administration's deadly anti-cartel campaign.
Turning to markets now, Karen, futures are higher this morning, but yesterday stocks kicked off the month of December with losses. The S&P 500 dropped 0.5%. Cameron Dawson is Chief Investment Officer at New Edge Wealth.
If the riskiest parts of the market are starting to show a bit more risk-off tone, it raises questions about an equity market that's trading at very high valuations. But we would note that if you look at positioning metrics for the S&P and broader equities, they still remain just neutral or even underweight for some investors. So we're still of the camp that any dips are likely to be bought rather quickly, but that doesn't mean that you won't get volatility along the way.
New Edge Wealth's Cameron Dawson. December is historically a good month for stocks. According to CFRA, since 1990, the S&P 500 recorded its second best average price return in December.
Well, we're seeing some stabilization in the cryptocurrency markets this morning, Nathan, following yesterday's 5% sell-off in Bitcoin. And right now, Bitcoin, it's higher. It's up 0.9%. It's at $87,300. Bloomberg Intelligence Mike McClone says it may be heading lower.
Right now, Bitcoin's about 15% below its 50-week moving average. It's rolled over. And the S&P 500 is 12% above its same moving average. We have never had Bitcoin drop at this velocity since futures were launched in 2017 without the stock market following. And that might mean the Bitcoin's set to be the Grinch that stole Christmas.
And Mike McGlone with Bloomberg Intelligence says Bitcoin could fall as low as $50,000 before the end of the year.
Well, let's take a look at some stocks to watch this morning, Karen. We're keeping an eye on shares of Bayer. They are up more than 8.5% in Germany. The Trump administration has urged the Supreme Court to consider the German company's appeal targeting thousands of lawsuits that blame its Roundup weed killer for causing cancer. Bayer inherited the weed killer in its $63 billion acquisition of Monsanto in 2018. The company's already shelled out more than $10 billion in verdicts and settlements over the herbicide.
Well, Nathan, Amazon.com plans to offer deliveries of hundreds of household items within 30 minutes in a test program beginning in Philadelphia and its home city of Seattle. And Bloomberg's John Tucker reports.
Those household items include some fresh groceries and over-the-counter medicines. The company says it will use specialized, smaller facilities for the deliveries. The fee will start at $13.99, discounted to $3.99 for Prime members. Amazon has a long history of experimenting with quick delivery from specialized urban facilities stocked with inventory similar to the products sold by convenience stores and pharmacies. I'm John Tucker, Bloomberg Radio.
John, thanks. Tesla's in the spotlight this morning as well. Investor Michael Burry is betting against shares of the EV maker, saying they are, quote, ridiculously overvalued. Burry is also warning that Tesla CEO Elon Musk's proposed $1 trillion pay package would worsen shareholder dilution. Burry, you may recall, is best known for correctly betting against the U.S. housing market during the 2008 financial crisis.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. Monday Night Football figured to be a mismatch, and it was. The Patriots are 11-2. They've won 10 in a row. The Giants are 2-11. They've lost 7 in a row. New England was ahead 30-7 by halftime. Went on to the easy 33-15 victory. A baseball free agent signing, relief pitcher Devin Williams pitched last season for the Yankees. He'll now pitch for the Mets. Signed a 3-year deal for $51 million. Mark Stoops, longtime coach at Kentucky, fired. The Wildcats are aiming to hire Oregon offensive coordinator Will Stein. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
The forces shaping markets and the economy are often hiding behind a blur of numbers.
So that's why we created The Big Take from Bloomberg Podcasts, to give you the context you need to make sense of it all.
Every day, in just 15 minutes, we dive into one global business story that matters.
You'll hear from Bloomberg journalists like Matt Levine.
A lot of this meme stock stuff is, I think, embarrassing to the SEC.
Amanda Mull, who writes our Business Week Buying Power column.
Very few companies who go viral are totally prepared for what that means.
And Zoe Tillman, senior legal reporter.
Courts are not supposed to decide elections. Courts are not really supposed to play a big role in choosing our elected leaders. It's for the voters to decide.
Follow the Big Take podcast on the iHeartRadio app, Apple Podcasts, or wherever you listen.
What's Ministry of Foreign Affairs doing right now, possibly facilitating lighting the president's visits to some of your diplomatic allies in Central and South America, possibly with a U.S. state visit, or a U.S. visit, not state visit, but a visit? Is that something that is possible or very sensitive right now, given Trump's courting, if you will, of a lasting truce with Beijing?
It's always possible, and based on our previous experience, I think the U.S. government will provide, I think, assistance to our transit visit.
But is it actively being discussed right now as possibly having a visit to the United States?
Yeah, I think now the Trump administration already showed its goodwill. And so based on our communication, So we are confident in the near future. Yeah, we can just have a visit to the Latin American countries. Okay. Yeah, by way of the United States. Yeah, so that's I think business as usual.
First day of December, and actually a couple of hours ago we started things looking pretty bleak. Nvidia has turned a corner, which has kind of changed a little bit the tone, but basically tech lower, crypto lower, and we've started December in risk off mode. Why?
Yeah, I mean, we had a really solid rally last week, on those expectations that the Federal Reserve will be cutting interest rates in December. But as we start off this new week, there's been a turnaround in that sentiment. And I think the catalyst for that, for me, came from Japan. So we had Bank of Japan Governor Ueda adopting a more hawkish tone, really ramping up sort of expectations for a December rate hike. Now, what does this mean and why is it important? Basically, there are concerns now that we might see the unwinding of the carry trade. So that's when we sort of have institutions, investors borrowing in the low interest yen in order to invest in higher yielding, riskier assets. Now, if we're seeing the Bank of Japan raise interest rates, we've got yields in Japan, 10-year yields at a 17-year high. There is this concern that we're going to start to see the repatriation of those funds back to Japan. Now, this is important because liquidity changes. And those sort of sectors of the market, such as crypto, such as tech, which are really sensitive to liquidity, are where we're seeing that sort of risk off come through.
December, historically strong, particularly for technology, right? And when I was on vacation last week, what a week to pick. We had the Thanksgiving holiday. Circular financing was a factor, Nvidia in particular weighing on the index level. You just heard the reporting about how the Synopsys Nvidia deal is not circular financing to the mind of the leaders of those companies. Do you buy it? And how big a factor is that in this market right now?
Really good question. I mean, this is front and central, I think, in a lot of investors' minds at the moment, particularly as soon as we hear the name Nvidia. Nvidia's been investing in firms that, are or will be major customers of its products. So, that has raised concerns within sort of the markets. And we've seen that play out in previous weeks where Nvidia really has come under a lot of pressure. It does feel like that is sort of starting to turn a little bit of a corner. Obviously, those comments today, I think, will help a little bit to ease those concerns. But at the end of the day, there is this sort of worries surrounding circular financing, and they're not going to disappear overnight. And that's because circular financing makes an ecosystem fragile. It just takes one disappointment for the whole loop to fall apart. So I think it is right that the market does question whether this circular financing could be a problem.
Meanwhile, Fiona, you could think that these are companies that are strategically thinking of how they can ride extra upside should the AI wins really come to bear. We're going to be digging into how OpenAI is backing a fund of its own VC partner that is looking at integrating its technology into portfolio companies, into service companies, for example. It wins not only by adoption of its technology, but on seeing some equity upside, Fiona. What do you need to see to vindicate that the productivity gains are there?
Yeah, this is why it's so difficult, because I think sometimes or often, if you're in that bubble and it's falling apart, you won't often realize when it's actually too late. I think the numbers that we've been seeing from Nvidia have been encouraging. The latest earnings report was extremely positive. There weren't really any faults there. I think this is just a nervousness that we're seeing. But I think at the end of the day, We know that AI technology is solid. We know that it exists. It's going to increase productivity. There are obviously concerns over monetization, circular funding, revenue lagging investment. But I think, longer term, this technology does have a broad use. And I think that's why over the longer term, this trade is still one that has upside. If we just think about the horizontally, automation, R&D, customer service, vertically, different sectors, and then infrastructure level as well. So this is a very broad technology, which sort of helps ease those concerns over the bubble fears, I guess.
What about crypto?
Yeah. Crypto. I mean, every Monday I feel I wake up and something else is happening in crypto. We saw that rejection at that 92,000, just above that 92,000 level, which was a pretty key level. And I think again, this is that unwinding or fears over the unwinding of the yen carry trade. Crypto is very sensitive to liquidity, and that fear that there might be a slight reduction in liquidity if that unwinding of the carry trade happens is what I see pulling on crypto. Institutional demand is still very weak. We saw November ETFs, they saw outflows of 3.48 billion, so huge outflows. I think second worst month that we've seen so far. So that really does need to turn around before we can expect to see any sort of recovery or solid recovery in the Bitcoin price or crypto prices.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT's investment solutions
this move in the last 24 hours, basically in yields. So we repriced, and it looked like we were all set for the Fed, and now we've got this curve steepening. What's going on?
I think what you're seeing in the Fed is like you've got two sides of the coin, and they're debating each other, and we're seeing that debate happen in public. The odds of a Fed rate cut in the December meeting, so next week, has really increased substantially. It's now up almost at 80%. And you're looking at that rate increase, and you're comparing it to the fact that the Fed is looking at inflation data and they're looking at unemployment. It looks like on the inflation side, people are getting pretty comfortable that inflation is under control. I'm not quite yet there in that camp, but on the employment side, we started to see some weakness. We started to see a little tick up in the employment, and people seem to believe that that narrative is going to dominate headlines, the unemployment narrative, and you layer that in with the AI concerns that people have about the job market, and particularly younger people being hired into companies.
Yeah, there are a lot of concerns out there, but just on the pricing and repricing. Last time you were on, which is not that long ago, the market was not pricing in a December cut, and you agreed with the market then.
Yes.
Do you agree with the market now that it's almost a done deal?
No, I actually don't believe it's a done deal. I do think that the people are going to wait. I think that the data that we're looking at coming in is a little delayed because of the government shutdown, and I think they're just going to take a pause in December, and if we need to in January, where they have a little more data and they have they can set the tone for 2026, I think maybe you'll see a cut there, but I'm actually not in the camp that we'll see a cut in December.
I mean, it was fascinating how the market just turned on its head after those Williams comments. That was really the beginning of the catalyst for pricing in a cut in December, right? But as you say, if the Fed waits until January, I mean, will the market be roiled? By the way, I should mention that there were all those comments, Nick Timros in the Wall Street Journal saying the ground had been laid and stuff. It wasn't just the Williams comments.
Exactly. But the fact that are we talking ourselves into forcing the Fed into that rate cut scenario? And I'm in the camp that the Fed really is independent. I think it is very data dependent. And I don't think you've had enough of a move down in the inflation numbers. So if you look at why we're concerned about inflation, you still do have the residual effects of tariffs tariffs that need to come through the data. The holiday season is going to be where you see a lot of that price action, and we're hearing it from consumers. We're hearing it. There's a little bit of sticker shock as they walk in the front door of those retailers. So I think the inflation narrative isn't quite done, and we've yet to have the deflationary impacts of, the AI and everything there, because that's the offset to what you're seeing in terms of underlying inflation that is coming from items such as, defense spending over in Europe is being higher, is not another inflationary force that we see. So we do see a lot of these pressures in the market.
What about the labour market? When you look there, do you see weakness? Or are you just only concerned about inflation?
I think we're looking at the labour market as being relatively stable. I think the unemployment numbers have slightly ticked up, but I think slightly is the word there. I think what we're getting confused with here is a lot of people are looking at their own college graduates at home and saying, hey, they haven't got a job yet, and we're in December. But I think that as we go into January, people get very comfortable that, earnings growth is there, that companies have got, a good outlook going into 2026. GDP is a strong growth driver, that they'll start hiring again. So I'm actually optimistic about, the ability of people to get jobs and keeping that unemployment number low.
So you seem to be pretty optimistic about the economy in general,
Yes.
then. Are you as optimistic that the stock market will see that reflected in whatever the Fed does?
Look, when I look at the stock market, I think the bears are telling you valuation, beware. And I think what we're saying is look at underlying earnings growth. If you look at just the third quarter, so just take that very narrow period, we actually had forecasts of 6.5% earnings growth. We came in at 15. That's a significant beat across a very broad part of the market. If I look at the market generally, breadth has been the key to all of this. It's not just a few stocks, the Magnificent Seven, that are doing the heavy lifting today. It's actually a broad brush of stocks. 2/3 of the stocks in the market are up, only 1/3 of them are down this year. So we do think that we've got breadth. And if I look at the 2-year forward stack of earnings across multiple sectors and multiple geographies, we're looking at numbers in the high teens, low 20s as driving, earnings growth. And it's earnings growth that really do drive markets higher.
Well, you've maintained that investors have been climbing this wall of skepticism, not a wall of worry, but a wall of skepticism. Will it take some kind of a negative event to wash that out? Or what, once skepticism is in there, isn't it like, undermining the foundation of something?
If I take a look, a wall of worry to me is actually a lot more negative than the wall of skepticism. So I think the market is gradually getting, those bears are getting a little bit, their claws are coming in a little bit. They're not quite as bearish as they were, and that's why we shifted from that language of a wall of worry to a wall of skepticism. You are always going to have skeptics in the market. And, sometimes they will be right. As I mentioned just before, 2/3 of the stocks in the S&P 500 are up this year, but there's still 1/3 of those stocks that are down. So there's always going to be fodder for those skeptics. They're always going to find things to do. But as we look, I think that the setup going into 2026, you're starting to see, analysts come out with estimates. We're starting to see those forward outlook reports. And I think generally speaking, we're looking at a number of positive things driving earnings. We're looking at strong earnings growth. We're looking at inflation under control, and we're looking at that AI narrative.
So the choppiness has been due to fund flows to some extent, at least. Where are you seeing those funds flowing now? And are we still looking for a Santa Claus rally?
I don't think we want to be talking about a Santa Claus rally. I do think that we're going to see volatility going into year end. And I don't think that we want to be in a position where we feel uncomfortable that volatility is going to drive the narrative. We think that it's earnings growth driving the narrative. So if you're really leaning into volatility, you're right. You may be looking at a Santa Claus rally one day, and you may be looking at, the Grinch coming in the second day, driving that push and pull. When you have a situation where you've had Fed cut rates, on a year-out basis, you do have about a 17% return, average return on the S&P, but it does come at the cost of higher volatility. So we think that the historical playbook is actually playing out here. So, yes, I don't think you're going to be looking at a significant rally into year-end, but I do think that you've got a positive momentum.
checked on the leaderboards. Certain of them already have you at the number one spot, Cristobal. What is it that yours offers versus Sora 2 versus the latest Google offering?
Yeah, that's true. So we just released Runway Gen 4.5, our latest video model, and it tops the charts in terms of performance and benchmarks across all other models, which is kind of like a big deal within research. It's the first time a company has led the leaderboards, and this company not being basically a large research lab. It's a model that surpasses pretty much all other models with incredible consistency, really good realistic results, and just like across the board, amazing creative results. So really, really excited to get this model out and have people use it.
Now, you had it out there on the leaderboards with a pseudonym before it was launched in public, Cristobal, and you had it called David. Is that a Goliath-David construct? How are you competing against these vast generative AI companies?
Yeah, it was a little bit of a play with David and Goliath. I think we've managed to outcompete the largest research labs by being very focused. I think it's the era of both research and efficiency. And if you're able to maintain the focus as a team, you're able to deliver kind of groundbreaking results. And we're proving this. This is the first time I think anyone has kind of topped the leaderboards, not being a large, well-funded research lab. And I think part of it is really like the team, and it's really also the vision. We've been working on this for almost 7 years. We started working on video models when there weren't even like leaderboards to start with. And I think eventually you build some sort of intuition and really good like momentum as to how to improve these models over time. And look, this is still like the worst the models will ever be. And so we have a bunch of more releases coming up that I think will further improve both pre-training and post-training. And so we're very excited for that.
Cristobal, you're not that small. You raised $300 million in April at almost $4 billion or $3.3 billion valuation. I do think there's some value in you explaining what was different this time around in the training of Gen 4.5 and the data set. What is it that you did differently and that has allowed you to release such a competitive model?
I think there's a lot of different things. On the one end, pre-training has been one of our focus for a long time, making sure that both the algorithmic improvements are there, but also the way we caption, we structure data, we build the models themselves and test them. The best way really to think about a lot of the research is you need to conduct multiple experiments through multiple months. And there's a lot of learnings within how you run those experiments. And I think what we're kind of proving is that infinite resources, you're right, we're definitely not in the smallest side of a company, but we're not $1 trillion or $4 trillion company, yet still managing to outcompete the resources of those companies is kind of insane, to be honest. And I think a lot of it has to do with the experiments and the research taste, which is if you're running all these experiments, how do you make sure they're effective and efficient? And I think that's something we've done really, really well, which is focusing a lot on pre-training.
Gen 4.5, apologies, has been released to your enterprise customers straight away. What's the business model for it? How do you guys monetize on top of that? You've just talked a lot about research.
It's pretty straightforward. We have subscriptions and we have credits that people can buy to use the model. We're releasing this model to gaming companies, to studios, to brands, to production companies, to creatives around the world. We have tens of millions of users actively using Runway. And again, the efficiency side is not only coming from the pre-training or the training side of things. We've also been incredibly efficient at deploying the models. We partner with Nvidia for a lot of this work, and we managed to get really good performance of inference. And so we actually make money every time you use the model. And that's, I think, a remarkable feat, not only on how we think about the research that needs to be done, but also the market and deploying this so the unit economics make sense.
Because Cristobal, sorry, just real quick. So you're saying you're profitable running Gen 4.5?
No, we're making. I'm saying we're making money by every time you use the model. We have a good margin on the model itself on how you use it. We managed to deliver really good performance on inference, so the model is still cheap to use compared to other models, while still being the best model in the category. And that's incredibly hard to do. Again, it just goes back to the focus the team has had for quite some time.
ओके गाइस, क्रूड ऑयल को देखोगे ना, स्टक हो गया एक ही लेवल पर। आई डोंट नो, मुझे लग रहा है शायद वेट कर रहा है किसी न्यूज़ का, इवन दो कोई न्यूज़ है नहीं अभी तक। तो मोमेंटम थोड़ा और स्ट्रिक्टली हो जाना चाहिए था, ठीक है, क्योंकि जितना ये कंसोलिडेशन कर रहा है ना, एक बहुत ही नैरो रेंज बनाते जा रहा है प्राइस, उतना ही रिस्की ट्रेड होते जा रहा है। अगर मोमेंटम किसी एक डायरेक्शन पर आया तो फिर बड़ा ही मोमेंटम करेगा। अभी के लिए तो बिल्कुल साइडवेज हो गया है, दो नैरो रेंज और बना दी हैं। अब मैं इतना कहूँगा, कोई सेलिंग में है तो मैं कहूँगा एसएल कॉस्ट पे रख लो या बुक भी कर सकते हो प्रॉफिट। अब जिस हिसाब से अटक रहा है इस लेवल पे, हो सकता है अब ये किसी एक डायरेक्शन पे बड़ा ही मूव दे दे। लॉजिकली तो उसको नीचे आ जाना चाहिए था अभी तक, ठीक है। तो जो लोग सेलिंग में हैं, बुक द प्रॉफिट या फिर एसएल कॉस्ट पे रख लो क्रूड ऑयल में, क्योंकि अब ये नीचे आया तो 5270 तक जरूर जाना चाहिए। यहाँ पर ना ये रेजिस्टेंस है, यहाँ पर देख पा रहे होगे, ये भी रेजिस्टेंस ही है अभी भी स्टिल, प्राइस को भी ब्रेक करके नहीं जा पा रहा है। ठीक है, लेवल थोड़ा सा मैं ऊपर वाला भी सही कर देता हूँ रेजिस्टेंस को। बहुत ही कॉम्पैक्ट रेंज है, ब्रेक करता है इस रेंज के अब तो फिर 5260 टू 70 तक ही नेक्स्ट सपोर्ट। लेट्स सी, अब 630 की कैंडल का ध्यान रखना, वही है जो थोड़ा सा मूवमेंट करा सकती है। बाकी ऊपर अगर ब्रेकआउट आता है 5377 जो ऊपर का रेजिस्टेंस है, तब फिर एक अपर लेवल पे रेंज मिल सकती है। बहुत रेजिस्टेंस का ट्रैफिक है, अगर देखोगे ना प्राइस को थोड़ा सा क्रूड ऑयल में इस पर्टिकुलर जोन पे इतना ज़्यादा कंसोलिडेशन करके प्राइस रेंज के अंदर जा रहा है कि ऊपर स्मॉल रेजिस्टेंस क्रिएट कर रहा है, थोड़ी बहुत सेलिंग आ रही, नीचे सपोर्ट क्रिएट हो जा रहा है, फिर सेलिंग आ रही, थोड़ी बहुत रेजिस्टेंस क्रिएट करते हुए देन अगेन सपोर्ट लोअर एंड पे। तो प्राइस मोमेंटम भी कर रहा है तो बड़े स्लो। अगर रेजिस्टेंस सपोर्ट थोड़ा दूर हो तो फिर भी एक चांसेस है कि प्राइस रेंज ब्रेक करके निकल जाए। सवाल क्या, ठीक है, जो लोग क्रूड में ट्रेड कर रहे हैं, बाकी ऊपर एक मेजर रेजिस्टेंस आपको ये मिलेगा 5475 से 485। बाकी छोटे छोटे रेजिस्टेंस हैं जहाँ पर प्राइस रुक रहा है, बट मुझे लग रहा है जिस तरह की कंसोलिडेशन में फंसता जा रहा है, एक छोटा सा चैनल भी बना दिया है, ब्रेकआउट या ब्रेकडाउन करता है तो फिर थोड़े दूर के लेवल पे जा सकता है। क्रूड ऑयल में फिर रिपीट कर रहा हूँ, जिन लोगों ने सेल किया अपना एसएल ट्रेल कर लेना, सेलिंग वाले बहुत देर से रुका हुआ है, नीचे आता है तो ये फाइनल टारगेट जो लगाया हुआ था, नहीं आता है तो फिर अगर यहाँ से ऊपर गया तो फिर अगेन ये सेम दो छोटे छोटे रेजिस्टेंस हैं, इन पे रुकना चाहिए, इसके ऊपर निकल जाता है तो बेटर है, फिर इस लेवल से सेल करना फिर से सही रहेगा, क्योंकि वो लेवल थोड़ा सा रेंज के बाहर है, तो एक्सपेक्ट है फिर रेंज के प्रॉपरली ट्रेड करने पे मिलेगा। बाकी नेचुरल गैस यार देखो ओवरऑल तो बुलिश ही है, ऊपर 15 मिनट में कोई रेजिस्टेंस है नहीं है, 4 आवर टाइम फ्रेम का पूरा ही रेजिस्टेंस जोन है, इसमें कहीं से भी सेलिंग आ सकती है, एक लेवल लगाया तो है बट ये कोई एग्जैक्ट नहीं है, क्योंकि इतना बड़ा एसएल ले नहीं सकते कि मैं इतना बड़ा एसएल लगा दूं, फ़ायदा नहीं है, तो छोटे से एसएल के साथ ट्राई करना है तो वहाँ पर कर सकते हैं, अदरवाइज या तो कोई 15 मिनट का रेजिस्टेंस ही क्रिएट हो जाए ट्रेड करने के लिए, अभी के लिए 4 आवर टाइम फ्रेम ही यूज़ करेंगे। ये कैंडल अगर क्लोजिंग आती है नेचुरल गैस में तो मुझे लगता है गिरना तो चाहिए इसको अब, अगर ये कैंडल अभी 9 मिनट है वैसे। भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम जिन लोगों ने लाइक नहीं किया है। नेचुरल गैस भी यहाँ पर 437 438 के आसपास थोड़ा रुक सकता है ये कैंडल अगर क्लोजिंग आती है 437 के नीचे तो फिर हमें फाइनल टारगेट मिलना चाहिए 437 के नीचे क्लोजिंग नहीं आती है तो ये भी थोड़ा सा रुक जाएगा ऊपर 4 आवर के रेजिस्टेंस और यहाँ पर एक आप कह सकते हो इसको कन्फ्लुएंस एरिया ऑफ पर्टिकुलर कंसर्न इस एरिया पे हो सकता है थोड़ा बहुत रुक जाए प्राइस
for year end right now. We're seeing a little bit of wobbles, whether it's in bond markets and crypto. Are we still set up for a year end rally?
I think I'm going to be a little bit more of a Grinch on this one. It does seem like there's a little bit of rotation happening in terms of profit taking, but most of the moves in U.S. equities have been driven by earnings growth, right? So it's not really been a valuation blowout. So I think there's a little bit of trimming happening, particularly in some of the big risk-on type of movers. And then if you look at some of the sector flows from the last month, you see a big shift in things like healthcare, industrials. These are historically defensive names, but these are also kind of the one level down AI play. So there's also that underlying theme that's still going on. But it's been a very good and unexpected year, I think. If you look at the start of 2025, a lot of concerns about tariffs, inflation, rate hikes. Now it looks like the Fed's going to cut again in December. Everyone feels relatively good, but I think maybe some profit taking into end of the year.
How does that set us up then going into 2026? I mean, it seems like all of those fears that we had going into 2025, maybe you could just sort of kick into next year to an extent.
Yeah, well, I think that the overall theme is like set and forget doesn't work anymore. So particularly for that core U.S. equity holdings, still 70% of your underlying index. And so within that, how do you play around sectors? How do you look for income to diversify? I think the diversification is really going to be the main theme again into 2026. It's a little bit boring, but you have earnings growth, which have been strong, but earnings projections are coming down a little bit. And how do you diversify? You either play around in sectors or you look for things like income and dividends. And that's been a big trend over the last couple of months, particularly in the active ETF space.
Yeah, tell us a bit more of the active ETFs, because it seems like the landscape is kind of constantly evolving, right, when it comes to what you're seeing in Asia. How does that compare to maybe passive strategies?
So it's primarily being led by the U.S. at the moment. We're seeing very early signs of shifts to active ETFs in Asia. But essentially, you're looking for an active type of performance without the active fees. It's basically what it boils down to. And because you have this huge dispersion in terms of earnings growth, sector performance, economic performance, the need to get active has really come to the fore for a lot of investors. And so they're using an ETF wrapper. That's all it is really. It's a wrapper. And the big trends, as I mentioned, have been into things like income, options overlays, dividends, these kind of volatility mitigation strategies. Because, again, if you're just holding a 70% of your portfolio in S&P 500, the dispersion is so much and the volatility is so much, and trading around eats into your performance. So active ETFs have been 40% actually of the inflow into ETFs this year in the US, which is a huge number.
Wouldn't it be great if you could see inside the refrigerator without opening the door? That's why we created AI Vision Inside. We believe any product we use every day, any home appliance, can be meaningfully evolved with AI.
So let us dive into this question that we've been wrestling with for about 47 minutes now, which is why stocks are quite as risk-off as they are, because, European futures are a little weaker, but NASDAQ futures down 0.8%. Maybe there's a Bitcoin read across. There's the Japan story we've just been discussing in depth. I mean, what's your take on why things have started on the back foot in December?
Yeah, I mean, I think it's really just a symptom of investor cautiousness, all of it. And so you get pieces here and there that are maybe negative news, but maybe the clearest sign of that investor cautiousness is the amount of money you're seeing in cash. So if you think about the amount of money in money market funds, that's actually reached an all.
Hello, I'm Caroline Hepker, introducing you to the new Stock Movers report from Bloomberg.
There are so many big names in equities to keep track of, and our Stock Movers report is the best way to find out which individual names are making the biggest moves every day. Stock Movers consists of short audio reports, they're 5 minutes or less, delivered right to your podcast feed throughout the day. We'll bring you conversations on the day's biggest winners and losers in equity markets and explain the news and the data that's driving those gains and losses. Listen a couple of times throughout the day to find out what's moving equities and why. Just search for Stock Movers on Spotify, Apple Podcasts, or anywhere you listen. Get the latest stock news and data backed by reporting from Bloomberg's 3,000 journalists and analysts across the globe. Subscribe to Stock Movers wherever you get your podcasts.
News when you want it with Bloomberg News Now. I'm Karen Moscow. The Kremlin says White House Special Envoy Steve Witkoff has arrived in Moscow. He is set to meet with Russian President Vladimir Putin on the latest proposals to end the war in Ukraine. The Kremlin says President Trump's son-in-law Jared Kushner will also attend the talks. Ukrainian President Volodymyr Zelensky said the latest plan, quote, looks better during a visit yesterday with French President Emmanuel Macron in Paris. Bloomberg's Balazs Pence has more on what to expect today in Moscow.
Well, it certainly does seem like Steve Witkoff has been able to build a very strong relationship with some of his Russian counterparts, and he has a very good rapport with some of President Putin's underlings. The question now is whether we will see a breakthrough, and unfortunately, based on some of the statements from the Russian side, it doesn't seem likely that they are willing to climb back from some of their demands.
And that's Bloomberg's Balazs Pence. And ahead of today's talks, Putin claimed that Russian forces have taken over the eastern Ukrainian city of Pokrovsk. It would be their biggest military advance in nearly 2 years. Ukraine denies it. Bloomberg News is unable to verify either side's claims. The White House is defending Defense Secretary Pete Hegseth over an attack in the Caribbean that's led to accusations of war crimes. Press Secretary Caroline Leavitt has confirmed a second strike was ordered on a suspected drug-running boat on September 2nd, but she denies reports that Hegseth ordered everyone on board killed. And she says the attack was ordered by Navy Admiral Frank Bradley and not Hegseth.
Admiral Bradley worked well within his authority and the law. He directed the engagement to ensure the boat was destroyed and the threat of narco-terrorists to the United States was completely eliminated.
That's White House spokeswoman Caroline Leavitt. Democratic Congressman Jamie Raskin is demanding more answers.
International law, American law, and the rules of the Department of Defense forbid attacking essentially helpless people who are just desperate and struggling to survive. They were of no military threat to anyone.
Jamie Raskin is the top Democrat on the House Judiciary Committee. Bipartisan leaders of the House and Senate Armed Services Committees say they will hold hearings on the second strike. The Northeast is preparing for its first major snowstorm of the season, and we get more with Bloomberg meteorologist Craig Allen.
By the end of today, over 100 million people will be impacted by snowfall, and it is moving in from west to east across our area now, and it could start as wet snow or a mix from D.C. all the way up to Boston, but it will likely change to rain in these major cities, including Philadelphia and New York City. However, north and west of here, there are winter weather alerts for 1 to 3 inches of snow and a winter storm warning in the Northeast, including the Poconos, Catskills, New York's Capital District, the Berkshires, and into northern New England. This is where 3 to 6 inches of snow expected and more in heavier bands.
And that's Bloomberg meteorologist Craig Allen. Luigi Mangione due back in court for the second day of a pretrial hearing in his bid to bar New York prosecutors from using evidence that they say links him to last year's killing of United Healthcare CEO Brian Thompson. The defense is seeking to bar evidence including items seized from Mangione's backpack during his arrest, including a gun and notebook. He's pleaded not guilty to state and federal charges. In company news, Amazon plans to offer deliveries of hundreds of household items within 30 minutes in a test program beginning in Philadelphia and its home city of Seattle. And we get more with Bloomberg's John Tucker.
Those household items include some fresh groceries and over-the-counter medicines. The company says it will use specialized, smaller facilities for the deliveries. The fee will start at $13.99, discounted to $3.99 for Prime members. Amazon has a long history of experimenting with quick delivery from specialized urban facilities stocked with inventory similar to the products sold by convenience stores and pharmacies. I'm John Tucker, Bloomberg Radio.
All right, John, thank you. The Prada Group says it has officially purchased fashion rival Versace in a deal worth nearly $1.4 billion. Cyber Monday spending grew more slowly in the U.S. than Europe. Analysts say it's a new phenomenon that reflects the impact of President Trump's trade war and aggressive interest rate cuts by the European Central Bank. The global economy is said to be weathering President Trump's trade tariffs better than expected as activity gets a boost from strong investment in artificial intelligence and supportive fiscal and monetary policies. The Paris-based OECD raised its U.S. and Euro area growth forecast for this year and next and made small upward adjustments for other major economies in its latest outlook. Still, it continues to predict global growth will slow to 2.9% in 2026. That's from 3.2% in 2025, as the full effects of levies on trade have yet to be felt. And Warner Brothers fielding a second round of bids. Bloomberg News has learned one of them includes a mostly cash offer from Netflix. Sources say bankers for Paramount, Skydance, Comcast, and Netflix worked over the long Thanksgiving weekend on improved offers for all or part of Warner Brothers. The parent of HBO, CNN, and its namesake film studio officially put itself up for sale in October after receiving multiple unsolicited offers for all or part of the company. Stock futures are higher this morning after equities kicked off the month of December with losses. Bitcoin higher as well following yesterday's 5% sell-off. Right now, Bitcoin's up 1.2% at $87,500. S&P futures are up 0.2%. Dow futures little changed. Nasdaq futures up 0.33%, and the 10-year Treasury yield is at 4.1%. That's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
This is Scarlett Fu.
And I'm Paul Sweeney, inviting you to join us for the Bloomberg Intelligence Podcast.
Every day, we harness the power of Bloomberg Intelligence to bring you deep dives into the companies that are moving markets, from publicly traded companies like Apple.
After the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
That potential pop, though, is going to be heavily dependent on the volatility of other asset classes. U.S. Treasuries sliding today in sympathy with the bond sell-off in Japan, Katie alluded to. Added pressure also from concern about Trump's rumored pick for Fed chair, who could prove too dovish. For the moment, with inflation stuck above target, the dollar remaining weak, silver at a fresh record, and as Katie just pointed out, the ground beneath Bitcoin continuing to quake. $1 billion of leveraged positions liquidated in crypto overall this Monday alone. As for the AI trade, that's also stuck in a bit of an air pocket. Bank of America strategists citing investor concern about that $500 billion or so in CapEx commitments, including, well, how a group of asset-light, nearly debt-free software companies have now morphed into an asset-heavy, cash-draining, debt-laden business models. A Kafka-esque metamorphosis, if you will, that suggests a more meaningful de-rating, potentially, Katie, in AI stocks.
So a lot to keep your eye on. But let's go back to seasonality, because as Romaine mentioned, the S&P 500, it tends to rally more than 70% of the time in December. But take a look at the monthly performance. Actually, over the past 10 years, the S&P 500 has averaged about 0.1% decline in December, which really speaks to the overall volatility that you tend to see in the final month of the year. Of course, seasonality is no clear guide to the future. I'll point out that you take a look at November's performance. Typically, you see a rally of more than 4%. We know that the S&P 500 was barely positive last month, Romaine. So we'll have to see what history, whether or not it's actually a guide for this December. But as you mentioned, certainly the start of this month not looking too hot.
Absolutely. Joining us right now is Kuei Wen, CEO of Equities over at Research Affiliates, kicking us off to the close. And Kuei, one interesting thing about this whole seasonality thing is when you look at past Decembers, very few of them had the type of run-up lead into the month that we saw this year. And I am curious about this idea of a market that it basically seems to have priced in so much of the future good news, if you will, and whether that kind of sets us up, not necessarily for a fall, but a bit of maybe a stasis or a tight trading range going forward.
Sure. There's a lot of fragility baked into markets because they are really dependent on a couple of things. The first thing being lower interest rates. And yet what we've seen is that the Fed seems somewhat divided on whether or not there'll be a rate cut in December. And the second is really just this whole AI story. How long can that go? How much further can that go?
Well, let's talk about the AI story, though. I mean, it's not. I don't think the AI story has sort of faded, but it's certainly morphed into something a little bit different. And I do wonder if the AI trade itself has sort of lost steam, or it's just that there's a rotation away from some of the big stocks that sort of got us to this point into whatever people think the new thing is going to be?
Definitely there's some of that, but I also think people are just sort of taking a breather. What they're seeing is that these big companies, they're spending a lot, they're investing a lot, they're actually issuing a lot more debt than they have ever done before, and they're just trying to reassess who's going to be the winner, who's not going to be as big a winner. Not everybody can be the big winner of AI.
Well, you heard Romaine mention that note from Bank of America with strategists talking about those investors concerned around the fact, as you mentioned, that a lot of these tech companies are taking on a lot of debt to fund these commitments. You think about some of the blue chip names there, specifically Amazon, for example, comes to mind, and they probably have the capacity to do that. But I wonder how you think about that as, you look outside of the top 7 largest companies.
Well, the top 7 largest companies are the ones that are driving the investment. And so they all have, well, not really the 7. You have to take out Tesla. You have to take out, some of the smaller companies. But, those 5 or 6 companies, they have fortress balance sheets. They definitely have a lot of capacity for debt. And a lot of them are investing with demand in mind. Mm-hmm. I mean, you see Microsoft talking about how they just can't fulfill all of the demand that they see, and they need to make this investment. So the way I think about it is that, these companies are probably okay, but the question is what happens to, the second-tier players that you see. And some of those stocks, they're beginning to participate. They see a lot of pressure to also invest. When you see an HPE, for example, or Oracle even, they don't have nearly as much of the strength as the Mag 7.
Yeah, absolutely. Oracle and what we're seeing in their CDS certainly comes to mind here, though. So, when it comes to the equity market, how do you invest around this? Because I'm taking a look at your notes, and you mentioned that the signs of a building bubble in AI, they're easy to identify, but the popping of that bubble, super hard to time. So what's an investor to do in an environment such as this one?
So the way we look at it is that, yes, the markets are rich, but they're not nosebleed levels. They're not what we saw in 1999. So it's hard to time. You don't really want to miss it. I think it's actually okay to own the Mag 7. These companies have magnificent earnings, they have magnificent balance sheets, and they have magnificent growth. They just probably shouldn't be 40% of your equity portfolio, right? So look outside of that, diversify into something that is less Mag 7 heavy. You can find great bargains in value stocks. You can find great bargains in small cap stocks and also non-U.S. stocks. A lot of high-quality companies that are going to be participating in growth.
Also on the AI trade, but particularly when it comes to some of those other stocks, there's this idea that people are now trying to seek out sort of the beneficiaries of AI, not necessarily the folks who are selling AI tools, but the idea of those that will be using them and presumably would see some sort of productivity improvements or cost improvements, et cetera.
Yeah, sure. I think that businesses are only just beginning to really tap into that, really experiment with it, really figure out what's working and what's not. And whatever works for businesses, whatever helps businesses improve their productivity, whoever provides those tools, they're going to be big AI winners. And the businesses that use those tools themselves will also be big AI winners.
And I do also want to ask about small caps. That's an area you identify in your notes as well. It feels like we've heard a lot of bull cases for small caps in the past couple of weeks. But how can you be sure that this current bid that we're seeing, this performance that we saw in November, is something that can be sustained in 2026?
That's always a big question with small cap, right? But I think that if you approach small cap in a very selective way, we don't necessarily advocate owning all the small caps, but find the ones that are relatively inexpensive, find the ones that have strong quality metrics, and those tend to be good long-term investments.
All right, Quay, always a great conversation. Quay Wynn, CEO of Equities over at Research Affiliates, kicking us off to the close here on this Monday afternoon, the first trading day of the month, the final month of the year, and a big deal here on Merger Monday. A conversation with Brian Lake over at Goldman Sachs Asset Management and a big ETF acquisition, Innovator Capital. That conversation coming up in just a second.
And from markets to markdowns, we're giving you a full Black Friday postmortem with the CEO of Klaviyo and Mary Shore of Columbia Threadneedle Investments. We'll discuss what rang up, sold out, and fell flat for shoppers this weekend.
And Greg Schwartz, the CEO over StockX, he'll have some thoughts on that as well. He'll be stopping by to discuss the recent resale rush and where he's seen the rarest drops and biggest bids. All that and more coming up here on The Close. This is Bloomberg.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment. Soon it was past 1 gigawatt of capacity, helping anchor Indonesia's clean energy future.
A lot of our inspirations for new features comes from experiences in our own daily life.
The other day, I needed to double check an important meeting schedule by finding a specific call recording. Thankfully, with call summarization feature on my Galaxy, I could quickly find it.
Our users ask complex questions, and our model has to be able to speak multiple languages. What seems impossible now can quickly become possible.
Goldman Sachs bolstering its ETF operation, inking a deal with Innovator Capital to buy the buffer fund issuer for $2 billion. Now, buffer funds are also known as defined outcome ETFs, and they're really meant to limit downside risk in exchange for capped upside potential. Let's discuss this deal with Brian Lake. He is partner, chief transformation officer, and also the global co-head of third-party wealth over at Goldman Sachs Asset Management. Brian Lake, it's great to see you.
Those are a lot of titles, by the way.
Thank you for having me. Yeah, no, you know what I mean. Like,
I'm sure there's a few
I try to
more.
turn the lights off when I go home at night. That's kind of my job.
Well, let's talk about this deal. Certainly caused a lot of ripples in the ETF industry. And I guess my first question for you is why buy Innovator Capital? It's $28 billion worth of buffer ETFs versus try to build this out at Goldman Sachs in-house.
I mean, you know, so much credit goes to the team at Innovator. They invented this space back in 2018. They invented defined outcome ETFs. I mean, they have a history of innovating in this space. So they build out this business. They invent the space. Over the last 7 years, they've been able to scale the business to be $29 billion. But in addition to that, they have a full suite of products that cover all the different horizons that we see across the defined outcome space. Plus, they have an incredible team, 70 individuals that are extremely talented at talking about these sophisticated strategies, working with clients and articulating these to investors and showing them how they can use them within their portfolio. So when you bring all of that together, it just makes so much sense to add it onto the platform that we have.
And let's talk about the price tag a little bit. So $2 billion, for that you get $28 billion of existing AUM. I was taking a look at the reaction piece from Bloomberg Intelligence. That's about 7% of assets. That's probably closer to private market deals than traditional products. So show us the napkin math of how you justify a $2 billion valuation.
So over the last kind of handful of years, I've been traveling around this country working with clients. And in more conversations than not, defined outcome ETFs were coming up. How do I get more income in my portfolio? How can I get targeted downside protection? What about different growth areas that I can get within my portfolios? And over time, you start to notice this pattern. There's more and more investors that are looking for better ways to build portfolios on behalf of their clients. And so when you take that, you start to see, like, wait a second, there's a massive trend here. Now, Cerulli put out research last week. They suggested the space could grow 4 to 5x over the next 5 years. And so I don't think I'll get into the napkin math, but what I will tell you is that I know investors are really excited about the strategies. You've seen it grow massively over the last 5 years, and groups like Cerulli projecting 4 to 5x growth over the next 5 years. You start to see why we're so excited about this space.
Who specifically, in terms of the end users of these funds, who specifically are those types of people? I mean, that we're talking about. Are they using this primarily as a hedge, or is this actual real sort of growth and or income opportunities, I should say?
It's a great question.
Yeah.
So step back for a second. We called it defined outcomes, which is a pretty wide space. We see income in this category, we see targeted buffer in this category, and we see growth in this category. There's a lot that's going on there. So we've seen everything from core replacement. You know, I was using the S&P 500. I want to swap that out with something that could provide a little bit more protection. We see it as an income play. I want to put this into my portfolio and it can enhance the income that I have. We see it as a bond replacement in some areas where maybe I can use this instead of bonds and it gives me a little bit more equity upside.
there's also some differentiated ways where, investors are starting to use this to put cash to work. Markets are still at kind of close to all-time highs. And so, if an investor's starting to put money to work, do you do that right now? Or maybe this is a great way to start to leg your way into an equity position without taking on some of the downside risk. And so I think that this is going to absolutely change the way that we think about portfolio construction over the next 5 years. We're seeing this both on the retail side and on the institutional side. Institutions have been using strategies like these for a long time. Now that we can deliver them through the ETF wrapper that is intraday liquid, that is transparent, that is tax efficient, that comes at an attractive price point, that starts to be a real game changer for us.
For the individual investors, is there sort of an education arc that's needed, at least if not for them, certainly with the advisors that are selling it?
Yeah, absolutely.
Yeah.
And that's another big part of the innovator team. I mean, they're experts at having those conversations, and we really want to embrace that. I mean, we want to lead with solutions. We want to lead with this is how these are going to work within your portfolios. It's important that you own it point to point. There's different ways that these are going to move out there. But once you understand how those work, then you can really enhance what you're doing within your portfolios.
So this news in and of itself is exciting, but the natural next question, Brian, is what's next? I mean, could we go out and see GSAM buy more companies, more areas in terms of white space where maybe GSAM doesn't have that presence?
So let's think about what happens with a transaction. You really need to get some things that are very aligned. First of all, when we think about Goldman Sachs and Innovator, our firms have very similar cultures. We wake up client-obsessed every single day. If you talk to the founders of Innovator or any person over there, they wake up thinking about the clients. When you talk to anybody at Goldman Sachs, we wake up thinking about our clients. So that's number one. Number two is Innovator has developed this space, like we talked about earlier, that is differentiated across anything else in the market right now. And so it's bringing differentiation to clients, which is something that Goldman's focused on as well. This fits perfectly alongside our direct indexing capabilities, our evergreen alternatives capabilities, and indeed our organic active ETF strategy as well. And so when you combine those things, it becomes really special. Now, that's a pretty high bar. And so to think that we're going to be able to find something else like that out there, I don't know. We'll look, but we're really confident in our organic strategy and what we're doing right now.
And just a fun fact, it's probably worth pointing out that, of course, you know the co-founders of Innovator well. Bruce Bond, I believe, gave you one of your first jobs at PowerShares.
Yeah, Bruce hired me into the industry a number of years ago. I think I was the 12th employee at PowerShares. And, he's got an incredible track record of hiring good talent, myself aside. He's built some really good talent there. He's innovated in this industry for years. He brought the first smart beta strategies before we even called them smart beta. And this is just another one of those things that he and John Southard and the rest of the team over at Innovator have been able to accomplish. And, so that's why we feel so aligned, that existing relationship that Goldman has had with Bruce and the Innovator team. And so coming together, we feel really good about that. Obviously we're bringing on all 70 of the employees to be full-time Goldman Sachs employees. We don't plan on changing anything as far as their sub-advisors or some of their service providers. We're just providing a massive tailwind to this business because we think the growth over the next 5 years and beyond is going to be absolutely explosive.
All right. Well, it's interesting to see the evolution, kind of what they built there, and now what the baton that you're taking up, Brian Lake, their partner and chief transformation officer at Goldman Sachs Asset Management. When we come back, we're going to talk about the battle for Warner Brothers Discovery heating up as the parent company of HBO and CNN, asking potential buyers, those deals you put on the table, you need to sweeten them just a little bit. That conversation coming up after the break. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Time now for our top calls, the big movers on the back of analyst recommendations. Let's start with Beta Technologies. Analysts initiating coverage on the electric aircraft maker that went public just last month. Morgan Stanley among the chorus, starting coverage with an overweight and a $34 target. The analysts likening Beta to a, quote, young Tesla, but with a more attractive end market in aerospace. That stock today actually down for the 10th time in the past 19 sessions since it IPO'd. Next up, Toast. BNP Exane upgrading the retail payments platform to outperform with the price target of $40, saying despite rising competition, Toast can actually still grow in its core U.S. restaurant market. Those shares up for a third straight day. And finally, Zscaler. Bernstein downgrading to market perform and setting a price target at 264, saying Zscaler's luster has worn off due to uncertainty around growth persistence. Those shares, though, looks like they're down about 3% here on the day, and those are some of our top calls. Let's turn now to Warner Brothers Discovery. Keep an eye on their shares as the media heavyweight said to be awaiting sweetened offers for that deal to potentially buy the company out. Jason Bazinet joining us right now to talk a little bit more about it. Managing Director over at Citigroup. Jason, we've seen some of the bids already, or at least we've seen reports of some of those bids. Do you think we're going to see a meaningful increase in those bids this week and beyond?
Well, I think it depends how you define meaningful. I think we'll probably get a few extra bucks. That's my guess. I mean, this is a very scarce asset. It has some very attractive assets that would help a lot of these companies. And so I think you can probably add a few bucks to the likely outcome if you're a Warner Brothers shareholder.
Well, Jason, I like the way that you broke down how to think about the potential suitors here in your note. You know, there are nice to haves and there's must to haves. So you think about the cast of characters that we're talking about. Paramount, for them, this is a must have acquisition. Talk to us about why.
Well, going back to 2019, we saw quite a bit of media consolidation, and I don't think there's been enough consolidation that's allowed any of the incumbent media companies to really take on Netflix. What Paramount Skydance did is it sort of, I would describe them as being sort of half pregnant in the DTC space. You know, they're not subscale relative to traditional media, but they are subscale relative to Netflix. And what the buy side's been clamoring for is another round of consolidation to hopefully give somebody enough oomph, enough content spend, if you will, to have enough content on that app to keep churn down, to keep gross ads aloft, to begin to drive towards what I call the true pay TV substitute, which is what Netflix is. All the other DTC apps, whether it's Paramount or Max or Peacock, I just think of them the way consumers thought of HBO in the old linear days. You know, you go on for a particular show and you watch that show and then you churn off. And that's the world most of these DTC apps are in. They need to get enough scale to become a true pay TV substitute.
Well, that gets to the idea, too, of like who ends up winning this. I mean, to a certain extent, I look at Netflix and I think, why even go through the hassle? And then I look at Paramount, Jason, and I just want to be honest here. Is there any realistic possibility anyone gets this other than Paramount? I don't mean just on price, but given the connections to the Trump administration and obviously the antitrust regulators that would have to sign off on this deal, I would think they would have a serious leg up over the other potential bidders.
Yeah, I think that's true. I think, you know, I don't think any of these potential suitors have insurmountable regulatory risks, but I think it's certainly going to be easier for Paramount to get the deal done with less regulatory review. I think what it comes down to is you could face a possibility where Warner Brothers shareholders, you know, or the board opts to sell for a smaller premium with a greater likelihood of sort of the deal going through relatively easily. That I think is certainly possible. I've seen it in the past with other deals where they've sold, where they've accepted less than the highest bidder because of lower regulatory risks.
Yeah, it'll be interesting to see how this shakes out. Jason, we only have about 30 seconds left with you or so, but let's quickly talk about what sort of premium we could be talking about here. Warner Brothers shares right now trading just below $24 a share. What do you think that ends up?
Yeah, I think we've sort of penciled in going back to early October, 23 to 28 is probably the range where we come out. The reason it's a wide range is we did the normal customary premium. We did the share in the synergies that we anticipate, which is about $3 billion a year. And then you get into this X factor of what is the scarcity value of the asset. And that we think that can range from $2 to $6. And so when you put all that math together, if you have a low scarcity premium, you end up at 23.
Right.
If you end up with a higher scarcity premium, you get up to 28.
All right, Jason, great to get some time with you. That is Jason Bazinet, Managing Director over at Citi. Coming up, it's all about Black Friday. This is Bloomberg.
Friday. Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. But Ito Renewables is unlocking this resource with continued investment.
You have to have very
clear global strategy to bring progress for humanity. Thinking from the customer point of view and taking the right decision, taking the right action, it may cost you more money in the short term, but you are creating customers for life.
Was another record-breaking Black Friday weekend. We saw about $6.2 billion in sales for Black Friday. That's up about 25% from last year. We saw peak sales of $5.1 million per minute on Friday. That happened around noon on Friday. That's up from $4.6 million last year as well.
The president of Shopify speaking on Bloomberg earlier today about the, quote, record-breaking Black Friday sales here at 3:30 p.m. in New York City. And Katie, I don't know if you had a chance to look at some of the sales stuff, but when you see these numbers, I mean, there's two issues. First question is, are they inflation adjusted?
Right.
But also, like, what are we really talking about in terms of sales? Are people really going out there and buying gifts, or are they just buying for themselves? What's the complexion of the spending?
That's the big question, right? Behind the dollar value alone, what actually are people buying, and what does it say about the state of the economy? I will say it's interesting with Shopify. You can see shares down nearly 5% right now, as we heard. Record-breaking Black Friday for them, but that 25% growth in merchant sales that they saw actually lagged the consensus expectations. So you pile on high expectations on top of that, and certainly there's a lot to sort through here.
Yeah, absolutely.
Well, let's keep this conversation going now, because according to Bloomberg Intelligence, Shopify is Klaviyo's largest platform, representing close to 80% of annual recurring revenue. And joining us for more on this and the overall health of the retail and payment space, I'm pleased to say, is Andrew Bialecki. He is the CEO over at Klaviyo. Andrew, great to have you with us. So give us some color. What did you see on Black Friday? And not just Black Friday, the weeks preceding it, and of course, the weekend too, which is lumped into that group overall.
Yeah, thanks for having me. So Klaviyo serves over 180,000 businesses around the world. We act as a CRM for consumer businesses. You can think of great brands like Glossier, Away, Mattel. And I'll give you three themes we've seen. So the first is, like you said, record-breaking. Through Klaviyo's platform, just on Black Friday, the businesses that we serve did over $1 billion in sales attributed back to our platform. That's the first time ever. That's up, like, similar to what you're talking about, about 25, 26%. And we're seeing an increase in repeat buyers. We've also had 20,000 businesses set a record on their best sales day ever on Black Friday, and I think we're going to have a lot more set records today. The two other themes are we're seeing consumers really demand better experiences from businesses. So we're excited for brands like Beyond Yoga that are now using our customer agent so that when you visit that website, you can use AI to chat with the brand and help find the right product, whether it's for yourself or for somebody else, to fit a budget. And then the last thing is that the state of consumer is pretty strong. When it comes to discounting, we actually saw a lot of brands not discount as heavily early in the holiday season, and actually instead they leaned into kind of more interesting product drops. So for example, Mattel, a great Klaviyo customer, they set up a member first sale for some of their new Hot Wheels around the Stranger Things launch on Netflix, and that sold through really well. So. I think we're seeing that instead of discounting, people are also just using special access or special experiences to drive demand.
I'm curious, Andrew, with regards to the types of consumers that have been shopping, what's sort of like the conversion? I mean, so for example, when I go and shop on Black Friday, I see a deal. Am I going to the retailers and e-commerce companies that I normally go to, or am I going to a place maybe that I've never shopped at before and I've been sort of tantalized by, the % off that they're offering me?
Yeah, it's a great question. So we mentioned not quite as much discounting as in past years. Another thing is we're seeing a slight uptick when we look at that $1 billion in sales that businesses drove through Klaviyo on Friday. A lot of that is from repeat buyers. So we're seeing more repeat buyers. Consumers are going back to brands that they already know, whether they're shopping for themselves or a friend or a family member. Another thing is we're seeing buyers be more considered. So product views. So you think about the amount of consideration before people buy. That's up 37% year on year. So we're seeing a lot more browsing behavior. People are trying to understand products better before they're buying them. And then in terms of categories, we've seen two categories that have sort of paced the field this year. Health and beauty, so probably people shopping both for themselves and for others. That was up over 12%. And apparel was up almost 12% year on year.
Interesting. And I mean, I wonder if this fits into what we were hearing from the likes of Home Depot and Lowe's, that folks are less willing to spend on big purchase, big ticket items here. And you think about health and beauty in particular, it's often thought of as sort of an affordable luxury. Andrew, I wonder if that fits into that sort of narrative, or does that not quite match with what you're seeing across your categories?
You know, we work with a lot of health and beauty brands, as well as some, home improvement businesses. I think a trend across all of them is, when folks are more budget conscious, they're looking for that brand to deliver more than just the products, but also a great experience. And that's why we're seeing a lot happen with AI. People are using AI now when it comes to marketing, for message personalization, say timing or content. And then I also mentioned on the customer service side, something that we at Klaviyo are happy to stitch together is they want businesses that know who they are. And so maybe if they are trying to fit a budget, they can find the exact right product or kind of maximize that value. Yeah. And they're able to do that now through conversational AI that's happening, with these brands. One of the trends we're really excited about is AI is both where people are starting their searches, say on ChatGPT and others, but it's also where they're ending their searches. They're leveraging AI that businesses themselves are providing and using that to decide which products to buy and make buying decisions in a way that just in the past, for most retailers, it was just whatever you find and you decide you want, that's kind of the end of the shopping experience. I think that's changing in a pretty dramatic way this holiday year.
All right, Andrew, great insights. Always appreciate it. Andrew Bielecki, the CEO over at Klaviyo. We keep the conversation going right now with Mari Shore, Senior Equity Research Analyst over at Columbia Threadneedle. And Mari, I am curious. I mean, we talk a lot about what consumers are spending and what they're willing to spend. I'm curious as to your thoughts how prepared retailers were for this holiday season, particularly given we spent all year long talking about tariffs and how that was going to disrupt supply chains and inventories and the like. Were they ready for this moment this weekend?
Yes, thank you for having me. I think the retailers were absolutely ready for this holiday and, in fact, positioned pretty conservatively into holiday. I think for the majority of the year, we've seen strength in categories like apparel and beauty that Andrew just spoke about. And even with strong current business momentum and strong Q3 results, all of the retailers took a very cautious approach into holiday. Based on the anticipation of higher inflation from tariffs. So as they enter holiday, inventory and promotional levels are very healthy. And I think it's important to note they've seen a better than expected price elasticity from price increases they've taken to date. So I think, if anything, the retailers position maybe even a little too conservatively into the holiday, given the recent strength we've seen.
Well, that's really interesting to hear, Mari, the fact that maybe retailers are positioned a little bit too conservatively. Do you think that that's something we could see change over the next 4 to 5 weeks?
No, I do think the retailers are very focused on managing unit inventory levels in order to protect full price selling and margin. So I think that that behavior will continue into next year as well. But again, that's very supportive for both the top line and margin. And I think that that is a trade-off that the retailers are willing to make.
As you sort of try to assess how retail is going to sort of perform this month and really into next year, Mari, do you have a sense here of maybe who you think is going to do better than the others?
Yes, I think that we've seen better than expected results and pretty consistent trends for most of this year. There have been a couple blips like in the month of September when it was much warmer, but overall we've seen continued strength in the online part of the business and categories like apparel and beauty. But when we think about really who the winners are in retail, I think about them in two buckets. On the one end of the spectrum, you have scale players who are offering value and convenience and are taking share. So I would put companies like Walmart, Amazon, Costco, TJX in that bucket. On the other end of the spectrum, you have brands that are executing incredibly well, that are offering great value and product. And within that bucket, I would put companies like Gap, Ralph Lauren, Tapestry, Levi. And we still think that among those two buckets, those companies will continue to take share as we move through this holiday and beyond.
All right, Mari, great stuff. Mari Shore, Senior Equity Research Analyst over at Columbia Threadneedle. A closer look here at the unofficial start of the holiday shopping season. When we come back, we're going to take a look at some of the big movers on the day. To the upside, not a lot of retailers out there. To the downside, not much there either, though you are seeing a huge downdraft in some of the vaccine makers. Moderna down 6%. It's our stock of the hour, and it's up next. This is Bloomberg. Time for our stock of the hour. We're taking a look at the biggest percentage decliner in the S&P today, and that is Moderna. The share is down after a warning that the FDA could enact new restrictions around which vaccines actually make it to market. Nora Melinda joins us right now, our Bloomberg's markets correspondent. And Nora, this gets to the idea. We should point out Moderna, obviously most famous for that COVID vaccine. Remember COVID, right?
Yes.
And of course, they were trying to sort of branch out from that, but into other vaccines as well, like flu vaccines. What exactly is the FDA talking about when they say they could sort of limit what actually makes it to market?
And that's what we're trying to really figure out right now. It's really as we're digging into the actual specifics here. I mean, they are calling out the fact that they are going to be implementing some new restrictions. They talked about 10 children passing away due to myocarditis, if I'm not mistaken. But essentially, they're talking about the fact that vaccines are linked to a lot of things that could be potentially fatal, and that's what they're really trying to limit. They're saying that they're done with the rubber stamps. We're just pushing things through and getting them approved, and they're really wanting to be a bit more critical and scrutinize a bit more what these companies are doing before they make it out to the market.
Just to be clear, as somebody who's covered the FDA for years, including sitting through a lot of PDUFA meetings, I don't think I've ever seen the FDA rubber stamp anything, but that's just my 2 cents.
Fair point there. Yeah. You're on the ground reporting there. I mean, let's talk a little bit about what this means for the space as a whole. We're spending a lot of time on Moderna. Certainly the stock is down about very deeply today. It's 8% over the past 6 months, but this would theoretically affect other vaccine makers in addition to Moderna as well.
Absolutely. It would actually affect multiple names, not just Moderna exclusively, but that is what we are seeing in terms of a lot of the pressure right now, down about 6% as we look at Moderna more broadly. But as we really see about what the stock has been doing this year, we are seeing a lot of pressure. The stock is down more than 40% so far this year. And of course, we know that's because the company spent a lot of its time on the COVID-19 vaccine. For a lot of people that weren't familiar with Moderna, that's when they kind of became familiar with the name when they were thinking about vaccines for COVID-19. But because a lot of people aren't really going out to get those vaccines anymore, they're having to come with more creative ways to really stay profitable and to really entice, customers here in this environment. But not only that, but outside of that, we also have RFK Jr., who also has been coming in as the head of the HSS. And of course, that really has been putting a lot of pressure on the space more broadly because people see him to be a vaccine skeptic, somebody who's more critical of the space. And he's also putting a lot of people in charge that are also similarly like-minded.
Yeah, a lot of headwinds for specifically for the vaccine makers, but the industry overall when it comes to health and pharma. Bloomberg's Nora Melinda, great reporting as always.
Have you gotten a COVID shot?
I should.
I got one a couple weeks ago.
Okay.
That's good.
I got a flu shot.
Maybe it's time for me to double back.
Perhaps. This is the close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Will December be a month to remember? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. A little bit, but we'll work through it. Let's go check on where these markets stand the first trading day of December, as Romaine alluded to. You can see the S&P 500 not certainly a gift for bulls right now, down about 0.5%. Really, you can see something similar happening in the NASDAQ 100, where all your big tech names live. I thought it was interesting to see that the bond market not getting any sort of haven bid right now. We know there was a sell-off overnight in Japanese debt that seems to have filtered through into the U.S. market as well. 10-year yields higher by about 8 basis points. And Bitcoin, Romaine, keep your eyes on Bitcoin, down another 6.7%, sitting at $85,000 a coin. Just fascinating to see where this thing will go.
Yeah, I can't take my eyes off it. Katie, I saw a stat earlier this morning showing that the S&P has rallied more than 70% of the time in the month of December. But day one of this December, not showing signs of life just yet. Clear risk aversion wafting through markets, belying that 5-day rally we had to end November, a rally that now appears to have been more technical than fundamental, a clearing out of bearish options that drove a bit of a squeeze higher in equity prices, a clearing out that may not have actually completely run its course and won't until the Fed's meeting next week.
So I think some of the position unwinds are maybe not sort of fully baked in, but then to see a bit of a rally, particularly after the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
That potential pop, though, is going to be heavily dependent on the volatility of other asset classes. U.S. Treasuries sliding today in sympathy with the bond sell-off in Japan, Katie alluded to. Added pressure also from concern about Trump's rumored pick for Fed chair, who could prove too dovish. For the moment, with inflation stuck above target, the dollar remaining weak, silver at a fresh record. And as Katie just pointed out, the ground beneath Bitcoin continuing to quake, $1 billion of leveraged positions liquidated in crypto overall this Monday alone. As for the AI trade, that's also stuck in a bit of an air pocket. Bank of America strategists citing investor concern about that $500 billion or so in CapEx commitments, including well, how a group of asset-light, nearly debt-free software companies have now morphed into an asset-heavy, cash-draining, debt-laden business models. A Kafkaesque metamorphosis, if you will, that suggests a more meaningful de-rating, potentially, Katie, in AI stocks.
So a lot to keep your eye on. But let's go back to seasonality, because as Romain mentioned, the S&P 500, it tends to rally more than 70% of the time in December. But take a look at the monthly performance. Actually, over the past 10 years, the S&P 500 has averaged about 0.1% decline in December, which really speaks to the overall volatility that you tend to see in the final month of the year. Of course, seasonality is no clear guide to the future. I'll point out that you take a look at November's performance. Typically, you see a rally of more than 4%. We know that the S&P 500 was barely positive last month, Romain. So we'll have to see what history, whether or not it's actually a guide for this December. But as you mentioned, certainly the start of this month not looking too hot.
Absolutely. Joining us right now is Kuei Wen, CEO of Equities over at Research Affiliates, kicking us off to the close. And Kuei, one interesting thing about this whole seasonality thing is when you look at past Decembers, very few of them had the type of run-up lead into the month that we saw this year. And I am curious about this idea of a market that it basically seems to have priced in so much of the future good news, if you will, and whether that kind of sets us up, not necessarily for a fall, but a bit of maybe a stasis or a tight trading range going forward.
Sure. There's a lot of fragility baked into markets because they are really dependent on a couple of things. The first thing being lower interest rates. And yet what we've seen is that the Fed seems somewhat divided on whether or not there'll be a rate cut in December. And the second is really just this whole AI story. How long can that go? How much further can that go?
Well, let's talk about the AI story, though. I mean, it's not. I don't think the AI story has sort of faded, but it's certainly morphed into something a little bit different. And I do wonder if the AI trade itself has sort of lost steam, or it's just that there's a rotation away from some of the big stocks that sort of got us to this point into whatever people think the new thing is going to be.
You know, definitely there's some of that, but I also think people are just sort of taking a breather. What they're seeing is that these big companies, they're spending a lot, they're investing a lot, they're actually issuing a lot more debt than they have ever done before, and they're just trying to reassess who's going to be the winner, who's not going to be as big a winner. Not everybody can be the big winner of AI.
Well, you heard Romain mention that note from Bank of America with strategists talking about those investors concerned around the fact, as you mentioned, that a lot of these tech companies are taking on a lot of debt to fund these commitments. You think about some of the blue chip names there, specifically Amazon, for example, comes to mind, and they probably have the capacity to do that. But I wonder how you think about that as, you know, you look outside of the top 7 largest companies.
Well, the top 7 largest companies are the ones that are driving the investment. And so they all have, well, not really the 7. You have to take out Tesla, you have to take out, you know, some of the smaller companies. But, you know, those 5 or 6 companies, they have fortress balance sheets. They definitely have a lot of capacity for debt. And a lot of them are investing with demand in mind. Mm-hmm. I mean, you see Microsoft talking about how they just can't fulfill all of the demand that they see, and they need to make this investment. So the way I think about it is that, you know, these companies are probably okay, but the question is what happens to the second tier players that you see. And some of those stocks, they're beginning to participate. They see a lot of pressure to also invest. When you see an HPE, for example, or Oracle even, they don't have nearly as much of the strength as the Mag 7.
Yeah, absolutely. Oracle and what we're seeing in their CDS certainly comes to mind here, though. So, I mean, when it comes to the equity market, how do you invest around this? Because I'm taking a look at your notes, and you mentioned that the signs of a building bubble in AI, they're easy to identify, but the popping of that bubble, super hard to time. So what's an investor to do in an environment such as this one?
So the way we look at it is that, yes, the markets are rich, but they're not nosebleed levels. They're not what we saw in 1999. So it's hard to time. You don't really want to miss it. I think it's actually okay to own the Mag 7. I mean, these companies have magnificent earnings, they have magnificent balance sheets, and they have magnificent growth. They just probably shouldn't be 40% of your equity portfolio, right? So look outside of that, diversify into something that is less Mag 7 heavy. You can find great bargains in value stocks. You can find great bargains in small cap stocks and also non-U.S. stocks. A lot of high quality companies that are going to be participating in growth.
Also on the AI trade, particularly when it comes to some of those other stocks, there's this idea that people are now trying to seek out sort of the beneficiaries of AI, not necessarily the folks who are selling AI tools, but the idea of those that will be using them and presumably would see some sort of productivity improvements or cost improvements, et cetera.
Yeah, sure. I mean, I think that businesses are only just beginning to really tap into that, really experiment with it, really figure out what's working and what's not. And whatever works for businesses, whatever helps businesses improve their productivity, whoever provides those tools, they're going to be big AI winners. And the businesses that use those tools themselves will also be big AI winners.
And I do also want to ask about small caps. That's an area you identify in your notes as well. It feels like we've heard a lot of bull cases for small caps in the past couple of weeks. But how can you be sure that this current bid that we're seeing, this performance that we saw in November, is something that can be sustained in 2026?
That's always a big question with small cap, right? But I think that if you approach small cap in a very selective way, we don't necessarily advocate owning all the small caps, but find the ones that are relatively inexpensive, find the ones that have strong quality metrics, and those tend to be good long-term investments.
All right, Quay, always a great conversation. Quay Wynn, CEO of Equities over at Research Affiliates, kicking us off to the close here on this Monday afternoon, the first trading day of the month, the final month of the year, and a big deal here on Merger Monday. A conversation with Brian Lake over at Goldman Sachs Asset Management and a big ETF acquisition, Innovator Capital. That conversation coming up in just a second.
And from markets to markdowns, we're giving you a full Black Friday postmortem with the CEO of Klaviyo and Mary Shore of Columbia Threadneedle Investments. We'll discuss what rang up, sold out, and fell flat for shoppers this weekend. And
Greg Schwartz, the CEO over StockX, he'll have some thoughts on that as well. He'll be stopping by to discuss the recent resale rush and where he's seen the rarest drops and biggest bids. All that and more coming up here on The Close. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Goldman Sachs bolstering its ETF operation, inking a deal with Innovator Capital to buy the buffer fund issuer for $2 billion. Now, buffer funds are also known as defined outcome ETFs, and they're really meant to limit downside risk in exchange for capped upside potential. Let's discuss this deal with Brian Lake. He is partner, chief transformation officer, and also the global co-head of third-party wealth over at Goldman Sachs Asset Management. Brian Lake, it's great to see you.
Those are a lot of titles, by the way.
Thank you for having me. Yeah, no, you know what I mean. Like,
I'm sure there's a few
I try to
more.
turn the lights off when I go home at night. That's kind of my job.
Well, let's talk about this deal. Certainly caused a lot of ripples in the ETF industry. And I guess my first question for you is why buy Innovator Capital? It's $28 billion worth of buffer ETFs versus try to build this out at Goldman Sachs in-house.
I mean, so much credit goes to the team at Innovator. They invented this space back in 2018. They invented defined outcome ETFs. I mean, they have a history of innovating in this space. So they build out this business, they invent the space. Over the last 7 years, they've been able to scale the business to be $29 billion. But in addition to that, they have a full suite of products that cover all the different horizons that we see across the defined outcome space. Plus, they have an incredible team, 70 individuals that are extremely talented at talking about these sophisticated strategies, working with clients and articulating these to investors and showing them how they can use them within their portfolio. So when you bring all of that together, it just makes so much sense to add it onto the platform that we have.
And let's talk about the price tag a little bit. So $2 billion, for that you get $28 billion of existing AUM. I was taking a look at the reaction piece from Bloomberg Intelligence. That's about 7% of assets. That's probably closer to private market deals than traditional products. So show us the napkin math of how you justify a $2 billion valuation.
So over the last kind of handful of years, I've been traveling around this country working with clients. And in more conversations than not, defined outcome ETFs were coming up. How do I get more income in my portfolio? How can I get targeted downside protection? What about different growth areas that I can get within my portfolios? And over time, you start to notice this pattern. There's more and more investors that are looking for better ways to build portfolios on behalf of their clients. And so when you take that, you start to see, like, wait a second, there's a massive trend here. Now, Cerulli put out research last week. They suggested the space could grow 4 to 5x over the next 5 years. And so I don't think I'll get into the napkin math, but what I will tell you is that I know investors are really excited about the strategies. You've seen it grow massively over the last 5 years, and groups like Cerulli projecting 4 to 5x growth over the next 5 years, you start to see why we're so excited about this space.
Who specifically, in terms of the end users of these funds, who specifically are those types of people? I mean, that we're talking about? Are they using this primarily as a
PKORI25, thank you so much for joining channel membership. If you have any question, you can ask in the comment box. सीधा 8 बजे यूएस मार्केट ओपन होगा, थोड़ा ध्यान रखना। क्रूड ऑयल में जिन लोगों ने सेल किया हुआ अपना आधा प्रॉफिट बुक करके ट्रेल करना, ठीक है। अभी भी रेंज के अंदर ये ब्रेक करने की कोशिश जरूर कर रहा है, बट ब्रेक नहीं कर पा रहा है। बाकी नेचुरल गैस भी आ गया है, वो वहीं पर थोड़ा बहुत रुकने की कोशिश कर रहा है इस पर्टिकुलर जोन पे। वापस ऊपर जाता है, वापस सेल कर सकते हैं। नीचे यहाँ पर एक सपोर्ट है, देन दिस इज अ सेकंड सपोर्ट एरिया। कैंडल का ध्यान रखना, ओपन इक्वल टू हाई में बाय मत करना।
Now that we can deliver them through the ETF wrapper that is intraday liquid, that is transparent, that is tax efficient, that comes at an attractive price point, that starts to be a real game changer for us.
For the individual investors, is there sort of an education arc that's needed, at least if not for them, certainly with the advisors that are selling it?
Yeah, absolutely.
Yeah.
And that's another big part of the Innovator team.
440 का कॉल आपने बाय किया 26.60 पे 2 लॉट, एंड 440 का पुट ऑप्शन भी बाय किया है। दोनों बाय किए सेल किया यार, थोड़ा कंफर्म कर दो एक बार, बिकॉज दोनों कैसे बाय कर लिया मैं समझा नहीं। कॉल ही बाय कर लिया, पुट ही बाय कर लिया, बाय करें दोनों, या मैं दोनों में क्या बताऊं आपको, दोनों क्यों बाय कर लिया आपने? पुट बाय करना चाहिए था, कॉल क्यों बाय कर लिया? एक सेकेंड, 440 का कॉल है ना। आई होप करंट एक्सपायरी में होगा नेचुरल गैस का 23 दिसंबर का। 440 कॉल ऑप्शन, $440 का कॉल 26 जस्ट अभी बाई किया क्या? देखो यहाँ पर कोई सपोर्ट नहीं था, यहाँ पर बाई करना तो नहीं चाहिए था। पुल बैक वैसे एक्सपेक्टेड है, आना चाहिए वापस डे हाई के आसपास तक। यहाँ पर एक पुल बैक वापस आ सकता है, तो उसमें अगर कॉस्ट टू कॉस्ट पे या थोड़े प्रॉफिट में आए तो निकल जाना। बीच में एंट्री मत किया करो, बीच में पुट क्यों ले रहे हो, सॉरी कॉल क्यों ले रहे हो। बाकी पुट का प्रॉफिट बुक कर लो या फिर हाफ प्रॉफिट बुक करके एसएल कॉस्ट पर रख लो पुट में तो। बाकी आपका 440 का कॉल 26.60 चल रहा है ना, ऑलरेडी प्राइस अभी 25.7080 के आसपास चल रहा है, तो इसमें एसएल भी रख लेना, ऐसा ना कि बिल्कुल ये कॉल में होल्ड करके बैठे हो फिर यहाँ से एक्सपेक्ट कर रहे हो कि पुल बैक आएगा फिर यहाँ मैं निकलूंगा। ठीक है, पुल बैक एक्सपेक्टेड है, इसका मतलब ये नहीं कि पुल बैक बस वहीं से जाता है हमेशा, हो सकता है पूरा टारगेट ही दे दे पहले गिरते गिरते प्राइस यहाँ तक और उसके बाद फिर होल्ड करे। तो अपना हाफ प्रॉफिट पुट में तो हाफ प्रॉफिट बुक करके ही ट्रेल करो रिमेनिंग क्वांटिटी। बाकी एक साथ बाय मत किया करो दोनों, सेल किया होता तो चलो फिर भी समझ में आता कुछ कि कुछ ट्राई कर रहे हो। बाकी जो पुट है उसमें प्रॉफिट बुक करना चाहो कर लो, नहीं तो हाफ प्रॉफिट बुक करके एसएल कॉस्ट पर रख सकते हो।
Be absolutely explosive.
All right. Well, it's interesting to see the evolution, kind of what they built there, and now what you're the baton that you're taking up, Brian Lake, their partner and chief transformation officer at Goldman Sachs Asset Management. When we come back, we're going to talk about the battle for Warner Brothers Discovery heating up as the parent company of HBO and CNN asking potential buyers those deals you put on the table, you need to sweeten them just a little bit. That conversation coming up after the break. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Time now for our top calls, the big movers on the back of analyst recommendations. Let's start with Beta Technologies. Analysts initiating coverage on the electric aircraft maker that went public just last month. Morgan Stanley among the chorus, starting coverage with an overweight and a $34 target. The analysts likening Beta to a, quote, young Tesla, but with a more attractive end market in aerospace. That stock today actually down for the 10th time in the past 19 sessions since it IPO'd. Next up, Toast. BNP Exane upgrading the retail payments platform to outperform with the price target of $40, saying despite rising competition, Toast can actually still grow in its core U.S. restaurant market. Those shares up for a third straight day. And finally, Zscaler. Bernstein downgrading to market perform and setting the price target at $264, saying Zscaler's luster has worn off due to uncertainty around growth persistence. Those shares, though, looks like they're down about 3% here on the day, and those are some of our top calls. Let's turn now to Warner Brothers Discovery. Keep an eye on their shares as the media heavyweight said to be awaiting sweetened offers for that deal to potentially buy the company out. Jason Bazinet joining us right now to talk a little bit more about it. Managing Director over at Citigroup. Jason, we've seen some of the bids already, or at least we've seen reports of some of those bids. Do you think we're going to see a meaningful increase in those bids this week and beyond?
Well, I think it depends how you define meaningful. I think we'll probably get a few extra bucks. That's my guess. I mean, this is a very scarce asset. It has some very attractive assets that would help a lot of these companies. And so I think you can probably add a few bucks to the likely outcome if you're a Warner Brothers shareholder.
Well, Jason, I like the way that you broke down how to think about the potential suitors here in your note. You know, there are nice to haves and there's must to haves. So you think about the cast of characters that we're talking about. Paramount, for them, this is a must have acquisition. Talk to us about why.
Well, going back to 2019, we saw quite a bit of media consolidation. And I don't think there's been enough consolidation that's allowed any of the incumbent media companies to really take on Netflix. What Paramount Skydance did is it sort of, I would describe them as being sort of half pregnant in the DTC space. You know, they're not subscale relative to traditional media, but they are subscale relative to Netflix. And what the buy side's been clamoring for is another round of consolidation to hopefully give somebody enough oomph, enough content spend, if you will, to have enough content on that app to keep churn down, to keep gross ads aloft, to begin to drive towards what I call the true pay TV substitute, which is what Netflix is. All the other DTC apps, whether it's Paramount or Max or Peacock, I just think of them the way consumers thought of HBO in the old linear days. You go on for a particular show, and you watch that show, and then you churn off. And that's the world most of these DTC apps are in. They need to get enough scale to become a true pay TV substitute.
Well, that gets to the idea, too, of like who ends up winning this. I mean, to a certain extent, I look at Netflix and I think, why even go through the hassle? And then I look at Paramount, Jason, and I just want to be honest here. Is there any realistic possibility anyone gets this other than Paramount? I don't mean just on price, but given the connections to the Trump administration and obviously the antitrust regulators that would have to sign off on this deal, I would think they would have a serious leg up over the other potential bidders.
Yeah, I think that's true. I think, I don't think any of these potential suitors have insurmountable regulatory risks, but I think it's certainly going to be easier for Paramount to get the deal done with less regulatory review. I think what it comes down to is you could face a possibility where Warner Brothers shareholders, or the board opts to sell for a smaller premium with a greater likelihood of sort of the deal going through relatively easily. That I think is certainly possible. I've seen it in the past with other deals where they've sold, where they've accepted less than the highest bidder because of lower regulatory risks.
Yeah, it'll be interesting to see how this shakes out. Jason, we only have about 30 seconds left with you or so, but let's quickly talk about what sort of premium we could be talking about here. Warner Brothers shares right now trading just below $24 a share. What do you think that ends up?
Yeah, I think we've sort of penciled in going back to early October, 23 to 28 is probably the range where we come out. The reason it's a wide range is we did the normal customary premium. We did the share in the synergies that we anticipate, which is about $3 billion a year. And then you get into this X factor of what is the scarcity value of the asset. And that we think that can range from $2 to $6. And so when you put all that math together, if you have a low scarcity premium, you end up at 23.
Right.
If you end up with a higher scarcity premium, you get up to 28.
All right, Jason, great to get some time with you. That is Jason Bazinet, Managing Director over at Citi. Coming up, it's all about Black Friday. This is Bloomberg.
Friday.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
It was another record-breaking Black Friday weekend. We saw about $6.2 billion in sales for Black Friday. That's up about 25% from last year. We saw peak sales of $5.1 million per minute on Friday. That happened around noon on Friday. That's up from $4.6 million last year as well.
The president of Shopify speaking on Bloomberg earlier today about the, quote, record-breaking Black Friday sales here at 3:30 p.m. in New York City. And Katie, I don't know if you had a chance to look at some of the sales stuff, but when you see these numbers, I mean, there's two issues. First question is, are they inflation adjusted?
Right.
But also, like, what are we really talking about in terms of sales? Are people really going out there and buying gifts, or are they just buying for themselves? What's the complexion of the spending?
That's the big question, right? Behind the dollar value alone, what actually are people buying, and what does it say about the state of the economy? I will say it's interesting with Shopify. You can see shares down nearly 5% right now, as we heard. Record-breaking Black Friday for them, but that 25% growth in merchant sales that they saw actually lagged the consensus expectations. So you pile on high expectations on top of that, and certainly there's a lot to sort through here.
Yeah, absolutely.
Well, let's keep this conversation going now, because according to Bloomberg Intelligence, Shopify is Klaviyo's largest platform, representing close to 80% of annual recurring revenue. And joining us for more on this and the overall health of the retail and payment space, I'm pleased to say, is Andrew Bialecki. He is the CEO over at Klaviyo. Andrew, great to have you with us. So give us some color. What did you see on Black Friday? And not just Black Friday, the weeks preceding it, and of course, the weekend too, which is lumped into that group overall.
Yeah, thanks for having me. So Klaviyo serves over 180,000 businesses around the world. We act as a CRM for consumer businesses. You can think of great brands like Glossier, Away, Mattel. And I'll give you three themes we've seen. So the first is, like you said, record-breaking. Through Klaviyo's platform, just on Black Friday, the businesses that we served did over $1 billion in sales attributed back to our platform. That's the first time ever. That's up like similar to what you're talking about, about 25, 26%. And we're seeing an increase in repeat buyers. We've also had 20,000 businesses set a record on their best sales day ever on Black Friday, and I think we're going to have a lot more set records today. The two other themes are we're seeing consumers really demand better experiences from businesses. So we're excited for brands like Beyond Yoga that are now using our customer agent so that when you visit that website, you can use AI to chat with the brands and help find the right product, whether it's for yourself or for somebody else, to fit a budget. And then the last thing is that, the state of consumer is pretty strong. When it comes to discounting, we actually saw a lot of brands not discount as heavily early in the holiday season. And actually, instead, they leaned into, kind of more, interesting product drops. So, for example, Mattel, a great Klaviyo customer, they set up a member-first sale for some of their new Hot Wheels around the Stranger Things launch on Netflix, and that, sold through really well. So I think we're seeing that instead of discounting, people are also just using special access or special experiences to drive demand.
I'm curious, Andrew, with regards to the types of consumers that have been shopping, what's sort of like the conversion? I mean, so for example, when I go and shop on Black Friday, I see a deal. Am I going to the retailers and e-commerce companies that I normally go to, or am I going to a place maybe that I've never shopped at before and I've been sort of tantalized by, the % off that they're offering me?
Yeah, it's a great question. So we mentioned like not quite as much discounting as in past years. Another thing is we're seeing a slight uptick. When we look at that, $1 billion in sales that businesses drove through Klaviyo on Friday, a lot of that is from repeat buyers. So we're seeing more repeat buyers. Consumers are going back to brands that they already know, whether they're shopping for themselves or a friend or a family member. Another thing is we're seeing buyers be more considered. So product views. So you think about the amount of consideration before people buy. That's up 37% year on year. So we're seeing a lot more browsing behavior. People are trying to understand products better before they're buying them. And then in terms of categories, we've seen two categories that have sort of paced the field this year. Health and beauty, so probably people shopping both for themselves and for others. That was up over 12%. And apparel was up almost 12% year on year.
Interesting. And I mean, I wonder if this fits into what we were hearing from the likes of Home Depot and Lowe's, that folks are less willing to spend on big purchase, big ticket items here. And you think about health and beauty in particular, it's often thought of as sort of an affordable luxury. Andrew, I wonder if that fits into that sort of narrative, or does that not quite match with what you're seeing across your categories?
We work with a lot of health and beauty brands, as well as some, home improvement businesses. I think a trend across all of them is, when folks are more budget conscious, they're looking for that brand to deliver more than just the products, but also a great experience. And that's why we're seeing a lot happen with AI. People are using AI now when it comes to marketing, for message personalization, say timing or content. And then I also mentioned on the customer service side, something that we at Klaviyo are happy to stitch together is they want businesses that know who they are. And so maybe if they are trying to fit a budget, they can find the exact right product or kind of maximize that value. Yeah. And they're able to do that now through conversational AI that's happening, with these brands. One of the trends we're really excited about is AI is both where people are starting their searches, say on ChatGPT and others, but it's also where they're ending their searches. They're leveraging AI that businesses themselves are providing and using that to decide which products to buy and make buying decisions in a way that just in the past, for most retailers, it was just whatever you find and you decide you want, that's kind of the end of the shopping experience. I think that's changing in a pretty dramatic way this holiday year.
All right, Andrew, great insights. Always appreciate it. Andrew Bialecki, the CEO over at Klaviyo. We keep the conversation going right now with Mari Shore, Senior Equity Research Analyst over at Columbia Threadneedle. And Mari, I am curious. I mean, we talk a lot about what consumers are spending and what they're willing to spend. I'm curious as to your thoughts how prepared retailers were for this holiday season, particularly given we spent all year long talking about tariffs and how that was going to disrupt supply chains and inventories and the like. Were they ready for this moment this weekend?
Yes, thank you for having me. I think the retailers were absolutely ready for this holiday and, in fact, positioned pretty conservatively into holiday. I think for the majority of the year, we've seen strength in categories like apparel and beauty that Andrew just spoke about. And even with strong current business momentum and strong Q3 results, all of the retailers took a very cautious approach into holiday. based on the anticipation of higher inflation from tariffs. So as they enter holiday, inventory and promotional levels are very healthy. And I think it's important to note they've seen a better than expected price elasticity from price increases they've taken to date. So I think, if anything, the retailers position maybe even a little too conservatively into the holiday, given the recent strength we've seen.
Well, that's really interesting to hear, Mari, the fact that maybe retailers are positioned a little bit too conservatively. Do you think that that's something we could see change over the next 4 to 5 weeks?
No, I do think the retailers are very focused on managing unit inventory levels in order to protect full price selling and margin. So I think that that behavior will continue into next year as well. But again, that's very supportive for both the top line and margin. And I think that that is a trade-off that the retailers are willing to make.
As you sort of try to assess how retail is going to sort of perform this month and really into next year, Mari, do you have a sense here of maybe who you think is going to do better than the others?
Yes, I think that we've seen better than expected results and pretty consistent trends for most of this year. There have been a couple blips, like in the month of September when it was much warmer, but overall we've seen continued strength in the online part of the business and categories like apparel and beauty. But when we think about really who the winners are in retail, I think about them in two buckets. On the one end of the spectrum, you have scale players who are offering value and convenience and are taking share. So I would put companies like Walmart, Amazon, Costco, TJX in that bucket. On the other end of the spectrum, you have brands that are executing incredibly well, that are offering great value and product. And within that bucket, I would put companies like Gap, Ralph Lauren, Tapestry, Levi, and we still think that among those two buckets, those companies will continue to take share as we move through this holiday and beyond.
All right, Mari, great stuff. Mari Shore, Senior Equity Research Analyst over at Columbia Threadneedle. A closer look here at the unofficial start of the holiday shopping season. When we come back, we're going to take a look at some of the big movers on the day. To the upside, not a lot of retailers out there. To the downside, not much there either, though you are seeing a huge downdraft in some of the vaccine makers. Moderna down 6%. It's our stock of the hour, and it's up next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Time for our stock of the hour, and we're taking a look at the biggest percentage decliner in the S&P today, and that is Moderna. The share is down after a warning that the FDA could enact new restrictions around which vaccines actually make it to market. Nora Melinda joins us right now, our Bloomberg's markets correspondent. And Nora, this gets to the idea. We should point out Moderna, obviously most famous for that COVID vaccine. Remember COVID, right?
Yes.
And of course, they were trying to sort of branch out from that, but into other vaccines as well, like flu vaccines. What exactly is the FDA talking about when they say they could sort of limit what actually makes it to market?
And that's what we're trying to really figure out right now. It's really as we're digging into the actual specifics here. I mean, they are calling out the fact that they are going to be implementing some new restrictions. They talked about 10 children passing away due to myocarditis, if I'm not mistaken. But essentially, they're talking about the fact that vaccines are linked to a lot of things that could be potentially fatal, and that's what they're really trying to limit. They're saying that they're done with the rubber stamps. We're just pushing things through and getting them approved, and they're really wanting to be a bit more critical and scrutinize a bit more what these companies are doing before they make it out to the market.
Just to be clear, as somebody who's covered the FDA for years, including sitting through a lot of PDUFA meetings, I don't think I've ever seen the FDA rubber stamp anything, but that's just my 2 cents.
Fair point there. Yeah. You're on the ground reporting there. I mean, let's talk a little bit about what this means for the space as a whole. We're spending a lot of time on Moderna. Certainly the stock is down about very deeply today. It's 8% over the past 6 months. But this would theoretically affect other vaccine makers in addition to Moderna as well.
Absolutely. It would actually affect multiple names, not just Moderna exclusively, but that is what we are seeing in terms of a lot of the pressure right now, down about 6% as we look at Moderna more broadly. But as we really see about what the stock has been doing this year, we are seeing a lot of pressure. The stock is down more than 40% so far this year. And of course, we know that's because the company spent a lot of its time on the COVID-19 vaccine. For a lot of people that weren't familiar with Moderna, that's when they kind of became familiar with the name, when they were thinking about vaccines for COVID-19. But because a lot of people aren't really going out to get those vaccines anymore, they're having to come with more creative ways to really stay profitable and to really entice, customers here in this environment. But not only that, but outside of that, we also have RFK Jr., who also has been coming in as the head of the HSS. And of course, that really has been putting a lot of pressure on the space more broadly because people see him to be a vaccine skeptic, somebody who's more critical of the space. And he's also putting a lot of people in charge that are also similarly like-minded.
Yeah, a lot of headwinds for specifically for the vaccine makers, but the industry overall when it comes to health and pharma. Bloomberg's Nora Melinda, great reporting as always.
Have you gotten a COVID shot?
I should.
I got one a couple weeks ago.
Okay.
That's good.
I got a flu shot.
Maybe it's time for me to double back.
Perhaps. This is the close.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Will December be a month to remember? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. A little bit, but we'll work through it. Let's go check on where these markets stand the first trading day of December, as Romaine alluded to. You can see the S&P 500 not certainly a gift for bulls right now, down about 0.5%. Really, you can see something similar happening in the NASDAQ 100, where all your big tech names live. I thought it was interesting to see that the bond market not getting any sort of haven bid right now. We know there was a sell-off overnight in Japanese debt that seems to have filtered through into the U.S. market as well. 10-year yields higher by about 8 basis points. And Bitcoin, Romaine, keep your eyes on Bitcoin, down another 6.7%, sitting at $85,000 a coin. Just fascinating to see where this thing will go.
Yeah, I can't take my eyes off it. Katie, I saw a stat earlier this morning showing that the S&P has rallied more than 70% of the time in the month of December, but day one of this December, not showing signs of life just yet. Clear risk aversion wafting through markets, belying that 5-day rally we had to end November, a rally that now appears to have been more technical than fundamental, a clearing out of bearish options that drove a bit of a squeeze higher in equity prices, a clearing out that may not have actually completely run its course and won't until the Fed's meeting next week.
So I think some of the position unwinds are maybe not sort of fully baked in, but then to see a bit of a rally, particularly after the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
That potential pop, though, is going to be heavily dependent on the volatility of other asset classes. U.S. Treasuries sliding today in sympathy with the bond sell-off in Japan, Katie alluded to. Added pressure also from concern about Trump's rumored pick for Fed chair, who could prove too dovish. For the moment, with inflation stuck above target, the dollar remaining weak, silver at a fresh record, and as Katie just pointed out, the ground beneath Bitcoin continuing to quake, $1 billion of leverage positions liquidated in crypto overall this Monday alone. As for the AI trade, that's also stuck in a bit of an air pocket. Bank of America strategists citing investor concern about that $500 billion or so in CapEx commitments, including how a group of asset-light, nearly debt-free software companies have now morphed into an asset-heavy, cash-draining, debt-laden business models. A Kafka-esque metamorphosis, if you will, that suggests a more meaningful de-rating potentially, Katie, in AI stocks.
So a lot to keep your eye on, but let's go back to seasonality because as Romain mentioned, the S&P 500, it tends to rally more than 70% of the time in December, but take a look at the monthly performance. Actually, over the past 10 years, the S&P 500 has averaged about 0.1% decline in December, which really speaks to the overall volatility that you tend to see in the final month of the year. Of course, seasonality is no clear guide to the future. I'll point out that you take a look at November's performance. Typically, you see a rally of more than 4%. We know that the S&P 500 was barely positive last month, Romain. So we'll have to see what history, whether or not it's actually a guide for this December. But as you mentioned, certainly the start of this month not looking too hot.
Absolutely. Joining us right now is Quay Wynn, CEO of Equities over at Research Affiliates, kicking us off to the close. And Quay, one interesting thing about this whole seasonality thing is when you look at past Decembers, very few of them had the type of run-up lead into the month that we saw this year. And I am curious about this idea of a market that it basically seems to have priced in so much of the future good news, if you will, and whether that kind of sets us up, not necessarily for a fall, but a bit of maybe a stasis or a tight trading range going forward.
Sure. There's a lot of fragility baked into markets because they are really dependent on a couple of things. The first thing being lower interest rates, and yet what we've seen is that the Fed seems somewhat divided on whether or not there'll be a rate cut in December. And the second is really just this whole AI story. How long can that go? How much further can that go?
Well, let's talk about the AI story, though. I mean, it's not. I don't think the AI story has sort of faded, but it's certainly morphed into something a little bit different. And I do wonder if the AI trade itself has sort of lost steam, or it's just that there's a rotation away from some of the big stocks that sort of got us to this point into whatever people think the new thing is going to be.
You know, definitely there's some of that, but I also think people are just sort of taking a breather. What they're seeing is that these big companies, they're spending a lot, they're investing a lot, they're actually issuing a lot more debt than they have ever done before, and they're just trying to reassess who's going to be the winner, who's not going to be as big a winner. Not everybody can be the big winner of AI.
Well, you heard Romain mention that note from Bank of America with strategists talking about those investors concerned around the fact, as you mentioned, that a lot of these tech companies are taking on a lot of debt to fund these commitments. You think about some of the blue chip names there, specifically Amazon, for example, comes to mind, and they probably have the capacity to do that. But I wonder how you think about that as, you know, you look outside of the top 7 largest companies.
Well, the top 7 largest companies are the ones that are driving the investment. And so they all have, well, not really the 7. You have to take out Tesla, you have to take out, you know, some of the smaller companies. But, you know, those 5 or 6 companies, they have fortress balance sheets. They definitely have a lot of capacity for debt. And a lot of them are investing with demand in mind. I mean, you see Microsoft talking about how they just can't fulfill all of the demand that they see, and they need to make this investment. So the way I think about it is that, you know, these companies are probably okay, but the question is what happens to, you know, the second tier players that you see. And some of those stocks, they're beginning to participate. They see a lot of pressure to also invest. You know, when you see an HPE, for example, or Oracle even, they don't have nearly as much of the strength as the Mag 7.
Yeah, absolutely. Oracle and what we're seeing in their CDS certainly comes to mind here, though. So, I mean, when it comes to the equity market, how do you invest around this? Because I'm taking a look at your notes, and you mentioned that the signs of a building bubble in AI, they're easy to identify, but the popping of that bubble, super hard to time. So what's an investor to do in an environment such as this one?
So the way we look at it is that, yes, the markets are rich, but they're not nosebleed levels. They're not what we saw in 1999. So it's hard to time. You don't really want to miss it. I think it's actually okay to own the Mag 7. I mean, these companies have magnificent earnings, they have magnificent balance sheets, and they have magnificent growth. They just probably shouldn't be 40% of your equity portfolio, right? So look outside of that, diversify into something that is less Mag 7 heavy. You can find great bargains in value stocks. You can find great bargains in small cap stocks and also non-U.S. stocks. A lot of high quality companies that are going to be participating in growth.
Also on the AI trade, but particularly when it comes to some of those other stocks, there's this idea that people are now trying to seek out sort of the beneficiaries of AI, not necessarily the folks who are selling AI tools, but the idea of those that will be using them and presumably would see some sort of productivity improvements or cost improvements, et cetera.
Yeah, sure. I mean, I think that businesses are only just beginning to really tap into that, really experiment with it, really figure out what's working and what's not. And whatever works for businesses, whatever helps businesses improve their productivity, whoever provides those tools, they're going to be big AI winners. And the businesses that use those tools themselves will also be big AI winners.
And I do also want to ask about small caps. That's an area you identify in your notes as well. It feels like we've heard a lot of bull cases for small caps in the past couple of weeks. But how can you be sure that this current bid that we're seeing, this performance that we saw in November, is something that can be sustained in 2026?
That's always a big question with small cap, right? But I think that if you approach small cap in a very selective way, we don't necessarily advocate owning all the small caps, but find the ones that are relatively inexpensive, find the ones that have strong quality metrics, and those tend to be good long-term investments.
All right, Quay, always a great conversation. Quay Wynn, CEO of Equities over at Research Affiliates, kicking us off to the close here on this Monday afternoon, the first trading day of the month, the final month of the year, and a big deal here on Merger Monday. A conversation with Brian Lake over at Goldman Sachs Asset Management and a big ETF acquisition, Innovator Capital. That conversation coming up in just a second.
And from markets to markdowns, we're giving you a full Black Friday postmortem with the CEO of Klaviyo and Mary Shore of Columbia Threadneedle Investments. We'll discuss what rang up, sold out, and fell flat for shoppers this weekend.
And Greg Schwartz, the CEO over StockX, he'll have some thoughts on that as well. He'll be stopping by to discuss the recent resale rush and where he's seen the rarest drops and biggest bids. All that and more coming up here on The Close. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We have in Singapore the state-of-the-art technology, and then we export that technology into our Meta plant in Georgia.
The Smart Factory brings software-defined manufacturing to life using digital twins, AI, and automation.
Our Meta plant was the largest investment of the company outside of Korea, at 3,000 acres, with an investment of $12.6 billion for a capacity of 300,000 cars a year.
Goldman Sachs bolstering its ETF operation, inking a deal with Innovator Capital to buy the buffer fund issuer for $2 billion. Now, buffer funds are also known as defined outcome ETFs, and they're really meant to limit downside risk in exchange for capped upside potential. Let's discuss this deal with Brian Lake. He is partner, chief transformation officer, and also the global co-head of third-party wealth over at Goldman Sachs Asset Management. Brian Lake, it's great to see you.
Those are a lot of titles, by the way.
Thank you for having me. Yeah, no, you know what I mean. Like,
I'm sure there's a few
I try to
more.
turn the lights off when I go home at night. That's kind of my job.
Well, let's talk about this deal. Certainly caused a lot of ripples in the ETF industry. And I guess my first question for you is why buy Innovator Capital? It's $28 billion worth of buffer ETFs versus try to build this out at Goldman Sachs in-house.
I mean, so much credit goes to the team at Innovator. They invented this space back in 2018. They invented defined outcome ETFs. I mean, they have a history of innovating in this space. So they build out this business. They invent the space. Over the last 7 years, they've been able to scale the business to be $29 billion. But in addition to that, they have a full suite of products that cover all the different horizons that we see across the defined outcome space. Plus, they have an incredible team, 70 individuals that are extremely talented at talking about these sophisticated strategies, working with clients and articulating these to investors and showing them how they can use them within their portfolio. So when you bring all of that together, it just makes so much sense to add it onto the platform that we have.
And let's talk about the price tag a little bit. So $2 billion, for that you get $28 billion of existing AUM. I was taking a look at the reaction piece from Bloomberg Intelligence. That's about 7% of assets. That's probably closer to private market deals than traditional products. So show us the napkin math of how you justify a $2 billion valuation.
So over the last kind of handful of years, I've been traveling around this country working with clients. And in more conversations than not, defined outcome ETFs were coming up. How do I get more income in my portfolio? How can I get targeted downside protection? What about different growth areas that I can get within my portfolios? And over time, you start to notice this pattern. There's more and more investors that are looking for better ways to build portfolios on behalf of their clients. And so when you take that, you start to see, like, wait a second, there's a massive trend here. Now, Cerulli put out research last week. They suggested the space could grow 4 to 5x over the next 5 years. And so I don't think I'll get into the napkin math, but what I will tell you is that I know investors are really excited about the strategies. You've seen it grow massively over the last 5 years, and groups like Cerulli projecting 4 to 5x growth over the next 5 years. You start to see why we're so excited about this space.
Who specifically, in terms of the end users of these funds, who specifically are those types of people? I mean, that we're talking about. Are they using this primarily as a hedge, or is this actual real sort of growth and or income opportunities, I should say?
It's a great question.
Yeah.
So step back for a second. We called it defined outcomes, which is a pretty wide space. We see income in this category, we see targeted buffer in this category, and we see growth in this category. There's a lot that's going on there. So we've seen everything from core replacement. You know, I was using the S&P 500. I want to swap that out with something that could provide a little bit more protection. We see it as an income play. I want to put this into my portfolio and it can enhance the income that I have. We see it as a bond replacement in some areas where maybe I can use this instead of bonds and it gives me a little bit more equity upside. There's also some differentiated ways where, you know, investors are starting to use this to put cash to work. Markets are still at kind of close to all-time highs. And so, you know, if an investor is starting to put money to work, do you do that right now? Or maybe this is a great way to start to leg your way into an equity position without taking on some of the downside risk. And so I think that this is going to absolutely change the way that we think about portfolio construction over the next 5 years. We're seeing this both on the retail side and on the institutional side. Institutions have been using strategies like these for a long time. Now that we can deliver them through the ETF wrapper that is intraday liquid, that is transparent, that is tax efficient, that comes at an attractive price point, that starts to be a real game changer for us.
For the individual investors, is there sort of an education arc that's needed, at least if not for them, certainly with the advisors that are selling it?
Yeah, absolutely.
Yeah.
And you know, that's another big part of the innovator team. I mean, they're experts at having those conversations, and we really want to embrace that. I mean, we want to lead with solutions. We want to lead with this is how these are going to work within your portfolios. It's important that you own it point to point. There's different ways that these are going to move out there. But once you understand how those work, then you can really enhance what you're doing within your portfolios.
So this news in and of itself is exciting, but the natural next question, Brian, is what's next? I mean, could we go out and see GSAM buy more companies, more areas in terms of white space where maybe GSAM doesn't have that presence?
So let's think about what happens with a transaction. You really need to get some things that are very aligned. First of all, when we think about Goldman Sachs and Innovator, our firms have very similar cultures. We wake up client-obsessed every single day. If you talk to the founders of Innovator or any person over there, they wake up thinking about the clients. When you talk to anybody at Goldman Sachs, we wake up thinking about our clients. So that's number one. Number two is Innovator has developed this space, like we talked about earlier, that is differentiated across anything else in the market right now. And so it's bringing differentiation to clients, which is something that Goldman's focused on as well. This fits perfectly alongside our direct indexing capabilities, our evergreen alternatives capabilities, and indeed our organic active ETF strategy as well. And so when you combine those things, it becomes really special. Now, that's a pretty high bar. And so to think that we're going to be able to find something else like that out there, I don't know. We'll look, but we're really confident in our organic strategy and what we're doing right now.
And just a fun fact, it's probably worth pointing out that, of course, you know the co-founders of Innovator well. Bruce Bond, I believe, gave you one of your first jobs at PowerShares.
Yeah, Bruce hired me into the industry a number of years ago. I think I was the 12th employee at PowerShares. And, he's got an incredible track record of, hiring good talent, myself aside. He's built some really good talent there. He's innovated in this industry for years. He brought the first smart beta strategies before we even called them smart beta. And this is just another one of those things that he and John Southard and the rest of the team over at Innovator have been able to accomplish. And, so that's why we feel so aligned, that existing relationship that Goldman has had with Bruce and the Innovator team. And so coming together, we feel really good about that. Obviously we're bringing on all 70 of the employees to be full-time Goldman Sachs employees. We don't plan on changing anything as far as their sub-advisors or some of their service providers. We're just providing a massive tailwind to this business because we think the growth over the next 5 years and beyond is going to be absolutely explosive.
All right. Well, it's interesting to see the evolution, kind of what they built there, and now what the baton that you're taking up, Brian Lake, their partner and chief transformation officer at Goldman Sachs Asset Management. When we come back, we're going to talk about the battle for Warner Brothers Discovery heating up as the parent company of HBO and CNN asking potential buyers, those deals you put on the table, you need to sweeten them just a little bit. That conversation coming up after the break. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We don't see the robots taking over the jobs from humans. We try to make the job of the humans easier and to have more technical people that are really controlling the robots and especially improving the quality by utilizing those technologies. We have already deployed a first phase of robotics through Boston Dynamics, and we are working on the next phase on how can we facilitate the job of the workers.
Time now for our top calls, the big movers on the back of analyst recommendations. Let's start with Beta Technologies. Analysts initiating coverage on the electric aircraft maker that went public just last month. Morgan Stanley among the chorus, starting coverage with an overweight and a $34 target. The analysts likening Beta to a, quote, young Tesla, but with a more attractive end market in aerospace. That stock today actually down for the 10th time in the past 19 sessions since it IPO'd. Next up, Toast. BNP Exane upgrading the retail payments platform to outperform with the price target of $40, saying despite rising competition, Toast can actually still grow in its core U.S. restaurant market. Those shares up for a third straight day. And finally, Zscaler. Bernstein downgrading to market perform and setting a price target at $264, saying Zscaler's luster has worn off due to uncertainty around growth persistence. Those shares, though, looks like they're down about 3% here on the day, and those are some of our top calls. Let's turn now to Warner Brothers Discovery. Keep an eye on their shares as the media heavyweight said to be awaiting sweetened offers for that deal to potentially buy the company out. Jason Bazinet joining us right now to talk a little bit more about it. Managing Director over at Citigroup. Jason, we've seen some of the bids already, or at least we've seen reports of some of those bids. Do you think we're going to see a meaningful increase in those bids this week and beyond?
Well, I think it depends how you define meaningful. I think we'll probably get a few extra bucks. That's my guess. I mean, this is a very scarce asset. It has some very attractive assets that would help a lot of these companies. And so I think you can probably add a few bucks to the likely outcome if you're a Warner Brothers shareholder.
Well, Jason, I like the way that you broke down how to think about the potential suitors here in your note. You know, there are nice to haves and there's must to haves. So you think about the cast of characters that we're talking about. Paramount, for them, this is a must-have acquisition. Talk to us about why.
Well, going back to 2019, we saw quite a bit of media consolidation. And I don't think there's been enough consolidation that's allowed any of the incumbent media companies to really take on Netflix. What Paramount Skydance did is it sort of, I would describe them as being sort of half pregnant in the DTC space. You know, they're not subscale relative to traditional media, but they are subscale relative to Netflix. And what the buy side's been clamoring for is another round of consolidation to hopefully give somebody enough oomph, enough content spend, if you will, to have enough content on that app to keep churn down, to keep gross ads aloft, to begin to drive towards what I call the true pay TV substitute, which is what Netflix is. All the other DTC apps, whether it's Paramount or Max or Peacock, I just think of them the way consumers thought of HBO in the old linear days. You know, you go on for a particular show and you watch that show and then you turn off. And that's the world most of these DTC apps are in. They need to get enough scale to become a true pay TV substitute.
Well, that gets to the idea, too, of like who ends up winning this. I mean, to a certain extent, I look at Netflix and I think, why even go through the hassle? And then I look at Paramount, Jason, and I just want to be honest here. Is there any realistic possibility anyone gets this other than Paramount? I don't mean just on price, but given the connections to the Trump administration and obviously the antitrust regulators that would have to sign off on this deal, I would think they would have a serious leg up over the other potential bidders.
Yeah, I think that's true. I think, you know, I don't think any of these potential suitors have insurmountable regulatory risks, but I think it's certainly going to be easier for Paramount to get the deal done with less regulatory review. I think what it comes down to is you could face a possibility where Warner Brothers shareholders, you know, or the board opts to sell for a smaller premium with a greater likelihood of sort of the deal going through relatively easily. That I think is certainly possible. I've seen it in the past with other deals where they've sold, where they've accepted less than the highest bidder because of lower regulatory risks.
Yeah, it'll be interesting to see how this shakes out. Jason, we only have about 30 seconds left with you or so, but let's quickly talk about what sort of premium we could be talking about here. Warner Brothers shares right now trading just below $24 a share. What do you think that ends up?
Yeah, I think we've sort of penciled in going back to early October, 23 to 28 is probably the range where we come out. The reason it's a wide range is we did the normal customary premium. We did the share in the synergies that we anticipate, which is about $3 billion a year. And then you get into this X factor of what is the scarcity value of the asset. And that we think that can range from $2 to $6. And so when you put all that math together, if you have a low scarcity premium, you end up at 23.
Right.
If you end up with a higher scarcity premium, you get up to 28.
All right, Jason, great to get some time with you. That is Jason Bazinet, Managing Director over at Citi. Coming up, it's all about Black Friday. This is Bloomberg.
Friday.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Today was another record-breaking Black Friday weekend. We saw about $6.2 billion in sales for Black Friday. That's up about 25% from last year. We saw peak sales of $5.1 million per minute on Friday. That happened around noon on Friday. That's up from $4.6 million last year as well.
The president of Shopify speaking on Bloomberg earlier today about the, quote, record-breaking Black Friday sales here at 3:30 p.m. in New York City. And Katie, I don't know if you had a chance to look at some of the sales stuff, but when you see these numbers, I mean, there's two issues. First question is, are they inflation adjusted?
Right.
But also, like, what are we really talking about in terms of sales? Are people really going out there and buying gifts, or are they just buying for themselves? What's the complexion of the spending?
That's the big question, right? Behind the dollar value alone, what actually are people buying, and what does it say about the state of the economy? I will say it's interesting with Shopify. You can see shares down nearly 5% right now, as we heard. Record-breaking Black Friday for them, but that 25% growth in merchant sales that they saw actually lagged the consensus expectations. So you pile on high expectations on top of that, and certainly there's a lot to sort through here.
Yeah, absolutely.
Well, let's keep this conversation going now, because according to Bloomberg Intelligence, Shopify is Klaviyo's largest platform, representing close to 80% of annual recurring revenue. And joining us for more on this and the overall health of the retail and payment space, I'm pleased to say, is Andrew Bialecki. He is the CEO over at Klaviyo. Andrew, great to have you with us. So give us some color. What did you see on Black Friday? And not just Black Friday, the weeks preceding it, and of course, the weekend too, which is lumped into that group overall.
Yeah, thanks for having me. So Klaviyo serves over 180,000 businesses around the world. We act as a CRM for consumer businesses. You can think of great brands like Glossier, Away, Mattel. And I'll give you three themes we've seen. So the first is, like you said, record-breaking. Through Klaviyo's platform, just on Black Friday, The businesses that we served did over $1 billion in sales attributed back to our platform. That's the first time ever. That's up like similar to what you're talking about, about 25, 26%. And we're seeing an increase in repeat buyers. We've also had 20,000 businesses set a record on their best sales day ever on Black Friday, and I think we're gonna have a lot more set records today. The two other themes are we're seeing consumers really demand better experiences from businesses. So we're excited for brands like Beyond Yoga that are now using our customer agent so that when you visit that website, you can use AI to chat with the brands and help find the right product, whether it's for yourself or for somebody else, to fit a budget. And then the last thing is that, the state of consumer is pretty strong. When it comes to discounting, we actually saw a lot of brands not discount as heavily early in the holiday season. And actually, instead, they leaned into, kind of more, interesting product drops. So, for example, Mattel, a great Klaviyo customer,
Hey guys, क्रूड ऑयल में यूएस मार्केट तो ओपन हो गया है. ओपन होते ही टारगेट मिल गया, इसमें बुक कर सकते हैं. ठीक है, यहाँ से एक बाइंग का ट्रेड देखते हैं, थोड़ा सा वेट करना, बाकी बुक कर लेना. 8 PM की कैंडल, यहाँ से अब एक बाइंग. वैसे अगर ये थोड़ा सा लिक्विडिटी नीचे की भी ले ले तो बेटर है मेरे अकॉर्डिंग. यहाँ पर ना इसमें एक सपोर्ट इधर भी है यहाँ पर, बट ये भी सपोर्ट है. 2 बार तो ले लिया सपोर्ट इसने यहाँ पे. दिस इज द थर्ड टाइम. बाकी नेचुरल गैस भी साइडवेज ही लग रहा है, अभी इस रेंज के अंदर गया नहीं, ब्रेकडाउन करके रेंज बाउंड हो गया ये. लगता है देखो क्रूड ऑयल में इस जिस पर्टिकुलर लेवल पे अभी है ना, यहाँ से अगर थोड़ी क्वांटिटी लेने की सोच रहे हो तो ज़्यादा मत लेना, क्योंकि देखो अब सपोर्ट भी ऊपर नियर बाई है. ये सपोर्ट ब्रेक हो गया, हो सकता है ये भी एज अ रेजिस्टेंस काम करे, फिर हम वो नहीं चाहते. जो उनसे थोड़ी सी क्वांटिटी कम ही लेना, ब्रेक भी हो सकता है ये. 3 बार तो आ गया इस लेवल पे, फर्स्ट, सेकंड, थर्ड, फोर्थ.
as well as some, home improvement businesses. I think a trend across all of them is, when folks are
नेचुरल गैस इन्वेंट्री आज नहीं है, आज नहीं आती इन्वेंट्री नेचुरल गैस की फ्राइडे को, थर्सडे को आएगी ना. क्रूड ऑयल की वेडनेसडे को आती है, नेचुरल गैस की इन्वेंट्री थर्सडे को आती है. इन्वेंट्री आज नहीं है. देयर इज नो डेटा शेड्यूल फॉर टुडे.
are happy to stitch together is they want businesses that know who they are. And so maybe if they are trying to fit a budget, they can find the exact right product or kind of maximize that value.
Yeah.
And they're able to do that now through conversational AI that's happening, with these brands. One of the trends we're really excited about is AI is both where people are starting their searches, say on ChatGPT and others, but it's also where they're ending their searches. They're leveraging AI that businesses themselves are providing and using that to decide which products to buy and make buying decisions in a way that just in the past, for most retailers, it was just whatever you find and you decide you want, that's kind of the end of the shopping experience. I think that's changing in a pretty dramatic way this holiday year.
All right, Andrew, great insights. Always appreciate it. Andrew Bielecki, the CEO over at Klaviyo. We keep the conversation going right now with Mari Shore, Senior Equity Research Analyst over at Columbia Threadneedle. And Mari, I am curious. I mean, we talk a lot about what consumers are spending and what they're willing to spend. I'm curious as to your thoughts how prepared retailers were for this holiday season, particularly given we spent all year long talking about tariffs and how that was going to disrupt supply chains and inventories and the like. Were they ready for this moment this weekend?
Yes, thank you for having me. I think the retailers were absolutely ready for this holiday and in fact positioned pretty conservatively into holiday. I think for the majority of the year, we've seen strength in categories like apparel and beauty that Andrew just spoke about. And even with strong current business momentum and strong Q3 results, all of the retailers took a very cautious approach into holiday. Based on the anticipation of higher inflation from tariffs. So as they enter holiday, inventory and promotional levels are very healthy. And I think it's important to note they've seen a better than expected price elasticity from price increases they've taken to date. So I think, if anything, the retailers position maybe even a little too conservatively into the holiday, given the recent strength we've seen.
Well, that's really interesting to hear, Mari, the fact that maybe retailers are positioned a little bit too conservatively. Do you think that that's something we could see change over the next 4 to 5 weeks?
No, I do think the retailers are very focused on managing unit inventory levels in order to protect full price selling and margin. So I think that that behavior will continue into next year as well. But again, that's very supportive for both the top line and margin. And I think that that is a trade-off that the retailers are willing to make.
As you sort of try to assess how retail is going to sort of perform this month and really into next year, Mari, do you have a sense here of maybe who you think is going to do better?
Stocks are staging a rebound. Final 10-year government bond auction of the year expected later this hour. Yields are surging. As speculation grows, the BOJ may hike interest rates soon. A Markets Live strategist, Mark Cranfield, is calling this a global bond event coming amid a major bond sell-off across major developed economies. To break it all down, let's bring in Mark. Also joining us is cryptocurrency reporter Subhashri Ghosh. Mark, well, seems like no end to this sell-off. What are you anticipating?
It's going to be an extremely difficult day for people in the Japanese market. Yields have been rising pretty quickly. As you mentioned, it's been partly spurred by the fact that Governor Ueda yesterday pretty much made it an almost certainty that the Bank of Japan will raise interest rates this month. And when you listen to the politicians who've spoken today, particularly the finance minister, they seem to endorse that as well. So it seems to be full steam ahead for an interest rate hike in December. The problem is that it's coming at a time when Japanese investors really wanted to see the Bank of Japan even look forward into 2026 and be more committed to getting the interest rate to a neutral zone. Now, even if they raise interest rates this month, that's only 0.75 with the inflation rate running at 3%. So you can see still very negative yields in Japan. We've also got the 10-year yield around about 188 today, but heading towards that 2% area, which is where you may expect long-term investors to come in. So they may well wait for that rather than today's auction. On top of that, in 2 days' time, we have a 30-year JGB auction. And just today, 30-year yields hit a record high since the issuance of JGB. So you can see from the Japanese point of view, things are not going that well. On top of that, externally, we've had massive corporate issuance in the US that's pushing up the yield curve in America. They're expecting the Federal Reserve to come in and steepen the curve further by lowering interest rates this month and possibly with the new FOMC chairman into next year. All in all, it's a very difficult time for fixed income markets, and JGBs are right at the center of it.
You got to wonder where demand will come from. As you suggested earlier, I mean, they're unlikely to be buyers until 10 years get to 2%.
Yeah, they really will be looking to their domestic base. The life insurance companies in Japan have a long history of buying bonds, particularly the longer duration ones. 10-year is not especially attractive for them, but at 2%, maybe that is. Maybe that's the kind of target where they will finally put it into their portfolios. But getting there could still be pretty ugly. It could cause a lot of pain, particularly as they might want to see that before the end of the year. So these are pretty rapid by the standards of Japanese markets. These are unusually rapid and disconcerting moves. And it's going to be pretty edgy between now and that Bank of Japan meeting, which is still 2 weeks away.
And also for the overall bond market, Mark, it is about the Fed. I mean, expectations are that it will move in December. The question is, what happens after that? That's a lot to do with, you've got the yield curve, the risk of steepening in the yield curve because
There's a lot of investors who don't think that the Fed shouldn't really be lowering interest rates so aggressively when it's uncertain what the path for inflation is in the United States, particularly because there's a big fiscal boost going on here. So our colleagues in London have been writing about this, saying that fiscal stimulus is pretty strong here. It's the strongest since Janet Yellen was the Treasury Secretary. They're ramping up spending, a lot of issuance of Treasury bills at the short end of the curve. So there's immense liquidity in the US market. That's not great for the long end of the Treasury curve. So that will unnerve investors there as well. That will spill over to the European markets as well, as we've seen. So there's a lack of conviction that Treasuries are really a good store of long-term value. And it's a bad timing for it to come in the fourth quarter when people are trying to assess their portfolios going into next year. So all in all, the Fed's job is very difficult. Lowering interest rates and trying to convince people that the curve doesn't need to steepen is going to be a very hard sell. Jerome Powell will be treading a very careful path. At the same time, he knows that he won't be chairman for too much longer. A new person is going to be announced pretty soon.
And Subhashri, let's get you into this conversation. A lot of pain in the crypto space as well. Cryptocurrencies wiping out about $1 billion of leveraged positions. That is just on Monday alone.
Indeed, it is, Has. And as you rightly said, a lot of pain. And the sentiment continues to be quite bearish and cautious in the crypto market. We have seen some recovery overall in the last few hours. But again, this recovery doesn't look like convincing. We are not really seeing a lot of dip buying or value buying that traders say. On the lower end, flows have been quite slow and sluggish, which really means that the conviction is missing. We can see an index called Fear and Greed Index in crypto, which is at 23, denoting that there is extreme fear in the market. That again shows to the kind of mood that traders are when they have, as you rightly said, sold their levered positions worth $1 billion and sitting almost on liquid cash.
And when you take a look at Bitcoin, that level we're looking at for is 80,000 and inching ever closely to that.
Indeed, it is, and that's the key level that a lot of traders have cited to us as a big way that. After that, if you break through $80,000, then it can sharply fall downwards. Before that, there are some other support levels as well, like $82,000, and even before that, $85,500 on the Bitcoin. Those are the key kind of technical support levels that traders are watching. But yes, the mood is pretty much so bearish that we can't rule out an $80,000. That's at least one key level that traders are looking at. Yes, you're right.
And Mark, of course, the massive sell-off we're seeing in cryptocurrencies impacting risk sentiment as well, isn't it?
It is, but I think it probably got a little bit exaggerated during Monday's session, partly because it was happening in Asia when people were a little bit skittish after the weekend. So you could see by the time we got into US trading yesterday, American equities are much more stable. They started to recover. They ended down, but well off the worst periods of the day. If you look at the Bitcoin in particular, really started tumbling from about September, and yet S&P 500 has made several new highs since then. So really the big picture impact of cryptocurrencies on US equities is getting smaller all the time. It doesn't mean to say that you can't get worried about it on a very short-term basis. If we do get sharp sell-offs in Bitcoin and other cryptocurrencies, it can hurt sentiment. But really, people are pretty steady. They're sure that the US market has enough liquidity in the equity space that we're probably going to grind higher in towards the end of the year. So it would need a really dramatic, maybe a 10% plus sell-off on one day for the major cryptos to really hurt equity markets before year end.
Markets Live strategist Mark Cranfield and crypto reporter Subhashri Ghosh, thank you so much for your time today. Let's get more market insights. Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC. Selena, it feels like it is risk-off, but there's so much liquidity out there that could still be a rally at the end of the year.
Well, I think if you look back in the context of what has happened in the last 11 months, we've been through this roller coaster ride with Liberation Day, and then markets came back quite strongly after that because they figured, well, if the Fed's cutting rates, more central banks got room to ease monetary policy, so liquidity is going to be ample. But now we are approaching end of the year. It's been a very good year for a lot of risk asset classes. I think it wouldn't surprise me, if we get a bit more volatile market swings from here because people will be looking to take some money off the table.
So it's just a case of taking money off the table and not to do with risk, or how are you assessing that risk sentiment, risk appetite out there?
Well, I think if you look at the overall macro backdrop, people's kind of like settled on this rough Goldilocks type of scenario, right? We didn't have a US recession. Tariffs have come on their initial high levels. There is a trade truce between US and China. So what could go wrong, right? US president said he's solved so many wars. So, really, you're looking for the curveball up here. But generally, at this point in time, markets kind of like gotten a little bit more comfortable with the front and center headline risk. And they think that, barring any nasty surprises, it's going to be a slow grind down into the new year. I mean, we're coming off a very high base, of course.
There's been a lot of momentum and a lot of FOMO, fear of missing out. You see a lot of retail investors getting in the equity space, and now retail investors are getting into the bond space, the corporate bond space. Surely that is a sign to worry. I mean, when it comes to herd mentality, when people get in, you get out.
Yeah, so typically, you separate between the smart institutional investors and the retail money being the last ones to get in the party when it's winding down, and you worry about who's going to be last out of the door. But I'm not sure whether this time around that exact scenario will play out in the traditional way, partly because we have seen the way, central banks have evolved, right? In the past, they used to be the lender of last resort. These days, they tend to tremble and be the lender of first resort at any sign of emerging crisis, right? Just look at what happened with SVB, what happened with the private credit market shakeout earlier this year. So I think, we've gotten a point where a lot of the guardrails are already in place, so we will have market volatility, but I think it will take a really nasty surprise, to bring the whole deck of cards down.
So what do you do? Let's start with the bond market. Some suggesting that EM's the place to be, not DM's. There's been a reversal of fortune somewhat because they've gotten the house in order.
Well, I always say that ASEAN in particular has a stability premium, right? If you look at the macroeconomic conditions, growth is relatively stable, even though it's slowing. They've had a renewed tourism inflow. Inflation is fairly muted. Most of the Asian central banks are done or close to the bottom of their easing cycle. There is still a lot of wealth that's coming into this region. The China plus 1 plus 2 plus 3 story is still in our favor. And then in a very, very volatile world where there's US tariffs and, you're not sure where to put your money, and if the Fed is going to be cutting rates very aggressively next year with the new Fed chair, then Asian bond markets do look particularly attractive, especially in local currencies.
Well, the thing is, there's always been that promise of, the EM market, making a comeback. Is it different this time around? Are you actually seeing flows? Are people actually putting money, in the space?
I think if they're feeling worried about the longer-term dollar prospects and U.S. policy uncertainty, diversification makes sense. Then it's a question of where do you go for that diversification. So at this juncture, people are still a little bit concerned about the recovery prospects for China. ASEAN looks like a relatively neutral zone in this whole geopolitical tussle. So I know EM always has a little bit of that tinge of volatility when things start to go south. But I would think that this time around, you have to pick your markets, but it does look a little bit more stable.
Which markets? I mean, you talk about how things can change. We've seen that happen in the Philippines, in Thailand, for instance.
Well, you look at Malaysia. The ringgit has been a big outperformer this year, right? It's up about 8% year to date. A lot of it is because growth is surprising on the upside. There is some momentum going on the electronics part. The Johor Singapore SEZ is gaining a lot of traction. So it does look like things are, at least generally moving in the right direction.
What do you do with China?
Well, for China, headline growth numbers don't tell the full story. They are likely to come in quite close to their full 5% target for this year, even though fourth quarter will slow down. It's always very uneven, right? The October numbers still suggest consumption is very weak. Businesses are a little bit worried about medium-term capex. There is still a lot of that anti-involution measures that will have to materialize. So the pressure is still on the downside as far as prices are concerned, right? But if you look at a 5-year plan, they're talking a lot about structural reform, especially on the medium term. So I think that's constructive. It's just that you're going to get a big bang bazooka type of stimulus plan that will spur, growth in the short term.
So it's just a matter of time before stimulus will trickle into the real economy.
I think what they're doing with respect to trying to improve private consumption and trying to basically stabilize the property market, those are really steps in the right direction. They may not show a very quick short-term payoff in what financial market players would like. But I think generally, if you look at it from a policy angle, these are the right moves. And anyway, the external demand conditions are not very favorable to China right now.
Anything you would be buying in China?
I think I am still a little bit hesitant for China for now, because if you look on the monetary policy side, the third quarter monetary policy statement suggests that they are not going to go for broad-based easing. So we have actually pushed out our interest rate cut to 2026 itself. So bonds also may be a little bit limited in terms of gains, right? Equities had a good run, okay? I think if you are a firm believer in some of the advanced manufacturing tech stories, you may be trying to look for potential winners in that space. But the whole high-tech industry, as we discussed earlier, is evolving so rapidly. It's hard to predict whether the winners of today is going to be the winners of the future.
And also Japan in focus, the BOJ in particular, expectations now really high for a move higher in December, perhaps even 2 moves in 2026. What are your own expectations? How might this play out in terms of the JPY?
Well, it's interesting that you asked that, because November has been what I would characterize as a whole round trip, right? Look at where U.S. equities went, look at where the bond yields are, whether it's in the U.S. Treasuries. And our base case has always been that the Fed would cut in December, and also the BOJ would hike in December. But market expectations obviously got swung left and right and center because of what happened with the government shutdown, the lack of data, and of course on the Japanese side because of the new leader and the whole China-Japan spat. So that caused some pullback in terms of the central bank expectations. But I do think they are on track to hike. Wage growth has been quite supportive, and I think generally price inflation is on track. So I don't really see any reason for them not to hike in December, and we do have one more hike penciled in for early 2026.
So for the whole of 2026, perhaps 2?
It's possible. It really has to depend on how the price momentum continues to play out. Obviously, we are coming to a case where people will look at the U.S. Treasuries yields and Japanese JGB yields and say the relative differential story and the monetary policy divergence story, is it going to come into sharper focus in 2026 itself? I know we haven't talked about the Fed chair changes, but it does look like the composition of the Fed is really going to lean towards the dovish side. I mean, you already have outright
Is likely to be Hassett?
Well, I think whoever it is going to be a dove for sure, right? We already have Miran calling for 50 basis point cuts. You have other doves like Bowman and Waller, etc. They have a clear majority, I think, for the FOMC members, the voting members. So I think it's a question of whether market is going to come around to the idea that the Fed may be at risk of cutting faster and steeper than what is already currently priced in.
So dollar yen could get to 153 perhaps? 154 thereabouts?
Well, I mean, we are in the year-end period where, traders are all starting to clear their leave. Liquidity is going to go down. So I wouldn't be surprised if we get, more volatile swings from here.
All right. Selena, thank you so much for your time. Selena Ling, OCBC. Still to come on Inside, we hear from Japan Exchange Group CEO Hiromi Yamaji on the rise of shareholder activism and what it means for Japanese markets. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back. You're watching Insight. Japan Exchange Group CEO Hiromi Yamaji says activist investors are not yet a dominant force in Japan, even as they push for more from corporate Japan. Speaking on a panel at FII Priority Asia in Tokyo, Yamaji discussed whether these investors affect the business.
As a market operator, we are quite neutral about those activists, or I call them engagement funds. Just because we need to have everybody in our market in order to keep the abundant liquidity. So we don't reject any specific kind of investor, or we don't show any favor to one specific type of investor, but we welcome everybody. But at the same time, I think there are a number of shareholders' proposals in our shareholders' meeting, and some of them this year, by the way, 114 companies received 399 shareholder proposals. This is just in June this year, and about 137 was from the so-called activists, and only 7 of them passed at the AGM. And probably market cap-wise at this moment, about 1% of the total entire market cap is owned by the activists. I think UK is about 2% of the entire market cap, and the US is 1.1%. So we are not so much, the engagement funds is not so dominant in Japan yet.
You expect more activism in 2026, and
well, yes and no. Some of them, yes. Some of the proposals from the activists are not so illogic or unreasonable. I think some of them are quite reasonable, and I think I'd like to encourage management to be direct to those engagement funds, to have a direct conversation with them.
And that was Japan Exchange Group CEO Hiromi Yamaji speaking on a panel at FII Priority Asia in Tokyo. Let's do a check on how Asian markets are doing ahead of that crucial JGB 10-year auction expected today. Today's auction is a big test for traders amid Governor Ueda's modestly hawkish comments. Also, Japan's finance ministry planning to increase its issuance of short-term bonds as well as treasury bills. In terms of the Nikkei futures, currently up by 0.3%, and dollar yen trading at 155.67. It is lower by a 0.1% versus the USD. Flip the page, take a look at where we are in terms of cryptocurrencies. They continue to trend downwards, a slump for Bitcoin, currently at 86,351. Some say keep a watch on the 80,000 level. Of course, some say it is a reflection of risk sentiment in the market. Crypto down and wiping out about $1 billion of leverage bets on Monday alone. Still to come. We'll unpack the impact of Airbus's ongoing challenges with one of the largest operators of the A320s, AirAsia's CEO, Tony Fernandez, will be joining us very shortly. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment. Soon it was past 1 gigawatt of capacity, helping anchor Indonesia's clean energy future.
Welcome back. You're watching Insight. Airbus stock fell the most since April after the plane maker revealed that inspections are needed for hundreds of its best-selling A320 jets. over potential flaws in the aircraft's body. The process risks complicating the company's effort to meet its delivery target and comes just days after Airbus was forced into its biggest ever recall, also involving the A320. For more, let's bring in Bloomberg Transport reporter Danny Lee. Danny, what do you make of this? First, the software glitch, then the fuselage. Really trouble after trouble.
Yeah, for Airbus, making one of the world's best-selling aircraft, this is not welcome news after dealing with one effective crisis over the weekend, the revelation of quality issues this time involving its best-selling jet. We don't necessarily know quite how many jets are affected. The statement from Airbus kind of indicated that this was something related to aircraft that were in production or had been handed over recently to customers. But we also don't know what kind of airlines are involved and are impacted. So we are still awaiting the details from that. But clearly, for Airbus, who is under great pressure to hit delivery targets of greater magnitude and to fulfill the levels of demand that airlines want to see jets handed over because of the huge demand in air travel, this is a blow given what is seen as being a very reliable supplier of aircraft.
What's been the reaction from airlines? Is it impacting sentiment, confidence in any way?
I think that kind of feeling remains to be seen, particularly as airlines who are Airbus is very sensitive to customer feedback, will be keeping that kind of conversation in private. We do know that Airbus has been having conversations with some of its top customers, including the likes of AirAsia over the weekend related to the software issue. But I'm sure any of those more harsh words that customers have with Airbus, even especially as this new revelation comes to light, they will try to keep in private. But I know airlines are probably not amused given that they've already seen a lot of delays on their new delivery of aircraft.
Bloomberg Transport reporter Danny Lee, thank you. And speaking of AirAsia, it is among the largest operators of the A320 with more than 200 in its fleet. Joining us now, CEO Tony Fernandes. Tony, we heard from Airbus, the software glitch, the fuselage issues. How are you responding to all of that? What's been your reaction to all of that?
We're, Airbus were great. They gave us heads up. Christian Scherer called me straight away. There was a little bit of confusion on the actual problem, but as soon as we got that message, our team did an incredible job, and we were able to sort out 96 aircraft in about 24 hours. So we had no operational major delays caused by this software glitch.
How about the fuselage issue? What's your own understanding?
We saw the notice. I don't think it's major. It's a few panels that they have to fix. It's on impending aircraft. Again, I don't see a major delay. We haven't been given any notification of any delays caused by it. So, what appeared to be a massive crisis, I think through good communication, good crisis management, we were able to avoid a major disaster.
So just to be sure, it will not impact upcoming delays, and it's not impacting, the aircraft that have been recently delivered to you?
No. No issue on the panels. In terms of the software, after getting the full information, it was mostly a software downgrade, which our team were able to do per aircraft about an hour and a half. And honestly, my team did an incredible job, and I'm sure many, many airlines did that as well. So no operational delays.
We've seen a host of issues to do with supply chains, with engines, and now issues to do with fuselage and software. Do these issues shake your confidence in Airbus in any way? How are you assessing the reliability of Airbus?
Well, look, I've been one of Airbus's first customers in Asia. We have an order book of delivered about 250 aircraft, and we have another 350 on order. We're very, very close to them. We feel that they produce excellent product. Obviously, supply chain issues have been a problem, especially engines. But I think we're over the worst of it. And I'm hoping by 2026, even in AirAsia's case, we had to bring back 230 planes. Our numbers have been crippled by the fact that we haven't had all our planes in operation, in spite of having a fantastic third quarter where we delivered 1 billion ringgit of EBITDA. I think fourth quarter, we will have all our planes back. We had our last issues with GE. And I think for most airlines, 2026 should be really the end of all these COVID issues and begin to see some stability in the supply chain as well.
As you said, you're among the biggest operators of the A320s. I mean, when it comes to the A320s, it is the most used aircraft. Help our viewers understand how rare are these hiccups that we're addressing right now?
I think it's the first time in my 20-odd years of AirAsia that we received a global notification such as this. I've never received a notice where all 6,000 aircraft had to be checked. So it was the first time. It is a good warning to Airbus and its supply chain operators to test things out properly. But it seemed a very odd one that solar radiation affected the software. It's kind of bizarre for me. But, I applaud Christian Scherer for calling me personally amongst many airlines. That gave us a good head start. And I think, I applaud OEMs that actually go on the front foot and work with airlines quickly. It's been one of my biggest issues during COVID that many OEMs weren't proactive enough in helping airlines during this very difficult period. But I remain very, very confident and optimistic of airline manufacturers, especially Airbus.
Why do you think we're seeing more and more manufacturing disclosures? Is it a case of perhaps the likes of Airbus are trying to produce as many planes as possible to meet the increasing demand from airlines?
Well, I mean, I think it's, there is a huge amount of orders per month versus what I started with. Airbus have ramped up its production tremendously. On top of that, technology is changing very fast. And in this case, software providers, missed out something. So I think it's a combination of increasing orders, trying to meet sustainability issues and make the aircraft more efficient, competition in the market, which is maybe putting a little bit of extra pressure. And so, I always say to all OEMs, take a step back and make sure that you can handle this ramp up. Make sure you test software properly. Don't rush out. So, we, outside of aviation, we had a massive problem with cybersecurity, like CrowdStrike releasing something which wasn't fully tested. So I think the pressures of quarterly results, sometimes the pressures of competition, probably the quality drops a little bit. So it's a good warning for everybody.
As you indicated, Tony, I mean, there was limited disruption, but I'm sure there's still a cost. Is there a cost to that disruption? And
of course.
Whose cost will that be, Tony?
Well, the biggest cost is to my health. Sitting at 10:30 and suddenly receiving a notification like that. So I'll be sending my yearly checkup to Airbus to pay for. It wasn't a major cost, to be honest, but a lot of time, a lot of effort. But it did show the amazing resilience of our airline, which I continue to tell everybody. We had a fantastic third quarter. Today, capital A, finally, my vision of capturing value outside of the airline has been encapsulated with a doubling of the share price. And so, there are enormous pressures. There's a little bit of cost, but really the major cost of COVID is now coming to an end. And I'm really optimistic about 26.
Any way of quantifying that minimal cost that you mentioned?
No, I don't. I honestly think it's negligible. Apart from a lot of man hours, it's not changing our numbers at all. No.
And Tony, to your knowledge, do you think any other aircraft might be impacted by this at all?
I've been through too much to say never. It's a good warning. Obviously, you've seen a lot of issues at Boeing. So I think all aircraft manufacturers have to really redouble their efforts. I've said it for a while, even with the OEMs like engines, customer service, customer satisfaction has to come ahead of short-term quarterly profits. I think most OEMs are recording record profits, but I throw caution to the wind that can turn very quickly if you don't maintain your quality and supply chain as well. So it's a good warning. It could have been much worse, and thank God it wasn't.
You express optimism for 2026. What kind of numbers are you anticipating? What's the demand that you're anticipating?
Yeah, well, demand is incredibly strong, and we're moving on to the next chapter of our growth, which is creating a hub and spoke airline. 10% of our customers fly and connect. We're looking at a new order book to bring in more aircraft, a smaller gauge that will enable us to create an even deeper network. ASEAN is very bullish. India is strong. China, Japan, Korea, and Australia. We started going westward into Kazakhstan, Uzbekistan, and now Turkey. So there's a huge appetite for travel. We're creating this new kind of hub and spoke product. So I see demand very strong. Our costs keep going down. We have a tailwind with oil and currencies. And so low fares means greater appetite for travel. And we're feeling good. We had a 23% EBITDA margin, which is remarkable if you think that we still had 15 of our planes on our ground. So demand remains strong. We can't get enough planes quick enough.
But the question really is, how strong is that demand? 20, 30, 40%? What's the number you're looking at?
Well, I can't declare that just yet, but demand is strong. I can't because we're a public company. But, we're growing again. We're adding 15 planes next year. Honestly, we could add 30 planes. So that gives you a sense that we believe we could grow 10 to 15% easily. So we'll have to wait and see, but demand is robust.
We know that you're talking to Airbus, Embraer, and COMAC. What's the status of those conversations? Are you any closer to making a decision of who you will go with for your additional aircraft?
Yeah, we're getting close. I think, these aircraft come with different engines. We have been a GE engine provider. I mean, COMAC is also the GE engine, but Embraer has a Pratt & Whitney. We have to make absolutely sure we're going to get the right cost structure, but more importantly that all the OEMs can deal with our very aggressive flying targets. And so we want to make absolutely sure that we give a fantastic low-cost product. So, we're months away as opposed to days away, but we're making good progress.
How much will engines be a factor in your final decision?
70%.
70%?
I mean, that's a percentage coming out of my head. But really, what I'm trying to say is, it's just the most important. It's the most important part of choosing this aircraft.
And Tony, as we inch ever closer to 2026, what's the biggest risk you think? I mean, we're seeing a lot of flashpoints around the world, uncertainties in terms of, trade relations. What's the biggest risk for your business?
Wow. Husband, I've been through every risk known to mankind. We've just come out of COVID. We've had trade wars. We've had oil spikes. We really can't predict what the latest risk is. But all I can say is AirAsia has been well tested. We have a very slick operation, judging by what we went through. We're going to have all our planes back. We're going to improve our customer service because we'll have more spare planes. Demand is strong. We'll take whatever risk that comes. But right now, where I'm sitting, 26 looks a lot better than it was. Even trade wars have probably been a little bit of an advantage for us because geopolitically, more people are flying in our part of the world and staying in our part of the world than moving to Europe or America. So that's probably been a benefit. If Ukraine and Russia solves this issue, then oil price and jet crack is going to come down. It will be a massive bonus. For me, as long as I can stimulate demand through low fares, and really our bread and butter is connecting cities and connecting routes that were never connected, then I think we have a fantastic 2026 coming up. You know, the most important thing
Tony,
is...
thanks so much for joining us today. Go ahead, Tony.
I was just going to say, it's fantastic looking at this outlook. You know, over the last 6 years, I don't think anyone gave us the time of day of surviving. Yet we've created a very strong airline, and more importantly, we've created 5 amazing companies in Capital A, where the value is now being seen. So we've risen from the dead, and we're looking forward to the future.
Tony Fernandes, we thank you so much for joining us out of Bangkok. Tony Fernandes, CEO of AirAsia. And, of course, we've been keeping an eye on that 10-year JGB auction. That saw pretty much stronger demand than its 12-month average. The bid-to-cover ratio was 3.59 versus 2.97 at the last auction. And the 12-month average is 3.2. Again, better than anticipated. Now, Taiwan's foreign minister says a bitter diplomatic dispute between China and Japan could stretch on for a year, even as Taipei hopes the two sides can find a way to ease tensions. Lin Xiaolong spoke exclusively to our chief North Asia correspondent, Stephen Angle.
It's not just a different policy change from the Japanese side, but for Beijing side, maybe take maybe a year to stabilize the situation.
And stay tuned for more from that exclusive interview with Taiwan's foreign minister in the next hour of Insight. Plus, the outlook just ahead. We get an outlook for travel next in an exclusive interview with Agoda's CEO. Much more ahead. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment.
Welcome back to Insight. Here's a look at Asian currencies. The strong dollar and rising prices are becoming a crucial factor for travelers. Agoda has revealed its 2026 travel outlook report, highlighting trends set to influence travel across Asia in the coming year. Travelers are looking beyond familiar hotspots to secondary cities in Asia. According to the report, the main reason they are exploring these places is lower costs. Our next guest runs Agoda, a digital travel platform with a global network of over 6 million holiday properties and more than 130,000 flight routes. The company has released its Travel Outlook 2026 report, highlighting industry trends and insights for the coming year. Joining us exclusively, Agoda CEO Omri Morgenstern. Omri, good to have you with us. So it seems like Forex is a major factor for travelers.
First, thank you for having me. And yes, I think price in local currency, general price is what I sometimes refer to as the ultimate enabler of travel. So we know from our report that about 40% of the travelers are planning to spend a little bit shy of 10% of the annual income on travel. So it's a big expense. And we know that they want to get as much as they can with their money. So we definitely see the movements of every dollar impacting travelers.
So when it comes to currencies, the Japanese yen is one to watch, Indian rupee. I mean, are you seeing, numbers growing exponentially for these markets? What are you seeing from your own report?
So it's very hard to differentiate sometimes the currency changes from other macroeconomics factors. Those tend to go hand in hand. But we're definitely seeing what we've seen in the past, that when the yen was weaker, then we've seen what looked like a more surge of traveling into Japan, etc. And as I mentioned before, we do see that when prices are cheaper, that stimulates, especially, we see it a lot with promos. Sometimes there are promos. Yes, please.
Omri, give me a second. We have just breaking news here. Speaking of currencies, the Indian rupee has fallen to a new record low of 89.7850 versus the USD. Again, the Indian rupee testing yet another record low, 89.7850 versus the USD. As we were saying, Omri, the currency does play a part in the Indian rupee again, testing a new low. Go ahead with your own thoughts.
So I don't want to say, but look, the underlying thing is that things fluctuate. And over time, I think travelers are definitely looking for opportunities. When the local currency is weak, I think it will mean the travelers are more susceptible to travel domestically. And they're definitely looking for opportunities when it's cheaper to go internationally and take that opportunity.
And of course, one trend that's developing is AI. Talk to us about perhaps one, bold AI trend that can be expected that is beyond people's imagination right now.
So I think, look, it's very hard not to look at an AI company demo without some travel example. Usually it's around trip planning. So I definitely think that you're seeing a lot of disruption in how we plan trips and put them together, itineraries, etc. But I think the broader story here is what we call the connected trip, which is at least the vision is to be able to give you the same experience of a travel agent that works for you, knows you very, very well, not only helps you put the trip together, but also is with you as you travel and takes care of anything that can go wrong. And I think we've been on that trajectory, by the way, before AI, but AI greatly expedited that process. And I think it's not far away before this type of experience that your own, call it travel concierge, will emerge, and you see it happening more and more on our platforms.
People talk about how AI could lead to a filter bubble where it suggests, mainstream places, not the unconventional ones. What's your take on that?
I actually think the opposite. I think AI, since the ability to personalize the travel trip, not only to your preference, but also to your budget, is much more available with AI. And at the same time, AI has much deeper knowledge of opportunities and places to go, way more than mainstream. I think the likelihood that you can match a traveler with a non-standard experience is actually increasing, not decreasing. So I actually see AI as an enabler of, sending travelers to more interesting exotic destinations that they would typically won't get to.
Omri, thank you so much for your time. Omri Morgenstern, CEO of Agoda. Still ahead on the show, Amundi Investment Institute's Guy Stier will be joining us to discuss the outlook for global markets and the AI trade. Plus, we'll hear exclusively from Taiwan's Foreign Minister Lin Qialong, with the island at the center of a heated diplomatic dispute between China and Japan. More to come in our next hour of Insight. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back. You're watching Insight. Taiwan's foreign minister says a bitter diplomatic dispute between China and Japan could stretch on for a year, even as Taipei hopes the two sides can find a way to ease tensions. Lin Qialong spoke exclusively to our Chief North Asia correspondent, Stephen Angle.
It's not just a different policy change. Through from the Japanese side, but for Beijing side, maybe take I think maybe a year to stabilize the situation.
And stay tuned for more from that exclusive interview with Taiwan's foreign minister later this hour on Insight. Meanwhile, we're tracking cautious trading across Asian markets today following a U.S. sell-off in what's been a shaky start to December. The Indian rupee touching a fresh record low against the USD, inching closer toward the 90 level. Also on the radar today, Japan's 10-year government bond auction saw stronger demand than its 12-month average. The bid-to-cover ratio was 3.59 versus 2.97 at the last auction. 12-month average is 3.2. And Bitcoin also stabilizing after touching lows of under $84,000 in the U.S. session, as almost $1 billion of leveraged crypto positions were liquidated. The biggest cryptocurrency is now down almost 30% since October. Let's get perspective with Guy Stier, Head of Developed Market Strategy at Amundi Investment Institute. Guy, good to have you with us. What do you make of the risk-off sentiment in the market kicking off December?
I think a lot of it is still a bit of similar to what we saw through November. So we had two waves in November of sort of profit-taking and position squaring. It's been a good year for U.S. equities in general. I mean, certainly a better year than we might have thought at the end of April. The market has really recovered since then. So I think there's still quite a lot of profits to be taken and people taking those profits at the moment. So part of it is seasonal. I think a second part of it is concern about two factors with AI. The first is what is the ultimate profitability of AI investments going to be? And secondly, and probably I think more importantly, how are those AI investments going to be funded? So I think that's going to be a continued theme over 2026. But if we obviously we've had a lot of pullbacks and recoveries. I think we're in a pullback phase right now, and we'll probably be in a recovery phase again before the end of the month.
So how will AI investment be funded? Are we looking at more issuances? What are you anticipating? How might this play out in the market?
I think the big question is, as you say, I think there's going to be a lot more bond issuance and debt issuance to fund CapEx in general over the course of 2026. At the beginning of the year, what we saw was that AI investments were really funded through free cash flow. And in some companies, that's still the case because free cash flow growth has been very strong. If you look at overall investment as a percentage of free cash flow, in the third quarter, it's not even back to where we were in 2015. So free cash flow is very strong, not just for AI companies, but for U.S. companies more broadly. But there are some companies, and I think this will be more and more the case, that free cash flow is not enough to fund their investments. So they're going to be needing to do more. I should say operating cash flow is not enough to fund their investments. They'll be needing to borrow more. So I think we're going to see more growth in investment grade, more growth in high yield. But investment grade credit could particularly grow more than we expect at the moment, or more than the market expects at the moment in 2026.
And guys, speaking of the bond market, we saw that global sell-off among G10 nations. All eyes were on the 10-year JGB auction. That came in better than anticipated. Might this, I guess, provide some support in the bond market?
Well, I think, yes, for government bonds, Japan has seen yields rise almost consistently over the course of 2025. I think there is a chance that there's a couple of factors here. I think there is a chance that we could see 10 years test 2% at some point in the not so distant future. So there's still expectations of more expansionary fiscal policy in training higher inflation. And we're looking for a couple of hikes as well from the Bank of Japan over the coming quarters. But we're getting to levels in terms of Japanese yields where for Japanese investors, it's becoming interesting to bring money back to Japan. So I think that this rise in Japanese yields will not continue ad infinitum. I think we're closer to the end of the rise in Japanese yields than we are certainly to the beginning.
So when might we see that repatriation, money coming back to Japan?
Well, I think it's probably, again, there's going to be some seasonal factors here, possibly before the end of the Japanese fiscal year. So we're really talking about the first quarter of next year. And again, part of it will be level driven. So I would really look for 2% on 10 years to be a level at which we really start to see a lot of repatriation domestic flows. But I think, although the mood is a little bit better at the moment, we probably will still have at least one more test to the upside in terms of Japanese yields.
And Guy, how about treasuries? I mean, we know that it's about the Fed moves. It's, I guess, fully priced in. We'll see that rate cut in December. The question is what happens in 2026? And I guess it also depends on who takes over from Jerome Powell. Polymarket has the bet on Hassett. What are your own, I guess, assumptions?
Well, I think that we need to separate two things there. I think, first of all, the U.S. economy is slowing down, and that does warrant at least another couple of rate cuts. As you say, we also think that the market will be cutting in December. We think there'll be another couple of cuts, most probably in the second quarter. So we may see a little bit of a pause in the first quarter, but that's another 75 basis points from where we are now seems warranted. However, it's quite possible that with the change of the administration of the Fed, we could see somebody coming in and a team coming in really, which wants to have even more aggressive rate cuts, which can take sort of key rates to or below the 3% level. And that's going to be good for treasuries in the sense that there can be a downward translation of the curve. But I think what we're really going to be seeing there is higher inflation expectations coming in. So we're probably going to see higher break-evens in the 10-year area. We're going to see a steeper curve between 2 years and 10 years, between 5 years and 30 years. So I think it's going to be more curve steepening trades, more anti-inflation trades that will dominate, even if the front end continues to see lower yields.
And we'll see a weaker dollar, won't we?
I think so. I mean, I think our view is in the first half of 2026, we probably will see a weaker dollar. We'll see it weaken certainly against the euro, but really across the board. The dollar will probably be weaker. But somewhere around the second half of the year, if we start to see growing investment, that's probably going to require that foreign investors put money into the U.S. So a lot of it in the second half of the year, I think the first half of the year will be determined by or dominated by monetary policy. And the second half of the year will be much more dominated by capital flows. So although we can see a dollar weakness at the beginning of the year, say first quarter, maybe second quarter, in the third and fourth quarter, we could very much see the dollar improve and recover.
Gold, of course, has taken the market by surprise in 2025. Do you see more upside for the yellow metal, especially on the back of expectations that could be a deal for Ukraine?
Well, I think that the real question about the dollar in the long term is, I think there's two. One is what's the view of global investors about the strength of the U.S. dollar and the ability to put money in the U.S. And if there's a little bit of concern about that, people will be looking for diversification trades. And I think the strength of the dollar, particularly in 2025, and maybe even in 2024, has really been about that. So this strength of the dollar, we think, can continue through 2026. It does seem likely to us that the dollar would test 5,000, probably early 2027. So there's still upside for the dollar over the next 12-month period.
What is the one factor that could derail your projections?
I think there are several, actually. I mean, I think that the one thing which could be very significant would be a real lack of confidence in terms of AI and a real lack of confidence in terms of the return on investment from AI and whether the technology ultimately pays off for the companies which are leading the race to develop it. If that were the case, we would see a much bigger pullback in terms of the U.S. equity market. We'd probably see declines of 15 to 20%. That would mean that there would be a flight to quality into fixed income. So U.S. 10-year yields would be down below 4%, and people wouldn't be too worried about the inflation implications. They'd be just more saying, I need to put my money in somewhere safe. We'd see a rally in terms of sovereign bonds across the globe, so it would be led by the U.S., but European sovereign bonds will be rallying, Japanese sovereign bonds too. And so I think that we do need to keep in mind that it is a question of confidence, and weakness would start in the equity markets, and you would see big moves in other markets as well.
Guy, hang tight. Guy Stier is staying with us still ahead this hour. Nvidia invests $2 billion in chip design software maker Synopsys as part of a broader engineering and design tie-up. We'll have details coming right up. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT
Crude oil getting some news actually. लग ही रहा था थोड़ा बहुत, आई होप थोड़ा बहुत क्वांटिटी ली होंगी, ली है तो ट्रेल करते रहो. अच्छा मूव आया है, सपोर्ट तो था. नेचुरल गैस भी साइडवेज ही हो गया, अब तो मोमेंटम मुश्किल है नेचुरल गैस में. ऑयल को देखते हैं अब ये क्या इस रेंज के बाहर निकलता है या फिर अब इसी रेंज में घूमता रहता है. ऊपर भी रेजिस्टेंस है, स्टिल देयर इज अ रेजिस्टेंस इन अबव साइड. नीड टू सी कि कितना और देर इसी रेंज के अंदर घूमता है प्राइस.
This is an investment, as you said, it's a multi-billion-dollar investment, but you're looking at around 2.6% of outstanding stock for Synopsys that Nvidia has just snapped up at around $415 a share. So to provide the context of what Synopsys does as well, so you've got companies like ARM, for instance, that's more on the chip IP side, but then you need the software to design that chip, also validate that chip or test that chip before it goes into production. And that's where Synopsys comes into the picture here. So essentially what is going to happen is that Synopsys is going to be integrating Nvidia software, namely GPUs, across its architecture essentially, or its software systems. And so the company is also saying, and you just heard both of those executives there, or Jensen Huang in particular, but they're going to also be looking at integrating or developing a new AI agent together, but also looking at joint marketing efforts as well. So yes, going back to that question around, are we looking at another circular deal from Nvidia's perspective? No, this is not tied to any sort of specific purchase agreements, and so that's why they're not saying it's circular in nature. He did also speak about what he hopes to achieve from this. Jensen Huang, you heard there just sort of that broader outline, but essentially it's about looking up or speeding the adoption of AI across a range of different industries.
And Bell, DeepSeek debuting 2 new AI models. What do we know about them?
Yeah, that's right. So this is a follow-on essentially from what we saw from the company back in September of this year. So at that point, China unveiled, or DeepSeek unveiled, what was called DeepSeek V3.2X, or what is essentially its experimental status. So that was back in September of this year. Now we've actually got 2 new versions of this AI model that have been brought into the market. So you've got the V3.2, and DeepSeek is saying that this is an agent, or a tool rather, a general purpose tool that has performance that's comparable to what you get from ChatGPT 5, so the latest iteration of OpenAI's offering. They're also saying that it has some agentic capabilities built into it, so that's more like human reasoning-like abilities, where it can, for instance, search websites, use calculators, execute on code. So that's one. The second model that it's also just brought to market is what's called the V3.2 Special. And this is a model that actually can look at more mathematical computations, other long-form thinking computations or capabilities. And this is about essentially pushing the inference of what's available to OpenAI or open source models, their limits, also just looking at the boundaries of what model capabilities can achieve as well. And they're saying that this V3.2 Special has performance that's similar to Google's latest from Gemini 3 Pro. So essentially what DeepSeek is saying here is that you've got 2 models that can beat, or they can match at least what's deemed to be the best on the market from the US. That's ChatGPT 5 and also Gemini 3 Pro. But they're, again, able to do more with less, because, as we know, DeepSeek is a lot less capitalized. It's got a lot less access, or really not access, to the most advanced chips on the market, and also far less human resources building up these efforts too.
And the competition intensifies, Bell. Thank you. Bloomberg Asia Tech correspondent Annabelle Jewell is there. Guy Steer from Amundi Investment Institute is back with us. Guy, what do you make of developments in DeepSeek? I mean, coming up with 2 new models, it could rival the best in the market. Again, we come back to the U.S. versus China AI capabilities.
Well, I think your colleague Bell really explained well what's going on in terms of the Chinese investment, in terms of DeepSeek's investment and development. And in a sense, I might say competition is really good because we're seeing a lot of different thrusts. But the question is it good for the valuation of U.S. equities, which I think is really the question we want to put our finger on. I think it's good for companies which are like Nvidia, which are part of the infrastructure, which people are going to need in terms of developing new models, in terms of using models, in terms of continuing to train models, because we think about a model being finished, but in fact, it's always going to need to be trained on new data. We're always going to continue to see data developing and things are going to change. And so the models will react in terms of the data and they'll need to continue to be refined over time. But what I would say is that the more sort of excitement we get, the more investment we're going to get, the more the continued theme of AI investment and seeing what AI can do is going to continue. And our view is that the big opportunities in terms of equity markets and in terms of investments are probably now beyond AI, but thinking more about what are the industries and the sectors which are going to be changed and improved by AI. So I think in 2026 and 2027, what we're really going to see is much more focus on things like robotics, drones, transport, biotechnology, which are sectors which can be radically changed by AI. And the question will be which business models and where are we able to develop businesses which will really take advantage of this new technology and really change. So I think that's something that we're working on, and I think a lot of other equity investors are thinking about in terms of their 2026 strategies.
The thing is, Guy, when you hear stories about developments made by DeepSeek, you tend to question the valuation of Nvidia. I mean, if one company, a Chinese company, can do things better and cheaper, then you wonder if the investment made by the likes of Nvidia is justified. What benchmarks, how are you assessing whether or not, the valuations for companies like Nvidia is sustainable or overstretched?
Well, I think there's 2 good points you bring in there. I mean, one is that the way you typically think about this is you look at what kind of profit are companies generating today and what kind of profit growth or even maintenance of profit are we looking for in the future. If you take Nvidia, in the Q3 figures, their operating margins were 62%, which is just incredible. But what you also see when you look at the semiconductor cycle over time is that a typical semiconductor cycle is about 2 years, 2 years of growth, and then we have a pullback. And we've been through 7-8 quarters of growth now. So there are cycles which have lasted longer, but we're really already at the point where we're at a median cycle in terms of the semiconductor industry. And Nvidia is a very special company, but that's really the way you should think about it in terms of the type of structure that it has. So we may see a pullback in terms of margins going forward, a sort of cyclical pullback in terms of margins. But from current levels, even if margins fall by half, we're still looking at a very profitable company, a very healthy company. So from a pure valuation standpoint, yes, it's definitely justifiable, these kind of valuations that we have, both in terms of margins and in terms of the growth that they've had historically and the growth that they will probably continue to have over the next 5 years. Having said all that, when you compare the multiples of U.S. companies to Chinese companies trade at multiples which are roughly half. So I think one strategy that every investor should be thinking about, equity investor should be thinking about, is diversification. With a concentration in the U.S. market, geographic diversification is tremendously important and will be in 2026.
How should investors think about their AI exposure in equities, in credit, in alternatives?
Well, I think more broadly, given the concentration levels, diversification is absolutely critical. And when we think about that, we're talking about geographic diversification, as much or maybe more than we're talking about sector diversification in terms of the US. And by geographic diversification, I would say there's two things to think about. The first is that emerging market equities had an excellent year in 2025, but they're coming off really a decade or more of disappointment. So they're still relatively cheap. Chinese tech is part of that, but it's more broad. Things like the Indian equity market, where valuations are attractive, where there's a lot of consumer demand, where there's good changes in terms of the government policy favoring equity investments and company profitability. This is part of a strategy in terms of equity. So diversification, where part of it is emerging markets, which we think are at the beginning of a multi-year improvement. Part of it is also Europe. European equities are cheap, particularly European small caps are cheap. They trade at cheap multiples relative to their history, relative to big caps in Europe, relative to the US, of course. And I think that Europe in particular is an area which is going to benefit from this second wave of seeing how AI will change industries. So that geographic diversification, I think, is really important in terms of portfolios in 2026.
When it comes to AI, it's also about regulation. I'm wondering if regulation will shape, the AI investment landscape, and if so, how do you see this playing out?
Well, I think, yes, certainly it depends. At the moment, we have a fairly libertarian freestyle approach to letting people develop AI. That may change in the future. I think one of the things that maybe in the medium term may become an issue is whether AI profits are taxed to actually support individuals. And that wouldn't just be in the US, it would be sort of across the globe. But I think we're probably not in the phase at the moment where regulation is a big driver in terms of thinking about the valuation of these companies. As you say, this may be a question for 2 or 3 years down the line. And certainly we need to keep an eye on how regulation is changing. But I think it's not the most important thing at the moment. As you say, it's really the barriers to entry. How high are the barriers to entry in this technology, and how special and profitable is the technology itself? Those are really the questions we need to understand as we make these investments.
Guy, great perspective there. Thank you so much for that. Guy Stier, Head of Developed Market Strategy at Amundi Investment Institute. Still to come, Taiwan's foreign minister warns that China and Japan's bitter dispute over the island may take a year to resolve. Our exclusive conversation with Lin Xiaolong is next. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back to Insight. Taiwan's foreign minister says the current dispute over the island between China and Japan could drag on for a year. Our Chief North Asia correspondent, Stephen Angle, has just spoken exclusively with Lin Xiaolong and joins us now from Taipei. What did we hear, Steve?
Yeah, obviously, it's a hot-button issue right now that's going into its second month now in December after Tachikawa-san, the Japanese prime minister, made those comments before lawmakers in Japan that essentially angered Beijing. Obviously, we've heard about the different boycotts of Japanese products and the Ministry of Foreign Affairs in Beijing and its very strident comments lashing out at Tachikawa's statement. So we did need to hear from Taiwan because they're the party that is at the center of her comments about basically a survival scenario for Japan. So essentially linking Japan's survival to Taiwan's survival, and that has obviously angered Beijing. Now, in a wide-ranging interview, we did talk about why essentially Taipei is kind of trying to dial back the tension and says, it's going to be about a year at least of frayed tension between Japan and Beijing.
So we have very good communication channels with the Japanese government. So we are trying to manage the situation to avoid it's become a situation out of control. So because...
So are you saying you're downplaying it? Because
yes.
the response so far from Lai Ching-te, the president, has
yes.
been fairly muted.
Yes. So we show our support through, I think, a soft approach, suggesting that our people to travel to Japan, also to eat Japanese food. So we want to help cool down the situation, because once the Chinese nationalist sentiments stimulated, it will very, to some extent, out of control. So I think for Beijing, it also not in its interest to escalate the conflict.
Do you believe, though, with Prime Minister Takaichi-san essentially linking Japan's security to Taiwan's security, does that indicate to you that Japan is willing to shoulder more of the security requirements, either diplomatically or militarily, in the East Asia?
Yes, indeed. I think we have to share the burdens in terms of defense capabilities, and also through diplomatic way to co-manage the situation in the Indo-Pacific. So it's I think the situation shows that we are coordinating with the United States in defending the status quo, trying to avoid the Chinese authoritarian expansionism in this region. So in the Indo-Pacific, we don't have a collective security arrangement such as the NATO. So we have to strengthen our bilateral cooperation, and even to bring all bilateral arrangement into a latest strategic framework.
Right. Well, this downplaying of the situation is in lockstep, I guess, with why Taipei was fairly pleased as well that Donald Trump or the White House did not mention Taiwan in the readout of the recent phone call between Xi Jinping and Donald Trump, where Beijing tried to make the case again for the post-World War II order, basically cedes Taiwan to the rightful leader of China, and that being, after 1949, being Beijing. Obviously, with Donald Trump not mentioning Taiwan, it takes it off the front burner, but at the same time, it does not allow Donald Trump a chance to reaffirm America's commitment to Taiwan. Do you question, under the Trump administration, their commitment to the defense and support of Taiwan?
We have no doubt on the Trump administration's commitment to the regional security in the Indo-Pacific, especially the first island chain. So I think it's a different kinds of strategic arrangement.
How is it different?
By asking the U.S. allies or to have this burden sharing in terms of defense budget, or to show our determination and resolve to defend ourselves. So for our side, President Lai Ching-te already adopted a series of policy to show our commitment for our self-defense strengthening. For example, the increase in defense budget and the extension of mandatory military service. Also, I think the whole society defense resilience. I think also the strengthening of asymmetrical warfare capability. So we have to try our best to show our determination and resolve in defense of Taiwan's democracy.
What are you communicating to Tokyo? Do you want them to back down to cool tensions or stand ground?
I think it's in everyone's interest to stabilize the current situation, because once Xi Jinping mobilize its society through nationalist sentiment, it's also not in Xi's interest, because the economic downturn and also the high the rising unemployment rate, and also the trade conflict with the United States. So I think it's not in everyone's interest to have the China-Japan disputes on the issues related to Taiwan to escalate.
So by not provoking Beijing, you feel, this is the way I'm reading it, you feel that this could die down sooner?
Yes, I think so.
How long?
Because I think Japan has already shown its willingness, because it's in the parliament, it's in the QA session. Yeah. So there are some backgrounds. Yeah, so it's not just a different policy change from the Japanese side, but for Beijing side, maybe take maybe a year to stabilize the situation. But for saving Xi Jinping's face, he has to do something to show his domination in the disputes.
So obviously there's a lot of diplomacy going on behind the scenes, which is quite limited for a region like Taiwan, essentially, because it only has diplomatic relations with 12 nations, 7 of which are in Central and South America. So they are leaning more on like-minded nations like Japan, South Korea, the United States, and also the European Union, in addition to the Philippines and India. And in fact, Minister Lin has been to Europe 3 times in the last several months. The Vice President, Xiaobi Kim, is in Europe. She just gave a speech to the European government for the first time for a Taiwan Vice President to give a speech there since 2002. So there are other diplomatic efforts underway to kind of get counsel on how to de-escalate and defuse this situation between China and Japan.
And a rare conversation there with Taiwan's Foreign Minister. Steve, thank you so much for that. Stephen Angle, our Chief North Asia Correspondent in Taipei. Let's get reaction from Beijing and bring in Victor Gao, Vice President at the Center for China and Globalization. Victor, we had Minister Lin saying that it'll take at least a year for relations between China and Japan to normalize, to ease. What's your take on that? Is he being too optimistic or not?
Thank you very much. What Prime Minister Takaichi of Japan did recently is very profound, because she was the first sitting Prime Minister of Japan to openly threaten war against another country, and in this case, threaten war against China. Now, what she did was tantamount to turn the table on the terms of the unconditional surrender of Japan that Japan entered into with China and other allied countries in 1945. That will be tantamount to overturn the table on the international order established in 1945. And China will never allow the remilitarization or the neo-fascism of Japan. China will never allow Japan to constitute another threat to China. Why? Because the Japanese imperialists caused 35 million people to be lost in the 14 years war against China between 1931 and 1945. And what Prime Minister Takaichi did is also tantamount to triggering the enemy state clause in the United Nations Charter. So you are talking about peace or war as a result of what Prime Minister Takaichi did. And for those Taiwanese separatists,
But Victor,
you don't. Yes.
But Victor, To be sure, Prime Minister Takaichi did not threaten war. What she did say was if Taiwan were attacked, Japan would take action. That was what she said. She did not threaten war.
If you listen very carefully, she was talking about removing the 3 restrictions on the nuclear weapons policy of Japan. That means there are forces in Japan who want to develop and deploy or eventually use nuclear warheads. Against whom? You need to think very carefully about it. There were people talking about sinking the Fujian aircraft carrier. There was a leader of the Naval Self-Defense Force of Japan talking about sinking all the surface naval ships of China within, let's say, 24 hours or 48 hours. And this is happening in a country which unconditionally surrendered in 1945, which undertook never to constitute a threat to a country like China. So let's be honest. We are faced with a moment of truth. We are faced with a moment where Japan needs to be stopped in this dangerous march into militarism or new Japanese.
It is quite apparent right now, Victor, that both sides want to stabilize the relationship. The question is, how do we get there? What might Japan do to stabilize its relationship with China right now?
Japan needs to cut off any relation with the Japanese fascism. When Japan unconditionally surrendered in 1945, Japan needs to openly, publicly acknowledge that Japan will honor the commitments it went into when it unconditionally surrendered to China and other allied countries. And Japan needs to undertake solemnly that it will never develop weapons of mass destruction, especially nuclear weapons. Because let me tell your audience, the moment Japan develops the nuclear weapon, that will be the moment of annihilation of Japan as a state. Because China and other peace-loving countries will never allow Japan to develop weapons of mass destruction. That means for Prime Minister Takaichi to threaten war against China is moving in the dangerous direction of destroying peace in this part of the world. And if they want to implicate the United States in this threatened war against China, let me tell all the Americans, remember Pearl Harbor. Don't allow Japan to betray its commitments it entered into when it unconditionally surrendered to China and the United States and other allied countries. We are facing with the moment of truth, and China will never relent any effort in stopping Japan in that move in the wrong direction of neo-Japanese fascism and turning the table on the verdict of the unconditional surrender of Japan to China in 1945.
I would just like to put it out there that it is a matter of interpretation of what Prime Minister Takaichi said. And you have your own interpretation, and some might say that there was no threat of war as far as she is concerned. I just want to take the conversation forward. In terms of the role of the U.S., how does China view the role of the U.S. in terms of the cross-strait relations between the two sides?
President Trump is very clear. President Trump does not want to be involved in overseas war, especially an extended war. And I think President Trump fully is aware that if war breaks out between China and the United States, it will be the beginning of the Third World War. And neither country can survive this Third World War unscathed. Therefore, if I have a piece of advice for President Trump, it will be, President Trump, embrace peace between China and the United States. Let's really believe in the inevitability of peace between China and the United States. And neither China nor the United States should be swayed one way or another into war against each other. And we should be opposed to any country or any region which want to bring either China or the United States into a state of war against each other, because war between China and the United States will be Armageddon for mankind. Therefore, I want to call on people like Prime Minister Takaichi, stop the dangerous move of trying to bring the United States into a war with China. And I want to tell every Taiwanese separatists, stop betraying your own country, and you can never achieve the independence or separatism of Taiwan. The Chinese reunification is the megatrend of our time,
Right.
and you will all live to see the reunification of China.
We saw President Trump make a phone call to President Xi Jinping before that phone call to Prime Minister Takaichi. How would you describe the relationship between President Trump and President Xi Jinping currently?
I think Wall Street Journal report tells the better truth. Between China and the United States, despite of all our differences, we have very good channels of communication. President Trump and Chinese President Xi Jinping, we have very reliable, very trustworthy channels of communication. And China and the United States, being the two largest economies in the world, two countries with tremendous amount of responsibility for world peace, can always decide that they need to embrace peace and they should not be tempted into war, either directly or by a third party, especially by Prime Minister Takaichi. Therefore, I have tremendous amount of trust and confidence in the quality of communication between the Chinese president and President Trump, and I don't think China and the United States will be tempted into war, and peace between China and the United States will forever preempt any country, any leader, especially Prime Minister Takaichi, from trying to use the United States for its own devious purpose of turning the table on the verdict of the Japanese unconditional surrender in 1945.
Victor, thank you for your perspective today. Victor Gao, Vice President at Center for China and Globalization. Plenty more ahead. Keep it here with us. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back. You're watching Insight. Hong Kong Chief Executive John Lee has announced that a judge will lead what he says will be an independent inquiry into the fire at a housing complex last week that killed at least 151 people.
I directed the effort to make a comprehensive and thorough investigation. Next step, in order to prevent the same kind of tragedy from happening, I think we need reform. I thought about partners we need to take forward the reform, and the partners I need would definitely be legislative councillors. They have all experienced the fight, they understand the pain, they will work with the government to implement the reform together.
Let's go to Hong Kong and our China correspondent Min Min Lo. Min, what are some of the key takeaways from John Lee's press briefing this morning?
I think definitely the fact that he is starting an independent inquiry to look into the cause of this fire and why it spread so rapidly. That is one important takeaway, because that was one of the 4 demands that people have been asking for in an online petition. And he also talked about the need for systematic reform, the need to look into whether or not there were transfer of benefits, conflicts of interest, bid rigging or corruption that is going on. He said that the government needs to look into whether the list of compliance safety materials are comprehensive enough, whether the inspections are effective, whether penalties are strong enough to deter wrongdoing. So a lot of changes that he says needs to happen, and that's why he says Hong Kong needs to move forward. He says that the government will not be delaying the upcoming legislative councillor election that is taking place this Sunday, and he said he needs the partnership of these legislative councillors to make the necessary changes to the rules. He also provided an update to the number of arrests, and so far the government has arrested 13 people, accusing them of manslaughter. These are consultants, subcontractors related to the scaffolding project. He also said that the Anti-Corruption Bureau has arrested 12 people on corruption-related charges.
Min, John Lee was asked whether he should step down. What did he say?
Yes, and this is really, showing you how political and sensitive this situation is, and the upcoming legislative councillor election is obviously going to be a test for his administration, right? Although it's not necessarily going to show up in the results because we are now under this electoral system imposed by Beijing under the so-called patriots-only system. John Lee was asked if he deserves to stay on as chief executive, but he did not really answer the question. He was also asked to confirm whether or not the National Security Police had arrested 3 people, including a district councillor, a volunteer, and someone who started a petition. Again, he didn't answer the question, but he was very strongly convicted in what he had to say about national security. Have a listen.
And I emphasize, I will not tolerate any crimes, particular crimes that exploit the tragedy that we are facing now. Societies, everybody in Hong Kong are uniting to help those who suffer to continue their living and face up to the future. Anybody who dares to sabotage this attempt, this commitment of society, we will do anything we can to ensure that justice will be done.
And you can hear from the tone of his voice, he was extremely convicted about that, warning against anyone trying to exploit this tragedy. And he actually switched to English when he said those lines instead of speaking in Cantonese, really marking how important this message is, not just to the domestic, but any international audience as well, Has.
Min Min Low, thank you so much for that. And before we go, here's a look at our guests for tomorrow. Bombay Stock Exchange CEO Sundaram Ramamurthy will be joining us exclusively to discuss India's red-hot IPO market and the outlook for stocks heading into 2026. Plus, SACE chair and former Italian foreign minister will be sharing his insights on investment and trade opportunities across Asia. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.